regime, Fordo, Natanz, and Esfahan. Everybody heard those names for years as they built this horribly destructive enterprise. Our objective was the destruction of Iran's nuclear enrichment capacity and a stop to the nuclear threat posed by the world's #1 state sponsor of terror. Tonight, I can report to the world that the strikes were a spectacular military success. Iran's key nuclear enrichment facilities have been completely and totally obliterated. Iran, the bully of the Middle East, must now make peace. If they do not, future attacks will be far greater and a lot easier.
The United States hit Iran's nuclear facilities with Tomahawk cruise missiles and bunker-buster bombs. Parikshit is here to tell us, to understand where the U.S. struck Iran and the significance of the three sites that were attacked.
Let's try to understand where the United States has struck Iran and why. U.S. forces have struck Iran's nuclear sites in Natanz, Isfahan and Fordo. 135 U.S. military aircraft and a submarine were used in this exercise, along with B-2 bombers. Natanz now is an underground facility under 25 feet of concrete, 300 kilometers from Tehran. Isfahan has Iran's largest nuclear research facility, 443 kilometers from Tehran. Trump says all three Iranian nuclear sites have been completely obliterated. But why did the United States strike Fordo? Now, Fordo was the key reason for the U.S. to join Israel's war. This was constructed between 2006 and 2009. Fordo is Iran's deep underground nuclear facility with over 2,000 centrifuges, located 250 to 300 feet deep inside a mountain. It is 30 kilometers from the city of Qom and 95 kilometers southwest of Tehran. This is the critical one now. Fordo is Iran's main nuclear enrichment location, which is enriching uranium to almost 60% purity. Reports have actually said that Iran has achieved nuclear weapons-grade uranium enrichment of 85% at Fordo. Most importantly, Israel could not have attacked Fordo on its own, as it does not have the bombs and the missiles which can penetrate and destroy a facility 300 feet under a mountain. So how did the US strike Iran's nuclear sites? They fired 30 Tomahawk cruise missiles at Natanz and Isfahan and dropped 6 to 7 bunker-buster bombs from B-2 stealth bombers. Why did the US use massive ordnance penetration bombs? The United States dropped 30,000-pound bunker-buster bombs on Fordo. 6 to 7 bombs were dropped successively in quick succession to drill the Fordo nuclear site. This was aimed at destroying the nuclear facility 300 feet below the ground in the mountain. This was the first time that the GBU-57, or this massive ordnance penetration bomb, was used by the US military. Only the US government and the US military have these bunker buster bombs. In terms of impact on Fordo, Iranian Atomic Energy Agency said attack was a barbaric violation of international law. The extent of damage is unclear. Iranian state media has reported that Natanz, Isfahan and Fordo were actually evacuated a while ago and there is no significant damage, while the US and Israel say there has been a lot of damage to Iran's nuclear capabilities.
Well, thank you so much for those details, Parikshit. Meanwhile, Iran has said that it has the right to respond to the attacks. The Iranian parliament has voted for the closure of the Strait of Hormuz. However, the final decision is from Iranian Supreme Leader Ayatollah Khamenei is awaited. If the strait is closed, it will choke 20 to 25% of the world's oil and 30% of global LNG trade. Let's listen in to Steve Leisman explaining the impact of US strike on Iran on the prices of oil, the economy and inflation.
This action, the military action in Iran, and it's just going to add uncertainty and possible additional inflation to a U.S. economy, worrying about hefty measures of both already from tariffs. Well, the good news comes in so far limited market reaction, as Brian was explaining. But those same uncertainty and inflation concerns, depending on how long they last, what kind of retaliation we see, if any, are likely to further stay the hand of the Fed, which had been waiting for the haze of tariffs to lift before doing anything with policy. In general, an oil price shock can have a similar stagflationary impact as tariffs, raising prices and reducing growth. According to a 2015 study by the Dallas Fed, $10 on the price of oil, a barrel of oil, can reduce U.S. GDP by 0.1 to 0.2 percentage points. And according to the IMF, that increase would come with a 0.1 to 0.3 increase in inflation. Ben Amos from FedWatch Advisors, writing before markets open, said it is now more questionable whether markets will continue to treat Iran as an isolated incident with solely a temporary effect on oil prices. Long-term rates may price in a reacceleration of inflation. We'll have to wait and see. Here are some oil price shocks we've seen. 1979, the Iranian Revolution up 166%, 128% for the Gulf War, a big jump for the Russian-Ukraine War, and the Arab Spring up 24%. But since 1991, I cannot find an oil event that moves meaningfully into core inflation measures, which exclude food and energy and is closely watched by the Fed. Why? Well, there are some offsets to an oil price shock. As Brian has explained 100,000 times on television, a huge domestic production means we're less affected than we have been in the past. A limited impact from temporary spike that just washes away. And oil can act as oil price can act as a tax, exerting downward pressure on demand. Let's check here. One good sign, probabilities for Fed rate cuts largely unchanged at this hour. The chance of a rate cut for both September and December around 70%. As Brian mentioned, Fed Governor Waller provided some optimism of possible July rate cuts in a CNBC interview on Friday. Now, markets have to listen closely to congressional testimony this week by Fed Chair Powell over 2 days. He had been more concerned than Waller about tariff impacts that could extend to worries about an oil price shock.
Well, Steve Leisman there explaining the complete impact of US's attack on Iran. The United Nations Security Council held an emergency meeting at the behest of the Iranian government after the US struck the country's nuclear sites. The UN Secretary General said that we must act immediately and decisively to halt the fighting and return to serious, sustained negotiations on the Iran nuclear program.
We must act immediately and decisively to halt the fighting and return to serious, sustained negotiations on the Iran nuclear program. We need a credible, comprehensive and verifiable solution, one that restores trust, including with full access to inspectors of the IAEA as the United Nations technical authority in this field. The Non-Proliferation Treaty is a cornerstone of international peace and security. Iran must fully respect it.
Following U.S. strikes on Iran's nuclear enrichment facilities, U.S. Vice President J.D. Vance talks about President Trump's decision-making process and how Iran responds.
No, we're not at war with Iran. We're at war with Iran's nuclear program, and I think the president took decisive action to destroy that program last night. We have to give an incredible amount of gratitude to the troops who did an amazing thing last night. Think about this, John. They flew thousands of miles away, a 30-hour nonstop flight. They never touched down on the ground, and they dropped a 30,000-pound bomb on a target about the size of a washing machine. No military in the world has the training, the skills, and the equipment to do what these guys did last night. I know the president and I are both very proud of them. But we know that we set the Iranian nuclear program back substantially last night. Whether it's years or beyond that, we know it's going to be a very long time before Iran can even build a nuclear weapon if they want to. But I actually think that raises the most important question. The president talked about this last night. We want Iran to give up their nuclear weapons program peacefully. But there is no way that the United States is going to let Iran have a nuclear weapon. And so they really have to choose a pathway. Are they going to go down the path of continued war, of funding terrorism, of seeking a nuclear weapon? Or are they going to work with us to give up nuclear weapons permanently? If they're willing to choose the smart path, they're certainly going to find a willing partner in the United States to dismantle that nuclear weapons program. But if they decide they're going to attack our troops, if they decide they're going to continue to try to build a nuclear weapon, then we are going to respond to that with overwhelming force.
Let us now listen in to David Zervos, the chief market strategist at Jefferies, to get his views on the U.S. stock futures on the back of U.S. entering the Israel-Iran war.
I think it's a response that most people would think is much, much smaller than many would have forecast given the weekend's actions. So I think you have to sort of step back and ask yourself a little bit about what are the scenarios the market is pricing. There's the obvious scenario that I think has been discussed here and is being discussed by many, that is an escalation and risks, and we're going to go down this sort of very difficult path. But there is another scenario, which is this is a beginning to an end of a period where we had an isolated Iran, we had all the sanctions, we had all the risks and difficulties, and there could be a solution.
Well, we also spoke to senior fellow of Tilotoma Foundation, Wael Awad, who is also a senior journalist, and here is what he had to say on the developing geopolitical situation.
If you wanted to talk of international law, this is an absolute violation of international law and the Geneva Convention, which prohibits any country to attack the nuclear site of another country for any reason. So therefore, if there was a peaceful solution to this crisis, we should have continued with the peaceful solution. I think the damage has been done. I remember when I was in Afghanistan, when the Americans used the B-52 and we saw the earth shaking. I know the amount of damage that they have caused. I covered the war there. So I think there will be some time to know the extension of the damage the US have done to the Iranian nuclear site. The whole of the Gulf is going to be conquered by the United States and the West, because once you take on Iran, then you will be able to have control on the Strait of Hormuz, the Red Sea, the Mediterranean Sea, the Suez Canal. So if that is the aim and the objective, I think we all saw from day one when Israel attacked Iran, it was a regime change policy. The whole attack was carried out by United States, by France, by Germany, by UK, and by Israel. It wasn't carried out by only Israel. Remember, this is the actual covert operation they have been planning. Even the United States press have been indicating that this attack on the Iranian nuclear site was planned a year ago.
Well, let's slip into a very short break. Up next, we tell you how these overnight cues impact our own Indian market. Don't go anywhere. Welcome back. You're watching Power Breakfast on CNBC-TV18. We now have our research team joining in with how the trade setup looks like and the stocks that are likely to be in the news. First up, Vinny is joining us to get us all the market cues we need to watch out for in today's trading session. Vinny, we're not off to a great start today.
Absolutely not off to a great start as of now is what we're seeing coming in for the Indian markets. But just a quick look at what happened last week as well as on Friday. Now, Friday also the Nifty actually for the first time after a very long time, 6 sessions, managed to see about the 25,000 mark, 25,000. 100 mark. So that was interesting. We saw mid and small cap see gains of around 1% as well on Friday, and bank also was performing well, 1.2% uptick around that level. So overall, Friday was a good trading session. Week-wise also, Nifty, the benchmark indices managed to do well. Underperformance came in the mid and small cap. Now, obviously, FIIs, we saw those adjustments coming in. So FIIs were buy coming in on Friday as well, 7,940 crores. Buying coming in from FII, while DIIs were sellers in Friday's trading session. Now, obviously, given what happened over the weekend, and like you're mentioning, we're not, off to a good start as of now, given US attacks on Iran that have dampened the sentiment across the globe as well. Brent crude prices, they did go around that $80 per barrel mark. Then they've come off a bit. But, that is an important one to watch out for, because a lot of stocks will be in focus on the back of that as well. Oil stocks continue to be remaining in focus, and other stocks in the Indian market as well that we'll keep an eye out on. IT, let's keep an eye out on that. Accenture reported their numbers. Revenue was a beat. Some bit of a commentary was muted. So it will be interesting to see where IT is headed. The mid-cap IT could do well. Asian markets have opened up in the red. We are seeing US futures that have seen a decline as well, and Nifty implied open is indicating a negative start for the Indian market. So important to watch out for in terms of the updates that are coming in on the global front, as well as commentary that comes in from the US as well as across the globe.
IT, oil, there is a lot to cover. Vinny, thanks a lot for that. Over to Upasna now, who will list out the stocks that you need to keep an eye out for today. Upasna, good morning.
Good morning. First up, let me start with Granules India. US FDA issues Form 483 with one observation for company's API unit in Hyderabad. Next up is HCL. Companies become a successful bidder for manufacturing of small satellite launch vehicle developed by ISRO. Next up is BEL. The company has secured additional orders worth 585 crores since 5th of June 2025. Sai Life Sciences will also be focus on the back of a block deal. TPG Asia sells 10% stake in the company for 1,505 crores. Lloyds Metal and Energy also in focus as the company successfully commissions two of its key strategic projects in Maharashtra. LT Foods is the next one on our radar as US Department of Commerce imposes highest possible countervailing duty at the rate of 340.7% on company's subsidiary, that is EcoPure's export of organic soybean meal to US. NLC India will also be in focus as company's wholly owned subsidiary, that is NLC Renewable, has received LOA from Tamil Nadu Green Energy Corporation for development of 3 standalone battery energy storage system projects. Next up is Zen Technologies. Company announces a strategic acquisition of majority stake in TSI Aerospace Private Limited. And lastly, EMS Limited also on our radar as company has said that it's the lowest bidder, has acquired L1 status awarded by UP Jal Nigam Urban Limited, and the estimated order value is around 104 crores. So all in all these stocks will be on our radar today.
Lots of stocks to watch out for, Upasna. Thank you so much for that. And finally, we now have Mangalam joining in with cues from the F&O space. Good morning, Mangalam.
Good morning. So if you look at Friday and if you look at Monday, it's a sea change in terms of sentiment. So Friday was a very good day of trade. You had both the Nifty and the Sensex do extremely well. And all the heavyweights of the index, be it the banks, be it the IT index, or be it Reliance, all of them were top contributors. And IT and Reliance will be in focus today on account of what took place geopolitically. So you have, the IT pack on account of Accenture's numbers and Reliance on account of what's taking place in oil. So those will be a couple of factors we'll be watching out for. The FIs, they bought about 7,900 crores in cash on Friday, and the DIs sold about 3,000 crores. But remember, the FI volumes were higher on account of the semi-annual Sensex as well as the FTSE rebalancing flows. The FIs bought about 118 crores in index futures, longs inched slightly higher from 22% to 24%. But the GIFT Nifty, now that's indicating a 100-point downtick at start. And here's where the kicker is. Remember, the FIs on Friday sold nearly 22,000 crore worth options. Where were those options sold? All of them index puts. 1.7 lakh short index puts added, telling you that the street hopes for a support or a bounce from lower levels. What are those lower levels? 25,000 put, fairly active, premium of 100 rupees. 24,900 put, equally active, premium of 80 rupees. So the street expects between 24,800 and 24,900 to see a strong bout of buying and support. On the way up, however, 25,350 to 25,370 could be a bit of a supply zone. First port of call on the way up will be the Nifty June 11th high, the pre-crisis high of 25,222. And at the lower level, we'll be watching out for important support coming in at the 20-day moving average for both the Nifty as well as the Nifty Bank. Importantly, watch out for CDSL, Hudco and Manappuram. All of them in expiry week are out of F&O ban.
Important there. Interesting stocks out of the F&O band. Mangalam, thanks a lot for that. Take a short break. Up next, all the important cues from the commodities market as a result of all the weekend action. Stay tuned.
Welcome back. You're watching Power Breakfast on CNBC TV18. We now have Manisha Gupta joining in with all the updates from the commodity space. Good morning, Manisha. All eyes on crude price.
Oh, well, absolutely. When you look at safe haven buying, that's all happening in the crude oil prices right now, up 2.5% right now at one point in time as a knee-jerk reaction after the markets opened over the weekend. We did see prices gain up by 5.5% to almost $81 a barrel. Even now at these current prices, we are trading at a 5-month highs. The markets are looking at, some sense of response from Iran. And we haven't seen that coming in. And that's the reason you've seen easing coming in on prices. In any case, globally, a lot of experts that I'm talking to tell me that this fallout will be contained. We will not see Strait of Hormuz get shut. There have been statements, there have been threats on that, but that hasn't really happened because there are way too many countries and a major chunk of nearly 20% of the global oil that flows out of that area is concerned. So we perhaps may not see that. Is the reason you have seen the crude oil prices quite contained. We are still trading below 80. We actually haven't seen any buying come in for gold prices either. And when you look at the sell-off in equity markets globally, that also is not so intense. So that tells you perhaps the worst may not happen.
The worst may not happen. That's what the street would be hoping for. Manisha, thanks a lot for that. We call time on this edition of Power Breakfast from Amakshimi and the team that put this show together. Thank you so much for watching. Bazaar Morning Call sets you up for the day's trade.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Surabhi. Guys, morning.
Hi, good morning. Who would have thought that Sunday morning will get so exciting, right? Just wake up to all kinds of news, and I think the markets are still digesting the impact, bracing for impact, whichever way you want to call it.
Well, that's right. And, you know, over the last few days, markets were speculating that something like this will take place. And that's what happened on Saturday night as well. So I think now the bad news is here. We'll have to deal with it.
You know, I remember on Friday we were debating this point, right? That he's a deal maker. Nigel and I were saying that he's a deal man. He'll do a deal. He'll do a deal. He proves most people wrong. He was certainly proven wrong.
And that editor's the playbook, that program, it was actually
it was a good debate
before it happened. So lots to talk about. But you know, I'll start with. You know, it's almost as if the dog which did not bark, right? I mean, to use that famous analogy, and you know what I'm talking about is the markets. Look at what the markets are doing or they're not doing, right? I mean, the reaction actually is pretty muted across the board. You look at what's happening with oil, you look at what's happening with US futures, you look at what's happening in Asia, and of course, I mean, you know, so many people were sending these images of the Israeli market, which was higher, you know, Middle Eastern markets which trade on Sunday, which were higher as well. So, I mean, and I think that's proved to be largely on the ball. Markets are worried, but are they panicking? Are they throwing a tantrum? Absolutely not. And I think we should just look at the GIFT Nifty straight up as well, which will give you a sense of what we are doing. And it'll give you, I think it's a 100-point cut the last I checked. The point is, okay, 35-point cut is what we have. So which is nothing, right? Implied open is 125 lower. Yeah, okay. So it's like a regular start. And that's essentially what I'm going to take off from. So just to kind of sort of rewind the clock back and take you through the highlights. So early Sunday morning, that is yesterday morning, US conducted airstrikes on 3 Iranian nuclear sites. And, you know, unless you've got your head buried under the sand, I mean, you pretty much know what's happened, right? The big question, the big unknown in that sense is, was the US strike successful? Because these were nuclear strikes. The stated objective is to hamper Iran's nuclear capabilities so that they're not able to make a bomb. Was the US strike successful? That's the big question, because if the answer to that is yes, you know, everything changes. If the answer to that is no, everything changes again. So we don't know. Now, the US, of course, claims that Iran's nuclear capabilities are destroyed. And President Trump, I think, has put out a tweet again this morning, essentially saying that obliterated is the right word, because, I mean, and he's kind of sort of pointing to how they were absolutely on target, etc. But independent verification of the extent of the damage to these nuclear sites remains unavailable, at least right now. You also had Iran's Atomic Energy Organization, which is insisting that its national industry, it's referring to its nuclear industry, will persist. There are also concerns about one particular tranche, 400 kilos of 60% enriched uranium that Iran reported to the UN in terms of where this cache of uranium is, which is enriched up to the level of 60%. For a bomb, you need you know, much higher levels. The IAEA head essentially believes that, and he said that this material has been moved by Iran before the strike, so it's not been really damaged. So this, I think, is this will determine, because it's important, because how will we know whether this is ended now? This is the only phase and this is ended, and, you know, we'll move on, even in terms of military strikes. And that's the off-ramp. If we are able to get determination from independent outside agencies or, you know, IEA, etc., that the nuclear capabilities have actually been completely hampered and they're in no position to conduct these enrichment, etc., then that's the off-ramp. Otherwise, I mean, you basically are in a bit of a state of indecision. Russia and China have condemned the strikes against Iran, but importantly have not offered any military support. So that is the other thing to watch. Strait of Hormuz, right? I mean, when this started a week and a half back, we put out that piece. Risk of closure, of course, is high. Iran's parliament is backing closing the Strait of Hormuz. But the actual decision, the power lies with Iran's National Security Council. In that sense, no decision has been taken. U.S. has called on China. The Secretary of State, Marco Rubio, has called on China. China is the largest buyer of Iranian oil in Asia to prevent Iran from closing the Strait of Hormuz. So, I mean, we'll see how this one goes. But broadly, if you think about this, I mean, and we put this out back then as well, closing the strait hurts, Iran's sort of closest economic partner, which is China. It hurts Iran because oil is the biggest source of foreign exchange. And it, of course, hurts other Gulf countries, which are Iran's neighbors, because a lot of their oil passes through this narrow strait as well. So we'll see if there is disruption. But, I mean, I would imagine if there is any disruption, I mean, there are U.S. aircraft carriers and there are, enough sort of war machinery around to ensure that the closure is not for long. It's temporary disruption in that sense. Just to tie in the levels here, the Nifty, of course, rallied sharply on Friday. The last hour was pretty spectacular. So 300 points higher. There was that MSCI rebal here in India. There was also the MSCI World expiry, which happened. And I think a lot of the last hour action was related to that. But anyway, we went past the high of 24,982. We also, took out some important near-term levels. The resistance now stands at 25,222, about 100 points away from where we left off on Friday. Support stands at the 20-hourly average, which is 24,863. For the Nifty Bank, we broke above 56,067, which is the recent high. We reached the 61.8% retracement of the shortfall we had, which is 56,324. We left off almost exactly at 56,324 on Friday. Support here for the Nifty stands at 55,846, which is again the 20-hourly moving average, simple moving average. So lots to track here in terms of geopolitics, markets. But as I began by saying, I mean, the market reaction is pretty muted and is quite telling as well. Surabhi.
You know, folks, I was just looking at a BBC report talking about protests around the world against the U.S. strikes. Not that it's ever stopped Mr. Trump, but from Athens to Paris to Tokyo to the Philippines to here, in India and parts of West Bengal to, multiple places to, of course, New York. Lots of protests against the American action, but then the action goes on regardless. Let's take a look at what Asian markets are doing. Like Prashant mentioned, there's no shock and awe kind of a reaction coming through. Markets are down between 0.5% to 1%. It could have been any day. That's what we have right now. And crude, after spiking to over $79 to the barrel, has actually climbed down from the initial spike itself. Last I checked, it was 78 plus, 78.52 thereabouts. So what was a over 3% spike has now cooled off to just about 2%. So markets being very measured in their reaction, at least for now. US futures are down between 0.4% to 0.5%. Again, it could have been any given day. The critical question that markets are asking is that, is this it? Is this over? Can we now move on? There's no clear answer, but here's what we know. The Iranian ambassador to the UN had an emergency meeting yesterday. He said that the US is waging a war against, quote-unquote, fabricated and absurd pretext, said that Iran reserves the right to defend itself against blatant US aggression. Now, all eyes on Iran to see what shape and form their retaliation, if any, will take. Of course, Trump himself has gone on social media, even acknowledging the possibility of regime change. He goes on to say, and I quote, that it's not politically correct to use the term regime change, but if the current Iranian regime is unable to make Iran great again, why wouldn't there be a regime change? So we don't know if it's over. The rhetoric is still very, very high. The U.S. Defense Secretary, Pete Hegseth, said that any retaliation by Iran, of course, would be met with force far greater, quote-unquote, far greater than what has been witnessed. So we don't know whether this is indeed it. But that's the big question for the markets. The markets want to believe this is it and no further. Let's talk about the flows. Because of the index adjustment and a couple of the block trades that happened, we've got a big FII net buying number coming in, almost 8,000 crores of net buying on Friday. And that's what had powered the indices. And the Nifty itself had come back to the top of the trading range, which was around 25,100. Domestic institutions were on the sell side, sold off cash stocks worth about 3,000 crores. Let's see how that plays out today. Now, aside of all the geopolitics and the global headlines, I'll watch out for the IT space because A, it's anyway, perceived safe haven. And B, we have a mixed sort of outlook from Accenture coming in. The results, the quoted results for Q3 were actually slightly better than estimates. They've also increased the guidance. Increase as in narrowed the guidance by increasing the lower band of the guidance from 5 to 7%. Now they're talking about 6 to 7% growth. That's good. But then the bookings have been fairly soft and they continue to be sort of lackluster. And let's see, the commentary is still a little cautious, but overall better than estimates is what we have on Accenture. So let's watch for IT. Small finance banks are going to be more about that because the RBI regulations have come in. They have reduced the priority sector, lending mandate from what was 75% earlier to, in effect, 60% now. So there's more cushion and more flexibility for small finance banks. So let's watch for these stocks. And finally, there's, if you go by it, the devil is always in the detail. There's a silver lining in the macro data that we got on Friday. The 8 core sector data otherwise is at 9-month low. The growth is barely anything, 0.7%. But within that, look at steel, look at cement. Month on month, the growth is very, very strong. Steel production 6.7% versus 4.4%. Cement production at 9.2%. And this is despite the fact that we're just getting into the monsoon period. So pre-monsoon, steel, cement looking good. I'll watch out for these stocks as well. Nigel.
Well, just a word on that core sector data. Last year, we had a general election. So that growth has come on a lower base. But nonetheless, it's a decent number coming in both for the steel as well as the cement industry. But in Friday's trading session, it was a rather good one. And it came on very, very large volumes. 2 factors played out. One was the volumes were much higher. That's the gross volumes were higher because of the FTSE rejig that we saw. And that's why institutional participation was much higher. And there were signs of short covering both on the futures as well as on the options data. Let's get a little bit into further detail on that front itself. The FI action, if you look at it, on index futures, they added pretty much longs as well as shorts on index futures. However, on stock futures, you saw there was a bit of a short covering bounce that played out because there was big covering out here and there was long addition as well. So that's telling you there was a swing factor of close to around 77,000 contracts on the stock futures side of things. So that was a bit of a short covering bounce that played out on stock futures itself. The positioning as of now, the FIs continue to remain net short with close to around 76% of their positions on the short side itself. But I was telling you that even in the option side, there was a bit of a short covering bounce that played out because those call writers were getting very, very confident. They were forced to cover. The 24,800 call, that's been seeing a lot of open interest build up. Big unwinding is what we saw out there. So those called writers, they had to cover their positions. The 24,900 put, though, continue to see some addition, which is telling you the 24,800 mark, that's a crucial level that you're looking at just in the near term. Which brings us to the levels that we're looking at. The 20 DMA, by the end of today, you'll want to see both the Nifty and the Nifty Bank end as close as possible to around this 20 DMA. For the Nifty, you won't want it to break it because the next reference point is another 2% cut from here on, which is the 50 DMA, both on the Nifty as well as on the Nifty Bank. So we'll keep an eye out on both those two levels. So the Nifty Bank will have to play a role today. Yet again, it'll have to bounce back and it'll have to fight for the bulls because that, in fact, could be the pocket that holds strong today. Stocks that I'm looking at, a few stocks have come out of the F&O band, so I'll keep an eye out on all these 3 names. And Reliance Industries, that's an index by itself, right? Even in Friday's trading session, it was rock solid. The last 6 months, actually, it's been an outperformer. Over the last 1 year, it's been a relative underperformer. But that's the one that I'll be tracking. Reliance Industries and the Nifty Bank, both those two could hold up for the bulls.
All right, Nigel, thanks very much for that. So that's essentially the overview that we are looking at the market with. Matt Orton is Chief Market Strategist at Raymond James Investment. We also have William Lee, Chief Economist and Executive Director at the Milken Institute, who's with us. Gentlemen, great to have both of you here. Thank you very much. Prashant this side. William, if I can start with you, a quick word on the developments over the weekend. Of course, market reaction is pretty muted, as I began by saying. Across the board, oil's up 2%. Equity markets, not very much. Neither here nor there. So kind of sort of moving on. But markets will wait for how Iran responds. In a counterintuitive way, since markets are not responding in an aggressive way, William, do you think if Iran's response is actually a weakish, symbolic kind of response, there is a downside for oil from here?
Well, you have to remember that the amount of oil that Iran produces is potentially at the 3 million barrels per day level. But because of sanctions and the war that's been going on, the latest reports are that its exports have been down to about 150,000 barrels per day. That's about the same production as we have in the state of Montana. So the impact on the oil market has already been felt. And yet you see that oil prices are only about $78, which is where it was back last January. I think the Iranian reaction that's where the huge amount of uncertainty is. I'm sure that there'll be Iranian proxies and sleeper groups that are being activated, and acts of terrorism around the world will be something that everyone will be watching out for. But in terms of how that affects markets, that is not something that I think can be systematically priced into markets. It's a global act of terrorism, potentially aimed at the United States more than elsewhere, but certainly aimed at U.S. allies as well. And I think the markets right now have such a diffuse level of uncertainty over so many possibilities that markets really aren't reacting right now. But I think the cloud of uncertainty certainly is much broader now than it was before the strike occurred.
No, absolutely. Point taken. Matt, same question to you. If this does not escalate and the response from Iran is small, even this $15 surge that we've seen in oil, it'll disappear pretty fast because there is spare oil capacity. And my question is there actually, in a counterintuitive way, if you think about it, more downside rather than upside from here?
Yeah, good morning, Prashant. It's always great to join. And I would agree. I've been telling clients over the weekend and writing a note that, it really depends on how Iran reacts. But right now, the probability of one of the left tail scenarios is still fairly low. Iran's very constrained with respect to its options. The reaction to whatever Iran does is going to be quite negative if it does take some of those more left tail scenarios. And so while this is not a market I would be chasing higher, I would be looking for signs of a de-escalation in the coming weeks. And I think you do have the potential to see oil prices come down if there's any more certainty. I also think that there's the potential for the dollar to continue to weaken, even despite its strength, once we get a little bit more certainty or maybe a little bit more visibility through the policy fog that we have right now. So I just don't see, at least based on what we know today, based on the reaction that's more likely to come from Iran, I still think that the macro fundamentals that are underpinning the rally that we've had globally speaking still remain in place. And I would be biased to use weakness opportunistically, especially as investors who are looking to broaden, get more diversification, and potentially find ways or investments that they haven't been able to lean into yet so far.
Interesting to hear that, Matt. Let me go back to Willem for a question. Willem, would you concur with that view? Because the market, at least this morning, seems to be thinking that in that sense, it'll still remain limited. No one's expecting a very big reaction out of Iran. And I think from the market's perspective, as long as the Strait of Hormuz is open, yes. I mean, I wouldn't say it's business as usual, but business goes on. So, how would you gauge the situation right now from that perspective?
That's the absolute key. If the Strait of Hormuz remains open and Iran is not able to muster the military action it takes to close the strait, then I think it'll be business as usual because as I said, the Iranian supply of oil on the market is really trivial. But the key is Strait of Hormuz, where 20% of the world's oil supply goes through. And that will be a real game changer if that does get closed. But from what people tell me, the military actions required to do that are significant enough. And given that the U.S. has sent several aircraft carriers and military ships there, if they were to mine the straits, I think the mines could be cleared relatively quickly. So the kind of uncertainty that of real spikes in uncertainty are pretty limited. And, the kind of buy the dip strategy that has worked so well, I think will probably continue to work in this situation because it looks like the fighting will be fairly contained, barring these unusual kind of radical terrorist attacks all over the world.
Good morning, gentlemen. Good to see you all in. Matt, you have been using opportunities like this to buy the dip, right? And I recall you were quite bullish on this travel, leisure kind of space. IndiGlobe is one stock that you like to make my trip as well. Would you be using this dip to buy into these names?
Yeah, Nigel, it'll be interesting to see as we head into another quarter end, how results may have been impacted by some of the tragedies over the past 2 weeks or so. I'm still biased to use downside opportunistically because heading into these disruptions, the fundamentals were incredibly strong. The bookings on Make My Trip looked very, very attractive. The fact that Interglobe continued to buy ahead of the number of fleets and jets that we were looking for and anticipating, all of that's very, very bullish. And their expansion, not only domestically within India, but outside of India, has tailwinds, and that's something that doesn't get disrupted because of a tragic event. So while the humanitarian side of what's happened over the past few weeks might put a hold or might make people want to wait a little bit for a trip, I still think the more pervasive long-term demands of a growing middle class, those secular growth drivers that I've talked about, really wanting to lean into, I think those still remain firmly in place. And I am a buyer, especially if we do start to get some increasingly good news. So I'm paying attention to a lot of just real-time data, travel statistics, all of that, to really help guide when to make additions to those names.
No, I think points taken. So, the other thing is, again, there were all these on news channels I was seeing World War III and this and that and all that, right? I mean, whether this is going to trigger this and that. Actually, if you think about it, if anything, this actually... so those who were opposed to the US, there was a lot of uncertainty, right? Whether US under Trump is going to do something or not, whether they will actually use its force, whether it's not going to, or they're going to keep talking. I mean, that famous...
Imagine the trick. I'll decide in 2 weeks' time.
2 weeks, right? So it almost became...
24 hours later, the bombers were there.
Yeah, but there is a reason for that, by the way. But anyway, that's not... My point is that now with these use of all these bombers and these, the 30,000-pound bunker busters, which had never been used before, I think it's a very decisive message to those who are that US will bring about and bring to bear its considerable power on Iran and elsewhere if needed. So actually, if anything, this kind of presages the end of what people are calling as funny, but people are using World War III like so easily, right? I mean, a third World War is starting or whatever. I would argue in the opposite sense that there is certainty now that US, there's no doubt that US, the most powerful country in the world, is going to use its force decisively if required to end it.
If it wherever it feels it's warranted. Yeah. I'm just reminded of a term that we had in social studies class way back. I don't even remember. It's been so many decades back. Yeah. Remember the word hegemony?
Yeah, of course.
The use is back. I think this is exactly what we're seeing.
Yeah, no, absolutely. William, of course, is still with us. William, I don't know if you have any thoughts on that. It's a larger question. It's not related to financial markets. Maybe it is. But I don't know how you think about this. William.
The whole notion of geopolitical risk now, I think, has been shifted. The notion that the U.S. is the most powerful country in the world and is willing to use its military might when the just cause is there and a clear danger is there, I think shifts the balance of power somewhat. U.S. has asked China and Russia to intervene and do something, and has been asking this for so long. And I think it's shown that their political clout, as mighty as we thought it was, they're not willing to use it, whereas the U.S. is willing to use it to help its allies. And I think that's a big shift that the political scientists and financial analysts have to take into account.
Okay, fair enough. Okay, Matt, let's talk markets. What's to be done? We don't know. It's from MAGA, it's gone to MEGA, make Iran great again. We don't know what's next. From a market perspective, what should one be doing? Buying what kind of markets? Risk assets, dollar? Just give us, what you do, say, over the next couple of weeks.
Yeah, first and foremost, keep calm and carry on. This is not the time to be panicking in the market. What we're seeing here is it's just another brick in the wall of worry that the market has continued to be able to climb, at least based on how events have turned out so far. This is what investors need. We need some sort of uncertainty so that a lot of the bears continue to come in, have a narrative that the bulls can finally continue to keep climbing. And I think as we get into the next 2 weeks or so, we're going to be moving into earnings season. And so there's no reason for investors to do anything right now, unless you have idiosyncratic factors that happen, like we just talked about with Make My Trip, Interglobe, within specific parts of the market. There's no need for investors to be aggressive. Wait for the market to come to you. If there's more of a sell-off based on this hyperbole around World War III, which I think is greatly overstated, that's a great opportunity because the underlying macro fundamentals still remain in place for this market. And so what I like right now is strengthen some of these durable growth themes like artificial intelligence, or at least tangential plays to artificial intelligence, leaning into growing parts of the market that have continued to deliver strong fundamentals. So within India, for example, which remains a great complement to global portfolios. And you're seeing that with these rebalancing, money continues to keep moving into India as its markets remain strong. Look for some of these long-term durable winners like an M&M. We've talked about that quite a lot, but the company has done so well because management are masterful execution, and they have a number of models that are just being released that have a lot of strong demand for them. And the company has a number of growth gems along the side that can further support the underlying fundamental business of autos and farm equipment. So there's a lot of companies like that across the market. And when there is downside in the market, like we had a couple of months ago, that's the time to be opportunistic and add your position going forward.
There are some flashes at the bottom of the screen. This is, I think, coming in from there was news that the UN's. Let me just quickly get this. The United Nations Security Council, the UNSC, is holding an emergency meeting at the behest of the Iranian government after US has struck Iran's nuclear sites. UN Secretary General has said we must act immediately, decisively to halt the fighting and return to serious, sustained negotiations in the Iran nuclear program. So, I think there is a soundbite we can maybe play it out, right? Let's just play it out.
We must act immediately and decisively to halt the fighting and return to serious, sustained negotiations on the Iran nuclear program. We need a credible, comprehensive and verifiable solution, one that restores trust, including with full access to inspectors of the IAEA as the United Nations technical authority in this field. The Non-Proliferation Treaty is a cornerstone of international peace and security. Iran must fully respect it.
Okay, well, that's the UN, but like in most cases, sort of comments after the fact. But William and Matt, thank you very much for joining us. Great speaking with both of you here on CNBC-TV18. It's a pleasure as we track these developments, and we'll sort of come back to you over the next couple of days. Let me just quickly run you through the interactions which are lined up here over the next 2.5 hours or so. 8:35, you'll hear from Prakash Diwan in about 10 minutes' time, and we'll talk stocks. 9 o'clock, you'll have Richard Ridoglia of Matrix Global Oil Prices, right? I mean, I think almost about 80 now. 9:20, Pankaj Murarka will come in on markets. Prashant Khemka, White Oak Capital, will also be with us to talk about markets at about 9:30. Gargi Chaudhary of BlackRock will be speaking with us about global macros. That's at about 9:40. We'll have Ajay Kaval of Jana Small Finance Bank joining us at 9:50 to talk to us about RBI easing priority sector lending norms for small finance banks. And towards the end of the program, it's the Economy Latha in Conversation with Saugata Bhattacharya, Senior Fellow at the Center for Policy Research, Delhi, on the state of the Indian economy under changing geopolitical circumstances.
Well, time to slip into a short break, but we've got a lot of stock-specific action to track for you on the other side. We'll get to that in just a bit in our special Top 10 segment. For the time being, I run you through the list. We're looking at IT stocks, small finance banks, Bharat Electronics, Godrej Properties, and oil and gas-related names as well will be on our radar. On the flip side, we have Dr. Lal Patlab, Metropolis, LT Foods, OMCs, and paint stocks that will be reacting to negative news flow. Take that break, come back, we get into further detail on all of these names.
Welcome back. So the news is the market reaction is very, very measured to, the events that have transpired since the last 24 hours. Taiwan's actually the one that's falling the most. Otherwise, most markets are down about 0.5%. Hang Seng's down even lesser than that. Japan's down about 0.5% as well. The implied open was telling us that we could start lower by about 100 points, 120 points. Let's see if that's still the picture. Yeah, been 120 points. Now it's about 103 points. Of course, there are individual stocks as well that we have to keep on our radar. So let's go to our team to look at the CNBC-TV18 list of top stocks to watch this Monday morning. Guys, hi to all of you. Vinny, let's start with IT, usually a safe haven in times of, risk off. Plus, there's Accenture. So tell us more.
So in terms of Accenture that have come in, revenue that met the guidance, they saw a growth of around 7% on a year-on-year basis. Other than that guidance, 6 to 7% now is the guidance. Previous guidance was 5 to 7%. So lower end of the guidance is what they've increased. Organic growth guidance of 3 to 4% as well. So that is nearing that pre-COVID long-term average. So these are certain positives that have come in for the company. Overall, the Q4 guidance for next quarter, which they've given, is also 1 to 5%, reflecting some bit of a headwind that they could expect to see coming in terms of the federal contracts. That is what they've highlighted. Deal wins have been good as well. Bookings, a bit of a mutedness is where we saw muted performances where we saw coming in from the company. So that was a bit of a negative. But read through that comes in for IT companies. Like I was saying, federal contracts, that's a headwind coming in. For Indian IT companies, they do not have much exposure, limited exposure. So not much of a worry that comes in here. AI momentum, that is continuing for Accenture. So that is expected to do well for Indian IT companies. We are also seeing a pace in terms of pickup in pace for generative AI as well as bookings on that terms as well. Financial services, they have remained strong for Accenture. So the read-through for Indian companies turns out to be positive. Margins, a 10 basis point expansion is what we're seeing. But analysts are expecting that margins maybe for Indian IT company could remain muted. Overall, the read-through that comes in is for especially mid-cap IT companies. We could expect to see a positive move coming in, maybe open up in the red given that this geopolitical scenario that are coming in. But otherwise, from the red, it's expected to move to the green. And for mid-cap IT, we're expecting positive signs.
All right, thanks a lot for that, Vinny. Well, let's hop across to Vamakshi. She's here to tell us about some of the small finance banks. Vamak, morning.
Morning, Nigel. A lot of these small finance banks will be in focus today with the likes of AU Small Finance Bank, Ujjivan, Equitas. All of these counters are expected to open higher, and that is because there has been an RBI circular, and effective FY26, the additional component, which was at 35% of priority sector lending, is now reduced to 20%. Therefore, the overall PSL requirements now stand reduced to 60% from 75% earlier. This essentially means that SFBs will now have to allocate a lower portion of their lending to specific sectors of the economy, and brokerages appear to be quite positive regarding this development. Morgan Stanley says that this is a structural positive as it will give small finance bank greater flexibility in terms of portfolio diversification as well as operational yields. They also add that they will also likely improve their potential growth run rate over the long term. As far as Citi is concerned, they believe MFI segment was leveraged to achieve PSL targets and sub-targets, and SFBs with relatively more diversified portfolio can now scale up their non-PSL portfolio. So bodes well, expect all of these stocks to do well.
Okay, well, thank you very much, Vamakshi, for that. Let's talk about Dr. Lal Path Labs and Metropolis as well. Ekta has got those. Ekta, morning.
Morning. Well, the news with regards to diagnostics is that Amazon India has launched an at-home diagnostic service allowing users to book tests through their Amazon app. Now, what Amazon has said is that the reason for this is that it really completes Amazon's healthcare trio in India, which is launching the launch of the Amazon Pharmacy 3 years ago and Amazon Clinic around 6 months ago. So Amazon has partnered with Orange Health and they will be offering these services in 6 major cities and will be available across 450 plus PIN codes, operating daily from 6 a.m. to 9 p.m. I did have a word with the Amazon management and they did mention that as of now, the tie-up is only limited to Orange Health and they will not be an aggregator for many more diagnostic labs to come through, at least in the near term. So that's the reason why I think, a couple of these diagnostic companies could be under pressure today.
Okay, Ekta, we'll watch out for them. Keep them on the radar. Thanks very much for that. A couple of other stocks are in the headlines as well this morning. Let's go across to Ria to look at that list. Ria, morning.
Morning, Surbhi. First, taking a look at BEL. Positive news flow for this one. They've secured orders worth rupees 585 crores since the 5th of June. And these orders are largely related to fire control and sighting systems for missiles, as well as communication equipment and jammers as well. Remember, the total order book of the company is in excess of rupees 71,000 crores. And the company is also expecting order inflows of about rupees 27,000 crores in FY26. And this is X of the QRSAM order that they're expecting this year as well. Moving on to Godrej Properties, this one expected to open in the green as well. They've registered sales of about rupees 2,000 crores for their Bangalore project. They've sold about over 1,450 homes with over 2.2 million square feet of area. This is in the first phase of the project, the Godrej MSR City project, which has a total potential of 5.6 million square feet. So it still has significant unlaunched inventory remaining to be sold. On the flip side, LT Foods expected to open in the red today. The US DOC, which is the Department of Commerce, has imposed the highest countervailing duty of 340.27% on exports of soya bean meal by EcoPure, which is an arm of the company. And the duty has been applied for the period from January 1, 2023 to December of 2023.
Okay, all right. Thanks a lot for that, Ria. Well, let's hop across to Manisha. She's here to tell us about the big story over the weekend. Crude oil prices spiking. It'll have its implications on various stocks as well. Morning, Manisha.
Morning, Nigel. Thank you for that. Well, yes, the knee-jerk reaction, as everybody expected, was 5.5% on the higher side, where we did see the crude oil prices go to $81 a barrel as soon as the markets opened post the weekend. But currently, we are just trading about 2% on the higher side. We are near Jan 2025 highs. But no immediate response from Iran has led to slight easing in prices. Well, the markets have been dealing with threats and markets have been dealing with expectations on what could go further, and that perhaps is already baked into the prices. Oil prices have already climbed 10% since Israel launched its attack on Iran a week ago, and both US and Brent have remained below $80 a barrel. So 80 at this point in time does look like a resistance, while of course there are various worst-case scenarios on if there is an impact on Iran production, if there is a closure of Strait of Hormuz, if there is a regime change in Iran. So there are a lot of ifs that the markets are working with, but until they actually see that playing out, there's a tough chance that the crude oil prices will cross above 80 and stay above those levels. We already have a $10 off a war premium baked up into the prices. From here on, you'll need to see way more in sense of those threats played out for the crude prices to gain up.
Okay, all right, Manisha, thank you very much for that. Well, let's quickly recap our list of stocks to watch this morning. The ones that have positive news flow around them would be IT names, small finance banks, BEL, Godrej Properties, and of course oil and gas stocks, while stocks with negative news flow would be Dr. Lal PathLabs, Metropolis Healthcare, LT Foods, oil marketing companies, and paint stocks. We'll take a quick break on that note, come back on the other side, and we'll have Prakash Diwan join in with some fundamental stock analysis.
Welcome back. Well, the United States yesterday struck Iran's nuclear facilities with cruise missiles and bunker buster bombs. Parikshit is here to help us out understand where US struck Iran and the significance of these three sites. Parikshit.
Let's try to understand where the United States has struck Iran and why. US forces have struck Iran's nuclear sites in Natanz, Isfahan and Fordo. 135 US military aircraft and a submarine were used in this exercise along with B-2 bombers. Natanz now is an underground facility under 25 feet of concrete, 300 kilometers from Tehran. Isfahan has Iran's largest nuclear research facility, 443 kilometers from Tehran. Trump says all three Iranian nuclear sites have been completely obliterated. But why did the United States strike Fordo? Now, Fordo was the key reason for the US to join Israel's war. This was constructed between 2006 and 2009. Fordo is Iran's deep underground nuclear facility with over 2,000 centrifuges located 250 to 300 feet deep inside a mountain. It is 30 kilometers from the city of Qom and 95 kilometers southwest of Tehran. This is the critical one now. Fordo is Iran's main nuclear enrichment location, which is enriching uranium to almost 60% purity. Reports have actually said that Iran has achieved nuclear weapons-grade uranium enrichment of 85% at Fordo. Most importantly, Israel could not have attacked Fordo on its own, as it does not have the bombs and the missiles which can penetrate and destroy a facility 300 feet under a mountain. So how did the US strike Iran's nuclear sites? They fired 30 Tomahawk cruise missiles at Natanz and Isfahan and dropped 6 to 7 bunker buster bombs from B-2 stealth bombers. Why did the US use massive ordnance penetration bombs? The United States dropped 30,000-pound bunker buster bombs on Fordo. 6 to 7 bombs were dropped successfully in quick succession to drill the Fordo nuclear site. This was aimed at destroying the nuclear facility 300 feet below the ground in the mountain. This was the first time that the GBU-57 or this massive ordnance penetration bomb was used by the US military. Only the US government and the US military have these bunker buster bombs. In terms of impact on Fordo, Iranian Atomic Energy Agency said attack was a barbaric violation of international law. The extent of damage is unclear. Iranian state media has reported that Natanz, Isfahan and Fordo were actually evacuated a while ago and there is no significant damage, while the US and Israel say there has been a lot of damage to Iran's nuclear capabilities.
All right, that's Parikshit putting it in neat context for us. Now, following US strikes on Iran's nuclear enrichment facilities, US Vice President J.D. Vance talks about President Trump's decision-making process and what Iran stands to lose further if indeed it decides to retaliate. Take a look.
No, we're not at war with Iran. We're at war with Iran's nuclear program, and I think the president took decisive action to destroy that program last night. We have to give an incredible amount of gratitude to the troops who did an amazing thing last night. Think about this, John. They flew thousands of miles away, a 30-hour nonstop flight. They never touched down on the ground, and they dropped a 30,000-pound bomb on a target about the size of a washing machine. No military in the world has the training, the skills, and the equipment to do what these guys did last night. I know the president and I are both very proud of them. But we know that we set the Iranian nuclear program back substantially last night. Whether it's years or beyond that, we know it's going to be a very long time before Iran can even build a nuclear weapon if they want to. But I actually think that raises the most important question. The president talked about this last night. We want Iran to give up their nuclear weapons program peacefully. But there is no way that the United States is going to let Iran have a nuclear weapon. And so they really have to choose a pathway. Are they going to go down the path of continued war, of funding terrorism, of seeking a nuclear weapon? Or are they going to work with us to give up nuclear weapons permanently? If they're willing to choose the smart path, they're certainly going to find a willing partner in the United States to dismantle that nuclear weapons program. But if they decide they're going to attack our troops, if they decide they're going to continue to try to build a nuclear weapon, then we are going to respond to that with overwhelming force.
All right, well, let's get in Prakash Diwan, a market expert who joins in on the show. Good morning, Prakash. Prakash, we're going to be in for a rough morning, it seems. But times like these, present a great shopping opportunity. Will you be buying anything this morning, or will you be waiting on the sidelines?
Good morning, Nigel. No, I do agree. These opportunities do at times give you entry levels into certain teams, certain names. But the way things are panning out, it seems a bit uncertain in terms of what kind of level of retaliation you could anticipate, what kind of response you'll anticipate from Iran, and it might make sense to kind of figure out whether this is going to be a bit of a prolonged conflict or whether this is going to be just a flash and it will probably disappear. But very clearly, crude is where things could kind of look down. And this also kind of starts shifting focus on renewables, on certain other areas which provide alternatives. So I would believe, yes, defense stocks, for instance, will start kind of getting their mojo back. There will be a lot of scramble for those names. But I would want to kind of see things ease out, to be fair, before making any kind of before jumping into this. But yes, defense is the play. Renewables is going to be another area to look at, but not in a hurry necessary today to do something in terms of shopping.
Okay. Well, Prakash, I'm mourning. Let's see what happens, because I mean, the way Asian markets are reacting, or even, what we're getting in the implied open, it may not be total mayhem, not that kind of a session. So we'll see. Let's also analyze some of the news here closer home. The relaxation that the small finance banks, for instance, they've got. Priority sector lending, no longer 75%, now it's just 60%. Is this an area of interest to you? Jana, Equitas, Small Finance Bank, AU. You like any of the stocks?
Good morning, Surbi. So I think it's in continuation of what RBI started off some time back and kind of wanting to also strengthen this pillar of the banking or the credit markets. And from that perspective, this is a very important breather for most of the small finance banks to kind of come off, all the lows that they had. So you will see a lot of activity around that. But some of them will also need to kind of internally strengthen their processes and systems to be able to leverage on this opportunity, this advantage which has been announced. So it's not going to be so easy. But what it does, it makes the entire credit sector very encouraging from a long-term investing perspective. And I would still stick to the smaller banks, not necessarily jump to the small finance banks. But if you had to look at something, AU is probably one of the best places to take advantage of that. It's probably not a small bank as categorized, but you'll probably see advantages coming through for most of them, but it will take some time.
Got that. What we're going to do is take a quick break here, Prakash. A bunch of other questions coming your way, but let's do that. 10 minutes to go for the pre-open session. We'll get you some trading ideas as well in a bit. Stay with us. Okay, welcome back. 8 minutes to go for the pre-open session. Let's get Sudarshan and Sukani and Mitesh Thakur into the conversation in terms of how they'd like you to trade things. Gentlemen, good morning. Great to have both of you here. Mitesh, what's your sense this morning? A 100-point cut. We had a 300-point surge, especially last hour was quite consequential, but there was an MSCI rebel, etc. This morning, how's it set up and what's the thing to do?
Morning, Prashant. I think, with this move which happened on Friday, we were close to the highs of the Nifty, which was around 25 to 20. I think once we take that out, there will be more upside. But looking at the opening, I think we might just be, looking at a range of 24,900 to about 25 to 20. And therefore, in case we get a 100-point kind of a cut and we get closer to about 24,900 post that, that will be the time when I would want to go long. A lot of stocks are showing positive bias and the index pattern is also not very negative. So around 24,950, 930 is the buying zone with a stop just below 24,880 or so. And on the upside, as I said, 25 to 20 is the level which needs to be taken out. So you try to take some profits as you get closer to that level. And in case there's a breakout, then you add the positions back or take fresh positions.
Got it. Okay. All right. Thanks for that, Mitesh. Sudarshan, what about you?
Yeah, good morning. Well, this market has made a breakout the second time on Friday, and that also with a large, long expansion day. I would expect this to be suggestive that we are willing to go higher. Today is a dip, therefore. If my thesis is correct, then today is not a decline, the beginning of a decline. It's a dip. We could have had this decline dip today even without the news because we had a big run up on Friday. So this is a buying opportunity. The only question is one of tactics. How do you buy? You don't buy at the open. Wait patiently. A dip towards 24,900 would, of course, be an ideal opportunity. Then your stops would be 24,800, just a tight 100-point stop loss. So try to look for a buying opportunity on a shallow or large dip.
Got it. Okay. All right. What about individual stocks? Sudarshan, you go first.
Okay, Trent is a buy with a stop under 58.36. Naukri, InfoEdge is a buying opportunity with a stop under 14.78. Ipca Labs is a buy with a stop under 13.55. These are all mid caps. And finally, that large cap Reliance is a buying opportunity with a stop under 14.34. If Reliance has a gap down, and it could easily have, that's a buy.
Mitesh, what about you?
I have 2 sells and 2 buys. Jubilant Food is a buy once it crosses Friday's high of 698, 698.5. Keep a stop at 684, look for targets of 730. ONGC is a buy with a stop at 246 for targets of 262 and a sell on Gas Authority with a stop at 185.5 for targets of 174. And Indian Bank is a sell with a stop at 626 for targets of 595.
All right, we'll take a quick break here. Gentlemen, thank you very much, both of you, for joining us. We'll be back in just a bit and we look at the pre-open rates. We'll also have Richard Redoglia of Matrix Global, is oil market veteran, to talk about what the oil market is doing or not doing. I mean, it's a 2% jump, but given the events over the weekend, some would say it's a little underwhelming. What's the oil market telling us? Coming up.
Welcome back. 17 minutes to go before the action kicks off today. And once again, let's just pull up the implied open because 100 points lower is what it told us last. Most Asian markets are range-bound, declines between 0.5% to 1%. US futures down about less than 0.5% right now. So it's very measured. That's the short point. Let's then go on and discuss some more important themes and ideas and stocks. Prakash, we had the Accenture numbers come through. Now, the third quarter print itself is ahead of estimates, though, of course, they're a little cautious. But they've also, increased the lower end of the guidance a little bit.
Yeah.
What's your sense? IT in this market environment, would you allocate anything here?
So, interestingly, the kind of valuations that have come about after IT lost its sheen and kind of, sector rotation has ignored most of the larger names. There's been some activity in the mid-sized names and some positives. But if you really look at every time this happens and things start kind of looking up in the underlying business opportunities, the large cap IT comes back with the bang. And my sense is Infosys is the one that you would probably look at doing, given its geographical spread. TCS is still embedded into a lot of businesses, which will take some time to kind of, start looking up. But I know Infosys is much more nimble-footed in that sense to take advantage of any kind of green shoot that it would see in order booking. So if TCVs were to start rallying a bit, given the currency the way it is, I believe Infosys is the one that you should look at. Yes, I would allocate some money to IT names, especially these large names, as I said. But it's going to be over a period of time. You start doing it today, you start doing it for the next month or so on days when there are dips in the market. But the whole thing about IT is that it always performs more by virtue of sector rotation given softer valuations. And that's where, I think something will look positive. The US situation is what everybody is banking on in terms of reviving and all that. But that would take some time to give you clarity. So I don't think till September there's going to be any clarity. So the real numbers will start probably appearing before that, but the markets will start discounting some positive stuff before that happens post-September.
Okay, got that. Prakash, thank you very much for joining us. Good speaking with you. Appreciate your time here on CNBC-TV18. Let's talk about oil prices, right? Because that is in a way, the most clean kind of way in which markets expresses nervousness around what's happening with Iran and what may happen with the Strait, etc. Richard Redoglia, CEO at Matrix Global, is with us now with some questions and answers. Richard, great to have you back on the program. Thank you very much for your time. 1.5%, 2% jump in oil, Richard. I mean, would you say it's kind of underwhelming?
We had talked about this. So the story we've been talking about over this past week, I think it's all kind of coming to pass. You made a point before that the market is talking about lower prices. So let's look at the price today. The high price today is around 78.40. The price after the initial attack was 75.50, and the current price now is $75. So we had a large spike in price, followed by kind of a ho-hum back down again. I had made a point prior in a prior conversation that the shorts have been in control of this market since Trump came in office. The belief that there's an oversupply of crude oil in the world has put pressures on prices from as high as $85 all the way down into the mid-50s. The war obviously has taken those shorts out of the marketplace. And like any market, oil is traded by money, and money moves where there's fear. And the fear right now was this recent attack, obviously. And that caused the spike, the short covering, and it put us up to another higher price. But what's interesting is the crude price, while up, is less has moved up less than the product prices, because while crude prices have moved up $4 to $5 in this recent few days, product prices have been up as high as $7 to $8. And the reason for that is that while we have crude oversupply or overcapacity of about 5 to 6 million barrels, we only have about 1 million to 2 million barrels of refinery overcapacity. And the Persian Gulf is a major supplier of products, particularly into Europe and into Asia. And that is really where the concern is. When you have any kind of conflict that's going to affect refining capacity, it shows up in the distillate price. And that is exactly what is happening right now. And so where we have this attack, the concern is that the Persian Gulf or the Strait of Hormuz can be closed. The market's kind of believing that the success of these two attacks by both Israel and then last night by the United States shows in a way, and I don't mean to say this lightly, I'm not trying to make any kind of political statement, that Iran in a way is a paper tiger, that what they could do is going to be met with significant force, which means that any attempt to close the Strait of Hormuz is going to be very difficult, and thus it's not going to have a great effect on crude price.
Richard, hi, morning. So hearing you, right now say that the possibility of closure of the Strait of Hormuz looks a little maybe distant or difficult. If one were to think that way, then do you expect a cool off in crude oil prices in the near future? I mean, if you could put some timelines to it, and also maybe give us the probability of the closure at all. I mean, is it 5%, 10%?
It's difficult to any of us sit here to make a decision like that. I think, to be honest, we don't know, right? What we do know is that the information technology and the ability to analyze this is instantaneous, which is different than what we've had historically. Historically, it takes time for information to get out. What's happening now? We're knowing in almost real time. Every tanker on the water is tracked. Everything is known at all times. So your question is, it's a hard one to answer from the perspective of if they are able to close the Strait of Hormuz, that is, sink multiple tankers, the price will definitely spike. You'll see another move to the upside. The question is, what is the ability to hold the strait closed, and who are they damaging? Where Iran is truly between a rock and a hard place. Iran's major purchaser of crude is China, and that's effectively their number one ally. And so, do they really take out their number one ally's source of crude, or one of their major sources of crude? You have to be suspect of that. And so I can't speculate on the percentage, but I think with the way the market is looking at it, it's taking this information, it's looking at it, it's assuming that the amount of crude is still flowing into the marketplace. The economies of the world are not slowing, but the price, if you look 1 year forward, is $8 lower than where the price is on the screen right now.
Wow, 1 year forward, $8 lower. We love that. We're buyers of crude oil. We need to import lots of it. But I mean, you mentioned shooting down tanker. This is a very hypothetical question.
Yes.
But how do you close the strait? I don't know. Would it be via a blockade? Because there's a presence of, the U.S. Navy as well in the region. Or would it be just actually attacking tankers? I mean, I don't know. It's completely hypothetical. It's never happened before. How do you do it? How can they possibly? You attack.
Yes, you attack. You have ship missiles. You attack the tankers. They blow up. They cause environmental disaster. You put yourself in a situation where you have all kinds of problems. And interesting, last week or 4 days ago, because they were jamming radio signals, one of the Dark Fleet tankers collided with another tanker and caused an issue. So there was a spill, and I think it's been taken care of by now. But I think the Strait of Hormuz is only about 40 miles wide, so it's a very narrow area, and the actual sea lanes are even much smaller. And so the U.S. is militarily prepared for this. This is not something. This has been gamed out. And the first time an air missile hits any kind of ship, that location that shot them is going to be taken out. So I think the market really looked at what's happened here between what Israel did with the air defense system of Iran and what the U.S. did last night. And I believe that the oil traders of the world, that the people who are trading the money, are thinking, I'm not so concerned about an oil shortage. I'm more concerned about an oil oversupply. And what one has to start thinking about down the road is, what does it mean to have someone like Iran coming back into the Western fold? It changes the dynamic of the entire region, and it has a major effect on oil prices.
Sorry, what do you mean coming back into the Western fold, Richard?
Yes. Well, that's the question, right? Because this is gone. I made a point. There's a special place called Karg Island. Karg Island is and I made a mention on your show the other day.
Yes.
Karg Island is where 96% of all oil exports from Iran come from. It is a sitting duck in the middle of the Gulf. Why has it not been taken out? What is the reason for that? You can completely take out the entire export facility of Iran. Why hasn't it been taken out? And I believe, at least my thought would be, that if I am looking for any kind of regime change in Iran, the last thing I want to do is take out the one major income source that would support a new government. And so I believe it's by design that both the U.S. and Israel has decided not to take out Carg Island. It's sitting right there. And one of the reasons would be is if there's some kind of regime change, if we can move beyond what we're seeing now with a theocratic government, that would mean you'd have a new government come in and it's going to need money. And where's that money going to come from? It's going to come from oil exported through Carg Island.
Very interesting. Richard, okay, one more hypothetical question.
Yes.
If we remove all the geopolitics, all the risk premium, all of that out of the market, focus on just demand and supply, where would the price of oil be? Where should Brent be trading?
Very good, excellent question. Where should we be trading? Is where we're trading about 3 weeks ago, which is about $6 lower. Remember, OPEC Plus with Russia has been holding oil off the market to the tune of 5 to 6 million barrels a day. We're seeing a significant amount of new crude coming on from offshore Guyana, a major new field that's run by Exxon and the Guyana government, and offshore Brazil. So you have significant amount of new oil coming online. Demand is not peaking by any stretch. This concept of peak oil demand I find to be I don't believe it. We're going to continue to see oil demand rise for the next number of years. So peak demand currently is around 104 to 105. Saudi Arabia came out about a month and a half ago and said, we believe that other countries are cheating. They're not doing what they said they were going to do as far as it relates to curtailing, and they were starting to release crude back into the marketplace. So at this stage, it's going to be run like it always has been by the cartel and their ability to produce the extra barrel. And if they produce that extra barrel, I would think prices could be $10 to $15 lower than they are right now.
Okay, so about 60 to 65 would be a rough range, minus all the bombs and all the missiles flying around. Got that. That's a great reference point to have at the back of our mind. Thank you very much. Great conversation.
Richard, you wanted to add something? Sorry, you wanted to right at the end there?
Her point was exactly right. That is exactly the price, that 55 to 65 area. I use WTI, but Brent is the same price. That's a very good reference point to look at. When you get down to that level, demand picks up a little bit. You tend to see some production maybe not come online until you start to get a balance back in the marketplace. Yeah. That's really, it's almost self-correcting from that regard.
All right. Richard, thank you very much for joining us. A great conversation as always and very good perspective as always. Really appreciate your time here. And thank you for staying up for us. Well, I think, what we're going to do is take a look at market rates in a bit. The pre-open has come to an end. But Sudarshan and Mitesh are with us with their 9-10 calls. Sudarshan, what do you have?
Well, I have IPCA Labs. Buy IPCA Labs with a stop under 1355.
Okay. Mitesh?
Buy on ONGC for targets of around 261 to about 264.
Okay. IPCA and ONGC are the two stocks which are coming up as trades. Well, let's talk about small finance banks and what the RBI has said. Vamakshi is here with details. Vamakshi, take it away.
Well, a whole host of small finance banks will be in focus today with the likes of AU Small Finance Bank, Equitas, so Jeevan Small Finance Bank. There was an RBI circular which indicated that effective FY26, the additional component, which is 35% of priority sector lending, will now be reduced to 20%. Now, with this, the overall PSL requirements stand reduced to 60% as compared to 75% earlier. So what this essentially means is that SFBs will now have to allocate a lower portion of their lending to specific sectors of the economy, and brokerages are quite bullish on this development. Morgan Stanley says that this is a structural positive. It will give small finance banks greater flexibility in terms of portfolio diversification as well as operational ease. This will also likely improve their potential growth run rate over the long term. Citi believes that the MFI segment was leveraged to achieve the PSL targets and sub-targets, and SFBs who have a relatively more diversified portfolio can now scale up their non-PSL portfolio as well. So this bodes well for all of the small finance banks. So we'll be keeping an eye out on all of these names.
Okay, all right, got that. Thanks very much for that, Vamakshi. Let's quickly go to Hormuz. He's tracking Bharti Airtel and Colgate. Hormaz, morning. Some brokerage notes there?
Morning, Surabhi. And a positive note on a positive stock and a positive note on an underperforming stock here. Where Jefferies on Bharti, of course, it's a buy recommendation at 23.50 price target. And they are highlighting 4 key reasons why investors should own Bharti Airtel as a stock. One being the fact that it is the best way to play a consumption theme in India, as it is operating in a category with a larger market size and a much lower competition compared to others. It says there's a significant runway for a mid-teens revenue growth for the company. Valuations have a significant scope to re-rate, and of course the capex intensity for the stock has structurally declined for the company as a whole, as a result of which they are positive on Bharti. On the flip side, an underperforming Colgate gets a buy recommendation from UBS with a 3,000 rupee price target, and where they mentioned that a cyclically weak time is a perfect opportunity to buy. That the fourth quarter was a weak one. The near-term outlook is still tepid, but the structural attractiveness of the stock has risen, and it currently is trading at a multiple of 39 times, which is undemanding, and it already reflects the weaker earnings, and that is already in the price, and therefore UBS is also positive on Colgate. So 2 positive notes, Bharti and Colgate on our radar.
Okay, Bharti and Colgate on our radar. I think we are about 2 minutes out from the market open. The pre-open rates are all flashing at the bottom of the screen. And it's coming up. So 170 lower on the Nifty. It's about half of the gains of the 320-odd point gain that we saw on Friday being reversed with what we are seeing right now. Mitesh, I think, is still with us. Mitesh, any of the IT stocks coming up on your radar in any way tradable?
In fact, many of them. I think I do like HCL Tech, which kind of just moved on to a new high, swing high on Friday. And in case it starts getting past Friday's high, it should do well. I have had buys on Infosys earlier. I think that's also a stock, once it clears 1640, 1650 should do a good run. And Wipro was also a trading call, I think, on Thursday. That is looking very interesting. And I think that the stock price will easily head towards 277, 280 to begin with, and then maybe even higher.
Okay. All right. Got that. Thanks very much. By the way, I just want to remind all our viewers that, along with all the geopolitical action, all the news, we'll also be watching out for the listing of Aditya Birla Lifestyle Brands. Remember, the demerger was announced, and Vinny points out, and this is important to keep on the radar, the brands that are coming under the entity that lists today would include some of the big legacy brands like Louis Philippe, Van Heusen, Alan Solly, American Eagle, Reebok, etc. It was almost an equal split, in terms of when the company split. So we'll watch out for both Aditya Birla Lifestyle Brands and, of course, fashion and retail.
Okay, and I think we'll have Mr. Kumar Mangalam Birla at the event, the listing event. So that's coming up a little later. 24,980 on the Nifty, about 0.5% lower, about 0.5% lower on the Nifty Bank, 55,980. You got the mid-cap index, which is down about 0.5%. The small-cap index is lower as well. And this is the opening rates. It's a pretty well-behaved screen all told, with just 0.5% cuts, and actually lesser if you look at the broader market. Small-cap index is down just 0.33%. The mid-cap index is down about 0.4% as well. Market breadth, though, is negative. So 1,270 stocks are lower, 400 stocks are higher, but this is just the initial first 30 seconds, actually. The heat map up on your screen, bulk of it is down and some of it is higher. About 5 or 6 names are up in the green and everything else are lower. I think this 100-point cut is also coming through with because of pressure on IT names, which we will look at with some of these individual stocks coming up as we go along. Surabhi.
Bunker busting bombs on Iran from the US. The way that headline read, this could be just any given day, right? So markets are very, very different animal, at least in this phase. 150 points lower on the Nifty. Let's talk about the stocks then. Infosys, HCL Tech, Wipro, Tech Mahindra, all the stocks are down. So it seems that the read-through from Accenture, the market's choosing to pick up the more cautious side of it. The fact that consulting revenues are lower, the fact that forward bookings, the new businesses they're booking, that's on the lower side. So not too much of enthusiasm over there. Let's see what else is weak. HUL, Hindalco, Shriram Finance, Bajaj Finance. These are some more names on the way down. Reliance itself is down about 0.7%, at least at this point in time. Coal India is also lower. On the upside, Nestle, BEL announced some order wins over the weekend. That's the only one, really. ONGC is up because of the slight up move in crude oil prices. Speaking of crude oil, OMCs are not, it's not like they're collapsing or anything, hardly anything. 0.5% down on oil marketing companies. HPCL, BPCL, IOC down about 0.5% each. It's pretty much about it. 150 points lower on the Nifty. Mid-caps also down 0.5%, Nigel.
Well, that's right. You know, Northern Arc, last week we saw this large trade that took place at around 200 rupees or thereabouts. Today as well, there's quite a big volume taking place out there, and that stock is up by close to around 3.5%. So Northern Arc is a stock that's on the radar. It's up close to around 10% from last week's lows. Small finance banks, Utkarsh, Equitas and Ujjivan, all of them higher in today's trading session. So good up move is what we're seeing out there. SCI, that's another stock that's done well. That one, in fact, is up close to around 2% or thereabouts. So good up move is what we're seeing on that name. And another smaller stock, Kerala Ayurveda, you know, the very, very large equity actually has changed hands. So I'll keep an eye out on that one. Close to around 18% equity changing hands at around 470 rupees. The stock is up close to around 15%. A small market cap, only 600 crores, but very, very large equity. Not too sure what's going on there, but we'll keep an eye out for details on that particular. Now up close to around 20%, 17% equity change hands out that one.
Just one more point on the diagnostic companies. Remember, Ekta was telling us Amazon's entering the space. So there's bound to be some disruption, some worries, but stocks are down 2%, not too much. Dr. Lal and Metropolis, slightly lower.
Absolutely, and you know, we'll come back to some of these prices, etc., as we go along. But for now, it's 0.75% down, 24,930. The Nifty bank is fit for about 55,930 as well. Pankaj Murarka is with us, CEO and Chief Investment Officer at Renaissance Investment Managers. Pankaj, of course, is you know, a long-term bottom-up stock picker. I don't know how much geopolitics is clouding his mind. Having known him for a while, I don't think it is, in a very large way at least. Pankaj, how are you thinking about the whole situation? I mean, actually markets around the world, equity markets especially, are largely unbothered with what's happening. Even markets in that region are unbothered. How would you look at where we are, and what are the dominant drivers according to you from here?
Morning, Prashant. Yeah, I think, Prashant, on this conflict over the weekend and the US strikes, I think markets are largely drawing an inference that this escalation will remain one contained within the region, so largely in Middle East, and probably there will not be a spillover to the rest of the world. And a large part of my understanding is a large part of transmission of this crisis, if we call it one, is going to be essentially through one, higher energy prices. And we've already seen oil prices up by almost 20% from $65 to $78 or so. So they're probably pricing a risk premium for this crisis. And secondly, probably through lower risk appetite. But I don't think so that the lower risk appetite, as far as the risk assets is concerned, is setting in globally, because the underlying economic growth momentum in across US and some of the Asian economies, or I would say global economy, remains fairly strong. So investors probably are taking a belief that probably this crisis will remain contained. They still believe the escalations will not go too far in terms of Iran exercising some extreme options, and probably a short-lived one. And to that extent, the larger part of transmission is through energy prices, which has some impact on India. But I think India can still deal with it, given our strong external balances. Overall, on the economy, I think one thing clearly that stands out when you talk now, how do you think going forward from here? I think India is in a situation where we are very extremely resilient as an economy. And I would like to draw your attention. The finance minister had written a piece in one of the business newspapers a week back, where she highlighted that all the 5 balance sheets of India are very strong, which essentially is government of India's macroeconomic fundamentals are very strong. The external balances with our forex cover and import covers are very, very resilient. Corporate balance sheets and bank balance sheet in India are very strong. I'm seeing such healthy corporate and bank balance sheets in India almost after a gap of 20 years at the same time, which effectively means there is significant capacity on part of corporates to invest and on part of banks to lend. And finally, the household balance sheet, your and my balance sheets are extremely strong in terms of ability to spend. So combination of all of this means that in an environment globally which is extremely challenged, probably India comes across as one of the most resilient economy with very stable growth. And I think that is what driving markets at this point of time, I think so. And I think that is what really sets India apart from a lot of other economies in the world which have their own set of challenges. So sum total, the view on market still remains positive. I still think that Nifty index can do a low teens kind of a CAGR returns from here over the next 1 year, over the medium term, over the next 3 years. And probably it's someone like us, or for investors who have a medium term perspective, it makes eminent sense to remain extremely bottom up focused and focused on picking right stocks and probably not letting some of these macro headwinds and news flow overplay on your investment decision or portfolios.
Hi Pankaj, good morning. Good to see you in. So you're sounding reasonably optimistic actually on prospects within India, which is good news as well. It appears that things should work in our favor. Earnings should be better. Earnings growth should be better. And actually our markets have been quite resilient. Going by all the cues we've seen in the first half of the year. I think you briefly alluded to the last time around, you're expecting consumption to pick up. And you're actually taking a contra bet. I think you were quite positive on staples. Tell us more. Does that call hold on?
Yeah, Nigel, morning. Yeah, absolutely. That does hold on. I've been saying that at a $4 trillion economy that India is now, and 60% of this economy drives its growth from consumption, so which effectively means our aggregate private final consumption expenditure by itself is the 8th largest economy in the world at $2.4 trillion. Companies which can execute well can derive significant growth out of this ecosystem. So I clearly think that as it is, I think there'll be we're coming out of the long-term growth, last 15 years growth of our aggregate consumption is about 11%. Last 2 years, the growth has been about 6.5%. So I firmly believe all the stars are aligned for a cyclical recovery in India's consumption sector or a consumption basket or final aggregate consumption expenditure by households in the second half of this year and building into the next year. So we are in for a very healthy cyclical recovery. And more importantly, companies which are executing well and strategizing and executing well can grow at a much higher rate. So yeah, my whole hypothesis on that is one space where I find, valuations have now normalized from where they were far in excess or pre-expensive at the time of COVID last 5 years. Consumption or consumer as a sector, companies in that sector have by and large underperformed big time as versus the broader market indices. And also earnings growth has been lagging. I think valuations have normalized and earnings growth will accelerate. So probably I think next year, consumer sectors will actually grow higher than the aggregate index earnings growth. So I certainly think that one can comfortably make mid-teens to high teens kind of returns in some of the consumer names, and with the kind of safety and security they offer in terms of downside protection both to earnings and valuations, I think for low risk investors like ourselves looking at medium term high teens kind of returns, at this point of time that sector looks very attractive.
Okay, consumer, you'll look out for that. Point noted, Pankaj. Also, by the way, I'm looking at some of the early movers and keep a watch on some of the defense names because they've already started gaining some ground, not all, but a little bit. Garden Reach Shipbuilders, for instance, some of the private sector names like Paras Defense I had seen earlier, even Idea Forge. Some green on these stocks while the overall market is a little subdued this morning. Pankaj, so yeah, what about this space? The news flow refuses to die down when it's defense. But the question is, whether it's too late from a stock point of view to be an investor now. What's your sense?
Absolutely. I think it's very clear that stocks have done phenomenally well, given that now there's a new defense doctrine that India has had with our own challenges with which we faced with our neighbor a few weeks back. It's a given that India's defense spends are going to increase significantly, and probably for all companies in the space, the opportunity is very significant. Yet I concede that the valuations in the space are extremely rich. Any defense company now trades at multiples, which it's difficult to justify this defense companies now basis near-term earnings multiple over the next 2 or 3 years. So clearly, markets are pricing in a sustained high growth in terms of earnings and cash flows for these defense companies over a very long period of time. I think some of these companies will deliver, but it's very obvious that when these kind of things happen in a particular sector, and we have seen time and again repeatedly in history of market, that many of these companies will not live up to the expectations. So I think it's very important for investors to make choices between the stocks very carefully. At this point of time, because a lot of this is driven by macro narrative, it's very difficult to figure out which companies will be able to execute well and deliver, and which will not be able to. From a value-oriented investors like ourselves, we have taken this opportunity to actually take money out of defense stocks. So, and it's very difficult for us to own stocks where we cannot justify them on the near-term valuations over the next 3 years or 4 years. So, I think anyone being invested into those stocks from a more fundamental perspective will have to look at earnings and cash flows over much longer time horizons. Stock price behavior is a more a function of momentum, and momentum. Investing into momentum in stock price is always very risky because momentums can fade. They can come very quickly, but they can also fade equally quickly. And the stock price swings on either sides can be very, very sharp. So I would urge that investors should really think through in terms of what they're expecting from these stocks from a longer term perspective. And as I said, from a value investor like ourselves, we are actually sold into our holdings. So we do have very little exposure to defense at this point of time.
Yeah, no, absolutely. And we've heard that, earlier as well. The tailwind is there, the spending thrust, etc. is there, but markets price everything so quickly, and maybe a lot is already priced here as far as the entire defense space is concerned. Pankaj, any new areas of interest to you where a lot of new sectors, right? Many are actually in the unlisted domain though, but new industries developing, segments, etc. coming about.
I still continue to feel pretty excited about, internet companies in India because I still think a lot of these companies are growing at a pretty healthy or high rate, if I may say so. So slightly more, the point is, Prashant, we are dealing with the most expensive equity market in the world. And we are in the 6th year of this bull market. So it's a very matured bull market. In a matured bull market, in the most expensive equity market in the world, it's difficult to find value on the table. So obviously, one way of playing it is one can go down the curve, which effectively means you end up compromising portfolio quality and buying poor quality companies. My experience of doing that way back 20 years back has been very bad, and I've burnt my fingers very badly. So I'm extremely cautious of not committing that error. And then the other way of playing around in these markets is you take a slightly more longer term horizon in terms of where you can find earning surprises, or where growth is underpriced in that sense, while keeping the quality of business and quality of management intact, kind of a thing. And one space where I still find that growth can surprise positively is the internet sector or India's internet ecosystem, because I think their growth, meaning while their markets are pricing in growth, I still think in the medium term, long term, given India's growth dynamics, growth can surprise there positively, or can be much higher than what market are pricing in. And my experience of investing into high growth businesses has been, as analysts, we tend to overestimate growth in the short term, but we do end up underestimating growth in the long term, where we underestimate India's long term growth potential and growth trajectory for many of these companies. So if you go back to a lot of these companies which are large, probably when we forecasted growth for these companies 20 years back, we did underestimate their long term growth potential. So I find a lot of those opportunities in internet sector, and from our point of view, we're trying to focus more on slightly more longer term while not going down the quality curve.
Sure. Okay. All right. Point well taken, Pankaj. Thank you very much for being with us this morning and for giving us all of that perspective. Good speaking with you today. Just a quick glance back at the market. We are still down just under 1%, 0.8% lower. 200 points is the cut. And actually, within the Asian region now, we are among the weaker markets, because other large markets like the Hang Seng, like Japan, they're actually down less than 0.5%. So let's see. Right now, dealing with a 200-point cut. By the way, even if you're looking at the dollar, or if you're looking at the US 10-year yields, now that rates are coming in and people are back to trading, even the dollar index is just about 99. So there's been no major reaction, no matter which parameter you're looking at, to assess the market's interpretation of the risk. Let's then get another interpretation from someone who's a veteran, who's seen a lot of these cycles play out in the past. Prashant Khemka, founder of White Oak Capital Management, is with us. Prashant, good morning. Thanks so much for joining in. A trade war, a real war, localized conflicts, and now direct US bombers in Iran. Who would have thought that you throw all of this at the market, and yet it turns out to be so very resilient? What do you make of the way the market is interpreting the rise in risk in the last 2-3 months?
Oh, certainly, Surabhi. First of all, thank you for having me here. Now, almost at all times, if you look at historically, the events might have been different, the nature of the events might have been different, but we've been interacting for so long, right? It always feels like we are in an elevated risk environment, almost always. So first of all, I don't want to say that we are in particularly, risk-prone environment. Tariffs, they were announced, but market very soon realized after initial pullback that they are not going to stick. Markets always, as you know, see ahead of what then transpires. The markets can see beyond horizon. Just like I keep going back to COVID. Market bottomed March 23, where there were less than 1,000 deaths or less than 1,000 infections actually in India. And then we had obviously so many because market could see beyond. Nothing, according to market, all this is not going to have any material or lasting impact. And both are important, neither material nor lasting impact on the cash flows of the corporates. And that market seems to be quite certain about. And hence the market, with a few points here or there, a few percentage points here or there, has recovered with each of these hits that we've seen.
Prashant, that's my question. I mean, I know the market's wisdom is the supreme. In my 20-year reporting career, the only time I can think the markets maybe got it wrong, couldn't, forecast the future accurately, maybe it was a global financial crisis, right? Markets kept rallying. They had no clue the kind of storm that was, waiting on the other side. But in the present environment, would you go with the market's wisdom that whether it's the trade war or tariffs or geopolitics, to borrow Prashant's phrase, Teflon coated, and that's the way to be?
Yes. I think the worst is behind us on each of these events, if you will. So tariff, we all can agree that worst is behind us, right? Maybe there would be ripples of the main announcements and the main event in each of these cases, but it seems like we can always be surprised, and I'm certainly not a geopolitics expert, if at all an expert on anything, but from what I can make out, it seems like we should have a relative phase of calm now on the geopolitical front, especially when it pertains to Middle East. Once US gets involved, and I'm not saying who's right, who's wrong, because I'm not that learned on the subject matter to make those conclusions, but just purely from the market's perspective, I think the worst of this geopolitical event, the most recent geopolitical event, is behind. I'm somewhat surprised that the Indian market's not up today. Not that we have any short-term perspective on these aspects. As you noted, the other Asian markets are not impacted much. So the Indian market impact is a little bit maybe not related to war, but this geopolitical event, but coming on the heels of it, maybe it is related to. But I don't see much of a lasting negative impact of what's happened over the weekend.
Right, absolutely. Prashant, by the way, are you speaking with you? You're coming to us from Mumbai or Dubai?
Right now, Singapore.
In Singapore. Okay, all right.
By the way, if it's Dubai, maybe he sees. You would have wondered if he's seeing the missiles up in the air. No?
That is why I asked.
I'll be in Mumbai next week, though, for a while.
Oh, okay.
A lot of flights, by the way. Shireen came back from the US last night. 18-hour flight.
Yeah.
My daughter came back from Germany yesterday. And again, I mean, actually, you're on flight radar, tracking flights. And it's like, there are real implications as well. Interesting conversation, Prashant. The other factor, of course, is just fatigue, right? Conflict fatigue. I mean, of course, it's just conflict. As you said, it began by saying, always in a heightened state of risk. So beyond a point, you just kind of, you just shrug your shoulders and move on in a way. I think that's also maybe one way to describe it.
Very true. See, Russia, Ukraine, in recent years or even decades, I would say Russia, Ukraine, which started, I think, 22, right? Yeah. So it's 3 years old now. Yes, there have been definitely economic impact of that war. but it does not cause bankruptcies, widespread bankruptcies and whatnot. To Surbhi's point about GFC, I think what the market really worries about and would take a huge hit and cause material lasting loss is there are widespread bankruptcies, as was the case, and also the risk of larger widespread bankruptcies in case of GFC, and as was the worry initially with COVID. And then that's why, because nobody can move out, all the travel companies would go bankrupt, all the airline companies would go bankrupt, and the banks would go bankrupt, and so on and so forth. And hence we saw 30% kind of hit. But these events, it's hard to make the case that there would be widespread bankruptcies around the world. And that is why I think, it's a risk that is consistent with the, what you call it, Prashant, the heightened state of risk environment that the market, we have all been, from a geopolitical perspective, at least for the last 3+ years now. And that's a beautiful material impact on corporates.
Prashant, I just want to compliment you. I think that's a beautiful point and so well put. Sometimes you forget this. And you're right, because with whatever is happening, there is no bankruptcy or a financial systemic collapse, which is what caused 2008, right? Yeah. And it reminds us once again that for markets, at the end of the day, I mean, as you can argue it's inhuman, sounds a little brutal, but at the end of the day, it boils down to profit, whether it's there or it's not there. So I just wanted to compliment you on a point well made.
Thank you. Thank you. And the bankruptcy is so important because, see, if there's a hit for a year, like COVID was a hit on the P&L for a year, but next year things normalize. If there's bankruptcy risk, then there's no time to normalize. Equity shareholders get wiped out. Yeah. And that is the distinction between a short-term hit and a bankruptcy.
Prashant, I always tell my co-anchors, because my career started after GFC. I haven't seen GFC because my career started after that. And hopefully we'll never see it as well because, markets are far more mature. As you said, corporate balance sheets itself are in far better shape. And I believe that, in fact, the retail investor is maturing as well. That's the hope, that we don't see something like what we saw in 2008. That said, Prashant, things looking good from an India market perspective. Give and take everything. I think, there appears there's a longer runway. One problem is when the markets are so strong and liquidity is so solid, you see a lot of supply of paper. Does that worry you, when promoters come and say, I'm willing to sell $100 million worth of shares, and will you buy it? Or do you believe that this market is far more mature? This is actually a positive sign that, there could be so much of money taken off the table, and ultimately some of this money gets rerouted back into the markets itself. Your take?
Nigel, I think it's very healthy. I mean, one of the real positive, real impact, one amongst the many positive real economy impact of, you can call it bull market or healthy markets, is that capital gets channelized into real economy. So the fact that companies are raising money to put up, and just over the last few days, several of them have done so, right, Nigel? So that's very healthy. The mutual funds, domestic mutual funds, foreign institutions, and other segments, prop investors, they're all basically channeling financial capital into real economy. And the markets are the most efficient place to do such capital allocation. And that's the most beautiful and most rewarding part to the society, rather than just stocks going up and down, is the channeling of this capital towards productive uses. Now, 100% isn't going to be productive. In any endeavor, 100% is not, the success rate. But in capital market history, in my assessment, it is, fairly high degree of success rate. Yes, there's nothing wrong if promoters also, obviously, as investors, we have to evaluate what signals are these managements providing when they're selling down their own stake. But it's not necessarily always wrong. Many a times, these promoters have 100% of their net worth linked to the company. And it may be prudent to take some off for the sake of family or for other purposes. So each case has to be analyzed differently, but the overall fundraising for corporate purposes is very healthy, and for individual purposes also. And for both purposes, you have to evaluate case by case. On the whole, I think of it as a healthy phenomenon.
So then, Prashant, it gets us back to the basic question. Now, we've discussed enough why the market is not falling and why we don't need to worry too much. So then let's round it off with the usual question. We come back to the argument of valuations here in India. Which pockets still look okay to you? In the past, when we spoke on earlier shows, including on Market Cafe, you were looking at some pockets of mid-cap pharma, some mid-cap IT. Of course, you've been liking internet stocks. So still sticking with those themes. Anything new? New ideas?
Well, I'd say yes. All those are still places, areas, and they structurally tend to be areas where we find good investment opportunities, financials, and in financials, particularly, larger caps amongst banks, but there are a lot of NBFCs where mid and small cap opportunities are there. Healthcare across board, but more particularly mid and small caps. IT services, more particularly mid and small caps. Industrials, selectively. Consumer in consumption, mid and small caps. Obviously, alpha opportunities often would come in mid caps and small caps, though in large caps also do provide opportunity to generate alpha. So those remain the same. If there is anything since we last spoke, Surbhi, and while it is a theme that has played quite strongly in the markets over the last 2-3 years, I think just the events of the last 2-3 months, particularly the India-Pakistan conflict, does merit a much closer look to all defense names and see if there is value there in the context of, I would say, a material change for the defense industry or the sustainability. You can say the change has been in place for last 10 years, but the sustainability of the change can have much longer legs to the events that played out over the last couple of months.
All right. And I think you guys are, sort of looking at niche manufacturing names, etc. as well, right? Which kind of feed into that broader defense theme. And we discussed that on the Editors Roundtable with your head of research, of course. Thanks very much, Prashant. Appreciate you joining us. And it's always a pleasure speaking with you on this. Gargi Chaudhary is Managing Director, Chief Investment and Portfolio Strategist Americas at BlackRock, and she's with us here in our studios to take us through what she's making of this entire situation. Gargi, great to have you with us in the program. Thank you very much for your time. We've had guest after guest, and we've been talking about this general sense of calm in markets, largely unbothered. Oil prices are up small, equity markets, of course. They're not the first port of call when you have things like this. It's oil, but it's not showing up in oil in any big way as well, what's happening. And we were also wondering earlier, it's not showing up in bonds, it's not showing up in the dollar, which are traditional safe havens. What do you make of it? The market reaction.
Not even in gold. Looking across asset classes.
Right.
It's just almost BAU.
Yeah, so good morning. Thank you for having me. And absolutely, to your point earlier, it's been a little alarming to see the news headlines, obviously. But at the same time, when you look at price action in markets, I think they're telling us something. And I think what we should take away is that historically, geopolitical events, as hollow as it sounds to say this, obviously from a human impact, historically, they have not had a longer-term, sustained impact on equity markets. So when you look back 20 years, 5 years, 3 months, all of the geopolitical events that we've had, if you look at the US global equity market response a month or 3 months out, you've seen that geopolitical events have not really had a role to play. So I think what we're seeing now is just a much more efficient version of that. The markets aren't even really doing the initial sell-off in a meaningful manner. They're looking ahead to earnings, which are robust, financial conditions, which are pretty supportive, especially in emerging market economies where there are rate cuts abound. And in the US, I think the market's looking ahead already to this idea that earnings still remain very, very solid. And once again, we think geopolitical events will eventually be looked through by the markets. I will take a little bit of the other side on your point earlier, Prashant, that you made on oil prices. A little bit more muted, especially after the weekend news. But if you look back from May, we have had a significant jump. So that 26% or so rise, that's not nothing. And I think that's the big event that the market's going to react to, especially if there's anything that happens with the Strait of Hormuz in the weeks and days to come.
So, I mean, given what you've said, what the previous speaker is saying, it just kind of reminds us, and it's good to sort of have that, that there is no immediate corporate impact, no immediate financial impact, and that explains the market's reaction. So can you now expand on one of the points you made, which is robust U.S. growth in corporate earnings?
Yeah.
Because there, the one sword that's hanging is tariffs. Now, in the midst of all of this, we've forgotten that we're very close to July 9 as well, right? But we're there, and we don't know what those final tariffs are like and what the implications of that will be. Your thoughts?
Of course. So there are a couple of things here as well. So number one, there's already been a significant amount of tariff de-escalation. And I think the markets have absolutely responded to that when you look at the price action from the beginning of April to basically now. We were sort of getting to a point where expectations of tariffs was in the mid-20s. Right now, that's landing somewhere. The landing zone is, call it between 10 and 15%. Significantly higher than where we were in 2024. But given what we had sort of thought it might be, it's still, there's been some de-escalation. While that's been going on, I think what the market should pay more attention to is that corporate earnings have actually been a lot stronger. So when you look at Q1, and obviously Q2 is upcoming, but when you look at Q1, earnings growth was almost double of what was expected. And that the diffusion index of that was very broad. That came across, it wasn't just the Mag 7 names. It was across different sectors. And I think that, alongside the fact that many investors have been over-allocated to cash, have been sitting on the sidelines because they've been nervous about this volatility as a result of geopolitical risks, as a result of tariff risks, uncertainty around future fiscal policy. Some of that money is beginning to move back into U.S. and, frankly, international markets, which is another big theme that we've begun to see for the course of 2025. So earnings have been strong. Growth weaker than 2024, but we're not looking at a recession in the U.S. anytime soon. And at the same time, we have a Fed that's sort of signaling that they're still willing to entertain about 2 cuts this year.
All right. Hi, Gargi. Good to have you in the studio.
Great to be here.
A quick point with regard to Brent crude prices. It's spiked up, as you said, by $15. At what level will become a bit of a worry for India? Because, you know, normally if you saw such a big spike, Indian markets would have been rogered. That's not really happened this time around. So at what point of time do you think it's a worry? And the second part is on the dollar index. Consensus seems to be suggesting that the dollar index has made a near-term peak and will correct from here on. What's your take?
Sure. So I'll talk about oil prices first, of course, especially as it pertains to Indian investors. So I think that it's not the level it touches, but the sustained amount of time that it can stay there. So obviously, if we have this left tail event of the Strait of Hormuz getting shut down, we all know that's 20% of global oil supplies. India, China, Europe being countries that are net importers of oil, of course, that's going to be GDP and consumption hampering. Yes. But the question is, how long do we stay at those $75, $80, $100 levels? If we stay there for a period of time, that is where it becomes a consumption worry. If it touches there and then, you know, it shuts down and then reopens, if it touches there, but then it de-escalates very quickly, I think that's going to be quite a different outcome. So I think both are important. Obviously the level, but more important than the level is the change. Yes, okay. And then the second point around the US dollar, I think there are 2 things to think about here. One is more around the, you know, medium-term impact. I think there are quite a few things that are pointing to a decelerating dollar trend. Number one, international markets being a source of asset allocation for our investors across the world again. To the extent that many investors were only thinking about US markets, this is a year that has shown why you need to be diversified globally in countries like India and Japan, and broadly in Europe as well. So the idea of moving away from the US, and then I would say secondly, many international investors in the past that haven't hedged are now beginning to hedge more meaningfully. That is another pressure on the US dollar. So both of those, I would say, are driving and will continue to be a driving force lower. However, I want to be very careful as to what that may or may not mean for structural views. This is not about USD not being a reserve currency. If you look at 90% of FX transactions, 40% of global trade invoicing, about 70% of global payments, it's still in US dollars. So we're not losing the reserve status. This is more of a structural view or a cyclical view to slightly lower levels than here, because the dollar, even today with the move year till date, is still an expensive currency. So I think we can see a little bit more of that.
There is also that inherent tension, right? I mean, the US and Trump administration wants the dollar lower, but they still want, in a way, the dollar to be right there, I mean, to be bought in adequate amounts. So, I mean, that inherent tension is there. I mean, you don't, that reserve currency point, I mean, that goes against the view that dollar should be lower, a lot lower. In a way, right? I mean, there is that...
Everyone should use the dollar, but the dollar should be lower.
Should be sure. So it's a...
I think it's balancing what you're trying to achieve. If it's trade deficit you're worried about, if it's budget deficit that you're worried about, I think it's thinking about all of those together and the role the dollar has to play. I will say there's a huge amount of focus on the unwind of US exceptionalism. So that's a narrative that's been out there, and you guys have talked about it. I think what's more important is what is the fragility in our fiscal policies in the US? What does that point to? And I think that's what the dollar is reacting to. If we're going to have a higher and higher fiscal deficit, can that support a stronger dollar? And I think that's why we've been telling investors a lot to stay away, in the US especially, from the very long end of the bond market. So I think that those are the ways in which it manifests itself.
Yes, you know, what's the size of the US stock market? $50 trillion?
Yeah, a little bit more. But yeah.
I mean, it's a little bit moving out. I think it's going to be good for the rest of the world, maybe good for US as well. It kind of takes the pressure of US valuations, etc.
I think
it's not the end of exceptionalism. It's just maybe just some
exactly. It's a pause, and I think it's a good way for many investors, US investors included, to think about a diversified portfolio which has allocations to emerging markets, to Europe, and to US.
So everybody benefits. Okay, so let's talk about India. I mean, and what do you think of things happening here? Because I think since we last had you in the studio, the Reserve Bank of India has been very, very generous with the CRR cuts, with the repo cuts. You know, and we were discussing this internally, that earlier when we would get a 50 basis point CRR cut, 100 basis point, we'd be like, oh my God, it's crisis time. So it's, you know, RBI firefighting. But I don't know if this is a new age of monetary policy. Just your thoughts on how things are positioned here.
Absolutely. So the last time I was here in the studio was about, I think, 6 or 7 months ago, we were just discussing. One of the things that we talked about or had talked about was just the longer-term appeal of India, especially for international investors, US investors, that may not have had India as a source of diversification in their portfolios. And more so than ever now, with the pullback that we experienced towards the end of 2024, coming into 2025, especially now with the cyclical turn in earnings in US. I was just looking at some of the earnings revisions ratios now moving up in India, alongside with your point around the RBI giving us a generous rate cut and financial conditions as a result being so supportive. I think those are all great. You've got the valuations, which may not look incredibly amazing, but I think that's always been the case in India. But on the same time, you have a case for a role in the portfolio. You have flows that are turning. We're seeing international investors that had left the Indian markets coming back a little bit. So that's positive. You've got the fundamentals from an earnings perspective, and you've got the macro fundamentals just from RBI being more able to support perspective. So all of that, I think, is short-term great. From a longer-term perspective, the demographic story, the digitization story, we've talked about that at BlackRock a lot. I think those are really beneficial for the Indian markets. And you know, we're constantly telling investors to think about India and China as standalone parts of your portfolio, as opposed to putting it all together as one EM bucket.
Okay, Gargi's making us feel good. The world, global equities, US, and of course here in India as well. So yeah, suddenly the missiles are not that frightening anymore.
Come more often, Gargi.
You would love that.
Thanks very much, Gargi.
Thank you.
Thank you so much for that. Well, with that, we will move on. Lots of market perspective over there. Quick check on the market. Market's actually still down about 250 points, 1% lower. For the time being, probably one of the weaker markets in Asia. And the Bank Nifty is down about 0.7%. Speaking of the Bank Nifty, over the weekend, we had more policy action from the RBI, and they've gone ahead to ease some rules, some norms for small finance banks. Now, the norms in question are the priority sector lending norms, which is where the earlier requirement of 75% has been now dialed down to about 60%. So what does this mean for companies? Let's talk about this with Mr. Ajay Kanwal, Managing Director and CEO at Jana Small Finance Bank. Mr. Kanwal, thanks so much for joining us this morning. So that's really our first question. No longer a mandate to do 75%, now 60%. So what does this additional flexibility mean for small finance banks, including Jana?
Right. So good morning to you and all the viewers. It has been a long request from the Association of Small Finance Banks to see if the norms could be dropped from 75% lower. So I think the 60% is very welcome, and a big thank you to our regulator. What it does do is it allows us to do different kinds of things. So, for example, car loans, lending to small corporates, which is probably beyond the turnover levels of MSMEs, two-wheeler loans. So there are many categories of loans which don't fall under priority sector. I think this allows us to do more of that. And it also fits very well into what is known as a diversification of asset book. So if any SFB did think that, his diversification strategy was being hurt by the high PSL number, then certainly now better opportunity to be more diversified. So those are three things that I could mention.
Hi, sir. Good morning and good to see you in. So you have the liberty now to lend to other sectors as well. So could you tell us how do you see things panning out? How do you see your loan book mix changing? Point number one. And point number two is it'll affect your margin profile, right? It'll be accretive. How do you see that pan out?
Right. So first is for Jana specifically. Listen, we are already 70% non-microfinance, and we have been in the affordable housing, business lab, MSME from the last 7 years. So for us, it's a good tailwind to have, but doesn't change any strategy, obviously, immediately. It does help us as we go up into supply chain, into lending to small size, mid-sized companies. Then we certainly have an advantage with this coming in. So that's what will happen within Jana's context. But as you very well know, all SFBs have different asset class diversifications and sizes. So I'm sure others will take bigger benefit of it. We'll probably take a smaller benefit of. But I think it's a very welcome answer for us.
Mr. Kanwal, in our earlier conversations, you've always spoken about how Jana is looking to increase the share of secured lending. So just revisit that whole plan for us, and now with a very different requirement on priority sector lending, say a year down the line, what would be your targeted book look like? I mean, how much would it be, maybe auto finance, and how much? Just trying to understand, say 1 to 2 years down the line with this new regulation and your move towards secured, what will the book look like?
So first is, this regulation is also signaling to us more diversification is better. And that supports us quite a lot. We certainly would like to reach 80%. And that is what we have said in the public domain also. We've reached 70% in the last 7 years. We would certainly like to reach 80%. In the balance 20%, of which is largely microfinance business, we would like to put that all under the guarantee program of both CGMFU and CGTMBC. So in a way, you can say that, we'll be secured 80%, but fundamentally my entire book will more or less be either under guarantee program or a secured book. So that will be a combination in the next 2 to 3 years at best, depending on how the different things work out. I missed answering Prashant's second part of the question, so I suddenly remembered. See, on the margins, yes, as you do secured, margins will be lower, no doubt about it. Yeah. There is a compensating answer when it comes to cost income. So your cost income for secured assets is better. And second, your gross NPS will be better. Yes. So starting wise, small compression in NIMs, we have lived through that in Jana. We were at 10.5, 11% NIMs when we were all unsecured. We're down to 7.7. But then our cost income has shown a big change. And I do think that even if you look at this whole stress in the last 1 year in MFI, we've been slightly more removed from it because the book composition is low there. So it certainly helps in cross NPA and cross income.
What's the AUM growth target this year? Now that you have this slight relief also from RBI, you can look at other segments.
So I must say that 2-3 things have happened very brilliantly in the last few months, probably signaling what to expect. I think the repo rate cut, the CRR cut, a very clear cut, helpful gold loan circular, now the 60%. I think towards the trend is very clear that things are getting easier as we go along. We have signaled a 20% growth in asset, and as of now, we were not changing that. But rest assured that yes, every endeavor that if you could do more.
Okay, so perhaps more than 20% growth of the book this year, given the favorable environment. Got that. Thank you very much for joining us. Short conversation today, but it's a helpful one. Thank you very much. Quickly going back to Mitesh now, take stock of the market, which has been still under pressure. Mitesh, what would you do now?
So, Surya, I was talking about, some kind of support coming in around 24,900. Now we are below that. So we're not taking the long position very clearly, neither on the index nor on stocks. But as long as we are below that, we'll explore some kind of shorting opportunities. And the stocks that I have right now, sell on Pidilite with a stop at about 29.65 for targets of 2,900 and below. And the other one is a sell on SBI cards with a stop at about 960 for targets of around 950.
Okay. All right. Thanks a lot for that, Mitesh. Just by the way, before we slip into the short break, I want to pull up the stock of Dixon. The low of the day was at around 13,280. As we speak, it's at 14,370. So there was a large trade that took place in the initial moments of trade. And from there, the stock has seen a sharp spike up. So, just keep an eye out on that one. More than 1,000 rupees from the low point of the day. Slip into a short break. Come back. Manisha Gupta will be waiting for us. She'll tell us what's going on in the commodity space.
Welcome back. We've got a new listing, not a new listing, but basically the demerged arm of Aditya Birla Fashion and Retail, the new arm which is now called Aditya Birla Lifestyle, has made its debut. Let's go across to Vinny to understand what is this business, what has shifted to this entity that is starting its listing journey from today. Vinny.
Hi, good morning. So yes, starting is listening to any talk today and the price.
Vinny, I think Mike, we need to get Vinny's mic back. In the meantime, let me just fill you in. The demerger was announced a couple of months back, and then there was a split. So basically, Aditya Birla Fashion and Retail, from what I remember, continues to have the Pantaloon business. That's the lion's share of their business, plus a lot of other ethnic brands and some of the high fashion brands like Tarun Tahiliani, etc. Those kind of labels are under Aditya Birla Fashion and Retail. The entity that's listed today will now house a lot of the big brands that have led to the rise of Madura, as it was earlier known, Madura Garments once upon a time. Those are the brands on your screens. Louis Philippe, Van Heusen, Allen Solly, Peter England, all of them have moved to this entity, which has listed today. Vinny, take it over now.
Hi, yes. So in terms of the listing, it's listed at the price that was expected. Motilal Oswal had indicated an implied price also on the record date of 22nd of May. That was at 171. So it's at 167 right now. And pre-open price was also at around 167. Now, obviously, Aditya Birla Lifestyle Brands is something that is housing Mundra Fashions Limited, a lot of brands that come into it, Western wear, legacy brands, growth brand segments specifically. So Reebok, American Eagle, Van Heusen, innerwear specifically something that they are betting on in terms of growth factors for the company going forward. Louis Philippe is also there, Allen Solly is there, Peter England. So these are the brands that they want to work on. More of the brands are coming into this side of the business, Aditya Birla Lifestyle side of the business, and lifestyle brands had accounted around 85% of the revenue for overall the merged entity of Aditya Birla Fashion. So now that has come into Aditya Birla Lifestyle Brands. Now the guidance that company itself had given when this demerger happened, they spoke about targeting around a 13% revenue CAGR growth over the next 5 years for the company, EBITDA margin expansion of around 300 basis points and expecting it at around 11%, and in terms of return on capital employed also of 70+% is what that indicated. This they said previously as well. This is over the next few years is what they're expecting. Now, Bernstein, according to their SOTP valuation, this should have been at around a 185 rupees listing. But obviously, it's below their expectation. But other than that, today's note from Motilal Oswal, they are giving a neutral rating, target price of 190 rupees per share for the company going forward. And that is what we'll keep an eye out on as well.
All right, Vinny, thanks very much for that. That's the update coming in as far as stocks are concerned. Commodities in focus. Manisha, of course, is here. She's been, I think, on top of developments as far as oil prices are concerned. Manisha, we've spoken to a bunch of people this morning, and everyone kind of course, highlighting the fact that oil perhaps should have been up more. It's not, and that's telling.
Oh, yes, it is. And, when you look at the prices itself, we've seen after that knee-jerk reaction, prices come off a bit. We're trading at around 2% on the higher side after the U.S. attacked 3 nuclear sites in Iran. The knee-jerk reaction after the markets opened after a weekend, we did see prices gain up by 5.5%. We saw $81 a barrel. But from there, we've seen easing in sense of markets. And that is because there is no immediate response coming in from Iran after these attacks. Of course, there's a lot of rhetoric and a lot of statements coming in, but nothing on ground. And that's taken the prices off those highs. In any case, if you look at the crude oil prices, we've seen 10% of gains coming on this after Israel launched its attack on Iran a week ago. And 10% on the higher side is still holding. And this is even as there is no impact on oil supplies, no impact on oil exports, and no impact absolutely on Strait of Hormuz as well. So the Brent, as we see it right now, is looking at resistance of $80 a barrel. Interestingly, if there is an impact on ground, we have seen crude oil prices jump up quite strongly in those cases. 1979-80, remember when there was Iran revolution, we did see the crude oil prices triple at that point in time. Very recently in 2011, during the Libya revolution, we did see prices surge all the way from $93 to $130 on the higher side as well. So things do happen when things happen on ground though. What is the worst case scenario that markets are talking about or looking at is if there is an impact on the production, especially coming in from Iran, which is producing at this point in time 3.3 million barrels per day. And apart from that, if you look at the prices itself, we've seen strong gains already come into the markets. As I said, the last 1 week has seen 8% of gains. In last 1 month, we are already up by 25%. And in this year now, we've turned in the positive. 2023 and 24 were negative years for crude oil prices, but 25 clearly in the positive right now. As I was saying, markets are looking at various scenarios on what really could go wrong. For example, Iran is producing 3.3 million barrels per day. It is exporting 1.84 million barrels per day. This was for the month of May. Any changes in this number, you will see the crude prices gain up. Apart from that, the closure of Strait of Hormuz is going to be a very, very important thing to watch out for. At this point, it's only about rhetoric. Nothing has been done. So you are looking at 20 million barrels per day, or 20% of global oil flowing through this route even now. As per the maritime reports, around 100 to 120 ships sail through Strait of Hormuz every single day. And those reports continue to be around those numbers at this point. Iran has threatened US bases in West Asia. If something happens there, you will see the crude prices go up. Apart from that, the regime change in Iran also could be a reason that you could see crude prices gaining. We have seen regime changes in major oil-producing countries do lead to crude prices being quite volatile as well. At this time, the spike in crude oil prices has led to a lot of hedging. It's been record hedging volumes that we've seen in the US markets that has gained up by 25% in last 1 month itself. Well, we've seen crude oil prices at $60 this year. So when you're looking at prices at around 75 and between 80, you are looking at prices gaining there. It's interesting on what various banks and brokerages also have been saying. They also have not been major bulls into the market. Citi said that the prices could hit 78 if conflict disrupts 1.1 million barrels per day in sense of Iran exports there. Citi also says that a disruption of 3 million barrels per day within Iran production can take the prices to $90. We haven't seen that scenario emerge. JP Morgan says in an extreme case, you could see prices go up to 120, 130 as well. And that extreme would be Strait of Hormuz being closed. We haven't seen that happen. Goldman Sachs also says that the prices can surge quite strongly. They already see a premium of $10 per barrel in the prices. And an extreme case like a closure of Strait of Hormuz, they also believe that the prices can go to triple digit there. Barclays' view is $85 if the exports are cut. We also have statements coming in from Mizuho Group, which says that in case of a disruption is when you could see prices going up to $85. And there are similar statements also coming in from trading.com, BOFA as well, which believe that de-escalation can take the prices to 65, and if something happens, then up to 85. And that is the kind of range that many of these banks and brokerages at this point seem to be working with.
Okay, all right, got it. Thanks very much for that. So oil in very, very sharp focus. We'll take a break on that note, come back on the other side. And in our special segment, it's the economy. Today, Lata speaks with MPC member Saugata Bhattacharya on the state of the economy under changing geopolitics.
The minutes of RBI's Monetary Policy Committee showed that all members agree growth needs more help while inflation is anyways way below the 4% mandate of the MPC, and hence the 50 basis rate cut, repo rate cut, was warranted to ensure banks have more certainty and can pass on the rate cuts, ensure transmission. However, one member voted against the 50 basis cut and opted instead for a 25 basis cut. Saugata Bhattacharya, the external member of the MPC, is our guest today. Good morning, Saugata. Thank you very much indeed for your time. Have I understood you right that you did not want a 50 bips but preferred a 25 bips because you think growth is very resilient?
Good morning, Lata. Thank you very much for having me on your show. So the first thing I need to emphasize is that I speak only for myself, not on behalf of anybody else in the MPC.
Sure.
So you put it absolutely succinctly. I think given the combination of the really elevated levels of uncertainty that still persist at this point in time, and all signals suggesting that growth impulses remain resilient, I thought that the risk-reward balance of a 50 basis point cut at this point in time was probably not warranted enough. I think a 25 basis point was more appropriate at this point in time, given the path of uncertainty. So again, if you permit me 2 seconds, 5 seconds,
sure.
This harks back to my old April policy statement that there is the inflation trajectory. And remember, there were only 2 data points which were relatively new for the July meeting. One was the reduction in the RBI's forecast of CPI inflation for FY26 to 3.7%, and the growth numbers that came in for FY25, together with the RBI's forecast of FY26 growth at 6.5%. So this gives, to my mind, space for good news rate cuts. There is ample policy space for cutting. However, there is absolutely no need to push forward into a bad news rate cut, given that growth remains so resilient. That, essentially, in a capsule, is my rationale for a 25 basis point.
Okay. So what may be your own trigger for another rate cut? Will it be if growth disappoints, or will it be if inflation undershoots?
Without question, inflation is the primary target. That's the mandate of the MPC. So I do remain confident that given the way the progress of monsoons that we have seen, given the global political situation, that for the next few months, at least for the next couple of quarters, we might see an undershoot of inflation given the current forecast. So that opens up space, to my mind, for further rate cuts. But that's something which has to be determined on a meeting-by-meeting basis, monitoring incoming data, seeing the macro-financial conditions that prevail at that point in time. So this is probably not the time for pre-committing on a policy path easing. It has to be done meeting by meeting and very data dependent.
Okay. Well, actually, the chances are the Reserve Bank will be surprised on the downside. The poll of economists actually indicates most of them are expecting 3.5 average inflation this year, not even 3.7. So if the Reserve Bank is forced to acknowledge that in, say, the October policy or December policy, do you see scope even beyond 5.5? I mean, like 5 quarter is a possibility?
Perfectly. I mean, actually, you're absolutely right. Beyond less than 5.5 is eminently possible. However, remember at this point in time, the assumptions behind all the forecasts, the models, the predictions, etc., these are very volatile. I mean, these are liable to change very, very quickly. I mean, if not in days, in the matter of a few weeks. So, so all of that needs to be treated with caution. We do not know how I'm not terribly worried about the current geopolitical tensions going on. I think that will settle within a few weeks' time, if not even early. So I'm not very worried about that. What I am worried about, the contours of the trade agreements that are liable to be signed, not just India with the US, all the other countries with the US, giving us a sense of the relative positioning of India vis-a-vis the US amongst our other exporting peers. That, to my mind, is a far bigger source of uncertainty, and that's something that we need to keep watch about. So, if the global growth situation begins to improve, remember the Fed forecasts a major reduction in growth in the US. If that doesn't pan out, if China growth improves, then you are actually liable to see global commodities prices, particularly metals prices, forget about oil, going up. So these assumptions are now very, very fluid, and that needs to be taken into account in forecasting the potential path of policy easing going forward.
Okay, actually, I was going to invite your comments precisely on that. We also have a very poor tax growth number, just 4% for the month of April-May. But before that, let me just complete the MPC issue. Did no one, I would have expected you to protest on the stance. I know you told us last time that the stance is not put to vote. But as a market man, you would probably better understand than even the RBI guys that when you give a 50 bips cut and change a stance in one policy, the market actually took the stance more seriously and yields went up. Would it not have been wiser to leave it as accommodative, but in the conversation or in their action, do a VRRR of a limited quantity? That did not come up for discussion? You didn't advise?
Again, let me go back to my original first statement. I speak only on my behalf, not
Yes.
So, I'm not going to comment on the discussions or the actual change in the stance. I will take you back once again to my April statement, where, if you remember, I did mention that I had a prior reservation about changing the stance from neutral to accommodative at that point in time. Okay. I felt it would have been wiser to keep the stance at neutral at that point in time, given the extreme uncertainty at that point in time. But ex post in the July meeting, despite my own vote dissent, once it became clear that the MPC was voting for a 50 basis point cut. So at that point in time, to my mind, it was more prudent to revert back to a neutral stance. Okay. Just to communicate to the market as a proxy for forward guidance that need to be very cautious at this point in time, need to be very, very data dependent going forward in the rate.
Okay.
So that was the basic rationale for agreeing to the change back to neutral.
Okay. You always were preferring that stance, you said. Don't pre-commit because we live in tense times. Just to wind up this growth argument, you yourself alluded that you are more worried about the tariffs rather than geopolitics, and that is obvious. Today crude prices, one would have thought with a threat to the closure of the Strait of Hormuz, it would at least go above $80. It hasn't even done that. So I take your point that geopolitics is a worry in a broader sense, but not for financial markets in an oil sense. But Saugato, there are worries about tariff destabilizing growth itself. Our exports, even in the last month of May, were flat compared to the previous year on year. And they could, goods exports especially, could take a hit. Global trade is expected to be lower. And above all, this May tax numbers are particularly a pointer that things are not as robust as the Jan, Feb, March quarter. Maybe. It is not only net taxes. It is not because people have asked for refunds. Gross taxes and net taxes are pathetic, 4% and 1%, minus 1%. So do you think, growth, the MPC members were perhaps right, growth does need help?
No, you're absolutely right. I couldn't have put it more succinctly than you've stated. I know, we've gone back a long time together. So I do worry about growth. There is absolutely, as the governor and the other members have mentioned, that this 6.5%, even if we assume that the RBI is correct, that the growth forecast of 6.5% for FY26 still pertains. And there are conflicting signals. There is no doubt about that. So some of the high-frequency indicators do seem to suggest that growth impulses still remain. The actual numbers, so this is again the divergence between the soft data and the hard data. The hard data coming in with the numbers for tax collections, e-way bills, etc., do suggest that there is some persisting weakness. The numbers that we have seen for the rural wages indicate that there is some resilience coming, if not fully coming back into the rural economy. The urban economy still remains relatively stressed. So, the picture is very mixed. I do not know which way growth is going to go.
No.
So, each and every new data point needs to be evaluated for the growth inflation balance, the growth inflation mix going forward, and then take a call on what it is that needs to be supported. And this is the reason that I came in the beginning saying that I am now very, very data dependent looking at the incoming data, monitoring the global conditions, domestic conditions, and then take a call on what.
Okay, just a final question on the inflation number. Like you said, it could well undershoot. At least the market expects it to be less than 3.7. But as the governor pointed out, in the rate setting calculation, next year's inflation also comes into the fray. It's a 12-month forward. And next year's, partly because of the low base, is expected to be well above 4.5. If that's the case, do you think the market should not be betting on another rate cut? Because the 12-month forward is not 3.5%, it's over 4%.
Far be it from me, Lata, to try to preach to markets. I mean, they're far smarter than I am. But definitely, I would suggest that a rate, the neutral rate, essentially, I mean, this is where it comes down to.
Yeah.
The neutral rate should be looked at as a steady state through the cycle, not just at a point in time. At this point in time, we are fairly deeply restrictive in terms of policy, but that's not the way to look at it, as you very well know, as your readers will know. It has to be looked at over the cycle. And given the uncertainties, again, I'm mentioning, because I just do not know which way the trade deals are likely to play out, not just in India, across the world, global, I mean, all the major trading economies, how this is likely to play out, India versus the UK, EU, FTA, India versus the US, the other trade agreements that we are looking, and all the other US trade agreements. So how that evolves over a period of time, you've already seen the preliminary trade indications of the US with China.
Yes.
If that happens, we should be prepared for an increase in global metals and commodities prices. So, I mean, given these uncertainties, I agree that inflation at this point in time, using the lens of the current situation, inflation looks to be very moderate, but that can change very, very quickly.
Okay. Fair point, sir. It was a pleasure speaking with you. As always, Saugata Bhattacharya, thank you very much indeed for joining us and explaining how we should be looking at data and how the MPC needs to be terribly data dependent. That's the word coming in from a very important policymaker and MPC external member. We wrap up on Bazaar on that note. Chartbusters coming up.
Geopolitical tensions spook the Indian market as United States enters Israel's war with Iran. Strikes against Iran's nuclear infrastructure. The Nifty slips over 1% and all sectors trade with losses. The broader market's slightly better off.
Diagnostics stocks slip as Amazon marks its entry into the sector with the launch of an at-home diagnostic services. Weighing on the stocks, Metropolis and Dr. Lal's, both of them down 1.5% to 2.5%.
Bharat Electronics, some of the few gainers in the market today on the Nifty. It's bagged a defense order worth nearly 600 crore rupees.
Aditya Birla Lifestyle brand lists on the exchanges following its demerger from Aditya Birla Fashion. The stock debuts at a slight discount to the discovered price of around 171 rupees per share. Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And Mangalam, you'll have to say it's not such a bad outcome, right? If someone had to tell you that the Nifty is going to be down 200 points, a little less than 1%, and the mid-cap index are down only around 0.2%, I think you'll take that outcome. And the breadth of the market is fairly good for the kind of news flow that we had. The geopolitical tensions as well, a lot of supply of paper as well. And you still have close to around 1,000 stocks that are still advancing. I think that's a good outcome.
That's a good outcome, and technically as well, it's important because the Nifty is back at 24,900, which means that it went below the 20-day moving average and bounced back from that. And secondly, so is the case with the Nifty Bank, which is down about 0.6%, but today went below the 20-day moving average. And now as we speak, 55,900 is where the 20-day moving average is. The Nifty Bank is slightly above that. So all these dips are getting bought into. The fact that there has not been any further escalation in oil prices beyond that as well is a bigger barometer of how the world sees this crisis emanate. Who's to say whether we're out of the woods or not, but the good part is that we're not falling as much, and that is something that the street will take note of. Let's welcome Shivangi Sarda from Motilal Oswal Financial Services for a quick technical check on the market. Shivangi, yes, we've given up the gains that we made on Friday, but then again, prior to all those days, we were in this range. Nothing much seems to have changed.
Very good morning, Mangalam and Nigel. Thank you for having me. So we've seen that there was a very strong comeback of the bulls on Friday's session. And over the weekend, we've seen some global tensions, of course, cropping up. But at home, domestic factors are quite strong and they're holding up the index. The opening was, of course, affected. But overall, after the opening, we've seen that there has been a bounce and the low hasn't been breached for the last week. So overall, we are seeing that, there is some sort of strength, but of course, lack of follow-up because of the sentiments. But we are recommending, some sort of consolidation at these levels. Of course, we've crossed a psychological 25K mark and we had, closed on a very strong note. But the momentum is likely to continue. We're entering into the monthly, expiry week for the June series. And from the last 10 years, seasonality-wise, we've seen June has always been positive for Nifty index. So overall, those factors will also play in, will be played out. Now, put-call ratio has also improved and, which is indicating that the put writers are quite comfortable. So upside, we're looking at 25,250, 25,350 odd levels and with the support of 24,700 marks for Nifty. Now, talking about Bank Nifty, of course, the smaller banking names have picked up strength and they are showing more resilience than the larger names as of now. But overall strength can be seen across the NBFCs as well as the banking space. So this one's, ready to hold at the higher zones. We're looking at Bank Nifty with a support of 55,500 for the next upside move towards around about 56,500. But of course, some sort of consolidation expected before the next leg of rally to come in.
Okay, got it. Hi, Shivangi. Good to see you in. Individual stocks, what's on your radar?
Individual stocks on my radar, Nigel, is first up BEL, of course, with the theme of the entire market and global cues right now. We've seen that this stock has consistently moved in an upward from the last 5 weeks in a very consolidative manner, but slow and steady. We've seen strength building up here. On Friday's session, it closed very strongly with a price volume surge, and we've seen that month-on-month basis also this stock has done very good from the last 4 months. Now, rollover activity has been quite interesting in this one, and which is why it's looking attractive at these levels. We're looking at this stock for the next target of 435 levels with a support of 406. And the second pick on my radar is Persistent Systems, strongest in the IT names, and we've seen that particularly this stock has done quite well. There was a significant open interest increase in the last week, and we've seen that on a month-on-month basis also it is coming out of a consolidative band. So overall, we're trading very comfortably above its key exponential moving averages as well. So we're recommending a buy here with a target of 6350 levels for this one with a support of 6000 zone.
All right, we take that point. Thank you so much for joining in, Shivangi, and giving us your call on the index as well as individual stocks. Diagnostic stocks, they're under pressure as Amazon announces its entry into the sector with the launch of an at-home diagnostic services which can be availed via the Amazon app. The services, which are in partnership with Orange Health, will be available in over 450 PIN codes across the country. Ekta got in touch with the team behind the launch of this service. Listen in.
We are working with Orange Health to bring in their reliable and trusted diagnostic ecosystem for the Amazon customers in the Amazon app. So what it entails is an Amazon customer can go to Amazon Medical's health intersection and have like a diagnostic test directly ordered on Amazon. And Orange Health will be the partner who will kind of fulfill it at the back end.
Orange Health from the beginning has been focused on hyper-convenience for consumers. 4 years ago when we launched, we started with the idea of enabling 60-minute home collection and 6-hour reports. And, Amazon is a company that we've been that we've admired from far in terms of their innovation, their scale, their reliability, and their customer centricity. So, with such a strong value alignment between their company and ours, we're super excited to be partnering with Amazon to actually launch Amazon Diagnostics across, the top 6 cities, and covering all 450 plus PIN codes. In terms of test coverage, look, we're a full stack diagnostic lab. So we offer over 1,000 tests that are available to customers.
We kind of look at healthcare as a trifecta of 3 different services, which we believe completes customers' requirement of an health intervention, which is a doctor consultation, there is a medicine delivery, and there is diagnostics. These work in tandem. We call it longitudinal healthcare, where each of them are supposed to feed into the other. So we are completing the health trifecta in its way by kind of offering Orange Health services to the Amazon customers. Why Orange Health? I think we are, as a company, we've kind of looked at Orange Health and kind of admired the kind of customer ethos that both Orange Health and Amazon shares, which is bringing the best quality service and a reliable, trustworthy experience for the customer, which the customers can bank on. And Amazon has given that, and we've seen Orange Health do it, which is why we feel it's an organic partnership.
Welcome back. Well, the markets continue to trade with a cut, but there are a couple of stocks that are moving higher. You know, Madhusudan Kela, his fund has checked into Northern Arc, and that stock now has made a bazooka move. Big volumes out there. It started off with a gain of around 2%. Last I checked, the stock was around 225 rupees. So Northern Arc is one stock. And the other one I'm looking at is Z. You know, they put out a presentation. They are talking about breaking even in Z5 from the losses that we saw in the past year of around 500 crores. So for the time being, the street is buying into that. Promoter entity as well had, pumped in money last week. They're going to be paying 25% of that money. So I think the street is turning a little bit optimistic on this counter.
You know, it will be very interesting, Nigel, because if they are turning positive in Z5, then ideally the inherent value of the business should be much higher. And in that case, what is it that prompted the promoters to, convert their warrants at 132 rupees itself per share? To 18 months from now. So that's something that we'll have to monitor very closely, whether, they actually go ahead, walk the talk. The street is valuing Z's business a year from now as well.
Indeed. We'll keep an eye out on that counter. Well, let's focus on another name, ITD Cementation. It's been seeing strong order inflows of late. The order book, however, has seen a good amount of inflows in this year. We have with us Mr. Jayanta Basu, Managing Director of ITD Cementation, who joins us on the show. Hi, Mr. Basu. Good morning. Good to see you in. It's been a while since we spoke. I recall visiting your office a couple of years ago, and you sounded very confident on the business. And boy, oh boy, haven't you delivered. Let's talk about business, though. A couple of order inflows is what we have seen in this year so far. Could you tell us, what is the current order book post these inflows? And what is the total order inflow you're estimating for FY26?
Good morning, Nigel. Thank you very much for arranging this interview. Yes, we have received a few orders this year already, amounting around 2,000 crores. One is the port construction at Trivandrum, one is building, and one is jetty at Odisha. And we are L1 also, few jobs around 1,500 crores. So you can say that around 4,000 crore order is already with us within these 2 months' time of this year. We are looking for, if we have seen the guideline, around 15,000 crore order we should book, at least 15,000 crores. Yeah, I think it will be more than that. Yeah.
All right, at least 15,000 crores, of which 4,000 crores you've gotten it. In terms of the other numbers, what are you guiding for, Mr. Basu? In terms of revenue, what sort of margins are you expecting by the end of this year? And by when does this entire order book get executed?
Well, if you see recently, we used to convert the order in 3 years' time, 2.5 years' time. Last year, it done in less than 2 years' time. So we expect that the same tempo will be maintained. The conversion become very fast nowadays. Last year, our revenue was 9,000 something, around 9,000 crores. We expect at least 25% growth this year, if not more than that, in top line. Yeah.
And on margins, last year you saw an improvement of around 70 basis points, at least in the fourth quarter.
Yeah.
What kind of margins are you anticipating this year on a 25% revenue growth?
We will be having around 10% plus EBITDA. Yeah.
EBITDA?
10% plus.
10% plus. Got it. Mr. Basu, I wanted to ask you about the receivables position as of now. And what is your exposure to Bangladesh? There were some issues out there. They are going through some political turmoil. So how is it impacting your business?
Well, Bangladesh, I think for 2 to 3 months' time, we had to stop the work because of the directive by the government of India. It is not only us, all the companies, those who are working in Bangladesh from India has to stop the work. We resumed the work in the month of December, and from there it is going on well. And production is good, and we have received advance, we have received 2 subsequent RA bill payment. So there is absolutely no way that there is any concern there.
What is the exposure, sir, in terms of business, revenues or order book? How much of it comes from Bangladesh?
The total value of the job is 1,500 crores. And we are expecting this year will be around 700 to 800 crores to be done this year. And we are quite hopeful that we'll be able to achieve that.
And there's no issue on the receivables?
No issue at all.
All right. Mr. Basu, the last time we spoke to you, you were an ITD-owned company. Now you're an Adani-owned company. So what we want to understand is that, with the new management or the new owners taking over, does the strategy of the company in any form change? What we're trying to understand is, were there any orders that you got because of your parentage that may go off. And now, because of the new parentage, will you get some more orders from the Adani Group? How does the nature of the company, the management, the strategy, the roadmap ahead move from here on?
Let me address it step by step. First and foremost, there will be no change in the management. The way we used to work before, same way we'll be working. It will be purely independent company. That is number one. Number two, because of Adani factor, they themselves have a lot of work, you know that. They're developing like anything. So any sector we name like port, power, green energy, data center, so everywhere they have their presence. And they want us to do as much as work I can do from them. So our volume of work for Adani will increase many folds. And third is that the exposure to the financial institutions. You know, we had little trouble a few years back to manage the cash, to have the non-fund-based facility. That thing will be much easier now because of Adani's involvement. And last but not the least, that they want us to grow very fast, which was not the case before. And all sort of supports are promised to be given by them. Yeah.
How much of your business comes in from the Adani Group as of now?
As of now, it will be around 25-26%.
Okay.
Yeah.
And it doesn't come at a lower margin, right?
No. It's all arm's length business. I mean, at market price, and you can see the result.
Right.
For Adani, it's quite okay.
You know, that is one part. And the other part is you said that you reconfirmed that you are looking at 15,000 crore worth orders being inflown this year itself. You're winning that. That is nearly double of what we saw last year. So is that on account of your existing businesses? What's leading this momentum? Or do you think that, you know, some part of it will also come in from the Adani Group because of the infrastructure presence that they have?
Well, some part will definitely come from Adani Group.
How much will that be?
Say 35% of 15,000 crore, around that.
So that's 5,000 crore of your order book you expect from the Adani Group. And the remainder you said will be business as usual, all the things that you've been doing.
Yes.
And what are the receivable terms out here? Okay, margins are, you say are market driven and they are allowing you access to financials, etc. as well. The receivables position, will that be at market terms as well?
Yeah, receivable position with Adani will be, because you see, whatever work we are doing, mostly the Ganga Expressway, we get payment within 7 days' time. Nowhere you can see such good payment terms. And we have absolutely no problem with Adani as far as receivable is concerned.
Okay. All right. Thanks a lot, Mr. Basu, for joining in. I think the street likes what you're saying. As we speak, the stock has recovered. And Mr. Basu, if I got it correct, I think ITD Cementation is the only firm you've been part of, right? I think next year you complete 40 years, if I'm not mistaken. Is that correct?
You are right.
All right. We hope to speak to you when you continue to, do a lot more and hopefully hit a half century as well out there, sir.
Loyalty at its best, sir. I think you joined as, post graduation and now you're leading the company. So kudos to that. We'll talk about that some other time as well. Thanks a lot for joining in and filling us in with all of those details. And all the best for the remainder of this year as well.
Yes, not only ITD Cementation, the street likes that, what the management said, but keep an eye on the mid-cap index. Briefly went into the green, and we have a bunch of stocks which are spiking. You spoke about, Z Entertainment. Look at, something like a Strides Pharma, Granules India, all of them moving to the high point of trade in decent gains. Nykaa is the other one, which was in the red for most part of trade and now has moved into the green. You have Ambuja Cement, Varun Beverages, MCX, a bunch of stocks making big gains. And speaking about big gains, pull up VIP. VIP Industries is the other one, which is up 18% this month. Poor numbers coming in. Everyone is hoping for a deal to come by. When that happens, how that happens, in what form or shape, the stock keeps buzzing along, up around 5% with big volumes on VIP as well. With that, we'll slip into a short break. And as we do that, let's get you good news. All you viewers, we have India's business news leader, which is CNBC-TV18. It's now just a click away. You get it on your phone. That's the all-new CNBC-TV18 mobile app, which gives you in-depth articles, financial world updates, all of them at your fingertips. You can just download this app from either the Apple Store, the Google Play Store, or just scan that QR code, which is up for you on the screen. Welcome back. Let's keep an eye out on a couple of these names which are buzzing around. Yes Bank has moved into the green. Angel One continues to do well. E-Clark Services is the other one. All of last week, one of the stocks was Swiggy, up in double digits. And this morning as well, from the lows, has seen about a 3% recovery back into the green. Let's get you some ideas for profit coming in from our colleagues at Money Control Pro. Today we have Anant, who joins in with a stock that he's been tracking.
So today's stock is Syrma HCL Technologies Limited, a leading player in electronic manufacturing services. The company specializes in manufacturing printed circuit boards, PCBA, magnetic coils, and telecom products. Currently, the leading share comes from the consumer segment, which accounts for 35% of the total revenue in FY25. Over the years, Syrma has broadened its product offering and expanded across industry verticals. The company is focused on reducing dependence on the consumer segment, while also increasing exposure to high-margin verticals like industrials, automotive, and medical. Another key focus area is growing its ODM share from 12% to 25% of the total revenue in the coming years. Syrma has strategically pursued acquisition to scale its operations. The recent acquisition of Johari Digital in 2023 marks its entry into the fast-growing medical devices segment. Additionally, a partnership with Taiwanese computer hardware company, MSI, to assemble laptops at its Chennai facility marks a notable step into the high-tech manufacturing. With an order backlog of more than 5,000 crore, management is guiding for 30 to 35% revenue growth and 8% EBITDA margin in FY26. The stock trades at reasonable valuation of 30 times on FY27 earnings. However, a key risk remains its high customer concentration, with the top 3 and top 10 customers accounts for 14 and 32% of total revenue respectively.
Thanks a lot for that, Anant. Well, let's hop across to Vinny. She's here to tell us about the new listing today, AB Lifestyle. Vinny, tell us more.
Hi, good morning. So Aditya Birla Lifestyle, that's the demerged arm of Aditya Birla Fashion and Retail. Obviously, the record date for this was 22nd of May. The listing has happened today. The price that was anticipated for the listing was around 171. Right now, it listed at 167 below that, and we've seen a bit of a fall coming in. So muted listing is what we're seeing for the company. Now, what does Aditya Birla Lifestyle brands actually hold as a company? They'll have the Western wear legacy brands that are there, growth brands and strategic brands that the company wants to focus on. Reebok, American Eagle, Van Heusen Innerwear is what they'll be hosting or having under their kitty as well. Now, obviously, lifestyle brands is a big part of the business as well. They overall ABFRL business before it got demerged, also it accounted to 85%. So yes, a good chunk of this business also is coming in here. The division in terms of revenues now for ABFRL as well as this new listed entity will be almost in the same range. So not much of a difference on that front. Now, according to Motilal Oswal, they are maintaining a neutral rating. They have a neutral rating for Aditya Birla Lifestyle brands, a target price of 190 rupees per share. And yes, a mutual listing is what they were anticipating as well, and that's what we're seeing coming in today for the company.
Thanks a lot for that, Vinny. That's about Aditya Birla Lifestyle Fashions. With that, we'll wrap up on this edition of Chartbusters. You stay tuned to CNBC-TV18 as Trading Hour comes up next.
Hello, good morning. You've tuned into Trading Hour, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. With me is my colleague Hormaz Fataki as well. Hormaz, good morning to you as well. Obviously, given what we're seeing coming in from the global end of the markets, it was not exciting. But the broader end of the markets, we're seeing that green coming in on the screen. You can see it here as well. Clearly, he's protesting against the red and wants to just be against it. And that outperformance coming in from the mid and small cap of the market. Yes, but Nifty and the Sensex both under pressure.
It's the mid-cap index. That's the recovery of the day. And even as the benchmark indices continue to struggle, it's the mid-cap index. There you can see an almost 300 plus point recovery from the lows of the day has moved into the green. It is the broader markets that are continuing to outperform in today's session as well. And there are movers, of course. You cannot deny that there are. And look at who's leading the recovery. Look at Z Entertainment, 10% higher now on the stock after the company shared its growth plans for FY26 in its investor presentation at the highest point of the day. The top gainer on the Nifty 500. And of course, no prices for guessing. Zen Technologies is up 5%. A lot of these defense names continuing to do well, of course, for obvious reasons. Zen Technologies, of course, on the back of an acquisition as well that they had made. And there are other movers, the oil sensitives, MRPL, Chennai Petro, and they are the ones that were supposed to be having a negative reaction because of the rising oil prices. But look at the spike there. MRPL is up 4%. Chennai Petro is up an equal quantum, if not more. 4% higher on that stock as well. So both of them trading at the highest point of the day. What's not doing well though is IT. And that is putting pressure on the index. Accenture's results were the key trigger there. The stock ended 7% lower on Friday, Vinny, and that's having a rub-off effect on our own names.
It is, Verma, having a bit of a rub-off effect. But as such, if you look at Accenture's numbers, except for bookings that were bad, it was not a bad set of number that came in from Accenture. Revenue 7% growth. Yes, they did say that, maybe some bit of a mutedness they could see coming in for the federal contracts, but guidance that they spoke about, now it's at 6 to 7%. So the lower end of the guidance is actually, something that they have risen further from 5 to 7%. Now it's 6 to 7%. Organic growth guidance, 3 to 4% is what they've given as well. And that is nearing that pre-COVID level long-term average that one was looking at. So, again, not bad in terms of guidance as well. Outlook also, they were quite positive on that front as well. One bit of a concern that comes in, this is just for the US market that was there, mainly federal contracts. That is a bit of a headwind that they are highlighting. Now, how does it work for Indian IT companies? Federal contracts, we do not have much of an exposure in terms of that. Very little or limited exposure is there. So not a big concern on that front. Now, AI momentum, that's picking up. So that turns out well, even for IT companies Indian IT companies in terms of read-through. BFSI, where Indian IT companies have so much of a larger exposure. That did well for Accenture. They're saying the trends are good over there. So that was not bad as well, Horma. So, clearly it is that something that we were expecting it to be a bit more positive. But I think given that the sentiment that is going on right now across the globe, some bit of a pressure that is coming in terms of that as well for Nifty IT as well. But to take this discussion forward, we have Bhavin Shah, founder and portfolio manager at Samiksha Capital, joining in with us. Bhavin, good morning. Thank you so much for joining in with us. I was just saying that Accenture numbers really didn't seem bad. Now, if we didn't have these issues today of geopolitical tension, what are your thoughts coming in for Indian IT companies as well as overall the performance there?
I think there are multiple factors at play apart from the geopolitical factors. There is obviously in geopolitical factors, I don't know what all you include, but clearly there is uncertainty with respect to US growth. There is a cuts in spending coming in the government area, but broad, much more important than all of that are a few other things. One is how Gen AI is changing the way code development is happening. And I think that is visible to anyone who does anything with code development. And I think it is sharply reducing the need for number of programmers you have. And while this faster pace of development may lead to superior applications and so on, I also feel that it's that will take some time, and more importantly, overall, there is going to be a reduction in the number of people required to do programming. And I think clearly Indian IT companies have a significant portion of their business that is tied to time and material, and that I think is a clear impact. The other important thing to remember is that the overall size of the market was seeing a slower growth prior to COVID. And I think now that COVID reset has happened, we are back to that trend line, and that trend line is, sort of shifting, heading down in terms of the growth rate. There is also a factor of GCC, the Global Competence Centers. What we are hearing anecdotally is that the growth rate, they are still hiring. So, there is some shift happening also from the Indian IT companies to the GCCs. And one of the data points on that is that if you look at last 12 months, how much revenues Accenture added with respect to the US business versus how much revenue Indian IT companies added. Indian IT companies have added very, very small number compared to Accenture. So there is clearly also that loss of market share that is happening. I think, there used to be a time when companies like Accenture would grow at a slower rate than Indian IT companies. The reverse is happening now. And as Accenture is available at a lower valuation than Indian IT companies.
Okay, Accenture is lower than Indian IT companies in terms of valuations. So then right now, should we actually, what should we be expecting for ourselves in Q1 FY26 now? Anywhere that there is value or in terms of earnings, mid-cap, large cap, what are you expecting in terms of performance there?
So I think there could be some very, very selective mid-sized companies that, are still enjoying double-digit growth because, they are small in size and they have bigger opportunities to play. And I think, they could be also, they all have corrected, in this along with the large companies. So there could be some opportunities very, very selectively there. But the overall tone for the sector is going to be of lower growth, profitable growth, good cash flows, but much lower growth. So that valuation reset, I think it has already happened a fair bit, but more further could happen.
Bharat, good morning. Thank you for joining in. Let's break it down now. I was just reading a note a couple of days ago where it spoke about Infosys completing a few acquisitions in the last couple of months, and that could be a trigger for the company to raise its guidance for FY26, which was currently around 0 to 3%. Do you see that happening this time around? Will those acquisitions that they have done be beneficial to them in the current financial year, so much so that they will raise their guidance?
I don't know, but I think acquisition obviously brings some extra revenues. In fact, even Accenture has talked about two numbers. One is the overall growth guidance, which seems not so bad. But if you take out the acquisition part, then the organic growth is only like 3%, 3 or 4%. So I think acquisitions can lead to higher growth and might help Infosys as well. But obviously that means that comes at the cost of cash flows. So then we are looking at free cash flows and free cash flow growth, and and that's ultimately what matters.
What's your pecking order then within the sector, Bhavin? Large cap IT, mid cap IT, where do your preferences lie?
Largely avoiding the sector. One or two very, very small bets on mid cap IT and sort of companies that are more catering to the system integration, distribution kind of businesses across many countries rather than the pure time and material type of businesses.
Okay, Bhavin, thank you so much for joining in with us on the show, giving us an understanding in terms of, what we should be expecting from the Indian IT companies, as well your thoughts on that as well. So this is coming in after Accenture's numbers. But on that note, we're going to slip into a very short break. And after the break, we'll come back, discuss what's happening in the world of commodities with Manisha Gupta. So do stay tuned in for that.
Welcome back. Still 200 down on the Nifty. So Sensex 50 down on the Sensex as well. But some of the movers in the broader markets on the downside is Ola Electric. It had a block deal earlier in the day, and that stock is now down 4.5% as we speak. And there you can see that knock that it took earlier in the day, and after the block deal, around 0.5% equity changing hands. So now at 44 rupees is where Ola Electric stands. LT Foods is the other one, 3.5% lower on that stock as well, after the countervailing duty that was imposed by the US Department of Commerce. So 3.5% lower on LT Foods. The diagnostic names are the ones that are moving lower today. Dr. Lal is down 3. Metropolis is down as well after Amazon's foray into the space, and that too. V-Mart Retail, of course, trading ex bonus in today's trading session. Sterlite Tech, a big mover of the last couple of weeks, actually 4% down on that stock as well. So some of the losers in the broader markets, and of course the stock of the morning on the gaining end though is Northern Arc Capital, 10% higher on that stock. Remember, a mega block deal took place in the stock last Friday, about 14% equity changing hands, and the list of buyers that has come in, as Madhusudan Kela's name features in that list in one of his funds that has featured among the buyers along with BNP Paribas. So 10% higher on Northern Arc Capital. Mind you, even after that 10% surge, the stock is still below its IPO price of 263. But shifting to the commodity space now, Manisha is here with us. Talking about gold, was supposed to shine but is not doing so, Manisha.
Oh, well, absolutely. When you look at the markets right now, we haven't seen many asset classes actually gain today. It actually is the money is being deployed towards shorting some of these asset classes, or it clearly seems to be waiting on the sidelines for some more clarity to appear. What we've seen happen in case of gold is, yes, there was an expectation that you would see the gold prices gain up given the kind of geopolitical tensions and scenario that we are dealing with. But the physical buying is quite amiss, and that seems to be weighing onto the markets. Also, when you look at the hedge fund money, the ETF inflows also seem to be really slow at this point in time. The markets did think that the US involvement in the Israeli strikes on Iran could lead to safe haven buying, and we have seen that happen. But that really seems to be happening in the US dollar index and not in many of these other asset classes. You have seen gold prices decline, silver is down, copper is down. Even the cryptocurrencies have been trading on the weaker side here. There is a growing consensus that we could perhaps see this fallout getting contained, and there would not be a need to buy in case of gold. In any case, markets believes that $100 of a premium is what we already have seen build up in case of gold. We already are trading nearly 30% on the higher side for this year. So there has to be some more very strong development before you see crude prices run up, or for that matter, gold being bought into. Having said that, it's going to be an important week otherwise as well. You have various Fed officials expected to speak in this week. Powell itself is expected to speak in the next couple of days. So markets will keep an eye on that, because there would be a reaction on what US has done, and of course the Middle East impact on the US economy as per se. Apart from that, it is about US core inflation, weekly jobless numbers, PMI readings. There's a whole host of data coming in this week that the street will react to.
Absolutely. We'll be keeping an eye out on that. But today, gold is not glittering for sure. A lot more data points will be required, given that we've already seen the run-up, is what Manisha is highlighting, before we see a run-up coming in for gold again. But what's shining today is the broader run of the market, and that's continuing to shine. Made in small cap, both in the green, especially Nifty small cap, that's trading with gains of 0.3%. But moving on, America's decision to target Iran's nuclear has sparked a massive political and economic crisis. CNBC's Matt Bradley, who is in Tel Aviv, brings us the latest political developments and what's transpiring on the ground in Israel.
All day here in Israel, we've been hearing praise for the American leader. We started off late last night with Prime Minister Benjamin Netanyahu releasing a pre-recorded video with fulsome praise for President Trump, using his name repeatedly. And then this has been going on all day from leaders here in Israel who have closed ranks behind, of course, President Trump, but also behind Benjamin Netanyahu, the Prime Minister, and his decision to preemptively strike against Iran on Friday morning late last week. But now we're starting to hear from President Trump the same shifting rhetoric that we've been hearing from the Israelis for the past 10 days. President Trump, after the whole day when his top leaders and colleagues were coming out and saying that this is all about attacking Iran's nuclear program, now, in just the past couple of hours, President Trump posted on his own Truth social media platform that it's not politically correct to use the term regime change. The current Iranian regime is unable to make America great again. Why wouldn't there be a regime change? And he wrote, MEGA, make Iran great again. Now, this is following a similar pattern that we've been seeing from the Israelis. Their rhetoric changed from supporting killing off Iran's nuclear program to now regime change, which shows that we could be seeing the American role in this going down that same path.
Well, the United States also struck Iran's nuclear facilities with Tomahawk cruise missiles and bunker buster bombs. Parikshit is here to help us understand where the US hit Iran and the significance of the sites that were attacked.
Let's try to understand where the United States has struck Iran and why. US forces have struck Iran's nuclear sites in Natanz, Isfahan and Fordo. 135 US military aircraft and a submarine were used in this exercise along with B-2 bombers. Natanz now is an underground facility under 25 feet of concrete, 300 kilometers from Tehran. Isfahan has Iran's largest nuclear research facility, 443 kilometers from Tehran. Trump says all 3 Iranian nuclear sites have been completely obliterated. But why did the United States strike Fordo? Now, Fordo was the key reason for the US to join Israel's war. This was constructed between 2006 and 2009. Fordo is Iran's deep underground nuclear facility with over 2,000 centrifuges located 250 to 300 feet deep inside a mountain. It is 30 kilometers from the city of Qom and 95 kilometers southwest of Tehran. This is the critical one now. Fordo is Iran's main nuclear enrichment location, which is enriching uranium to almost 60% purity. Reports have actually said that Iran has achieved nuclear weapons-grade uranium enrichment of 85% at Fordo. Most importantly, Israel could not have attacked Fordo on its own, as it does not have the bombs and the missiles which can penetrate and destroy a facility 300 feet under a mountain. So how did the US strike Iran's nuclear sites? They fired 30 Tomahawk cruise missiles at Natanz and Isfahan and dropped 6 to 7 bunker buster bombs from B-2 stealth bombers. Why did the US use massive ordnance penetration bombs? The United States dropped 30,000-pound bunker buster bombs on Fordo. 6 to 7 bombs were dropped successively in quick succession to drill the Fordo nuclear site. This was aimed at destroying the nuclear facility 300 feet below the ground in the mountain. This was the first time that the GBU-57 or this massive ordnance penetration bomb was used by the US military. Only the US government and the US military have these bunker buster bombs. In terms of impact on Fordo, Iranian Atomic Energy Agency said attack was a barbaric violation of international law. The extent of damage is unclear. Iranian state media has reported that Natanz, Isfahan and Fordo were actually evacuated a while ago and there is no significant damage, while the US and Israel say there has been a lot of damage to Iran's nuclear capabilities.
Okay, thanks for the latest update there, Parikshit. But following US strikes on Iran's nuclear enrichment facilities, US's Vice President J.D. Vance talks about President Trump's decision-making process and what they expect Iran to do.
No, we're not at war with Iran. We're at war with Iran's nuclear program, and I think the president took decisive action to destroy that program last night. We have to give an incredible amount of gratitude to the troops who did an amazing thing last night. Think about this, John. They flew thousands of miles away, a 30-hour nonstop flight. They never touched down on the ground, and they dropped a 30,000-pound bomb on a target about the size of a washing machine. No military in the world has the training, the skills, and the equipment to do what these guys did last night. I know the president and I are both very proud of them. But we know that we set the Iranian nuclear program back substantially last night. Whether it's years or beyond that, we know it's going to be a very long time before Iran can even build a nuclear weapon if they want to. But I actually think that raises the most important question. The president talked about this last night. We want Iran to give up their nuclear weapons program peacefully, but there is no way that the United States is going to let Iran have a nuclear weapon. And so they really have to choose a pathway. Are they going to go down the path of continued war, of funding terrorism, of seeking a nuclear weapon, or are they going to work with us to give up nuclear weapons permanently? If they're willing to choose the smart path, they're certainly going to find a willing partner in the United States to dismantle that nuclear weapons program. But if they decide they're going to attack our troops, if they decide they're going to continue to try to build a nuclear weapon, then we are going to respond to that with overwhelming force.
All the developments currently taking place in West Asia. Just before we take that break, we spoke of Zen Technologies. There are two other drone names that are surging higher today. Idea Forge is one of them, 10% higher on that stock as well. And the other one is Apollo Microsystems. That too is trading with gains of around 8.5%. So Idea Forge now at 631 is nearing its IPO price. So we'll keep an eye out on that stock as well. We take a short break. On the other side, we'll be joined by Apurva Sheth of Samco Securities for a quick chart check and some trading ideas. Stay tuned.
Welcome back to Trading Hour on CNBC TV18. Now let's move on big news from the renewable energy space. Sources have told CNBC TV18 that the government is unlikely to extend the ISTS waiver for green energy projects beyond June 2025. We have Shivani who's joining in with us to give us the details on this front. Shivani.
Well, that's right. The ISTS waiver or the Interstate Transmission System waiver, which has been a crucial policy tool since 2019, is unlikely to be extended beyond the June 30th deadline. That's what the government sources are telling us. Now, Discoms and the industry has been pushing for an extension in this case. These charges are a major cost component for developers, and the waiver helped make solar and wind project bids more competitive in the recent years in India. While the exemption was originally set to end in 2023, it was extended till June 2025 to support India's 500 gigawatt renewable energy target. Now, from July onwards, new clean energy projects may face increased cost as developers will need to pay ISTS charges, potentially pushing up green power tariffs in India. Now, this could affect ongoing project bids, financing assumptions, and even the pace of future renewable installations. Delayed projects also that counted on the waiver are at risk, potentially becoming financially unviable. According to industry sources, the ISTS waiver has saved developers approximately anywhere between 0.5 rupees to 1.6 rupees per unit, which is a big chunk of their competitiveness. So now, From 1st July, if this extension is not granted, which government sources say will not be, transmission charges are slated to return in stages. 25% of applicable ISTS charges for projects commissioned between July 2025 and June 2026, gradually rising to 100% by July of 2028. Back to you.
Shivani, thanks a lot for that. And just as we speak, there is a slight bit of recovery for the markets as well from the lows of the day. The Nifty is now nearing that 24,950 mark and has trimmed its losses from well over 250 points now to just 165 as we speak. But the one stock that has been doing really well since the start of the session in the broader markets is Zee Entertainment, and Vamakshi is here to explain why is that so. Vamakshi.
Well, Hormaz, the stock is doing exceptionally well in a trading session like this, right? And there was an investor presentation which the company uploaded, and just to take you through some of the key points from that presentation. Number one, they're expecting to achieve break-even in Z5 as compared to EBITDA losses of somewhere around 50 crores in FY25, and they also expect execution of business plan to achieve their 100% target. Now, if you recall, back in Q4, they had given an ambitious plan for FY26. They were expecting their TV viewership share to rise to 17.5%, ad revenue to grow between 8 to 10%, EBITDA margin between 18 to 20%, and they wanted to unlock value in music as well as syndication. Now, what they've also highlighted is that market consolidation is leading to increased competitive intensity. Therefore, they are looking at creating a significant cash reserve. Now, the cash balance at the end of FY25 stood at 2,406 crore. They already have an enabling resolution from the board for issuing fully convertible warrants to promoters worth 2,237 crores. Apart from that, they also have an enabling resolution to raise almost around 2,000 crores via FCCBs. Only the first tranche has been withdrawn. And the purpose they've highlighted beyond this significant cash reserve is to compete effectively with the competitor, which is the Reliance Disney JV. They will also building up their cash balances to act proactively to address any rapid market shift is what they've highlighted. They've also presented several growth levers that are in for the company. They're developing new business verticals to diversify their stream of revenues. They're building new distribution business models. They're enhancing content offerings, and they're also eyeing inorganic expansion through acquisitions of strategic partnership in high growth verticals such as digital, music, etc. So they've laid out a very ambitious growth roadmap, but whether or not the company executes will be key to watch.
Absolutely. Execution will be key, but good growth plans is what they've highlighted. Thank you so much for that, Vamakshi. But let's move on and talk about AB Lifestyles. Now, this is the demerged arm of ABFRL that got listed today. Mutual listing is what we have seen coming in for the company. What does ABFRL now hold? ABFRL will have the Western Wear legacy brands. They'll have growth brands like Reebok, American Eagle, Van Heusen, the innerwear side of Van Heusen as well. Then they'll have Louis Philippe, Van Heusen, otherwise Alan Solly, and some of these other brands. Do not forget lifestyle brands for Aditya Birla ABFRL, the merged entity. 85% of this business was lifestyle brands. Now that part is getting shifted here, and there are other brands which are there. Then the tie-ups that they have with some of these other designers, etc., still continue to be there. So that is what we'll keep an eye out on. But for Aditya Birla Lifestyles, we are seeing that the management has given a target of 13% in terms of revenue CAGR growth over the next 5 years. They've spoken about margins at around 11%, which is around approximately an expansion of 300 basis points in the same period as well. Improvement in terms of return on capital employed. So that is interesting to watch out for. Now, according to Bernstein, the SOTP valuation for Aditya Birla Lifestyle brands was somewhere around 185 to 215. While Motilal Oswal today had a note coming in on Aditya Birla Lifestyle brands as well. Neutral rating, target price of 190 rupees per share will be interesting to watch out for, given that there are the triggers that I mentioned before as well in terms of the growth brands that they want to focus on. So, Urmaz, we've seen that update coming in here, but the company's MD, Ashish Dikshit, spoke to the media after their listing today. Listen in to what he's talking about the growth or guidance of the company going forward as well.
I think, as you know, our brands are extremely well entrenched over a long period of time. These brands have shown enormous ability to grow as consumers shift. And we have created multiple sub-verticals, sub-brands, and therefore we serve a very large range of consumer occasions. Over next 5 years, we look to double our footprint, which means grow our network that much as well as revenues by that amount. We have brands which have proven formula over a long period of time. These brands have grown through 2.5 decades as consumers have changed, channels have shifted, and they have contemporized themselves at all periods of time. We also have emerging portfolio of businesses which are relatively new to our portfolio, whether it is Reebok or the innerwear business as well as the American Eagle business. And I think clearly they have a larger runway and a faster growth possibility for them. And therefore, cumulatively, the opportunity lies, which is extremely interesting for us.
Subdued listing there for the demerged entity of Aditya Birla Fashion. Of course, that is Aditya Birla Lifestyle Brands. But Apurva Sheth of Samco Securities is now joining in for a quick chart check and some trading ideas as well. Apurva, good morning. Thank you for joining in. Now, despite all of these global uncertainties that we are plagued with, does this texture of the market still remain a buy on dips one, or would you still be inclined to reduce some positions to when you head towards 25,000 as you are currently headed on the index? And what are your stock recommendations for the morning?
Hi, good morning, Hormuz, and thank you for inviting me on the show. Now, since last time when I was on your show, the markets have practically remained unchanged. There is some volatility going on, but markets have still remained range bound. So I'll just give you a stat that Nifty is trading in a range of about 750 points from 25,222 till 24,473 for the month of June. Now, this is about 3% of the current price, and since 1990 there have been only 17 months where the monthly range has been less than 3.5%. So there is absolutely no trend right now, and until there is a decisive breakout, one should avoid trading, or probably if one has to trade, then it has to be in a very small position size. And only once we break out of this range, there will be a decisive trend or action coming in a broader market. Right now the action is very much limited in specific sectors or industries. So one industry which is coming in our radar is defense. So out of all the geopolitical tensions that are going around, defense as a whole sector or as a space is something which is trading at close to its 52-week highs. And a lot of stocks from the defense space are also trading around their 52-week high. So that is a clear sign of strength. So my first pick is BEL, and the stop loss for the trade is 397 with a target of 450. Now, yesterday we witnessed very good volumes and the stock breaking out of a consolidation with good volumes. It is trading above its short and long-term moving average. It is forming a flag pattern. So the stock is likely to head higher. And another stock is Paras Defense. Again, it is also trading with a flag formation, and today's volumes were greater than yesterday's volume. So there is a breakout happening in Paras Defense as well. So the stop loss would be 1600 and target would be 1945.
Right, Apurva, any thoughts coming in on Z? Obviously they had that presentation they uploaded. They gave, Mamakshi, my colleague, was also talking about, what are the key highlights coming in there. And we're seeing good volumes today. So anything on the chart front for Z?
So the stock has formed a good base around 90 and 100 levels. It was trading compared to all the other media stocks. It was trading with a very extremely cheap valuations around those 100 levels, and from there onwards it has started moving higher. So our short to medium term outlook on Z would be positive, and it could head for targets of 170 in the medium term.
All right, Apurva, thank you so much for sparing time and joining us today with your views on the index and on specific stocks as well. From chart checks, we move to fundamentals on the other side. Anirudh Garg from Inviset PMS joins in. Stay tuned.
Welcome back to Trading Hour on CNBC-TV18. The Nifty has recovered 100 points from the day's lowest point. And like we were talking about before as well, 24,950. Around that mark is where we're seeing Nifty headed as of now. Just at that mark, 0.6% still of a decline is what we're seeing coming in for the Nifty 50. But we have Anirudh Garg joining in with us from Inva Asset PMS today to discuss the market fundamentals, his top sectoral picks. Anirudh, good morning. Thank you so much for joining in with us. It has been too much news flow that we see coming in on the geopolitical tensions front. Every weekend there is something new. There are so many comments that come in. In terms of market, how are you seeing this now? Do you think that, we have penciled in the worst and maybe this range-bound situation is where we could see the Indian markets move in?
Hi. Firstly, a very good morning for having me. I think we are in a structural bull trend. The run that started from 22,000, I think in 1.5 years should take us above 30,000. My stance has been very, very clear from the start. And I think, I remind it again and again, that there's an old saying in the market that the bull run, a structural bull run, it feeds on bad news. So whenever there is such a bad news, I think we will make a good range, as you were talking. We'll have some correction, and I think all of them are buy on dips to, why does the equity market reward us? I believe just because of two things. Firstly, you bet on extraordinary entrepreneurs, you bet on relative change, and the second thing is you buy when others are not, when there is fear in the market. So all these opportunities, these all fear situations, panic situations, these geopolitical situations, these are all, I would say opportunities to make money in the market now.
Anirudh, good morning. Thank you for joining in. So in this fear / pessimistic market where nobody is looking to buy, where are you buying? Where are your preferences? Where are they like?
Okay, so we have not changed much from the last time we talked. So maybe a couple of months back, around 1.5 months back, our top pick was defense. It's not just because of what is happening right now. It's because of the global order that is changing. Yeah, every country needs to be self-sufficient now when it comes to defense, because overall the structure of the world in the past 1.5 years has changed. Second relative change that we see is the stock market intermediaries. We believe that India has surely shifted from a lot from the FD culture, if I may say so, to the equity culture. And bringing such a change is not something that has happened overnight. SEBI, AMFI, or mutual funds, everything, all these people have worked really, really hard for the last 2 decades to make it happen. And being such a multifaceted markets where we have something like a Tata Steel from Tata Group and Tata Consultancy Services also, we encompass both old economy and new economy. And I think the Indian investor, the saver, has realized it. And these companies were given cyclical status maybe till the last bull run. But now, since the relative change is so strong, these companies are now given a re-rating. And I believe till the NSE IPO comes out, the valuation here should rise. Also, then there are smaller changes like the import duties on chemicals. So the chemical sector, the fertilizer sector, prices are going up. Yeah, so we like these sectors.
Okay. Anirudh, just a thought coming in even on IT. I want to understand what side of IT do we, what one could expect. Do you expect it to do well? And then in that, which side of IT? Would it be mid cap, large cap? What are we expecting here?
Okay. So firstly, see, money making and market generating alpha in the market is a game of a particular company or a sector can be right. But are you seeing bigger relative changes happening? Because ultimately money flows to that segment or that sector where the relative change is bigger. I do not see any big relative change happening in IT at all. So we have zero exposure to IT. No mid, small, large, nothing.
What about IPOs? Anirudh, you just briefly touched upon the NSE IPO. There is a large IPO that is lined up this week, that of HDB Financial. Do you believe that such large IPOs will cap the upside in the market, considering that it will suck out some liquidity from the system? A 12,500 crore IPO from HDB Financial, a potentially large IPO coming from NSE, another potential large IPO coming in from NSDL. Do all of these IPOs ensure that the market does not, at least delays its charge towards those record high levels?
Absolutely, it does. There is no doubt about it. It's simple mathematics, right? As you rightly said, the liquidity will be sucked out. But I think what really sucks out the liquidity of the market and where tops are made is basically, firstly, the expense. The market has to be really, really expensive, which Indian market currently is not. Secondly, there has to be exuberance in the market. By exuberance, I mean psychological exuberance. And that we have seen it again and again when we moved to 100% cash call in December. That is what we were witnessing. Everybody knew that the markets were expensive, but along with expensive market, if you can track how exuberance is there, when an IPO comes where everybody is like, I have to apply or I may miss the bus. I think that is not the case with HDB Financial. Maybe going forward, NSE will create it, will not create it, we'll all see.
Okay, surely. And, I think last time we spoke, Anirudh, also, you had spoken about autos, Nifty Auto. Doesn't that excite you? Do you think now it is something that will become attractive? Given, my main point is, given that, if the rains are fine, then at least the tractor side of the segment or anything on that front would you be looking at?
I think that is the only segment, as you rightly said, that's worth considering. Why? Because on the other side, there is a lot of problem. See, firstly, inventories are being built up. Secondly, going forward, there is very, very sure chance that we are going to face a lot of competition from the Chinese products. They are wonderful, wonderful products, and you cannot stay aloof from them for a very, very long period of time. Thirdly, the cycle. The cycle for autos is like, especially for the four-wheelers, they have a 5 to 6 year replacement period cycle. And I think that cycle is now behind us. So we are not very bullish on autos from here. So we do not take calls where we ignore a sector totally. But I believe since they are such cyclical sectors, I think auto is also a no-no for us right now.
What about some of these media names, Anirudh? If I could have the liberty to ask you about a specific name, that is Zee Entertainment. The stock was plagued with issues over the last couple of years with regards to corporate governance, with regards to its promoters. But now the promoters are increasing their stake in the company. It has also laid out very ambitious growth plans. The stock from levels of 90 odd has come back to 140, 150. Do you see Zee Entertainment returning back to the days of old, or do you just believe that this is early days and it still needs to execute before we give it the kind of value that the market is currently valuing it at?
So firstly, I think we are not a buyer, or we are not considering Zee Entertainment as well, because of the primary reason is that overall structure of the industry that Zee Entertainment used to operate in has changed significantly. Yeah, everything has now gone away from to all these Netflixes and Amazon Primes and stuff. So, okay, Zee is a dominant player, but the time that it has lost in which it could capitalize is very, very difficult. And overall, I do not think that things can plague, when you are in a plagued industry and the company is also plagued, it's very, very difficult that until and unless a strong relative change comes in your favor, you are able to shoot out of the problem. So I think it's too early for the market to, value Zee at the valuations at which it is getting. But of course, the markets are never wrong. You should keep on tracking it. Somewhere we know historically that the management has the capability, but was plagued with issues. If it can, companies have done it in the past. Suzlon has done it. A lot of companies have done it in the past, and best of luck to them. We are actively following Zee, and I think if it can mend its ways and get things in order, why not?
Absolutely, Anirudh. Thank you so much, for joining in with us this morning on the show, as well as giving us your thoughts and insights in terms of the markets, sectors, as well as individual stocks. So thank you so much for that. But on that note, we're actually going to slip into a very short break. And here's some good news coming in for our viewers. India's business news leader is now a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Now, download the CNBC-TV18 app from the Apple Store, Google Play Store, or you can just scan the QR code on your screens. So do download the app and tune in to CNBC-TV18 as well.
Welcome back. Now, sources have told CNBC-TV18 that the finance minister will be holding a day-long brainstorming conclave with direct tax field formations today. Timsy is joining in to discuss what is likely on the agenda. Timsy.
Well, after concluding key discussions with indirect tax officials, the Finance Minister Nirmala Sitharaman is now turning her attention to the direct tax machinery. Sources have told CNBC-TV18 that the Finance Minister is likely to hold a day-long brainstorming conclave on June 23rd with Principal Chief Commissioners of Income Tax from across the country. Sources say that the focus of the meeting could be on improving taxpayer services, faster refunds, quicker disposal of legacy appeals, and building a tech-enabled, transparent tax system. The CBDT is expected to present data on pending disputes, average case disposal times, and delays due to system glitches, and the Finance Minister is likely to stress on accountability and taxpayer-centric reforms. Sources also say that she may pull up zones where vigilance or disciplinary cases have been pending for too long without any action. Important to note, as I mentioned earlier, that this meeting comes just days after a similar session with GST and customs officials, where the Finance Minister flagged the gap between tax leakages detected and actual recoveries. Now, all eyes are on June 23rd, as we wait and see what Finance Minister Nirmala Sitharaman has to lay out as the direct tax action plan, as the roadmap for the remaining quarters of the current fiscal.
Okay, Timsy, thank you so much for that. And you just had those flashes at the bottom of your screen in terms of Idea Forge. That stock is buzzing in trade, was buzzing before as well. Now you have an order that's come in for the company, and this is from the Ministry of Defence. 137 crores is what the order win is for. A 12-month time period is the deliverable of the contract as well. So 1 year time period. 137 crore, not a bad order win. And on that note, actually, we'll slip into a very short break and we'll tell you why stocks like BL, Vagel Projects, as well as Polycab are buzzing in trade after the break. Welcome back to Trading Hour on CNBC TV18. Now let's put the spotlight on important stocks that are being in focus today, and we have a team of research joining in with us right now for that as well. We have Ria, Upasna, as well as Vivek. First up, coming to you, Ria, BEL, that's in focus as well, and this is an order win that you're picking up here, that we're seeing here, and that is why the stock is in focus. Take the details.
Well, yes, Vinny, BEL today has announced that they've won orders worth rupees 585 crores since the 5th of June. And these orders are largely for fire control and sighting systems for missiles, as well as communication systems and jammers as well. Now, remember, the total order book of the company as of the end of the last financial year stood in excess of rupees 71,000 crores. And the company has said that they're expecting to receive orders worth about rupees 27,000 crores in this year. And this is X of the QRSAM order that they're expecting this year as well. Now, up until now in FY26, they've secured orders worth rupees 6,820 odd crores. And these have been for the maintenance of the Akash missile system, supply of electronic warfare suites, as well as integrated drone detection and interdirection systems as well. And also the supply of spares for missile systems on Indian naval ships. So overall positive news flow for BEL, and the stock is up almost 3% today.
Riya, thanks a lot for that. And just before we move to Vivek, look at the flashes on your screen with DRDO, the Defense Research Development Organization, has posted on X that that Bharat Forge has been selected as the L1 for an equipment that they had manufactured. We'll get you more details on just that in just a bit. But Vivek is here for more on Bajaj projects for the order that they had won, Vivek.
Well, that's right. This particular company, Bajaj Projects, is actually the demerged entity of Bajaj Electricals. And what this company basically does is EPC project and EPC construction works for power transmission companies or power transmission projects of the group and also outside. So, what the company has won and what the company has informed the exchange is that they had secured an ultra mega power transmission order in India. The company classifies orders whose value is worth more than 400 crore as ultra mega projects. Now, what is the scope of work? The company has received an EPC contract for power transmission line and substation bay extension works. This particular order is received from Power Grid Corporation, and it's a significant order given the fact that the order book at the end of FY25 was around 2,980 crores. So an important order, no wonder the stock is locked at the 5% upper circuit limit today.
Okay, keeping an eye out on the stock. But next one that we're keeping an eye out on is also Polycab. That's in focus after we have a note that's coming from Jefferies. Upasana is here to take us through the details of the brokerage note. Upasana.
Well, Jefferies has given a buy rating on the stock with a target price of 7,150, which is an upside of nearly 18% from the current market price. Now, it says that despite 25% uptick from March 25, the stock currently trades at 4% higher. It's a 5-year historical average. Now, in FY25, the company gained 1% market share in organized cables and wires segment, which nearly stands around 26 to 27% versus the 18% market share that the company was seeing in FY20. Now, company's timely capex, that is around 2,800 crore in last 4 years, brokerage feels because of this, company has been able to manage 26% of the sales CAGR in cables and wires space. Now, FY25 annual report has also given the details of company's Project Spring, and its FY30 targets is what the company has mentioned. Now, FMEG segment, which is nearly 10% of the sales, has turned profitable in the past 10 quarters. And brokerage says that it estimates FY25 to 28 EPS CAGR of nearly 26%, which will be mainly driven by the strong order book that the company enjoys and even better FMEG margins going forward. So all in all, it's a positive note from Jefferies.
Positive note from Jefferies on Polycab, the stock doing well for itself in an otherwise wobbly market, if you could call it that, 3% higher today. And just we were speaking of Bharat Forge, the tweet from DRDO on X mentions that the 5.56 by 45 mm CQB carbine, which is designed and developed by the Armament Research and Development Establishment, which is a DRDO unit and produced by Bharat Forge, has been selected as the L1 for the Indian Army request for proposal. So positive news coming in for Bharat Forge. But with that, we take your leave on this edition of Trading Hour. From Vinny and me and the team that put this show together, thank you so much for watching. Halftime report on the other side.
Stocks take a knock on the worries of widening of Israel-Iran conflict and possible supply disruptions following strikes by US on 3 nuclear sites in Iran. IT and financials are the prominent losers.
RBI has lowered the priority sector lending requirements for small finance banks from a total 75% to 60%, providing them greater flexibility in lending. Stocks of SFBs see some green in a sea of red.
Amazon ventures into diagnostics for the first time globally with the launch of testing at home across 450 PIN codes in top 6 cities in India. In partnership with Orange Health Labs, its entry ups the competitive risk for incumbents.
Crude oil prices inflate on rising fears of a possible disruption of tanker movement via the Strait of Hormuz and the possibility of a cut in Iranian output. Brokerages project a wide price band of $60 to $130 per barrel. Hello and welcome to Halftime Report, live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra and with me is Manglam Malu. Well, we've definitely started off the week on a very cautious note at this point in time. So we have the Nifty, which is down around 173 odd points. We have recovered a tad bit from the lows for the day, but nonetheless, we're still in wait and watch mode in terms of what the incremental steps would be when it comes to the Iran, Israel, and now the US involvement in terms of the skirmishes which are taking place. We have the Bank Nifty, which is down around 0.7% at this point in time. Mid-cap index just about managing to hold its head above the water. So some amount of interest which is coming into specific stocks. Hi, Mangam.
Hi, Ekta. You know, the bulls would be very happy in today's trading session because of what took place over the weekend, and now they would take this with both hands. If you say that you went out with just about 175 points cut on the Nifty, of which, remember, most of the gains came on Friday itself, and we'd still hold above that 24,950 mark, then it would be a positive, along with the fact that, you know, the India VIX is fairly contained. The street would have, you know, expected it to rise by almost 7-8% on news like this and on market moves like that. But despite this, you know, and at an absolute level as well, it's at around 14 itself. You know, typically it would have been around 17, 18 on news like this. So it's up, yes, 3%, but nothing really to worry about. And the broader markets, we are seeing more stocks advancing than they were at the start of the show. So we have, you know, around 1,200 stocks which are still in the green. So the crisscross lines come up for you. There was more of red in the morning, and now those lines are coming closer. But it's Equitas Ujjivan Small Finance Bank in focus as the RBI has lowered the priority sector lending requirements for small finance banks. Vamakshi joins into the details. Equitas SFB up around 2.5% in a wobbly market. Vamakshi.
Well, surely all of these small finance banks are doing quite well in an otherwise weak market. You know, there was an RBI circular which suggested that effective FY26, the additional component, which was at 35% of the priority sector lending, will now be reduced to 20%. Therefore, overall, the PSL requirements will be reduced to 60% as compared to 75% earlier. This in turn means that SFBs will now have to allocate a lower portion of their lending to specific sectors of the economy, and brokerages are quite bullish about this development. Now, Morgan Stanley says that it is a structural positive. They believe that this will give the SFBs a greater flexibility in terms of portfolio diversification as well as operational ease, and will also improve their potential growth runway over the long term. Citi also has a view on this development, and they say that the MFI segment was already leveraged to achieve PSL targets as well as sub-targets, but SFBs which have relatively more diversified portfolio can now scale up their non-PSL part of the portfolio as well. So therefore, this development bodes well for all SFBs, and resultantly we're seeing an uptick on all of them.
All right, thanks a lot for that, Vamakshi. That's about SFB. But diagnostic stocks, they are under pressure. Amazon has entered the space. Typically, when a big person announces entry, you know, there are flutters. I mean, that's what you're seeing, Ekta, right? But should we worry?
Well, the diagnostic companies should probably worry, and for us, you know, it's probably more logistical ease that we'll probably have access to when it comes to booking a home blood test. But nonetheless, the news is that Amazon India has launched an at-home diagnostic service. It's allowing users to basically book lab tests through the Amazon app, and the move, according to Amazon, basically completes their healthcare trio in the country. So, for example, they launched the Amazon Pharmacy 3 years ago. They have launched the Amazon Clinic, which is actually seeing good reception 6 months ago. Amazon has partnered with Orange Health Labs to offer the service in 6 major cities, which is Bangalore, Delhi, Gurgaon, Noida, and Mumbai and Hyderabad. And the services are going to be available across 450 plus PIN codes, operating from 6 a.m. to 9 p.m. So I did have a chat with the management of Amazon as well as Orange Health. And one of the key things that stood out, and that's the reason why you're seeing the stocks under pressure, is the fact that they're not going to be an aggregator for all of the companies. They're not going to be offering multiple companies. They're just tied up with Orange Health at this point in time. So obviously that's where the competition comes in. The second they become an aggregator, the second there are companies with all different blood tests, just the same way a pharmacy runs, an online pharmacy runs. That's when the competition will probably ease. So as of now, yes, there is competition. But the other thing, to support the existing diagnostic companies, it's also a lot about trust. You want to go back to your old, company or firm, whichever one you use to get your blood test done from, because you have that trust factor with it, and hence maybe that's relatively where some of the competition.
That's exactly what my question was as well. You don't get a blood test just because it's logistically easily available. You probably get it because when you need it, and secondly, you go to the people that you have already been going to, or the ones that your doctor or physician recommends. So that'll be very interesting. And Amazon also could be a marketplace at some point in time, as again just tying up with the Orange Health Labs that you spoke about.
Absolutely. So Amazon is, the thing is, Amazon comes with trust.
Yeah.
You know what you're getting when you order a blood test of Amazon, and Orange Health has made strong inroads in a very short span of time. So it's a good combination. But whether or not it's going to really dent the market for quality tests where you're just very used to the person that you're going to, the kind of company that you're using, that's something that we'll have to really see.
Very interesting, because on products you can trust Amazon. I don't know what people buy versus what people consume versus what people inject into their bodies. It will be very interesting to see. I personally be very interested in seeing how this pans out. So in the meanwhile,
they're just providing a platform for Orange Health at the end of the day. And Orange Health is a diagnostic company which has been established, not probably as much as the others, but it's getting there in terms of its establishment.
Let's hear out what the management had to say then.
We are working with Orange Health to bring in their reliable and trusted diagnostic ecosystem for the Amazon customers in the Amazon app. So what it entails is an Amazon customer can go to Amazon Medical's health intersection and have like a diagnostic test directly ordered on Amazon. And Orange Health will be the partner who will kind of fulfill it at the back end.
Orange Health from the beginning has been focused on hyper-convenience for consumers. 4 years ago when we launched, we started with the idea of enabling 60-minute home collection and 6-hour reports. And, Amazon is a company that we've been that we've admired from far in terms of their innovation, their scale, their reliability, and their customer centricity. So, with such a strong value alignment between their company and ours, we're super excited to be partnering with Amazon to actually launch Amazon Diagnostics across, the top 6 cities, and covering all 450 plus PIN codes. In terms of test coverage, look, we're a full stack diagnostic lab. So we offer over 1,000 tests that are available to customers.
We kind of look at healthcare as a trifecta of 3 different services, which we believe completes customers' requirement of an health intervention, which is a doctor consultation, there is a medicine delivery, and there is diagnostics. These work in tandem. We call it longitudinal healthcare, where each of them are supposed to feed into the other. So we are completing the health trifecta in its way by kind of offering Orange Health services to the Amazon customers. Why Orange Health? I think we are, as a company, we've kind of looked at Orange Health and kind of admired the kind of customer ethos that both Orange Health and Amazon shares, which is bringing the best quality service and a reliable, trustworthy experience for the customer, which the customers can bank on. And Amazon has given that, and we've seen Orange Health do it, which is why we feel it's an organic partnership.
Okay, so that's the word coming in from Amazon as well as Orange Health, talking about the tie-up when it comes to diagnostics. You can see that stocks such as Dr. Lal's are under pressure today, even Metropolis, which is down over 1.5% at this point in time. We'll take a short break, but up next, we'll connect with the management of Biocon as the company has raised 4,500 crores via QIP. Welcome back. Well, for the market still weak, we have the mid-cap index, which is picking up a little more of pace, so up around 0.3%, but nothing really to write home about. Let's see how it treads. As of now, we have the advanced decline ratio, which is still on the declining side. But let's talk about specific stocks. Biocon is in focus. Last week, they successfully completed raising 4,500 crores via QIP. To talk more on this fundraise, the company's debt reduction plans and their business outlook, I did catch up with Siddharth Mittal, who's the CEO and MD of Biocon. Listen in to excerpts of that conversation as I began by asking him about the demand for the QIP.
We just concluded a very successful QIP earlier this week, and it was a very strong demand coming in from domestic mutual funds, domestic insurance companies, domestic funds, as well as a very large interest from foreign institutional holders. So if you recall, we had said that we will raise 4,500 crores through QIP in one or more tranches, but the demand was so strong that we actually thought that it's better to complete the entire book at this stage and strengthen the balance sheet for the coming quarters for the growth.
Okay. So post QIP, what does the promoter shareholding stand at in Biocon?
So promoter would hold roughly 54%, down from 61% prior to the QIP.
All right. What is the promoter holding that Biocon would be comfortable with going forward?
Well, honestly, that's a good question that Kiran should ask, but or should answer. But there is no threshold that's in mind. I mean, of course, holding 50% plus makes sense when it's a corporate entity where consolidation is important. But since the promoter is an individual, there is no such threshold. And whatever makes strategic sense for the company, that Kiran is, of course, going to go with.
Okay. Let's talk about the proceeds of this 4,500 crore QIP. What will it be used for?
We have certain obligations at Biocon, which is the holding company for biologics. If you recall, the acquisition of Viatris business required $2 billion of cash, of which 1.2 billion was taken in form of bank debt, and remaining 800 million was pumped in by Biocon or certain private equity investors. And we had to give exit to some of these private equity investors. And today, large part of the proceeds of QIP will be used to give exits to these investors such as Goldman Sachs, who has an optionally convertible debenture, which is coming up for payment.
Okay. Can you tell us how much of that 4,500 crores will go towards the optionally convertible debentures?
It's close to $200 million.
Okay. All right. And how much would probably be outstanding post the QIP?
We still have roughly, I mean, the total private equity obligations were roughly $550 million, including some of the assured returns which few investors had. And with 550, as I said, we will retire close to 200 million. So the remaining would be $350 million.
Okay. All right. And when would you probably need to service that $300 million by?
See, the option that the investors have to exercise by end of this fiscal year, which is by March 26. And of course, the investors will, now that we have cash in the balance sheet, we will talk to the investors if they want an early exit. But legally, the obligation is by March 26.
Okay. All right. Net debt is around $1.1 billion as of FY25, and this is X of your structured instruments. Where does it stand now post the QIP?
See, the net debt at the business level does not change. As you said, that this 1.1 billion was excluding structured equity or structured debt. So the QIP will address only that section. So we have $800 million of bond, which was taken in September 24. And in addition to this, we have around $350 million of bank debt. So that remains unchanged.
All right, that remains unchanged. Let's approach it from an interest cost point of view. You did around 900 crores in terms of interest costs in the previous fiscal. How much would it probably reduce to?
See, it will come down a bit, but still, $1.1 billion of debt will have its own interest cost. Some of the structured equity or the private equity investors did not have assured returns, so there was no imputed interest. But likes of Goldman Sachs, Kotak, Edelweiss, which had a short return, did have an interest component. So once those are settled, then interest costs will come down. And as I said, that the outer limit is March 26 for repayment. So I do not expect a significant reduction in this fiscal, but definitely next fiscal, we will see on a roughly $500 million, 9 to 10% of interest coming down on an annualized basis.
What is the plan on further reduction of net debt? $1.1 billion. What is the timeline on reduction and how?
See, $800 million of bond is repayable in 29. It's a bullet repayment. So you don't have repayment obligations until then. And the remaining $300 million bank debt again has a repayment more towards the fourth and fifth year. So that will be in starting 27, fiscal 27. Of course, as we expect our business to grow over the next couple of years, cash flows to improve, we would start repaying that amount in a manner which will align with the cash flows.
But what is the plan in terms of raising funds to repay the debt? Do you have any plans in terms of fundraising? You did sell a stake in Syngene in December of 2024. Any further stake sales plan, for example, in Syngene? The holding currently stands at 52.46%.
Yeah, so there are no immediate plans to sell down any more stake in Syngene. Of course, we had sold down a portion of Syngene's stake to meet some of the obligations. And if you recall, we had certain obligations to Viatris, which was coming as a part of the overall purchase consideration or deferred consideration that we had to pay out.
Okay, for Biocon Biologics, a stake sale, IPO, what exactly is under consideration there?
We've always said that IPO is one of the plans to unlock the value and to give exit to the shareholders of Biocon Biologics, including Viatris, Serum, who are large shareholders. But recently, the board also constituted a committee to look at various options, including a potential merger of Biocon and Biocon Biologics. So once that evaluation is complete, we will know what's the next course of action. But at this stage, I won't give any definitive timelines of when any of these actions would be undertaken.
Okay, what is the launch timeline for bevacizumab?
It should be anytime in the coming weeks to months. We've already secured the approvals, so the launch is imminent, I would say.
Insulin aspart, you have a target action date, I understand. When is the TAD and what is the update on it?
So the facility has been cleared. There were no other scientific questions open with the FDA. And the TAD is coming up within the next few weeks. And we are hoping that we will get the approval on the target action date.
All right, with that, we'll take a short break. Come back on the other side. Sudeep Shah of SBI Securities joins in with some trading strategies. Stay with us. Welcome back. You're watching us here on Halftime Report. A couple of stocks which are buzzing around right now. We do have BEML, which has moved to the high point of trade of around 4% odd. We have Kajaria Ceramics, which is doing well as well. And then Nykaa has been doing well. All of today's trading session from the lows had seen a bit of a pickup. And we have, something like an Angel One as well. A bunch of these, market participants are doing well. So Angel One is one of them. The other one is BSE as well, Bombay Stock Exchange. That's the stock which has seen a big up move currently at the high point of trade with decent volumes tracking it as well. So all in all, with just about 160 points cut, the Nifty is doing a lot better than what it was in the morning. And that exactly tells you how the way the market is poised at the middle of the day when it comes to the F&O setup as well. So when you look at it, you have the Nifty, which has seen a recovery. The Nifty Bank down by about just 0.6%. Mid caps are moving a lot better, as is the small cap index. If you look at the advanced decline ratio as well, we have seen Nifty recover almost about 120 points from lows, and in doing so, it's reconquered the 20-day moving average. Similar is the case with the Nifty Bank. Today's low, and you look at the Nifty Bank 20-day moving average, is just above that at 55,921. So all these factors working well for the bulls. The second factor that works well for the bulls is the advanced decline ratio, like we pointed out. They have been coming closer to each other. If there is an intersection and more green stocks as against red, will be considered by bulls as a positive. The other factor which is considered as a positive by the bulls is that the India VIX is still contained at around 14 itself. So that's nice, despite the sort of uncertainty that we're seeing around the world. What is it that the option writers are betting for this week? We have the 24,900 put, which has premium of almost 116 rupees, fairly active. And we still have the 24,900 call writers, which are active in trade today. They have a premium of 150 odd rupees. So together, the street believes that a little above 25,000, 25,050 thereabouts, there could be some sort of supply, but at lower levels, today's low and maybe around that 24,700 mark, 24,700, 24,800, we will see a fair amount of support for the frontline index. The one stock that I'm watching out for today is Titagarh Rail Systems, which may exit F&O ban in the F&O expiry week. So we'll watch out for how that pans out. But by and large, we're totally, out of danger zone, so to say, with the recovery that we've seen from the lows.
Okay, all right. Well, Sudeep Shah of SBI Securities joins in now to discuss the strategies for the market. Sudeep, hi, welcome to the show. Well, it's definitely a weak day for us. We have the mid-caps, however, which are managing to hold up in the green. So what would your overall call be in terms of the index?
Good afternoon, Ekta. Ekta, definitely a weak start or a weak day till now, but it's much better than it was early morning. And as Mangalam was rightly pointing out, the improvement in advanced decline since morning, as well as the strong momentum which is visible in a lot of mid-cap stocks. So I feel that even if the markets are say trading between this 24,850, 25,000 mark, it will still be better considering the kind of uncertainty that is currently there in the geopolitical arena. So what we feel is from here on, one should be focusing on large cap quality names as well as select mid cap names. And from a Nifty levels perspective, 24,780, 24,800 we feel should hold out as an important support until this is held. Nifty initially will be in a range between this 24,800 and 25,100 mark, and crossing 25,100 there could be a straight move up to 25,400, 25,600 on the upside. So this consolidation in a way is much better. Coming to Bank Nifty, we feel that today it's slightly underperforming compared to Nifty, but overall still it is in a much better shape. 55,500, 55,600 zone will act as a strong support. Until this holds, we feel that the banking as well as the financials, most of these stocks should outperform, and the banking index itself could move to 56,500, 56,700 in the coming few sessions.
All right, we take that point. Meanwhile, important story at the bottom of your screen, CNBC-TV18 exclusive, and we'll probably get Yash shortly to talk about this as well. Sources say that in the next Nifty 50 review, which is due sometime next month in August, we will have two new entrants, and it'll be the BSE as well as Interglobe Aviation. On the way out, making way for BSE as well as Interglobe Aviation would be IndusInd Bank and Hero MotoCorp. So that's something we'll be watching out for. That explains why the BSE stock was doing well with decent volumes as well. Interglobe Aviation too has now moved into the green from red at the high point of trade, and despite oil prices being where they are. So we'll definitely keep an eye out on. Will be definitely an important moment to watch, where the BSE is actually part of the Nifty, and it's obviously not listed on the Bombay Stock Exchange itself. Absolutely. That was one of the contentions, but the story suggests that that will not be a concern when including BSE into the Nifty 50 as well. But Sudeep, your stock picks would be what today?
Good afternoon, Mangalam. Mangalam, couple of stocks are on my radar. The first one being Glenmark Pharma. Now, we've seen certain pharma stocks outperform, but specifically if we see Glenmark Pharma, that has broken out of a range that it had got itself since November 2024. So there were a lot of times then 1600, 1650 zone used to act as stiff resistance, but this time around it has broken out with strong volumes. There has been a retest of this breakout zone, and once again the stock has started to cross and move above 1700. So what we feel is from the current levels, Glenmark Pharma could move to 1830, 1870 on the upside. This and the stop loss on the downside should be 1650 levels. The second stock that is there on our radar is a pullback candidate. A rebound rally is quite likely in Polycab. Here the stock has moved 4.5% today, but we still feel that there is much more steam left in this counter. And there has been a breakout since last 4 months, like since February, the stock was not able to cross 6,050, 6,100. But now with volumes that has been crossed, and we feel that now the stock is headed up to 6550, 6600 on the upside, and this can be bought with a 6150 stop loss on the downside.
Okay, Sudeep, just quickly before we let you go, we were discussing a couple of these stocks such as BSE, Indigo. Any call on these counters or on the technicals, even Hero as well as Indicin?
Ekta, coming to BSE, that stock has been in a strong uptrend. Last week, we saw some kind of a profit booking, but once again, this 2500, 2550 mark acted as a strong support, and we feel that it could still consolidate at these current levels, but steadily move up once again up to 3000, 3200 on the upside. And the support zone for this move could be closer to 2600 on the downside. The other stock that you mentioned, Indigo. Now here, just because of the crude prices uncertainty, we had seen some correction from higher levels from 5600, 5650 in the last week. But still, the stock has managed to hold 5200, 5250 and is now consolidating at the current levels. And while we are not seeing any significant moves on the Brent crude crossing 80, 82 levels, and it is still closer to 78, 79, which is quite decent considering the last few quarters. So I feel Indigo could consolidate between 5200, 5400, and steadily it could stay once again start inching up towards the previous highs and even surpass them. So at these levels and on dips, I feel Indigo can be bought with a 5200 stop loss positionally.
Okay, all right, Sudeep, we're going to let you go on that note. Thanks very much for joining in. We'll take a short break. Up next, Manisha Gupta will join in with Vandana Hari, founder and CEO of Vanda Insights. Stay tuned. Welcome back. Well, sources tell CNBC-TV18 that BSE Indigo may enter the Nifty. Yash has more details. He's joining in on this. Yash.
Well, that's correct. So, of course, two important stocks where the focus would be. That would be the Bombay Stock Exchange, BSE, and Indigo. And that's because what we're given to understand from our sources is that both these stocks could enter Nifty 50 in the upcoming index review itself. What we've been given to understand is that there would be two factors which would be considered for the inclusion of BSE and Indigo in Nifty 50. The first one would be the previous 6 months, average free float. And if that is double of the current 49th and the 50th stock of Nifty, then of course these two stocks enter Nifty 50. At this point of time, both those stocks, that is BSE as well as Indigo, the free float, the average free float is double of the 49th and the 50th stock of Nifty. The second condition, of course, there will be a monthly cutoff date which will be taken as a reference point to understand the previous 6 months average free float for both these stocks. Now, there were two important questions which we were hearing from a lot of participants on the street, a lot of analysts on the street. The first one was, can BSE enter Nifty 50 if it is not listed on both exchanges? Remember, BSE can only list on NSE and not on its own exchange, that is BSE. What we are given to understand from our sources that that is not going to be an impediment which comes in the way of BSE entering Nifty 50, and hence that won't be a condition which could prevent BSE from entering Nifty 50. The second doubt which a lot of participants on the street had was that if BSE is not a part of Nifty 100, then can it enter Nifty 50, or does it have to spend some time in Nifty 100 for it to enter Nifty 50? That condition also is not required and something that would prevent BSE to enter Nifty 50. What we've been given to understand from our sources is that BSE can simultaneously enter both exchanges, of course, both indices, that is Nifty 100 as well as Nifty 50, as a part of the same review. As far as the two exclusions, likely exclusions are concerned, which would be replaced by BSE and Indigo, that according to our sources could be IndusInd Bank as well as Hero MotoCorp.
All right, we take that point. Yes, thank you so much for that. Explains why BSE is up around 2% But let's cut across to Manisha Gupta now, who is in conversation with Vandana Hari. Manisha.
Thank you so much for that. Well, yes, it's been the crude oil prices which have been on radar, and we've seen quite volatility come in for prices. Vandana, when it comes to the knee-jerk reaction that we saw into the markets was 5.5%. We did see $81 on the higher side. It did not sustain there, as the markets haven't still seen much happen on ground in sense of supply disruption or export disruption for that matter, would you say?
Yeah, good afternoon, Manisha. So the market is not pushing the panic button. And I think justifiably so, because the keywords that you just mentioned there, what is the actual reality on the ground in terms of supply, production, and flows from the Middle East? Nothing has changed. I would put out another point out there, Manisha, sort of paradoxically. It's just possible that the US strike on Iranian nuclear facilities over the weekend, as shocking as it was, and creating a sort of a more nervousness in the markets, it might actually push Iran, have pushed Iran enough into a corner to want to now de-escalate things. And even if you look at the messaging from the White House, and there's been mixed signals, but what I extract from all of that, most importantly, that is, it was a sort of one and done strike from the US, at least for the time being, until perhaps Iran deliberately escalates it. And Trump is looking for peace. So, those are the sort of, that's the scenario that the market is taking into consideration. No disruption in supply, no disruption in the Strait of Hormuz, and Trump very keen to start moving towards peace.
Also, when you talk about Strait of Hormuz, and I mean, that has been a conversation on an everyday basis, Vandana, but Strait of Hormuz is as important to Iran as it is to all other countries, and the way we are looking at that financial distress within Iran as well, would you say it's perhaps a 10 to 30% of a chance that we would actually see something happen at Strait of Hormuz?
No, Manisha, I would put it at less than 2%.
Okay.
Manisha, it reminds me of that saying to, cut one's nose to spite one's face. Iran has very little to gain, if anything. and a lot to lose if it attempts to blockade the strait. Not that it is easy by any stretch of imagination. So there's logistical, tactical issues there. We have seen that the US has increased considerably its firepower in the region, its naval strength in the Arabian Sea. So that, to my mind, acts as a deterrent and also as a ready response should Iran try to blockade. But also, I think strategically, it just doesn't make sense for Iran, Manisha. If it blockades the strait, it is going to stop the flows of its neighboring oil-producing and exporting countries, the vast majority of which, I would say almost all of them, have been quite neutral in this conflict, even sympathetic towards Iran, even protesting against US and Israeli strikes. Why would it want to turn them into enemies? Equally, it risks provoking the ire of China, its single biggest market, and other potential buyers in Asia, who will be stranded if the strait is closed. So for all of those reasons, I see it as a very remote tail risk that it actually proceeds to blockade that waterway.
So Vandana, you're saying that all this fallout is going to be contained and we may perhaps be looking at a same range-bound move for crude oil prices, even lower?
On the lower part, Manisha, I would say that we need to see the US and Iran getting back to the negotiating table. Now, it doesn't matter how much rhetoric flies between the two, which is harsh towards each other, or how much sort of signals they send to each other. I think the market's not going to react much to that because, let's face it, the whole thing has just become one big drama, and it's really become hard for market participants to extract the signal from that noise. But if we do see some concrete steps towards them starting to re-engage and resume their nuclear negotiations, I think we would see quite a bit of erosion in the, I would say, $12 to $14 premium right now because of the escalation. We would see quite a bit of erosion. For all of that premium to disappear, I think we'll probably need to see something much more concrete. And I think herein lies perhaps more of an issue in terms of the hurdles for them to see eye to eye. Iran's ability to enrich uranium at all, no matter which purity level, I think that's become a big red line for both the sides. US doesn't want Iran to enrich at all, and Iran says it wants to continue to be able to do that. So it's at this point, Manisha, it's hard to see how they'll get over that hurdle. So I wouldn't count on a swift and enduring peace and complete disappearance of the risk premium, but I think it should start easing very soon.
And then also looking at the kind of supplies that we have, and that clearly is an underlying very important fundamental, the reason that you haven't seen the crude prices run up. How are you working with supplies and demand in the global markets for this year now?
Yeah, so I think that's quite a bearish picture. And I think if we didn't have that sort of narrative out there, which has been with us since the start of this year and extends not just to the end of this year, but into 2026, that we are in a well-supplied market, enough supplies, enough additional supplies coming at an accelerated pace from OPEC+, demand seen not looking too good because the assumption is that the tariff wars are quite a headwind for the global economy. So it's not looking too good. And then we have plenty of spare capacity within the OPEC Plus alliance as well. So all of those factors are probably not just weighing on the one of the reasons why we haven't seen bigger, sharper jumps in crude, but also every time you see Brent jumping, and as a knee-jerk reaction, we saw that when the Israel-Iran conflict started, we saw again this morning. One of the reasons it pulls back very fast, I think, is also there are plenty of players out there who are essentially still quite bearish and very happy to sell if it hits $78, $79.
Okay, all right, Vandana, as well as Manisha. Well, definitely a developing story, but thanks very much for joining in and taking us through what could probably potentially happen to crude prices. And maybe the limited reaction that we're seeing on equities is the hope that maybe Iran will not have too much of an aggressive reaction and probably doesn't even have the firepower to do so at this point in time. That's probably the assumption at this point. We'll take a break, but we'll get you a lot more on the markets and stocks once we're back. Stay tuned.
Welcome back. Now the metal stocks have come back. So look at the metals index that's recovered from the lows, currently at the high point of trade, and leading it is Hindalco, which has moved higher, and alongside that we have a bunch of other metal stocks as well, which are picking pace, and as a result of which the entire index, Hind Zinc is the other one, which our ticker team is alerting us. Aditya Birla Lifestyle, on the other hand, is the new listed company today, and that's listed at a discount to its pre-demerger implied price, Aditya Birla fashion. Vinny joins in with what this listing means and what the company does going forward. Vinny.
Hi, afternoon Mangalam. So in terms of Aditya Birla listing, muted listing like you mentioned is coming for the company. May 22nd was the record date. So you know that's when the price was adjusted for ABFRL. So that implied price that came in for Aditya Birla Lifestyle brands was around 171. Now obviously right now we saw it opening in terms of the pre-open price, and listing price was also somewhere 167. And now we've seen a fall coming in furthermore in that. So muted listing that we're seeing for Aditya Birla Lifestyle brands. Now obviously ABLBL is going to be housing the Mundra fashion lifestyle brands as well, and limited brands. This will include something of the western wear legacy brands that they have, growth brands and segments that are there for the company as well. So that is something like Louis Philippe, Van Heusen Innerwear, Alan Solly, Peter England, American Eagle are among some of these brands which are housed with Aditya Birla Lifestyle brands now. Now according to Bernstein's SOTP valuation, they were expecting somewhere at 185 in terms of the SOTP for ABLBL. While Motilal Oswal this morning also came out with a note, and they also said that they have given a target price of 190 rupees, and they're saying that they're giving a neutral rating for Aditya Birla Lifestyle brands. Some bit of a risk that they've highlighted, but in terms of the guidance that the management has given when the demerger happened, 13% growth in terms of revenue CAGR over the next 5 years, EBITDA margin expansion of 300 basis points in that same period, expected to be at 11%. So that is something interesting to watch out for going forward.
Okay, all right, Vinny, thanks very much for that. Well, we need to take a short break, but as we do that, here is some good news for our viewers. India's business news leader is now just a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at just your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or just scan the QR code on your screen. Welcome back. Well, for the markets, it's weak. We have the mid-caps, which are picking up a little bit of pace, so up around 0.4% currently for the mid-cap index, and the advanced decline ratio seems to be showing some amount of a tad improvement. So maybe the advanced decline lines should come up for you, and let's see how that works. Otherwise, we have, as you can see, it seems to be narrowing a tad bit, so maybe there is some momentum which is picking up from the broader markets. Let's see how the second half of the trading session works. But nonetheless, just watch out for a couple of these defense stocks because they seem to be attracting attention. Mazgon Docks as well as Garden Reach Shipbuilders, both those are some of the top turnover stocks in today's trading session, so do watch out for them. It seems as though defense continues to be a strong theme considering all the developments that are taking place globally. We'll wrap up on the show. Thanks for watching. Business Lunch up next.
Stocks take a knock on worries of a widening of the Israel-Iran conflict and a possible supply disruption following strikes by US on 3 nuclear sites in Iran. IT and financials are prominent losers. RBI has lowered the priority sector lending requirement for small finance banks from 75% to 60%, providing them greater flexibility in lending. Stocks of SFBs see some green in the sea of red. Amazon ventures into diagnostics for the first time globally with the launch of a testing at home across 450 pin codes in top 6 cities in India. The partnership with Orange Health Labs, it entry ups the competitive risk for incumbents. Crude oil prices inflate on rising fears of a possible disruption of tanker movement via the Strait of Hormuz and the possibility of a cut in Iranian output. Brokerages said that the project a wide price band of $60 to $130 per barrel. Hello, good afternoon and welcome to Business Lunch on CNBC-TV18. I'm Vinny Motiwala. Thank you so much for tuning in today to Business Lunch. Now, looking at the markets right now, the benchmark indices continue to be muted, but the outperformance today is coming in from the broader end of the market. You can see that green on the screen is only for the broader end of the market. Right now, the Nifty also has recovered from the day's lowest point. 24,950, around that market's what it's holding on to. And that's where it's in that range right now. More than a 100-point recovery from the day's lowest point for the Nifty. Nifty Bank, that is also muted in today's trading session as well. So keep an eye out on Nifty Bank as well. That's down 0.5 to 0.6%, recovered from the day's lowest point here as well. Now, mid and small cap, like you were seeing, that Nifty mid cap was the only green one on the screen today. And Nifty mid cap almost trading at the day's highest point. 0.4% of uptick is what we're seeing coming in for the Nifty mid cap. Small cap also holding on to gains of 0.5%. So the broader end of the market clearly is managing to do well in today's trading session. And media, obviously, among one of those other sectors that is holding on to some bit of a green. Other than that, diagnostics, that's in focus today because of Amazon's entry into diagnostic space. We have rice exporters that are under pressure because of the Israel as well as Iran tensions. And Ida Forge is also a stock that has been buzzing in trade, and they had an order win that came in as well. But let us begin the show today, and this we'll talk by shifting focus and talking about the tensions that are going on in West Asia. Now, Israel and Iran continue to strike each other, and Iran's air defense system intercepts hostile targets over the capital city of Tehran, while missiles were seen moving through the sky above Jerusalem, and sirens were heard in several areas and parts of Israel, warning people to enter shelters. Over the weekend, the United States bombed key nuclear strikes, and there were 3 of them which they attacked in Iran. And the president said, and that's President Trump, said that the attacks were a spectacular military success and warned of more attacks if Tehran did not surrender. We have NBC's Richard, who's joining in with us to give us the latest update on this.
Just hours after those U.S. airstrikes on its nuclear facilities, Iran fired dozens of ballistic missiles at residential areas of Tel Aviv, hitting this apartment building, causing significant damage, although few injuries. People here warned to go to bomb shelters.
So we've just moved into our own safe room in the place where we're staying. You can still hear the air raid sirens, and there have been some very loud impacts close by.
Israel kept up its attacks inside Iran, taking out more missile launchers. Israel's prime minister, who has been pushing the U.S. to join an attack on Iran's nuclear sites for decades, today congratulating President Trump.
History will record that President Trump acted to deny the world's most dangerous regime the world's most dangerous weapons.
Many in Israel appeared to agree.
I want to thank President Trump because this could be the end of the war.
In Iran, there was anger in the streets. Iran's foreign minister today saying his country was in the midst of negotiations as the American bombs dropped.
There is no red line that they have not crossed. And the last one, and the most dangerous one, happened only last night.
But will Iran attack the U.S. directly? Its missiles and fighter jets don't have the range to reach the United States. But American troops and bases in the Middle East could be targeted. Iran's parliament voted to close the Strait of Hormuz, a potential economic attack. 20% of the world's oil flows through the strait, but no action. Parliament saying the move would have to be approved by Iran's supreme leader. The New York Times reports citing 3 Iranian officials, Ayatollah Ali Khamenei, is now in a bunker and has picked replacements in case he's killed. Across the Middle East, the response from Arab countries was largely silent. Many calls for talks, no government offering to fight for Iran.
The only people in the world that are unhappy about what happened in Iran last night is the regime in Iran.
Okay, the United States hit Iran's nuclear facilities with Tomahawk cruise missiles and bunker buster bombs. Parikshit is here to tell us and help us understand where US struck Iran and the significance of these three sites which they struck as well.
Let's try to understand where the United States has struck Iran and why. US forces have struck Iran's nuclear sites in Natanz, Isfahan and Fordo. 135 US military aircraft and a submarine were used in this exercise along with B-2 bombers. Natanz now is an underground facility under 25 feet of concrete, 300 kilometers from Tehran. Isfahan has Iran's largest nuclear research facility, 443 kilometers from Tehran. Trump says all three Iranian nuclear sites have been completely obliterated. But why did the United States strike Fordo? Now, Fordo was the key reason for the US to join Israel's war. This was constructed between 2006 and 2009. Fordo is Iran's deep underground nuclear facility with over 2,000 centrifuges located 250 to 300 feet deep inside a mountain. It is 30 kilometers from the city of Qom and 95 kilometers southwest of Tehran. This is the critical one now. Fordo is Iran's main nuclear enrichment location, which is enriching uranium to almost 60% purity. Reports have actually said that Iran has achieved nuclear weapons-grade uranium enrichment of 85% at Fordo. Most importantly, Israel could not have attacked Fordo on its own, as it does not have the bombs and the missiles which can penetrate and destroy a facility 300 feet under a mountain. So how did the US strike Iran's nuclear sites? They fired 30 Tomahawk cruise missiles at Natanz and Isfahan and dropped 6 to 7 bunker buster bombs from B-2 stealth bombers. Why did the US use massive ordnance penetration bombs? The United States dropped 30,000-pound bunker buster bombs on Fordo. 6 to 7 bombs were dropped successively in quick succession to drill the Fordo nuclear site. This was aimed at destroying the nuclear facility 300 feet below the ground in the mountain. This was the first time that the GBU-57 or this massive ordnance penetration bomb was used by the US military. Only the US government and the US military have these bunker buster bombs. In terms of impact on Fordo, Iranian Atomic Energy Agency said attack was a barbaric violation of international law. The extent of damage is unclear. Iranian state media has reported that Natanz, Isfahan and Fordo were actually evacuated a while ago and there is no significant damage, while the US and Israel say there has been a lot of damage to Iran's nuclear capabilities.
Okay, thank you so much for that update there, Parikshit. But keeping it with West Asia specifically, while Iran and Israel and the US battle it out, the geopolitical game is likely to come at an economic cost. And this is in the form of the closure of the Strait of Hormuz, a key supply route for global oil. Now, Iran controls the checkpoints and reports suggest that the country awaits the Supreme Leader's final approval to close the strait for shipping. A number of brokerages say that the closure will impact crude oil prices. Manisha is joining in with us to give us more details on this one. Manisha, afternoon, and what are we expecting in terms of these impacts that could come in here?
A lot of banks and brokerages have come out with their reports. One from Citi, which says that the crude oil prices can hit $78 a barrel if the conflict within the Middle East or West Asia continues to go on. It also says that the prices can surge to those levels only if you see a disruption of 1.1 million barrels per day. Citi also says that a disruption of 3 million barrels per day can take the prices higher to $90 a barrel as well. There also is a report from JP Morgan which says that in an extreme kind of a scenario, if there is a closure of Strait of Hormuz, that is when you can see the crude prices going to $120 to $130 a barrel. Goldman Sachs has a similar report suggesting that the geopolitical tensions or a premium of $10 is already in case of crude oil prices, and it's going to be an extreme scenario where you can see the prices gain up much higher from here. A report from Barclays also says that $85 a barrel on the higher side can go only if Iran exports cut down by 50% there. Mizuho Group says that the crude prices could surge to 85 if crude exports from Iran are hampered in some way. So clearly there are lots of ifs and buts happening in right now. Only if we see oil facilities getting impacted, exports from Iran getting impacted, or Strait of Hormuz getting closed, is in only that scenario you will see the crude prices going higher. Trading.com also says that they're looking at a range of anywhere between $65 to $85 an ounce for the year 2025. Bank of America, in the meanwhile, says that the Brent prices will average $75 a barrel in 2025, with a potential range of around $60 to $80 until 2030. So clearly, nobody is believing a three-digit number would come, only in case of extreme scenarios. And remember, Iran exports everything through Strait of Hormuz, and it exports 80% of its crude to China. So to begin with, it would not be in interest of Iran itself to go and block Strait of Hormuz. So the markets do not believe that that's going to happen, and is the reason we're looking at the prices staying quite range bound.
Absolutely, Manisha. Thank you so much for that. But on that note, we're going to take a short break. We will get you more on the impact of escalating tensions on the market and as well as on India's rice exports after the break. So stay tuned in for that. Welcome back to Business Lunch on CNBC TV18. Now, earlier in the day, we actually managed to speak to veteran investor Prashant Khemka on those ongoing tensions in West Asia and asked him whether the ongoing tension will have a lasting impact on the Indian market. Listen in to what he had to say.
According to market, all this is not going to have any material or lasting impact, and both are important, neither material nor lasting impact on the cash flows of the corporates. And that market seems to be quite certain about. And hence the market, with a few points here or there, a few percentage points here or there, has recovered with each of these hits that we've seen. It seems like we should have a relative phase of calm now on the geopolitical front, especially when it pertains to Middle East. Once US gets involved, and I'm not saying who's right, who's wrong, because I'm not that learned on the subject matter to make those conclusions, but just purely from the market's perspective, I think the worst of this geopolitical event, the most recent geopolitical event, is behind.
Okay, and the conflict in West Asia is also threatening India's rice exporters, a large part of which goes to the Gulf regions. So for these details, what is the impact? With Santya joining in with us for that. Santya, good afternoon.
Yes, Vinny, as you rightly mentioned, that how the ongoing US-Israel-Iran conflict has started impacting India's basmati exporters, the exporters who export their basmati rice to Iran. So CNBC spoke to the All India Rice Exporters Association, and they told us that 1 lakh metric tons of basmati rice is stuck at Indian ports and Mundra and Kandla port. The president of the association told us that since no insurance company provides cover to vessels traveling or entering into a conflict zone, that's why there is no insurance cover anymore, and that's why the vessels are not moving towards Iran. They are stuck at these two ports, so 1 lakh metric tons of basmati rice. He also told us that if the Strait of Hormuz is closed, that is going to impact India's rice export to Gulf region severely, because out of India's basmati export, 80% of it goes to the Gulf, and out of this, 30 to 35% goes to Iran. So that's why this particular conflict is extremely crucial for Indian basmati exporters. If we talk about the situation, the exporters say that as of now, they are in a wait and watch mode. They are in touch with the government of India. They are going to wait for some more days, and they hope that the situation will improve in the next few days. But if it doesn't, in that case, they will decide what their next course of action is going to be. But as of now, 1 lakh metric ton basmati rice is stuck at Indian ports, and Indian exporters claim that if the Strait of Hormuz will be closed, it's going to severely impact their business in the Gulf region. Vinny.
Absolutely important updates over there, Santya, that we'll be keeping an eye out on. Thank you so much for this latest one coming in there for rice exporters specifically. But as of now, we're going to sip into a very short break. After the break, we'll come back and give you more updates on news and what's happening. So do stay tuned in. Welcome back to Business Lunch on CNBC-TV18. Nifty is again trading above the 25,000 mark, almost near the day's highest point is what we're seeing the Nifty trade at, recovered 150 points from the day's lowest point. Contributors in terms of the positive side, we have Hindalco, Kotak Mahindra, Bharat Electronics, Adani Enterprises among the Nifty 50 names which are supporting the markets. IT seems to be a bit subdued, and HDFC Bank and ICICI Bank are among the drags coming in for the Nifty 50, but a good recovery coming in for the markets. But that's how we're going to be ending today's edition of Business Lunch. So thank you so much for tuning in to CNBC TV18. Thank you so much for myself as well as the team who put the show together. But don't go anywhere. Up next, your Midcap Radar.
Good afternoon and welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I am Bamakshi Doria and with me is Vivek Iyer. Well, a very good afternoon to you, Vivek. Monday morning blues for the market, but we've seen a fabulous recovery from the lows.
That's right. Good afternoon, Bamakshi. A strong recovery in the mid-cap and small-cap index now in the green territory. We have quite a lot lined up on the show, a couple of interesting discussions lined up as well. Let's start off with the top headlines. Stocks take a knock on worries of widening of the Israel-Iran conflict and possible supply disruptions following strikes by the USA on 3 nuclear sites in Iran. IT and financials are prominent losers. Metals and consumer durables surge. Mid-caps gain.
Idea Forge gains after receiving an order worth 137 crore rupees to supply mini UAVs with accessories to Ministry of Defence. Stock up over 10%. Zentech gains after company announces strategic acquisition of majority stake in TISA Aerospace. The cost of acquisition is over 6.5 crore rupees.
Amazon ventures into diagnostics for the first time globally with the launch of testing at home across 450 PIN codes in top 6 cities in India in partnership with Orange Health Labs. Its entry ups the competitive risk for incumbents.
Zee Entertainment gains after the company says it aims for Z5 to break even in FY26 and higher viewership share. Stock up over 9%.
RBI has lowered the priority sector lending requirements for small finance banks from a total of 75% to 60%, providing them greater flexibility in lending. Stocks of SFBs see some green amidst a sea of red.
Well, the Nifty has claimed the 25,000 mark and in fact is trading, only 70 points lower. This is a very sharp recovery, especially in the last couple of minutes that we've seen. The market seem to be shrugging off all, at least most of the global geopolitical risks. As far as the mid-cap index is concerned, it is now in the green, up almost 0.5%. The advanced decline ratio graph will also come up for you on the screen, and that will indicate how the gap between the advances and the declines is now narrowing, and in fact we could maybe expect a crisscross sometime soon. The bank Nifty is holding in the red, down almost 0.2%. As far as sectoral indices are concerned, it's a mixed picture. We do have, the IT index down in trade after Accenture numbers. Autopac is also not doing too well, but the Nifty Media, on the other hand, on account of the kind of move that we saw in Z, is also holding up quite well in the top sectoral gainer, and Nifty Metal Pack is also holding up well. Now, let's go across to Hormaz, who is here in our special segment Midcap Movers to take us through the midcaps that are moving around in trade. Good afternoon, Hormaz.
Good afternoon, Ramakshi. It is turning out to be a good afternoon for the broader markets, considering the recovery that we have seen from the lows. More importantly, the Dow futures have now turned positive. They were down 350 at one point and have now into the green. We'll start off with some of the gainers then in the broader markets in today's trading session. And look at Chennai Petro and MRPL, a positive brokerage note coming in on both of them from Yes Securities. And that is a result of which both of these stocks are the top gainers despite the rise in oil prices, mind you. And the other two names are the wires and cables makers. Polycab, of course, on a positive brokerage note, and side by side having a reaction in KEI Industries as well, both seeing gains of around 4.5% to 5%. Now, some of the other names, the newsmakers in today's trading session, the Idea Forge, of course, on the back of an order win, 10% higher and upper circuit there. Zee Entertainment, as you just mentioned. Ola Electric, after the block deal that took place earlier in the day, 5% lower on that stock, continues to grind down. And Zen Technologies, a 5% circuit after the acquisition that it announced over the weekend. Now, some of the other movers in the broader markets today include the rice stocks that are not doing well. Of course, Santhia just reported about this, about shipments being stalled at Indian ports, and of course the uncertainty because of the Gulf exports, losses of anywhere between 2% to as much as 9% for LT Foods. LT Foods, of course, has a reason of its own as well because of the countervailing duty imposed in the US. Stocks that are doing well on the volumes front today. And of course, there are also some news-driven names here. KFin Tech, CCL Products doing well, and Alkyl Amines on the back of strong volumes is seeing gains of close to 4%. And lastly, some of the losers in the broader markets, they too recovering from the lows. Not Godrej Industries though, 4.5% lower at the lowest point of the day. Dr. Lal too at the day's low, 3.5% lower. What has recovered slightly though is Astral, still down around about 4% in today's session. Back to you guys.
Thank you so much, Hormaz, for joining us, giving us a comprehensive list of stocks that are doing well, as well as some of the stocks that are slipping as far as the broader end of the markets are concerned. We'll now slip into a short break, more stock-specific action on the other side, and we'll also connect with Jyoti Gupta of Nirmal Bang Institutional Equities as different stocks continue to extend their rally. Stay tuned. Welcome back to Midcap Radar. Well, the positive rebound that we're seeing in the market continues to sustain. One particular sector that continues to rally is the defense space. Ria joins in with a quick roundup of all the news flow that we've seen over the weekend and today morning.
Well, yes, Vivek, a lot of action as far as the defense names are concerned today. First up for Idea Forge, the company has received an order worth rupees 137 crores to supply mini UAVs with accessories to the Ministry of Defense, and this is to be delivered within the next 12 months. Remember, at the end of FY25, the order book of the company stood only at rupees 13.6 crores, so this is a big order for the company, and the stock is at an upper circuit of 10% as a result of this. Moving on to Zen Technology, 5% upper circuit for this one as well. They've announced the strategic acquisition of a majority stake in TISA Aerospace Private Limited, which specializes in the indigenous development of loitering munitions and UAVs, and this marks the company's entry into the UAV space as far as the defense space is concerned. For BEL as well, the stock is also up almost 3% today after securing orders worth rupees 585 crores. Remember, the company had said that they're expecting to receive about rupees 27,000 crores of orders in FY26, X of the QRSAM order also expected in this year, and so far in FY26, the company has secured orders worth about rupees 6,800 crores in this year. The last one that we're keeping an eye out on is Solar Industries. The stock is up around 0.5% after receiving an order worth rupees 158 crores for the supply of defense products to the Ministry of Defense, and this is to be executed over a period of 1 year.
Well, thank you so much for that, Ria. That explains why most of these counters are up in trade today. But to take this discussion forward, then we now have Jyoti Gupta, research analyst at Nirmal Bang Institutional Equities, joining us. Good afternoon to you, Jyoti. This is Vamakshi. Jyoti, I'd first like to get your perspective on how much is actually priced into all of these defense counters. Of course, we have a slew of orders coming their way, and we also have rising geopolitical tensions. So how much of it is baked into the price?
Okay, thank you so much for having me on the show. So most of the defense companies are trading at elevated valuations, reflecting high investor expectations despite, the execution levels that we're expecting. Now, I mean, however, Bell and HAL and BEML are ones which I still feel they offer attractive risk-adjusted upside. And typically, our approach has remained conservative, factoring in padding for execution or order delays. So current valuations appear reasonable, but for the long term, especially versus peers with higher multiples and operational risks.
Understood. Jyoti, that really is quite helpful. What I want to understand from you, Jyoti, is when it comes to a specific space within the defense, where do you see the most ordering momentum? So where is it that you're therefore most bullish on? Is it the drone system, or is it some of the homegrown players where you expect to see elevated ordering activity?
I would say I am optimistic on the entire defense sector because underpinned by strong policy momentum and heightened strategic urgency. In fact, the government's increased focus on emergency procurement, which is, I think, is in somewhere in the range of 30 to 35,000 crores, and it is across all the sectors, all three divisions. So, and that is particularly in the light of geopolitical dynamics, and this has led to accelerated order placements and concerted push towards fast execution timelines. Now, everybody's been talking about, emergency procurement post-Sindoor. As far as my understanding goes, I think procurement orders were already given before that because the companies were already working 2.5 shifts, in fact, 3 shifts. So I think this shift only, supports the robust near-term growth visibility and also enhances cash flow and order book strength for key defense OEMs.
Well, Jyoti, I'd like to ask you about the export opportunity for Indian players, because there's a NATO summit that is scheduled tomorrow, and the allies are expected to increase the defense spending to 5% of GDP from the current 2% of GDP. So now, of course, we do know that the Indian players directly are not eligible to build for that. But what about the second order effect from some of the OEMs that are based out of there?
So, we believe there's a huge TAM for drones and UAVs, and it remains largely vast and untapped with strong potential across tactical and strategic applications. Now, whatever spending happens, Indian market would be the net beneficiaries. And while you say we're not in the, I think overall basis we will benefit, whether in the first or the second category doesn't matter. And, as modern combat shift towards greater reliance on autonomous surveillance, real-time intelligence, and precision targeting, I think the demand for UAV and is set to grow and the defense manufacturers, in fact, you will see that the defense manufacturers are also increasing their capabilities in areas such as loitering munitions, vertical takeoff and landing, drones, swarm systems, counter-drone technologies, jamming. So, and this is, of course, supported by the government budgetary support, where the government is saying that we'll take the exports order to something like 50,000 crores. So. Right. So I think overall, Indian market and also with Operations Sindhu, the kind of confidence that we have built up in terms of our capabilities, I think we'll be the net beneficiaries going forward.
Jyoti, one last quick question. Number one, give us an approximate sense of the TAM as far as drones as well as UAVs are concerned. And secondly, give us your top picks both in the large cap space and some interesting names in the small and mid cap space. Some of the companies that are doing interesting work, especially as far as exports are concerned.
So I wouldn't really have the exact TAM. In fact, I won't even have a ballpark figure, because the TAM that you expect is going to be for the next 5 years. That could increase substantially with the 5% spending that you're seeing. So difficult as of now to give you a number. I do think that there are some companies which are doing very well. One, of course, if you look at the listed space, and the ones that I'm tracking is HAL and BEML, because they still continue to offer some upside because of the delay in execution. While on the other side, I see small companies like, Unimec, you could see, again, you have Sign DLM, you have Idea 4, which will be getting it. Some companies are doing extremely well in listed space as well. You could look at WEM Technologies. There are, MKU. All right. So there are a lot of companies who are doing, and they're getting very big orders in terms of defense as well.
Sure. Thank you so much, Jyoti, for joining in with us this very afternoon. But let's slip into a very short break then. Praveen Sahai from PL Capital Group also joins us as government implements government implementation of BIS norms till December 2025 gets extended. Welcome back. You're watching Midcap Radar on CNBC-TV18. Well, it's a big jolt for pipe makers as government has delayed the implementation of quality control standards for PVC, which is a key material used to increase durability of pipes. To discuss the impact on organized listed pipe players, we are now being joined by Praveen Sahai, VP of Institutional Research at PL Capital Group. Well, good afternoon to you, Praveen. Let me first start off by asking you, what do you make of this development? It has been delayed countless times now. What is the impact of this on the prices as well as some of the listed players?
Yeah, so there is a delay in the implementation of a BIS norm in the PVC resin, and this delay is a third time. So it was earlier, expected to implement in the August 24, and then there is a multiple delay happened. Because our PVC resin around 55% get imported of our total consumption, and as there are several countries from where we import, and China is one of the big, so around 32-33% of import come from there. And with these implementation, that was expected some curtail in the import and the quality product. And especially in the PVC resin pipe to increase, and which will directly benefit the organized player in the pipe and fitting segment. And that also expected some stability in the PVC resin prices to come in, because from the last October 20th, when the ADD was proposed, continuously the PVC resin on the volatile space. So with this stability expected to improve and the organized to gain the market share, and so as the listed peers.
Praveen, in fact, you've been highlighting via various notes to clients that PVC resin prices, especially post Q4, were actually on a rising trend. So spreads were improving for players. So does this now mean that once again you will see spreads contracting? And also, any clarity or any timeline as to when we can expect any imposition or any comments as far as ADD is concerned?
So there is two things actually. The one BIS, another is the ADD. Both has resulted a fluctuation in the PVC resin prices. So from the November onwards, we continuously see there is a correction in the PVC resin prices because delay in the ADD, and then after the start of this month, when the BIS norm implementation getting nearer, there is a 3.5 rupees per kg increase in the PVC resin prices, and now that's got deferred again, and we don't know when the ADD is expected to come in. Definitely, these both things will lead to some uncertainty in the especially in the demand and inventory filling, and which will result in the correction in the PVC resin prices, maybe. Now, the most important over here is because of these fluctuations in the last 2 quarters, we have continuously seen that the inventory level at the channel for the pipe and fitting has reduced significantly. Usually, channel used to keep around 5 to 6 weeks of inventory. Now, that's around 2.5 weeks. So that inventory filling restricted because of fluctuation in the PVC resin prices, and that's impacted the volume growth for the peers. So that will continue like this with these uncertainty time, and we will see a muted volume growth for the peer set for plastic pipe.
So for the entire year, when you say it's a muted volume growth that you're expecting, what is the kind of range?
So when we start this financial year and there is a news for stability in the PVC resin prices, this 4 weeks of a filling in the inventory only expected to bring around 7 to 8% of a growth for the sector. And now we are not seeing any kind of stability in the PVC resin prices. Definitely the industry would be in the range of around low single digit of a growth, or maybe a flat.
Understood. Thank you so much, Praveen, for joining us, giving us a view on 2 very important developments as far as the entire pipe industry is concerned. Thank you once again, and we hope to get you on the channel soon to discuss, when there are more developments in this particular space. But with that, we've completely run out of time on this edition of Midcap Radar. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in, as always. Markets, we've seen that recovery coming in, now managing to hold on to 25,000 as of now as well. So no complaining in terms of the recovery that we've seen so far. 24,000, 2220, around that mark is what the Nifty is trading at. 0.3% of decline is what the market is still holding on to right now, whether you look at the benchmark indices. Outperformance, we've spoken about this before as well, coming in from the broader end of the markets, so Nifty mid-cap and small-cap doing quite well in today's trading session, holding on to strong gains of more than 4.10 to 0.5% in today's trading session. Opened up in the red, but look at that recovery in the chart that's coming in, right? It's just like a steep uptick that started coming in, and that recovery has continued through the day for the broader end of the markets. Nifty Media among the top sectoral gainers, obviously led by Z Entertainment. They had their presentation that was released yesterday, so that's why Z is among the top stocks movers in today's trading session. But this is a show where we solve all your stock related queries, and that is what we're going to be doing. To do that, we have Saumil Mehta, head of alternate research capital market strategy at Mirae Asset Sharekhan, joining in with us, as well as Gaurang Shah, senior vice president at Geojit Financial Services, to answer all your stock related queries. Saumil as well as Gaurang, thank you so much for joining in with us on the show. Let's just get started with the queries. We have a lot happening in the markets, 25,000 right now, so not complaining on that front. First query for today is coming in from Preeti Sharma, who's writing to us from Delhi. She's holding 800 shares of Varun Beverages. This is at a price of 617 rupees per share. She's making a loss on this one and wants to know whether to hold or look to sell, and she wants both the perspective, long-term as well as short-term. Gaurang, your view coming in for Varun Beverages, what are we watching out for here? Short-term as well as long-term, where do you see a better bet coming in here right now?
Thank you so much, Vinny, for having me on the show. Good afternoon to all of you all and all the viewers of CNBC TV18. Recommendations are a part of our research team. Our company, Geojit, or I do not have any investment or financial interest in any of the stock recommendations, and no conflict of interest. However, we recommend similar investment ideas to our clients. They might have their investment position. Varun Beverages, first of all, Vinny, as far as my knowledge goes, I don't think there is any other listed entity with whom we can do a peer comparison, given the kind of business model that Varun Beverages have. Point number two, I think the offtake of cold serve carbonated beverages and other beverages is going to grow at a very decent space. Our research team has a hold recommendation on the stock. Second advice that I would give this investor is that since you got invested at higher levels and you're getting the stock for further investment in case if you have investable amount at a very decent price correction, add a small quantity or maybe half the quantity at current levels. That will bring down your acquisition price, and from a long-term point of view, chances of profitable exit looks much, much brighter. But hold and average is the recommendation.
Okay, hold and average is the recommendation coming in on the fundamental front. On the technical, Saumil, what's the story playing out right? Because last 1 year, we've just seen that decline coming in, not any up move actually, 26% decline. So what would you say for short term as well as long term? What is the target?
Yeah, and at the moment, it has been forming lower top, lower bottom of the daily charts, struggling to go above the averages, short-term averages, long-term averages, both 20-40 daily moving average and 200 daily moving average. So that's a very weak sign for the stock. I would say in the very short term, the trend is negative, trend is downside, and I'll be expecting this trend to continue. And 430, 420 would be the targets in the very short term. However, once it starts going above the averages, closes about 200 daily moving average, which is way above, 540 would be the levels I'll be looking out for. If it closes above 540, then the medium to long-term outlook will be positive. But at this point of time, short-term is definitely negative.
Okay, short-term is negative. So that's the view as of now coming in on the short-term front, but keep an eye out on the long-term story. Next query for today is coming from Deepak Dave, who's writing to us from Gujarat, holding 140 shares of Birla Corp. This is at a price of 1,300 rupees per share. He's a long-term investor and wants to know whether to hold or to sell. Gaurang, there was a lot that was happening on this front as well, especially coming in this space where West Bengal legislature had also revoked some incentive schemes that came in, which spoken to the management that the commentary seemed decent because they kept expecting the growth of around 8% in terms of volume in FY26 going forward. What is your outlook for the stock and what should the viewer now do?
So on the outlook on the stock, we have an accumulate stance. That means if you have it, you can hold on to it. If you have investable amount on corrections, you can add on to it. Really, the entire cement sector is not really much spoken about in terms of investment ideas and theme. Now, Birla Corp happens to be a small to medium cap cement manufacturing company, has got decent presence in some of the geographies as well as market share is concerned. Consumption of cement, Vinny, is going to go up given the elaborated plans from the center and at state level also. If you see, there are a lot of infrastructure projects that are going on in different states and pan-India also. Real estate sector, which is the second largest consumer of cement, is also doing very well. You can very well recollect 11,000 crore project of DLF getting sold out in 1 week. So real estate sector consumption, private capex is likely to pick up. And along with that, Vinny, infrastructure creation in semi-urban and rural India. So cement as a sector looks extremely good, and we have accumulate stance on Birla Corp. Hold on, and if you get dips further to maybe about 1200 or 1225, you can accumulate as well.
Okay, surely. That's a view coming in on the fundamental front. Cement as a sector is attractive, and as of now, they do have a Birla Corp as a accumulate for your Gaurang. Okay, thanks for that view. Saumil, your view on the technical front. What are we watching out for here in terms of chart? Last 1 month, muted performance, a bit of a decline of around 9-10%. What should we watch out for now?
I think these levels are very attractive. The rise which we have seen in the last 3 to 4 months from the levels of 900, it has been retracing now that rally, and I'll be expecting now to take support around 1230, 1220 levels, and that will be a very good level to buy this stock. In the medium term outlook, positive, absolutely positive. In the short term, maybe a little sideways, maybe a little bit of more correction, but that will be a time to buy. And on the upside, I'll be expecting our targets of around 1450 and 1550 in the medium term outlook.
Okay, keep an eye out on those levels over there for Birla Corp. Let's move on to the next query for today. This is coming from Deepak Kishan, who's writing to us from BR, and he's holding 20 shares of LIC Housing Finance. This is at a price of 653 rupees per share, making some bit of a loss here right now. But he's a long-term investor and wants a long-term view on the stock. Should they continue to hold or look to exit this one? LIC Housing Finance, Gaurang, your view coming in. Obviously, last week we had seen some of those changes coming in, but that was mainly because of those project-related financing from the RBI side, right? So does that have any impact here? What are we watching out for in terms of LIC Housing?
So one of the beneficiaries of interest rate cuts that we saw of 50 basis point and of course CRR cut in a phased out manner, all this augurs extremely well for housing finance companies. Point number one. Point number two, real estate sector has its positive impact on the housing finance companies also, given the kind of run rate in terms of project launches and the projects getting sold out in maybe about a week, 10 days or so. In this case, 20 shares is the quantity acquired at 650 plus. Currently, the stock is trading at 590, I beg your pardon. Our team has an accumulate stance. I would again repeat what I said earlier. Hold on to it at current level, since you're getting at a 5% plus downside. If you have investable amount, maybe you can add another 10 or 20 shares from a long-term point of view.
Okay, that's a view on the fundamentals. On the technicals, your view, LIC Housing, Saumil.
LIC, I am extremely positive on this stock in the medium-term outlook. For a positional trade, this looks amazing because it has formed an inverted head and shoulder pattern, and it has already formed the right shoulder. It has been consolidating around 200 daily exponential moving average, and the breakout levels would be around 630. On the upside, I think the targets would be 730, 740 levels. Stop loss would be around 560. this stock on the higher time frame, the momentum indicator has already given a buy signal from the lower ends. Making higher tops, higher bottom. Great setup, very positive on the stock.
Okay, great setup. Positive on the stock coming in here on the technical front. Next query for today. Venkat Chalam is writing to us from Pune. He's holding 100 shares of Narayana Hrudayalaya Health at a price of 966 rupees. So they are making good amount of profit here. Wants to know the future prospect of the stock. Gaurang, your view coming in for Narayana Hrudayalaya, given that the stock has seen some bit of attraction in the recent time. Today also it's one of those stocks that's buzzing into it as well. How is the story actually playing out on the fundamental front?
Well, actually, Vinny, if you go to see, this has been a stellar performer in the healthcare universe, that is hospitals. Last 1 year, 1.5 year, purely on the basis of earning visibility and, of course, the capex that is likely to come through in the future. Our team has a hold recommendation on Narayana Hrudayalaya. Yes, you are making fantastic returns in terms of what levels you got invested at. If you are not in a hurry to book out, or if you want to, book out a part, you can possibly act according to your wisdom. But I would say hold from a long-term point of view. And the best part about the investment is the investment level and where the stock is trading.
Okay, interesting there coming in on the fundamental front. A good story playing out for Narayana Hrudayalaya. Your views are on the technicals also. Is it thumbs up here as well?
Absolutely. Great stock. It has been forming higher tops, higher bottom, just broken out of a small bullish flag pattern. Every time it comes down to 40 or 20 daily moving average, it starts making higher tops, higher bottom. So that is a very good sign for the stock. Momentum indicators on the higher time frame are on the buy side. I think the next level in the very short term would be 2050, 2100 levels. So I'll be very, very positive in the short term as well as in the medium term outlook.
Okay, that's a view coming in there on Narayana Hrudayalaya. Thumbs up on the fundamental and technical front. But on that note, we're going to step into a very short break. Here's some good news coming in for our viewers. India's business news leader is now a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or you can just scan the QR code on your screens. Welcome back to Your Stocks on CNBC TV18. This is the show where we solve all your stock-related queries, and we're doing just that. We still have with us Gaurang Shah as well as Somil Mehta. The next query for today, gentlemen, we have is coming in from TV George, who's writing to us from Chennai. He's holding 310 shares of Welspun Corp. This is at a price of 223 rupees per share. Wants to know if it's the right time to exit the stock, or should he continue to hold this? Obviously, he seems to have been holding it for a while. The stock is making a good amount of profit. Gaurang, does it make sense now to actually just book out some bit of a profit here, or do you think in the near term or the longer term they'll make more profits on this one?
Well, you're making more than double, right?
Yeah.
Vinny. Unfortunately, we don't have specific coverage on Welspun Corp, but since the investor has asked about switching the investment onto something else, then if he wants to book out, my sense is that private sector banks would augur extremely well. We have been positive on the entire BFSI segment for a pretty long period of time. If I have to choose one large bank, private sector, then I think ICICI would augur extremely well.
Okay, that's a view coming in there. If you're looking to switch, ICICI Bank is the word coming in from Gaurang. Somil, your view, coming in the charts and technicals, would you say it's time to just book out profits, look at something else now, you've made enough money here?
I think in the very short term, definitely if you've traded for, if you've been on the stock for a little while, probably it's a good time to, book some profits. In the very short term, it is looking negative. So I'll be looking for a target of around 865 on the downside, maybe 820 levels on the downside. So it would probably make sense to book out some profits and maybe get into some other sector. Real estate sector is looking great. Godrej Property, Oberoi, Prestige, all of these stocks are looking great. So probably that if you want to switch, real estate sector looks good.
Okay, real estate looks good on the chart and technical front, and on the fundamental side, Gaurang gave a view coming in even for ICICI Bank. So yes, keep an eye out on the private banks or real estate. So time to just book out some bit of a profit here. Next query for today, Ravi is writing to us from Bangalore, who's holding 50 shares of Protein eGov, and this is at a price of 1,420 rupees per share. Wants to know if the stock is worth holding, or should he exit at the current levels. Gaurang, what's your view coming in for this one? Because yes, PAN 2.0 was an issue, but after that they had won some other order as well, smaller one, but there was another one not related to PAN. So what should they be doing with this one?
So, this is a classic case wherein, name of a particular company starts moving up because of certain government orders coming in, and then there is a very long period of dryness or slackness in terms of inability of getting orders. Now, again, no specific comments, but since the investor has asked about an alternative investment idea, our sense is that possibly something in the EMS segment would augur extremely well. It won't do much damage in terms of already the loss that this investor is incurring. PG Electroplast is the recommendation from a long-term point of view. I think a switch would make a good investment decision.
Okay, switch would be a good investment decision. Technically also, would you say switch, or technically there is still some chance that they would make some money here?
I don't think so, Vinny. The short term looks negative. The medium term outlook looks negative. It has been, the stock has been struggling to go above the short term averages, the long term averages, making low tops, low bottom. The daily charts, weekly charts does not look good to me. So I think it would be great to switch to some other stock. Maybe, as I said, real estate stocks looks good right now.
Okay, switch to other stocks coming in as a view from both the fundamental analyst as well as technical analyst. Next query for today is coming in from Sriram, who's writing to us from Coimbatore. He's holding 85 shares of Dixon Technologies. Price is 6,320 rupees per share. So they're making good amount of money on this one. Wants to know if he can add more shares, and also wants to know the long-term view on this one. Dixon Technologies, Gaurang, what's the view, right? Because it had reached those high levels, then split, and again now it's gone to those heights. And the view wants to add more. Does it make sense now?
So very, this, if you look at 3-year performance or even 2-year performance, this has been a stellar performer, undoubtedly, and thanks to the sector that this company is into, and along with that, a tailwind positive from the government in terms of PLI scheme. Again, this is one company, according to my understanding, there is no listed entity in terms of peer comparison. And one thing you have to remember, look, if you look at 2-year performance, this stock has done extremely well. If you look at near-term performance, then from 18,000, 19,000, the stock went down to maybe 12 or 13,000 and now currently trading at 14,500 plus kind of levels. I can only speak about the sector and the balance sheet. I won't be able to give any specific comments since we don't have coverage on Dixon Tech. But the future of this particular sector looks extremely strong. And this company is one of the leading performers within its sector.
Okay, that's a view coming in there. And on the technicals, Dixon Tech, what's the view, Somil? What should the viewer do? Continue to, they actually want to add. Is it a good level to add more, given that they're already making profit? Or should they, just book out profits? Look at any of the other EMS names.
I think it has just broken off the ending diagonal pattern on the daily charts. Today is, I think, is a good move. Momentum indicators just giving a fresh buy signal. I think you can add in the short term, in the medium term for a positional view as well. My targets on the upside would be at least 17,000. And if it closes above 17,100, I think the next level would be crossing the previous swing highs or the all-time highs.
Okay, that's a view coming in there for Dixon Technologies. Keep an eye on levels over there. But, with that, we're absolutely out of time on this edition of Your Stock. So thank you so much, Somil, as well as Gaurang, for joining in with us as always and helping our viewers solve all the stock-related queries. And viewers, thank you so much for tuning in as always. Remember, you can always send us your queries and email us your queries on the email ID that will be flashing on the screens for you all. But don't go anywhere. Up next, we have Closing Bell to take you through the last hour of trade. So do stay tuned in for that.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV18 Motilal Oswal studio.
Hang Seng down 0.7%. The Taiwanese index is down almost 2%.
Iran's key nuclear enrichment facilities have been completely and totally obliterated.
Markets are worried, but are they panicking? Are they throwing a tantrum? Absolutely not. 24,980 on the Nifty, about 0.5% lower.
According to market, all this is not going to have any material or lasting impact.
Some of that money is beginning to move back into US and frankly international markets.
Nifty and Sensex both under pressure.
Today, large part of the proceeds of QIP will be used to give exits to these investors.
The Nifty has claimed the 25,000 mark and in fact is trading, only 70 points lower.
Well, that's the day so far. It has been actually a pretty decent session all told. Markets are not down that much. Actually, they're off quite a bit from the lows of the session. That's going to be, the broad tone tenor of the conversation we'll have over the next hour or so as we track market closing. We're coming to you from the CNBC TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Survi. Guys, afternoon.
Hi, good afternoon, folks. The markets are speaking, and they're speaking loudly, are they not?
Yeah.
Equities, US futures are positive. Oil, which spiked to 79 when trade opened out, on Monday morning, has come down to about 76. Dollar virtually unchanged. I think there's a lot that markets are saying.
Well, that's right. I think the last few days they were waiting for, whether or not the United States is going to get involved. Now they've gone ahead, got involved. So it's at least that part of the uncertainty seems to be behind. Hopefully there'll be some kind of de-escalation, which we're yet to hear about. But I think what's telling you about the pulse of the market is the mid-cap index. In the first hour itself, it moved into the green. And now you have the number of stocks advancing at 1,200 from around 400 earlier today. So the mid-cap index, as well as the crisscross lines come up for you in the screen. Yep. That's telling you that domestic money believes that this is going to be, short-lived with regard to the escalation.
Absolutely. And, in the morning we were saying how if the response is weak, oil prices perhaps have a lot to fall. They've not fallen a lot, but they're in the negative now.
Yeah.
So actually, Brent prices, I think we get those rates. Look at that. That's down about 0.25%. This a day after US has struck Iran, right? In terms of those nuclear bases and nuclear sites, essentially, where uranium was being enriched, apparently. So this is quite symbolic in that sense. It's quite telling, as I was saying on the morning as well. What happens now? Will Iran respond for the? They've got to save face. They've got to do something. The question is what? And the way I would look at it is, and you'll see, hear headlines and markets will respond. But broadly, if the response is very targeted, almost symbolic, tit for tat, almost like choreographed, the market will look through it and then maybe you get a bump and that gets faded. On the other hand, which is, I think, very, very unlikely, you get a widespread sort of, strike across, trying to target American stations and vessels and, bases around the region. Of course, then all bets are off. But I don't think that is the base case, or should be the base case at all. Some escalation, targeted perhaps, but the market should be able to look through it. We'll see. In the real world, anything can happen. It's not as if anything is foretold, but what we can do at best, of course, is just look at what's happening and just sort of try and read the tea leaves. So oil prices turn negative, gold prices struggling to sort of maintain their rally, just trading below Friday's close, focused on how Iran will sort of respond. And as far as the market is concerned, if you want to look at the level, 24,865 was a 20-day moving average, and we've kind of hit that in the morning. We bounced off it. We're still down about 0.5% or so. We'll see if there is more recovery afoot. Broader markets, as Nigel pointed out, also looking much, much better. Surbi.
Absolutely. And I guess on geopolitics, perhaps the market also thinks it's a very different warfare, right? It's unlike Iraq. It's not a ground invasion. Yeah. These are aerial strikes. So the market believes that expecting any kind of a major military strike by Iran, out on US soil, it seems, at least from the market perspective, seems something extremely far-fetched at this point in time. Now let's talk about mid-caps. Like Nigel was saying, mid-caps are a nice bright shade of green. The index itself is up 0.5%, the mid-cap index. I'll just give some examples. Stocks are moving to news, to sentiment, to, individual price action. Polycap, for instance, reacting very well to a Jefferies note. Stocks up 5%. Some of the defense names have been up since morning. So, for instance, Garden Reach Shipbuilders, something like a Zen Technologies. Zentech is up 5%. Garden Reach is up about 6% as well. Even beyond that, there's VIP. There is Idea Forge also, another defense name, 10% up on Idea Forge as well. KEI Industries, so some of the wire and cable guys, looking good this afternoon. All around MRPL, look at MRPL, 8% up on MRPL. So plenty of names in the broader market which have been looking good.
Yeah, that's right. Just since you spoke about MRPL, even CPCL, Chennai Petro, that as well is up close to around 10%. And I was just doing some quick research on the company. The GRMs have moved up actually, which is good. That's helping them. Their fuel, their fuel and loss, that quotient has come down. So operating efficiency for them has improved as well. And also if you look at replacement cost of these assets and, compare it to the current EV, there appears to be some valuation comfort as well. You can get whipsawed on either side, but this big improvement in GRMs as well as their focus on reducing the operating losses explains why a couple of these names are doing very, very well, in today's trading session.
Okay, all right. That's a helpful perspective on some of these oil and gas names that are up and about. So let's get started then with the trading ideas. As always, we have Mitesh joining in. Mitesh, very interesting market. Bulls seem to be having the upper hand. What would you do in the last hour?
Good afternoon, sir. I'm still not sure, if there is a directional bias. In fact, morning I was calling for the markets to take support around 24,900. We went slightly lower than that. But then again, the idea was that most of the volatility indicators are still flat, so I was not expecting a large move, though I think the decline was slightly 70, 80 points more than what I expected. But I still believe that we are in a sideways consolidation. 24,850, 25,200 remains the range. So not much on the index, to be very honest. But yes, a couple of stocks looking interesting. Grasim and Overall Reality, I think, look good. Grasim is breaking out. Keep a stop below 2,700. Look for targets of 2,820. While Overall Reality is also, trying to break out of a sideways activity. So buy here with the stop below 1915 and look for a target of in excess of 2,000.
Okay. All right. Got that. Thanks a lot for that, Mitesh. Well, let's get in Vamakshi then. She's here to focus on a couple of big movers today. Z Entertainment, that one is flying away. Vama, tell us more.
Well, Nigel, the stock is flying away because the company reported a presentation yesterday, and in that presentation, they've highlighted some of the key focus areas for FY26. One of them being that they plan to achieve break-even in Z5 as compared to an EBITDA loss of almost 550 odd crores that they had reported in FY25. They also are focusing on execution of their business plan to achieve the targets that they had set out. Now, just to recap, back in Q4, they had outlined some targets, which includes a TV viewership share of almost 17.5%, ad revenue growth between 8 to 10%, EBITDA margin between 18 to 20%, and value unlocking in music as well as syndication. Now, they've also highlighted that market consolidation is leading to increased competition, and to counter that, they are also increasing their cash reserves as well as cash balances. Now, keep in mind that as of March end, their their cash balance stood at 2,406 crores, and apart from that, very recently we did see the board approve issuance of fully convertible warrants to promoters worth 2,237 crores, and they also have an enabling resolution to raise 2,000 crore via FCCBs, out of which only the first tranche of 200 crores has been withdrawn. Now, the purpose that they're doing this is to first, number one, is compete effectively with the competitor, which is the Reliance Disney JV. They will also be acting proactively to address any rapid market share shift. Now, they've also outlined some growth levers for them going forward. They're developing new business verticals. They're building new distribution business models as well to capture a lot of eyeballs, and they're also enhancing content offerings to address all sort of age groups. They're also eyeing inorganic expansion through acquisitions or strategic partnerships in very high growth verticals such as digital as well as music. So they've outlined a very ambitious plan, and resultantly the stock is higher, but it will all depend on whether or not the company is able to execute on this.
Okay, all right. Thanks a lot for that, Vamakshi. 10% higher and massive volumes as well. Deepan Mehta of Alexa Equities joins us on the show. Deepan, what's your take? Z is set for better times, or would you avoid it going by past history?
No, I think that there's certainly a turnaround happening at Z. First of all, good afternoon, Nigel. There certainly is a turnaround happening at Z, and the management is far more focused on the business operations rather than all the M&A activities. And I think that they seem to have got gradually seem to have got their act in order. They are focusing on TRPs, reducing the losses from the OTT channel, looking at strategic gains as they can make to retain and grow their market share. So typically, it's just running the company better, focusing on content, focusing on improving efficiencies, reducing costs, and all of that will eventually get reflected in better performance. So very positive on Z Entertainment. I was very negative on the stock when all the controversies were there around it, but now I think the view certainly has changed for the positive, and it's a reasonably priced stock as well. I think 18 times or so trading 12-month, and if they're able to curtail the losses from the OTT division, then there could be a good delta in the profit. So it's a stock to watch out for. And if you're a turnaround specialist, this is a classic one for you.
Got it. Okay. All right. So Z, you're sounding a little bit more optimistic, Deepan, on this name. What about on these other couple of stocks that we were just discussing, MRPL as well as CPCL, Chennai Petro? What's your? Do you have a view out there? GRMs have improved. As a percentage of the mix, I think CPCL has higher amount of diesel. And they've also focused on bringing down losses. I think the valuations as well are supportive for them. Any view on either of these two names, or is it too tricky to play?
Well, Nigel, they're typical commodity stocks. There's nothing really exciting in them. From time to time, you'll have a very powerful trading rally in them, depending upon improving fundamentals the refining ratios and other things. But end of the day, I think they haven't created much value over the last several years or so. And I'm generally not in favor of investing in commodity type businesses. So I would like to avoid them. But as I said, I think they are cheap, and some positive news flow can come through, can take the stock prices higher. So the good current traders can play it. But I think for a long-term investment perspective, it's an avoid.
Okay, I think, as someone was pointing out, while crude oil supplies have not been disrupted, refining capacity is another matter. Refining capacity maybe has been disrupted. We saw this with Russia, Ukraine as well. But of course, back then, oil prices also jumped substantially. But the tightness in refining capacity lingered for a lot lower, even after oil prices had come off. So essentially, product spreads is what matters when you look at refining. And there maybe there is, spreads are widened, etc. So we'll have to track that. Maybe we'll try and speak with these companies as we go on. Well, let's talk about the other sector, which is buzzing, defense. Now, Vamakshi is here with what's happening. Actually, there are lots of these, some small, but some larger companies as well, which are up 4, 5, 6%. Ria, tell us more.
Well, yes, defense stocks have surged once again today after the tensions between Israel and Iran have escalated as the US has joined in the war. The defense index today is up over 2%, and the biggest movers in terms of individual names include Apollo Micro, Idea Forge, Garden Reach, Zentech, BEML, and even Paris Defense. One clear trend that we're seeing is that there's been some increased interest in drone and UAV companies as well. Just quickly taking a look at some news flow over the weekend and today that is impacting individual stocks. The first one is Idea Forge hitting an upper circuit of 10% after the company has received orders worth rupees 137 crores to supply mini UAVs along with accessories to the Ministry of Defense. This is to be executed over a period of 1 year. And remember, the order book at the end of FY25 stood just at rupees 13.6 crores. So this is a very big order for the company. The next one is Zen Technologies, 5% upper circuit for this one as well. The company has announced the strategic acquisition of majority stake in TISA Aerospace, which specializes in the development of loitering munitions as well as UAVs. And this marks the company's entry into the UAV segment as far as the defense space is concerned. The last one is BEL. The stock is also up around 3% after securing orders cumulatively worth rupees 585 crores. And remember, the company had said that they're expecting to receive about rupees 27,000 crores of orders in FY26, X of the QRSAM order that they're also expecting to receive in this year as well. Apart from this, just taking a look at the value valuations in the overall defense pack. Only 2 out of the 15 stocks that we've looked at are trading at or below their respective 3-year average PEs, and these are Paras Defense and Mazgon Dock. In terms of prices, many stocks are still trading anywhere between 7 to 34% below their respective 52-week highs, and these include names like DCX Systems, Idea Forge, Cochin Shipyard, Zen Technologies, and MTAR Tech as well, and some names including GRSE, Solar Industries, BEL, and Apollo Micro are trading close to or above their respective 52-week highs.
Okay, that's an important valuation chart that comes up. Let's actually put that back up, that valuation chart, and we'll discuss this with Deepan. DCX System, obviously trading above the average PE. Idea Forge, obviously higher. Cochin Shipyard, way above the 3-year averages. And it's pretty much the same for all of the stocks out there. Very few will be trading at or below their average price to earnings multiples. Deepan, hi, good afternoon. That's the conundrum, right? What do you do? If you put the PE filter, you shouldn't be buying any defense stock. But then people say, look at order books, look at the environment, look at 10-year opportunity, look at PEG, so on and so forth. I mean, there are arguments on both sides. Where do you stand?
I think it's a simple strategy. If you're already invested in a few other stocks, then remain invested. Don't worry too much about the PE multiple because the stocks have rallied so much. You have margin of safety. You can absorb the volatility in earnings in the stock price. From a fresh investment perspective, you're better off buying when the stock is slightly out of favor or it is dormant, correction of 15-20% in the valuation, which could be lower stock prices or increase in earnings per share. But look, this buying defense stocks is a global phenomena, and across the board, whether it's Europe, US, defense companies are doing really well. And if war is in the air, then defense stocks are the best way to play it. So I think it's a simple logic. But at these levels, I think it's better to just wait and watch. No point chasing a running train. I'm not sure the returns will be as great 6-12 months down the line. So wait and watch and buy at decline.
Okay, all right. Deepan, wanted your view on Trent. What a brilliant move that stock has given. Post that analysts meet that they had last week, we had highlighted the stock, I think, around 5,700. Today, it's the biggest gainer on the Nifty. It's nearly at around 6,300. What's your view out here? Not a particularly cheap stock, but the vision that they laid out in their analyst meet was quite encouraging.
And I will first a disclosure that we have shares of Trent Limited. But, at these valuations, what sort of a return you can expect? Because over time, the valuations can only remain steady or go down, which means the return that you can expect will be in line or slightly lower than the growth in the earnings per share. And base effect will come into play as it always does for a lot of these consumer stocks. We have seen it to the bluest of blue chip companies like say a DMart as well, which was having phenomenal growth, but now that has kind of tapered off. And something similar will eventually happen in Trent as well. So, I mean, again, the same logic as defense stocks. If you're invested, remain invested. Wouldn't worry too much about the P multiple because there's margin of safety. Your cost of acquisition is low. But from a fresh investment perspective, I think one should look for better ideas. And I think within the retail space, some of these specialty retail companies, I think they have been languishing, but now we've seen good quarterly numbers. Companies like Campus Activewear, Go Fashion, Ethos, Metro Shoes, Campus Activewear. So these are the companies I think which I think are more may give higher returns to investors than maybe a Trent at this point of time, but assuming at least a year holding period.
No, got that point taken, Deepan. Lots moving, by the way. Market breadth is still slightly negative. 1,500 stocks are down and about 1,300 stocks are higher. There's enough action with volumes on the upside as well, and actually not enough action on the downside with volumes. So that's the other thing to note. More volume on stocks which are higher and less volumes, even though numerically it's declines over advances at this point in time. Sterlite Tech made a high early last week. It's kind of sort of been drifting off. One-way move on Sterlite Tech recently. One source is down about 5.5%, 6% or so. That's actually very few names with any significant volumes on the downside. So that's something to keep an eye out on as well. Deepan, thank you very much for joining us. Good speaking with you. Appreciate it. We'll take a quick commercial break here. Lots more to talk about on the other side. Rupen Rajguru should be with us in just a bit. Okay, welcome back. Markets down 127 points and 24,986 is where we are now trading at. Rupen Rajguru is with us, Head of Equity Investments and Strategy at Julius Baer. Rupen, good to have you here. You know, we were just earlier talking about standalone refiners, but I think you do have a kind of positive value-led call on OMCs. Correct me if I'm wrong. Oil marketing companies. Any thoughts on this pack, Rupen?
Yeah, hi. Good afternoon, Prashant. So, see, OMCs typically are trading bet. So, probably 2-3 months back, we had a positive call on that. That was basis the lower oil price, wherein the oil price was hovering around 60, 65. So in the current moment, while the oil price will be volatile, but if oil price were to revert down, which is what we believe it would eventually be. At that moment, definitely we would be constructive on that, because what we have seen, as I think you also rightly mentioned earlier, that the GRMs have firmed up. I think the key for all the OMCs are the marketing margins. The margins are were before the oil price hike was close to 10-11 bucks as compared to steady state marketing margin of $3 to $4. So there's definitely enough cushion. But while I think volatile oil price will keep these stocks under check, but yes, I would say watch out for if oil price were to come down, it will definitely have a positive impact on all the OMCs.
Mm-hmm. Hi, Rupen. Good afternoon. Good to see you, Ben. Well, the other pocket that you have liked, which actually hasn't performed too well, is insurance. But do you believe it's in for better times now, and valuations are as well are palatable?
Yes, hi, afternoon, Nigel. You are right. If you see insurance as a sector, while it has done well this year, but if you zoom out and see from last 3 to 4 year perspective, this sector has seen significant derating. And one of the primary reason for derating, apart from a little bit slowing earnings growth, was extremely tight or a regulatory environment which had more and more news which were negative towards that sector, starting from the taxation front and some of the other areas which we have seen play out. And hence we have seen a significant derating of the sector. Today, if you see what we believe, incrementally the regulatory environment is easing. If you see across the board, starting from RBI or SEBI, while as we speak, we currently don't have we are awaiting for a new IRDA chief, and our strong sense is that overall the environment on the regulatory side would be a little bit loosening, which augurs well. And we have already seen some of those tightening measures like banca assurance channels and all. Now they have reversed on that. So A, the regulatory environment is now better. B, from a growth perspective, we believe growth is coming back. Protection as a business is doing well. And in an environment where the interest rates are low, and finally we are seeing banks also cutting their deposit rates. So some of those non-par products which had lost flavor because a lot of banks were garnering, focusing on deposits. Now the focus will come back on insurance products, which typically are non-par products, and that again growth will come there. So combination of all that plus lower valuation, we believe this sector can see both earnings growth and re-rating. And hence, yes, you're right, we are constructive on the insurance companies.
Okay, insurance is an area that you like. Rupen, hi, good afternoon. Just before you joined us, our colleague was appraising us once again of the defense names and the way the valuations are moving. And we were just discussing this, right? Because valuation-wise, most stocks are trading above historical, average PE multiples. But what is your sense? I mean, overall, the environment that we are in, if someone wants to take fresh exposure, first of all, is it advisable or is it already too late?
Yeah, hi, Surabhi. I think I agree with this conundrum. And in fact, if you see today, intuitively, markets are second-guessing a lot of things. So probably they are second-guessing all the bad news are temporary, because I think, as you rightly said, the oil is not moving up. Ideally, we all would have thought that oil will flare up today, but oil just marginally opened higher and now it is lower. Gold, which is supposed to also go up in an uncertain environment, is kind of steady and not moving up. But at the same time, defense stocks, because it's good news for them, they are moving up. So ideally, defense stocks also should not move up, right? Because on one hand, we are expecting that this war is not going to be lasting for long, and the sentimental impact on crude and gold is not seen, but the sentimental impact on defense is being seen. So yes, currently markets is only focusing that potential good news from a sector perspective, and on valuations, clearly all these stocks are trading way above our comfort level. So while we agree with the long-term potential which this sector would have, but we would definitely want to see translation of order books into revenues and into cash flows. And currently, the stock prices are discounting all that in a seamless execution for next 4 to 5 years. So ideally, we would want a meaningful correction in those stocks to come through for us to be constructive on that, on those segments.
Guys, some of these orders, I'm not sure, right? Smaller companies, I saw one order, 13 crores, 14 crore order. Stock is up 10%. I mean, maybe the market is saying, well, orders are coming at least, and this is from DRDO, etc. But some of these are, I mean, there is a strong element of the theme playing out rather than, maybe at the margin. Maybe that is the dominant driver, and stocks are just sort of, part of that theme which is working out. I'm not talking about the larger ones like BEL, etc., but some of the smaller ones which are now sort of, in a way, getting attached to the broader defense tailwind, which is lifting all boats. I mean, I think there's a fair bit of element. So, you need to be careful if you're looking to play a theme. I mean, you got to be in the right space. Stocks across the board, even if there is a whiff of defense, have done exceedingly well, very, very well. So keep that in mind, because otherwise you run the risk of getting stuck. Mood changes, things start to drop, and the exits become difficult, especially in some of the smaller names out there. I think we've got 130 odd points. Katamin market, of course, just not doing very much at all on the downside. Off the lows, though, I think that's the best way to kind of put it. NBFC is another area you still like, Rupen, from the financial space?
Sure. So, Prashant, in the current environment, one thing is very clear. The RBI, so to say, the bazooka, which RBI has given the market by way of, not only rate cuts, but significant liquidity infusion. And now what we are seeing, the rate transmission is much faster. So typically in an environment, like this, the wholesale funded financiers, so which essentially would be NBFCs and some of the other players, tend to get benefited the most because while their asset pricing will take some time to get repriced lower, but their liabilities gets repriced immediately because the bank loans which they are taken will get lowered immediately. So there is a case for a NIM expansion. And historically, what we have seen in an environment of easy liquidity, lower inflation, and lower interest rates, typically NBFCs tend to do well. And the growth definitely would be much higher than the system growth rate. So from that perspective, we believe NBFC is in a sweet spot. And from our next 3 to 4 quarters perspective, we believe the numbers will be much better than the market expectation. And hence, we are constructive on that side.
Okay, all right. A final question before we let you go, Rupen. I think you'd like some of these cement names as well. Some of them have come off a little bit because demand was a little softish in the first parts of the first quarter. However, the positive was that pricing has started improving. Are you still bullish on this theme? What do you like, large, mid caps, or any kind of geographic breakup you're looking at?
Nigel, you are right. Cement as a sector had one of the toughest years last year, and in fact, middle of last year, without any specific reason on either the pricing side, but they had seen the worst ever EBITDA margin, and thereafter, for last 2 quarters, we are seeing improvement. What we believe, 2-3 things. That this year, the overall industry growth rate, the volume growth rate would be much better than last year, which was sub 4-5%. This year, we believe it will be much higher. It will be closer to 7 to 8%. And as you rightly said, the key thing now is the pricing discipline is slowly coming back. Earlier, there was when the two groups were in loggerheads and there was a huge acquisition spree. There was a significant derating which we had seen for, barring the top two group stocks, or rather the top companies, the other companies had seen a significant derating. But now with the pricing environment coming back, some of those other top 3, top 4 players where we believe can see better days than what they have seen. And yes, from a pricing perspective, South has seen the maximum pricing impact positively, and the numbers of South-based cement companies will be much better in next 2 to 3 quarters. But from our pecking order, probably we would look into buying into the, say, number 3, number 4 players in the cement pack.
Okay. All right. Got that. Rupen, good talking to you today. Thank you very much for taking out the time and giving us the market perspective. By the way, there were some updates there that were there on the ticker as well. Just an update that there will be a meeting between the Russians and the Iranians today. And it seems that it is, Putin himself who will be receiving the Iranian foreign minister and then discussing the way forward. So let's see. The story may not entirely be dead. We'll figure out what the next couple of hours and days bring. Right now, a quick break. Come back on the other side. We'll get you a check on all the dealing room buzz. Nimesh will join in. And then some final trading calls with Nitesh.
Welcome back. You're tuned into Closing Bell, and we are coming to you live from the CNBC-TV18 Motilal Oswal newsroom. Well, the markets down 120 points, but a lot of action from the broader markets. Let's hop across to Nimesh, who's joining in on D Street Chatter to tell us what is he picking up. Nimesh, not a bad outcome at all.
Absolutely. Quite a bit of resilience for the Indian market, so to speak. And within that, I guess, is the broader markets, which are relatively outperforming. A lot of individual stocks are buzzing as well. But from a flow perspective, Nigel, again, it's a mixed day with a bit of a negative bias. So clearly, there is not big push from the largest institutions as far as large cap Nifty names are concerned. Within sectors, the PSU banks and the oil marketing companies is where there's a bit of buying interest back from large institutions. So that stands out for me in today's market. Tech is down largely on back of Accenture numbers, and the general feedback was it was not a big positive read-through for the Indian IT companies. So that's dragging the indices to some extent. But broadly, it's the mid-cap index which is buzzing in trade, and flow seems to be a bit negative within the large institutions.
Nimesh, thanks very much for that. What about stocks? What are you picking up?
So in terms of individual names, Prashant, the first stock is Kerala Ayurveda. We don't normally talk about this stock. Small cap company, 600 crore market cap, but the stock is locked at 20% upper circuit after a very large block. Nearly 20% equity got changed hands. I understand the promoter entity were sellers, and a couple of influential HN investors were buyers in today's block deal. Apart from that, there is a sense of some corporate development as well, which is to follow after this block. So potential fundraising and some deals as well is what I understand in Kerala. So that's the reason why that stock is locked at 20% upper circuit today. The second stock is Marathon NextGen Realty. Again, within the real estate names, this is one stock which is relatively outperformed today, up 7%. A couple of reasons for that. One, there was a selling pressure from a leading FII. That seems to be largely over. And also, I understand company is likely to raise funds via QIP very soon. So that's the trigger there. The third stock is Bandhan Bank. Within the small private banks, this is relatively outperformed of late, largely on back of FI buying. And I understand within that, a leading long-only FI has been an active buyer in Bandhan Bank in the last few days. And the last couple of stocks where this delivery-based buying, GMR Airports, as well as JSW Energy, both stands out after recent underperformance summit of buying has resumed in both these names. So watch out for delivery-based buying in these two names today.
Nimesh, on this Kerala Ayurveda, 600 crore market cap. I think Purinju is one of the shareholders I could see, owns about 5%. The last time, maybe the numbers have to be updated. But big move, I mean,
big move.
Ended 22 at 100 rupees, at 400 plus now.
Absolutely. And the fact that today there was a large block, 20% got changed hands. Some large HNI investors have bought as well. So looks like there is more on the cards. Not only today's block deal, but I understand there could be a pref issue where the companies will raise further money, and there could be some more developments as well. So looks like there is something more than today's block deal in this particular stock.
Okay, all right. Thanks very much. We'll keep an eye, and as always, thanks very much for joining us on D Street Chatter with the chatter stocks and the chatter itself. Mitesh is with us with what to do in terms of near-term trades. Sort of trades for tomorrow, I guess. Mitesh, what do you have? What should one do?
But on Polycom, something, just got, I think the stock is strong. Take a BTS to zero to the stop at 62.60 for damage. And the other one is Tata Consumer, which can be also position call, but we'll go for a BTST first. Take a BTST with the stop at 11.02 for damage 11.
Not very clear, Mitesh. We'll come back to to you to get those levels out of the way, Polycab and Tata Consumer, I think. So we'll go back to Nimesh, Mitesh, and get those levels. But let's focus on Polycab. That's in focus. There's a positive note coming in from Jefferies. Upasana joins us to tell us their rationale behind that. Upasana?
Well, Jefferies has given a buy rating on the stock with a target price of 7,150 per share. It says that despite 25% uptick from March 2025 that we've seen, the stock still trades at a 4% higher than a historical 5-year average. Now, talking about the market share in FY25, the company gained 1% market share in organized cables and wire segment, which currently stands at around 26 to 27%, versus 80% market share that the company had seen in FY20. Now, it says that the company's timely capex, that is 2,800 crore in last 4 years, has aided 26% sales CAGR in cables and wires segment. Now, coming to their FMEG segment, which is nearly 10% of their sales, it turned profitable post 10 quarters for the first time. Now, company in its FY25 annual report has highlighted Project Spring and FY30 targets as well, which are aspiring is what the brokerage has indicated. Now, for FY25 to FY28 EPS CAGR, the brokerage is estimating around 26%, which will be driven by strong order book and even better FMEG margins. So overall, it's a positive note from Jefferies on Polycab.
Okay. All right. Got that. Thanks very much for that. And Polycab is one of the stocks that Mitesh had also like. Mitesh, just clarifying once again, the levels that you mentioned on Polycab?
So Polycab, I think, is closing with a good strength near the day's high. See, again, I'm giving a BTST here because that's the format needed, but I think it's a good positional call. So for a BTST thing, take a stop just below levels of 60 to 80, look for a target of around 63.35, 63.40. It's also crosses 200 average. So for positional traders, take a stop just slightly deeper stop below 61.90 and look for a target in excess of around 67.50.
Okay. All right. Got it. Mitesh, thank you very much for that. You have a good rest of the day and we'll connect again tomorrow morning. Right now, let's go across to an exclusive story. Sources are telling CNBC-TV18 that BSE and Interglobe Aviation may enter the Nifty. Yash has more details on this. Yash, what are you picking up?
Well, that's correct, Surbhi. So, of course, two important stocks which will be in focus till the time the next Nifty review happens would be BSE and Interglobe Aviation or Indigo. What sources tell us is that both these stocks are likely candidates when it comes to getting included in the Nifty 50 index when the review happens next. As per our sources, the review is expected to happen in the month of August, which then will be effective the month of September. As far as the exclusions in place of the two inclusions, that is BSE and Indigo, are concerned, these two stocks could replace stocks like IndusInd Bank as well as Hero MotoCorp when it comes to the stocks that would be excluding Nifty 50. Now, the parameters on which these stocks are decided would be that the average free float market cap of these companies will have to be double of the current 49th and 50th stock in Nifty 50. That is IndusInd Bank and Hero MotoCorp. That is for the previous 6 months. And as we get closer to the date of the reject, the cutoff date would be announced from which the previous 6 months would be calculated as far as that average public float is for these two stocks is concerned. We've written to NSE on this particular query. A reply from them is still awaited.
Okay. All right, Yash, thanks very much for that. So let's watch out for future Nifty changes and whether these two make the cut. Let's move on now and address, of course, the big global international story, which is, of course, escalating tensions in West Asia. Israel and Iran have continued to strike each other through the course of the last few hours after the U.S. attacks on Iran's facilities. Now, Iran's air defense systems intercepted hostile targets over the capital of Tehran. Missiles were also seen in skies above Jerusalem, with sirens warning people to enter shelters. Over the weekend, of course, the United States bombed key nuclear facilities in Iran, and President Trump has said that the attacks were a spectacular military success, and he warned of more attacks if Tehran did not surrender. NBC's Richard Engel with the latest.
Just hours after those U.S. airstrikes on its nuclear facilities, Iran fired dozens of ballistic missiles at residential areas of Tel Aviv, hitting this apartment building, causing significant damage, although few injuries. People here warned to go to bomb shelters.
So we've just moved into our own safe room in the place where we're staying. You can still hear the air raid sirens, and there have been some very loud impacts close by.
Israel kept up its attacks inside Iran, taking out more missile launchers. Israel's prime minister, who has been pushing the U.S. to join an attack on Iran's nuclear sites for decades, today congratulating President Trump.
History will record that President Trump acted to deny the world's most dangerous regime the world's most dangerous weapons.
Many in Israel appeared to agree.
I want to thank President Trump because this could be the end of the war.
In Iran, there was anger in the streets. Iran's foreign minister today saying his country was in the midst of negotiations as the American bombs dropped.
There is no red line that they have not crossed. And the last one, and the most dangerous one, was happened only last night.
But will Iran attack the U.S. directly? Its missiles and fighter jets don't have the range to reach the United States. But American troops and bases in the Middle East could be targeted. Iran's parliament voted to close the Strait of Hormuz, a potential economic attack. 20% of the world's oil flows through the strait, but no action. Parliament saying the move would have to be approved by Iran's supreme leader. The New York Times reports, citing 3 Iranian officials, Ayatollah Ali Khamenei is now in a bunker and has picked replacements in case he's killed. Across the Middle East, the response from Arab countries was largely silent. Many calls for talks, no government offering to fight for Iran.
The only people in the world that are unhappy about what happened in Iran last night is the regime in Iran.
Okay, well, that's basically the update coming through. Let's focus on commodities now. Of course, as part of our new programming on CNBC-TV18 Prime, I spoke with Max Layton. He's the global head of commodities at Citi earlier today. He's got a very, very non-consensus view on gold, which is, of course, one of the safe havens. He thinks gold will not go up. The top is already in and prices could tumble 20% from current levels late this year and 2026 as well. So that is gold. The other bit is aluminum, where he thinks the story has just begun. Listen in.
The gold bull market, it's really accelerated this year. Start of this year, gold was trading around $2,700. End of last year, around $2,600. And we've rallied all the way to almost $3,400 at the moment. It's that part of the rally. It's this most recent part of the rally that we think in the base case by the second half of next year. So we're, in the near term, we're neutral on gold. In the near term, we see it consolidating at these phenomenally high prices by historical standards. But in 12, 18 months time, it's really a combination of a number of factors. But the first is President Trump is incentivized to drive an improvement in US growth, both growth and sentiment, into the midterm elections towards the end of 2026. We think the Fed has been at quite restrictive levels of policy, and we think just the move to neutral will improve both US and global growth sentiment. And there is the prospect that geopolitically things are less heated than they are today, both in the Middle East, but also with respect to the trade situation. So as you look into the midterms, much of the stuff that President Trump has done, particularly around trade, has raised global growth concerns, has led to people to barbell their equity portfolios with being long gold. And at the margin, into the midterms, we do think there is a President Trump put on his popularity and on US growth specifically that will at least will come into play as we look into the midterms. And we think, the market starts at President Trump and the market starts to think about that towards the end of this year, early next year. And that's the reason why we have gold coming off a little bit towards the end of this year and into 2026. The aluminium outlook is structurally bullish. This is a commodity that is very power intensive. A lot of people talk about aluminium as being, power in the form of metal. So it's super power intensive. And I'm sure you've heard, and there's been a lot of talk about the likely boom in power demand coming from AI and data centers. So power demand is being, particularly green power, is going to be in short supply relative to demand from things like data centers and the build out of electric vehicle supply chains and increasing use of electricity globally. Aluminium's at the heart of all this, has essentially no supply growth on paper over the next 2 to 5 years. China drove supply growth for the last 20 years, and that's come to an end. The smelters, even if they wanted to, probably couldn't get access to green power because they're competing against things like the data centers. And guess what? Aluminium is used in the data centers. It's an important part of things like humanoid robots, robot dogs in the robotics sector. And one day we think we are going to have an improvement in global growth sentiment. It's been pretty soft for 3 years now, but one day over the next 12 to 24 months, we do think there'll be a turn in global growth and turn in global manufacturing sentiment. Aluminium will be super leveraged to that. So yeah, we do see some very substantial upside in Ali.
Well, that is, slightly bearish on gold, but very, very bullish on aluminum. Remember to tune into the all-new CNBC TV18 Prime offering. And we're, of course, bringing you insights from policymakers, business leaders, economists, and, of course, we're talking about a wide range of subjects. So the shows that you can watch at 12 noon, you've got the Global Reset. At 1 o'clock, you've got the Big C. And at 8:30 in the evening, there is the Global Lens. So a completely new slew of programming lineup here on CNBC TV18 Prime. We'll take a quick commercial break here. See you on the other side with Sudeep Bandopadhyay of IndiTrade Capital.
Welcome back. Well, the markets, actually, the broader markets, there are a lot of stocks that are moving around. Case in point being, just pull up Supreme Petro. That one, in fact, has seen a sharp up move in the last few minutes. I think the intraday chart on that particular name should come up for you on the screen. Sharp uptick is what you're seeing out there. Sudeep Bandyopadhyay joins us on the show. Hi, Sudeep. Good afternoon. Good to see you, Ben. Any view on this name, Supreme Petro?
Well, we have been positive on this. I think, the last quarterly results also was pretty decent. There were a little bit of disappointment here and there, but by and large, we liked the results. I think, even valuation-wise, while it is not cheap, one can look at, getting into Supreme Petro even now from a long-term perspective.
Mm-hmm. Interesting. And I think, they had some inventory loss, I think so as well. And maybe in this quarter, we could see some part of that. But I think post that, the numbers should look up. Big move, massive volumes as well. Let's talk about a couple of these, delivery-based companies. Swiggy, Eternal. Do you like either of them?
Well, I do like Eternal. I think, one has to realize that the fact that you may not get a bumper quarterly number in the near future. And very clearly, they have articulated that. Eternal has articulated that they're going to spend on growing the quick commerce dark stores. And that does require quite a lot of investment. So immediate major upside may not be there. But from a long-term perspective, I think these are good businesses to be in. And if I have to pick one, I'll pick the leader because, some of these businesses, winner takes the all is what happens. So I will go with Zomato, or rather Eternal at this stage.
Go with Zomato, that is Eternal at this point in time. Sudeep, any thoughts on these, the KEIs of the world? You got, sharp move. Polycab is up very sharply.
Well, Prashant, I think, they had seen bad days when the bigger companies in the country announced their entry into cables and wire segment. They were beaten down mercilessly. And very clearly, the value-wise, they were looking attractive. I'm not saying they were cheap at any point in time, but they were definitely attractive because price had corrected significantly. Also, one has to remember that the competition here is not like paint industry that you decide to get into the business and you will be able to be in the business and start competing in the market within a period of 1.5 years. Here, it does take time, a lot of approvals, a lot of processes. While the competition will definitely come, but the way we look at it is that it will take time. B, market share will be lost by the unorganized sector more and more, not by really the entire organized sector. There was always a silver lining when the prices corrected, and to an extent, that is getting played out. Some of the research reports which came in highlighting some of these points were really helpful in pushing up the prices today.
Okay, all right. Sudeep, stay on. We'll just quickly get through the market close. Last 1.5 odd minutes of trade left. And it's a day that will go down with a cut of about 150 odd points. Market has recovered from the day's low. It's not been as bad as one would have imagined. And that's the situation with most global markets, actually. Not too many very deep cuts across Europe or Asia. So let's talk about the Nifty. Then what led to this 150-point drop? On the weak side, IT for sure, Infosys, HCL Tech, these names, TCS as well, Wipro, all of them down between 1 to 2.5%. Other big boys that were weak today included L&T, ITC, Lever. These stocks were down. The Bank Nifty today fell less than the Nifty. Nifty is closing down 0.6%. Bank Nifty is down about 0.4%. Some of the weak names include the likes of an SBI and an HDFC Bank. Even ICICI Bank is weak, no denying that. Some of the other names, Maruti, Reliance, all stocks losing over 0.5%. However, on the flip side, defense was definitely a theme. So the large space, BEL, in the stocks beyond the Nifty, you had names like Garden Reach, Shipbuilders, etc., Zentech, IdeaForge, all these defense names were up and about. Eternal, Trent, Tata Consumer. So the consumer stocks are definitely finding to get some traction or beginning to get some traction in the day's trading action. That's what we've got. But Nigel, mid-cap's much better. I mean, on a day like today, you've got some green on the mid-cap index.
Well, that's right. A lot of stocks actually moving around yet. Borosil Scientific, that stock was up close to 20%. Big move out there. Z Enterprises was up more than 10% in trade. You had another name, AGI Infra, that was higher in trade. Idea Forge did pretty well. SRM Contractors, another stock we don't talk about very often, was up close to around 9%. Northern Arc as well, up close to around 8%. So plenty of movers actually from broader markets. And, that part of your portfolio will be feeling good, though the headline index ended with a cut of around 100 points. Well, we'll wrap up on this edition of Closing Bell. Don't go anywhere. Markets Forward comes up next. Market fails to hold on to intraday recovery amidst worries of widening of the Israel-Iran conflict and possible supply disruptions following strikes by the US on 3 nuclear sites in Iran. Broader markets outperformed, though, for the second straight session, while defense stocks fire up in trade. Auto and IT, though, feel the heat.
IT stocks feel the heat after Accenture's third quarter numbers. Despite positive guidance, it fails to impress investors, mainly on the back of headwinds anticipated in federal contracts.
Diagnostics stocks slip as Amazon marks its foray into the sector with the launch of an at-home diagnostic service. This is in partnership with Orange Health Labs. Hello and welcome to Markets Forward, your go-to show where we aim to get you up to speed with regard to today's trading action and also set you up for tomorrow. I'm Nigel and with me is Ekta. Hey Ekta.
Hi Nigel. Yes, it was an overall dull start, you'd say, for the markets. It could have been better, but In the context of what was happening, maybe there was, some kind of positivity. So we had the mid-cap index, which did better. We had the Nifty, which recovered from the day's low. So net-net, given all which is taking place or what is taking place in terms of the global scenario, we seem to be okay.
Well, that's right. Ekta, I would say it's not such a bad outcome by the end of it, because we started off lower, but intraday you did see a lot of buying. And though the headline index was down 150 points, just want to make two factors to point out two things that stood out today. And that's why your portfolio will not be feeling too bad. Pull up the advanced decline ratio. If you just pull up the crisscross lines, at the start of trade, you had only around 400 stocks that were advancing. By the time we wound up, we had around 1,200 stocks that were advancing, on the BSE itself. So you had quite a few gainers in today's trading session. And the mid-cap index, from 10:30 a.m. itself, you had that index that had moved into the green, and it stayed in the green. So that's why portfolios feeling pretty okay, Ekta.
Well, yes, absolutely. And we had the IT stocks, which were weak in today's trading session, as well as the diagnostic stocks. So that was one segment which actually weighed down. But we had a lot of stocks such as Masgon Docs, as well as a couple of the other defense plays, which saw a lot of volume traction in today's trading session. And that seems to be the big theme which continues to play out, defense since the past couple of weeks, and that continues to be in focus. But nonetheless, let's now get to our first segment of the day. Hormuz joins in from the wall with the top movers and shakers of the day. Hormuz, over to you.
It was a day that was marred by some choppy moves, but the recovery in the broader markets is something that took precedence in today's session. And we'll start off with some of the names that had positive news flow and reactions to that. And look at Z Entertainment, 11% higher on that stock after some positive commentary and optimistic commentary shared by the management. Zen Technologies, of course, for the acquisition. Idea Forge for the order that it won. Northern Arc, of course, Madhusudan Kela buying stake in the company there. And Avantel also winning some orders worth close to 25 crore rupees over the weekend. And some negative news flow impact on certain names as well. LT Foods, of course, rice stocks were in the red in today's session, although it did recover from the lows, 6% lower there. Ola Electric, it will be interesting to see who are the sellers in today's block, 6% lower in today's session as well. Dr. Lal and the diagnostic names not doing so well. Credo Brands, the shareholder lock-in ending today. And Infosys, of course, the IT pack, the entire IT pack that did not do well after Accenture's results. Some brokerage commentary impact, and despite the rise in oil prices, Chennai Petro and MRPL continue to remain some top picks for some brokerages, and 7.5 to 12% gain seen in these names. Polycab, of course, on the back of the Jefferies note. Jana Small Finance Bank, and also all of these small finance names after the RBI guidelines doing well today. And KFin Tech, of course, a 1460 target set by Jefferies. In a wobbly market like this, there were stocks that ended at a 52-week high. Apollo Micro is one of them, along with the other defense names doing well. Kolte Patil was another one. Garden Reach, as Ekta just mentioned. Poonawalla FinCorp and Narayana Health also making new highs in today's session. And lastly, stocks that did well on the volumes front. You take a look at Alkyl Amines, CCL Products, and Polycab's moves also translated into gains for KEI Industries. BEML and Gujarat Pipavav also had a good day at the office on very strong volumes. Back to you guys.
All right, thanks a lot for that, Hormuz. Well, those are all the top stock movers today. Let's go across to our guest, though. We have Sudeep Bandyopadhyay, Group Chairman at Indie Trade Capital, and Jay Tucker from ICICI Securities. Hi, gentlemen. Thanks a lot for joining in. Jay, you go first. The markets get bad news, and you have to buy the dip. That's the way it's been playing out, right? Today, we could have very well been down 200, 300 points as well, but we ended with a cut, and also you had the broader markets that outperform. On the headline index, where are we headed? Nifty and Nifty Bank.
Good afternoon to you, Nigel. Absolutely correct, Nigel. I mean, the dips are getting bought into. I mean, we saw DIs buying for almost 22 to 23 trading session consecutively. They had some, 3,500 crore kind of a sell-off, or maybe, sell positions on Friday, but then we had FIs, in fact, buying by 8,000 plus crore. So overall liquidity is quite good enough. I mean, there were 4 consecutive days of FI buying as well. Almost, I agree that, it was due to the FTSE rebalancing, but then overall the figures have been positive. And on the downside, 24,800 on an immediate basis, Nigel is acting as a support, and positionally 24,500. On the upside, I think that 25,100, 150 is acting as a resistance. So this entire month has gone quite sideways. And I think, Nigel, until we don't get a clear breakout from this range, Nifty monthly expiry might just settle within this range, because despite so much of negativity, we haven't seen that jump in DXY or crude oil prices, or maybe those kind of cut in the global equity markets. And despite Accenture's guidance and the kind of cut which we saw in Nifty IT stocks, the market somehow managed to bounce back from the lower levels. So I believe that the range bound sessions will continue. Nigel 24,500, 25,150. That will be the range on Nifty. And as far as Bank Nifty is concerned, I think that 56,500, 57,000 on the upside, whereas 54,500 to 55,000 on the downside. These are the levels to watch out for. But I think Bank Nifty is too likely to trade sideways. Broader markets, I agree with you. I mean, they might just provide a breakout on the upside. If mid-cap select Nifty moves beyond the levels of 13,100, Nigel, it would confirm the breakout again, and thereafter it can head to 13,500 as well. So that's mid-cap select Nifty. Otherwise, frontline indices are likely to trade sideways.
Okay, all right. Well, that's on the Nifty. But IT stocks weren't focused today. They really did feel the heat after Accenture reported its third quarter numbers. This is despite positive guidance. Vinny is here to tell us what was the cause of the decline. Vinny, over to you.
Hi, Ekta. So yes, in terms of overall Accenture's numbers, like revenue guidance for the company or the revenue growth for the company in the quarter gone by, Q3 for them, was not a bad quarter. Revenue, they managed to see a growth of 7% above what the street was expecting. FY25 guidance that they've given was also in the range of now 6 to 7% for this year. Previously, it was 5 to 7%. So the lower end of the guidance, they've increased that. Now, where the problem comes in is in terms of deal wins. That's seen a decline of 7%. Bookings for the second straight quarter, that they're seeing a bit of a decline on that front as well. They've said that large deals are not getting converted too fast. So that's some bit of a pressure coming in here. Overall, FY25 guidance remains stable is what they've said so far. But mainly bookings and deal wins not coming in as the company was anticipating or the street was anticipating was a big concern. Now, for Indian IT companies, the highlight that came in was that, federal contracts which are facing a headwind for the company, Accenture is not an issue for Indian IT companies because there's limited exposure there. GenAI, they are seeing a pickup in terms of momentum, which turns out to be positive for Indian IT companies. Margins also 10 basis point increase in terms of margins, but analysts in India expect that Indian IT companies would face pressure in terms of margins going forward in Q1 FY26 or the year of FY26 as well. So that is some bit of a concern coming in, maybe in terms of the current environment commentary, and deal wins and bookings were the major concerns, and that is why that IT today seems to be under pressure. But all in all, it was a decent number that came from Accenture.
Got it. Okay. All right. Thanks a lot for that, Vinny. Sudeep, what are you making of this dip on on tech stocks? If it was a good reading, I think there was some commentary. If it was a good outcome, then we would say that Indian companies are, will see a positive rub-off. But when it's not such a good reading, then we say that maybe Indian companies, the product profile itself, the services are different. How would you approach the tech names?
Nigel, I completely agree with the comment that our company's profile and products are a little different. Look, I think BFSI is a major segment, and BFSI commentary, BFSI performance was absolutely fine. And I take a lot of reassurance from that fact that there is no damage on the BFSI front. That's pretty reassuring. Government contracts was never a stronghold of Indian IT companies as far as US government contracts are concerned. And so I'm not too perturbed with that. Of course, there is a challenge on deal wins and big deal wins in particular, and that's a reality of US market today. So we'll have to wait and watch, but I don't read too much negative into these Accenture numbers. Market, of course, reacted in a negative manner because of the deal wins and other smaller factors. But overall, Accenture guidance also was okay. And I draw the comfort from the fact that BFSI is not damaged at all, and the commentary on BFSI was good.
Okay, Jay, what would your approach be towards these IT stocks on the technicals?
Well, I think that overall IT is likely to trade with a sideways to negative bias in the short run. The reason is that we have seen a good performance or a bounce coming in Nifty IT, rather I would say since past couple of months. If you see, since 2 months or so, despite RBI's bonanza, the Nifty IT has outperformed the Nifty Bank, and now the ratio seems to have reached to those levels wherein I think that in a couple of weeks now, the Bank Nifty should outperform the Nifty IT, looking at that ratio and indicating that, going forward on the upside, 39,000 to 39,500 on Nifty IT would be a hurdle wherein it can correct until the levels of say 36,500, 36,750. So overall, I think that in a week's time or so, mostly post this monthly expiry, the probability of Nifty Bank outperforming Nifty IT again would be higher.
Got it. Okay, all right. Got that. Let's focus on Z. That one surged in trade after the company had shared its growth plans for the coming year. They also aim to break even in Z5 business. Vamakshi joins us to tell us more with regard to this particular update. Vama?
Well, Nigel, the stock was an outlier in the trading session today. They did upload a presentation and they highlighted what they're focusing on in FY26. One of them being that they expect to achieve break-even in the Z5 business as compared to EBITDA losses of 550 odd crores in FY25. In addition to that, they're also executing their business plan and they want to achieve their targets which they laid out in Q4. So with that, just to recap for our viewers, it includes a TV viewership share of 17.5%, ad revenue growth between 8 to 10%, EBITDA margin of 18 to 20%, and unlocking value in music as well as the syndication part of the business. Now, what they've also highlighted is that market consolidation is leading to increased competitive intensity. Resultantly, they're going ahead and increasing their cash balances. And the purpose behind this significant increase is that they want to compete effectively with the competitor, which is the Reliance Disney JV, and they also want to act proactively to address any rapid market share shift. Now, apart from that, they've also outlined their growth levers. They're developing new business verticals. They're building new distribution business models as well. They're enhancing their content offerings to cater to a wide variety of all age groups. And they also are looking at inorganic expansion through either acquisitions or strategic partnerships in high growth verticals like digital, music, etc. So they've laid out an ambitious growth plan, but whether or not they achieve that, that will be important to watch out for.
Okay, all right, Vamakshi, thanks very much for that. Sudeep, any view on Z Entertainment?
Well, I think we've been positive, and particularly what is good news is that Z5 is turning around. That used to be a huge drain, cash drain, and if they're going to become EBITDA positive and their loss of 500 plus crores get transformed into a positive number, I think that will be excellent development for Z. Overall, I think the valuation wise there is a significant comfort considering that it was beaten down. Also, the fact that management, rather than focusing on or chasing some M&A, they are focused now on business and business growth and profitability. That's good news from an investor's point of view. So yes, I'm overall positive on Z Entertainment.
Got it. Okay, all right. Well, let's focus about the sector then that's been on the offense. The defense stocks, they were buzzing in trade yet again. A lot of order wins is what we saw from a few of these companies. Ria joins us to tell us why these stocks were buzzing. Ria?
Well, yes, Nigel, a lot of defense stocks were buzzing in trade today. Let's take a look at 4 companies that were in focus on the back of individual news flow. The first one was Idea Forge, hitting an upper circuit of 10% today after the company received an order worth rupees 137 crores for the supply of mini UAVs as well as accessories to the Ministry of Defense. This order is to be delivered within the next 12 months. And remember, the company's order book at the end of FY25 was just rupees 13.6 crores, which is why this is a very substantial order for the company. Moving on to Zen Technologies, 5% upper circuit for this one as well. The company has announced the strategic acquisition of a majority stake in TISA Aerospace Private Limited, which specializes in developing indigenous loitering munitions and UAVs as well. And this marks the company's entry into the UAV space as far as the defense segment is concerned. For BEL as well, this one was in focus, up over 3% today after securing orders worth rupees 585 crores since the 5th of June. Remember, the company had said that they're expecting an order inflow of around rupees 27,000 crores ex of QRSAM in FY26. And so far in FY26, the company has secured orders worth about rupees 6,820 odd crores. The last stock that was in focus today was Solar Industries, closed mildly in the green today after receiving an order worth rupees 158 crores for the supply of defense products to the Ministry of Defense. This order is also to be executed in the next 1 year, but this is not a very significant order for the company since the overall order book of the company at the end of FY25 was about rupees 15,000 crores.
Okay, all right. So the defense stocks continue to be in focus. Jay, the defense stocks have just been going from strength to strength, but what would probably be a real standout in terms of the technicals for you?
See, I think that overall defense definitely is into the good momentum and it's likely to continue as well. But from a derivatives technicals point of view, I would say that HAL and BEL, these are the two stocks wherein we are seeing good long build-up. There had been a continuous long unwinding which had happened earlier in both of these stocks, and the price when they had corrected last year, which started from mid of 24 until March of this year, and almost 6 to 9 months of correction to consolidation is what we saw on Nifty Defense and these names was mainly on account of long unwinding. We did not see much of stocks getting built up here. And now after the positions having got quite light, the stocks have again started to move up, providing a breakout on the long-term charts, and the overall trend has been positive. So I still believe that HAL and BEL, these are the two names wherein there is much more upside left. BDL and Mazgao, out there the breakout has to happen, but then we don't have much of the F&O data out there, although we are seeing long build-up out there. So BDL and Mazgao can do better, but then out of these four names, I think HAL and BEL, these are the two stocks which are providing more data and providing more comfort on the long side. As a disclaimer, we already have a buy recommendation on HAL.
Got it. Okay, all right. Jay, before we let you go, any view on Reliance Industries? That one has been holding one end up. Last 6 months has actually been an outperformer. Your take?
I think that, Nigel, this is likely to be one of the outperformers going forward as well. The kind of consolidation in Reliance, which we have seen, that is within 1380, 1400 on the downside, to say 1450, 55 on the upside. I think the possibility of a breakout on the upside is quite high out here. Despite the market volatility, we haven't seen corrections coming out in Reliance. Rather, we have seen correction coming in BFSI. But Reliance has somehow managed to hold on to this range. And this range is likely to provide a breakout on the upside, post which I think Nigel Reliance is likely to head towards the levels of 1550. So we are positive in Reliance. I think till 1400 to 1380 levels are held. The upward breakout is quite likely.
Okay, all right. Well, you're liking Reliance. But, before we just wrap up the conversation, just wanted to get a sense in terms of a couple of these stocks such as Hero, Moto, as well as Interglobe and Indicin, if you would have a view on them, as well as BSE. If you could give your sense in terms of a couple of these stocks, Jay.
Sure. Hero is moving out of Nifty, so and out there we don't have a positive view. In fact, rather if we want to look at Nifty Auto, particularly in two-wheeler names, then TVS Motors is one stock which we are liking, and I think out there the breakout has happened. We already seen long build-up out there, so a positive in Nifty Auto. But particularly in two-wheelers, we are looking at Eicher Motors or maybe TVS Motors. And lastly, it would be Bajaj. These were the three names in that order. M&M, particularly, from the four-wheeler names overall, is looking quite positive. We are bullish out there on M&M as well. As far as Nifty Capital Market Index is concerned, that is also doing quite well. I think BSE has already seen quite a good run-up. We might see some profit booking coming out there. It might continue. It may or may not hit again a lifetime high in the near term. But then MCX out, has provided a fresh breakout again. It's been trending higher, and I think going forward in July series as well, MCX is likely to do good. It might head towards the levels of 8500 to 8600 on the downside. Now we believe 8100 is a very near-term support. So as of now, MCX is relatively looking positive or better than BSE from the Capital Market Index.
Cool. All right. Thanks a lot, gentlemen, for joining in and giving us your view on the Nifty Bank, as well as all the stocks that we did discuss. Well, time to slip into a short break. We'll get you key market voices on the US tariff and the wars around the geopolitical uncertainty. Let's listen in.
A significant amount of tariff de-escalation, and I think the markets have absolutely responded to that. When you look at the price action from the beginning of April to basically now, we were sort of getting to a point where expectations of tariffs was in the mid-20s. Right now, that's landing somewhere. The landing zone is, call it, between 10 and 15%, significantly higher than where we were in 2024. But given what we had sort of thought it might be, it's still, there's been some de-escalation. Earnings have been strong, growth weaker than 2024, but we're not looking at a recession in the US anytime soon. And at the same time, we have a Fed that's sort of signaling that they're still willing to entertain about 2 cuts this year.
According to market, all this is not going to have any material or lasting impact, and both are important, neither material nor lasting impact on the cash flows of the corporates. And that market seems to be quite certain about. And hence the market, with a few points here or there, a few percentage points here or there, has recovered with each of these hits that we've seen. It seems like we should have a relative phase of calm now on the geopolitical front, especially when it pertains to Middle East. Once US gets involved, and I'm not saying who's right, who's wrong, because I'm not that learned on the subject matter to make those conclusions, but just purely from the market's perspective, I think the worst of this geopolitical event, the most recent geopolitical event, is behind.
Welcome back. You're still tuned into Markets Forward. Now let's go across to some key corporate voices. First up is Biocon. It has decided to complete the QIP on the back of strong demand from domestic and foreign investors. Post this fundraise of around 4,500 crore, the promoter will now hold 54% as against 61% in the past. Large part of the proceeds will be used to give exits to PE investors. The management adds that this QIP will only address the structured instruments, adds it expects cash flows to improve, aiding debt repayment. That's now all the management expects, around 9 to 10% reduction in interest costs from March 2027 on an annualized basis.
Next up is Jana Small Finance Bank. The decision of the Reserve Bank of India to lower priority sector lending requirement for small finance banks from a total of 75% to 60% is a big boost for small finance banks like Jana Small Finance Bank. Commenting on this, the management says that this is a welcome move and will allow the bank to diversify into different categories of credit.
Okay, and before we wrap, let's bring you some key market events to watch out for. Vamakshi is here with the key events.
Well, Ekta, we'll be keeping an eye out on some economic cues. The US will be reporting consumer confidence data, so we'll be watching out for that. As far as corporate action is concerned, we'll also be keeping an eye out on stocks that go ex-dividend, which includes Polycab India, Alkyl Amines, as well as Vedanta. Keep an eye out on all of these counters. Apart from that, keep an eye out on Aztec Life Sciences as well, because the board meeting is scheduled tomorrow to consider fundraising. 3 new IPOs open tomorrow, so we'll also be keenly watching out for that. Kalpataru Limited is one name. Apart from that, Ellen-Bari industrial gases as well as Globe civil projects will be something that we'll be keeping an eye out for. And lastly, let's keep an eye out on some other important events. Fed Chairman Powell will be testifying before the House, before the House Financial Services for the semi-annual monetary policy report. And lastly, that there is a 2-day NATO summit beginning tomorrow in Hague, Netherlands. So that's something that we'll be also keeping an eye out for.
Okay, all right. Thanks a lot for that, Vamakshi. Well, on that note, though, we'll wrap up on this edition of Markets Forward. We'll be back with more news and updates on the other side.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. Iran reiterates its promise to retaliate against the US for striking 3 of its nuclear facilities over the weekend. Calls President Trump a gambler, says the US may have started the war, but Iran will end it. US President Trump warns of a regime change in Iran, even as the Secretary of State insists that the US is at war with Iran's nuclear program and not with the nation itself. Oil prices rise after Iran's parliament unanimously approves closing of the Strait of Hormuz and disrupting around 20% of the world's oil supply. The final decision on closing the strait lies with the country's National Security Council. The US urges China to intervene. Escalating tensions between Iran and Israel and closed airspaces in the region disrupt civilian flight operations. Airlines reroute flights via the Caspian Sea or via Egypt and Saudi Arabia despite the resulting higher costs. Air France, KLM, Singapore Airlines and British Airways cancelled flights to and from Dubai, Riyadh and Doha over the weekend. More cancellations are possible. Indian benchmark indices are dragged lower by global concerns over the escalating tensions in the Middle East, but there's no strong sell-off yet. The Sensex and the Nifty down over 0.5% each, but the mid-cap index closes in the green. Global markets also deal with mild aftershocks. US stocks tread water, but German and French stocks see mild losses. Asian markets, a mixed reaction. Food credit doubles in the first 2 months of FY26 on the back of robust wheat procurement. Early Kharif sowing signals that the momentum is likely to continue, but non-food credit hits a 3-year low. The government is unlikely to extend the waiver on transmission charges for interstate renewable energy projects beyond the 30th of June. Sources say industry may face higher tariffs in a phased manner as developers factor in added transmission costs. At least 7 people are reportedly killed and over 22 injured in Kyiv after Russia launched over 352 drones and 16 missiles at various parts of Ukrainian territory. This latest barrage is one of the biggest since the conflict began in Feb 2022. Well, let's go straight to the top story this evening. The United States striking nuclear sites on Iranian territory has exacerbated tensions in the Middle East, even as Israel claims that it wants to wrap up the war soon. Now, the conflict between Israel and Iran intensified, with Tel Aviv continuing to strike the regime's military facility. Israel struck Iran's underground uranium enrichment facility at Fordo, which was struck by the U.S. over the weekend. New bombardments were also reported in Tehran and other cities, with 6 airports being hit in the attacks. Iran launched 7 missiles targeting Israel over a 40-minute period, calling President Trump a gambler. The Iranian military has said that the U.S. may have started the war, but Iran will end it. Iran's parliament has approved the closure of the Strait of Hormuz. The decision to close the waterway now rests with the country's National Security Council. Iran's foreign minister also met Russian President Putin in Moscow. Meanwhile, people in multiple American cities and across the world took to the streets to demonstrate against President Trump's decision to launch strikes on Iran. Protests also broke out in Iran's capital of Tehran as well, with citizens demanding a response to the U.S. actions. President Trump has hinted of a regime change in Iran. The president's comments come after Vice President J.D. Vance and Secretary of State Marco Rubio insisted that the U.S. did not want a regime change and was only at war with Iran's nuclear program and not with Iran itself. Take a look.
No, we're not at war with Iran. We're at war with Iran's nuclear program, and I think the president took decisive action to destroy that program last night. We have to give an incredible amount of gratitude to the troops who did an amazing thing last night. Think about this, John. They flew thousands of miles away, a 30-hour nonstop flight. They never touched down on the ground, and they dropped a 30,000-pound bomb on a target about the size of a washing machine. No military in the world has the training, the skills, and the equipment to do what these guys did last night. I know the president and I are both very proud of them.
Well, that's J.D. Vance, and tensions with West Asia has only worsened with the U.S. striking Iranian territory since the 1970 Iran Revolution. Now, while China has criticized the U.S. for violating Iran's sovereignty, Arab nations, though empathetic towards Tehran, are yet to condemn Washington. Parikshit is standing by now to take us through the global reactions coming in. Parikshit, whether it's Macron in France or it is Putin, take us through what the world is saying.
Well, indeed, a very worrying situation, Serene, and the world has been calling for de-escalation, but they've been largely divided on the U.S. attacks on Iran in support of Israel. The 57-member Organization of Islamic Cooperation has called on Israel to stop these attacks against Iran. The Organization of Islamic Cooperation will be setting up ministerial contact group for de-escalation. Saudi Arabia, Qatar and other Gulf nations have expressed dismay over the American attack. However, the Gulf nations have stopped short of condemning the U.S. China has criticized both U.S. and Israel, calling for de-escalation of the conflict with Iran. The Chinese ambassador told the UN Security Council earlier that the U.S. has violated Iranian sovereignty and exacerbated tensions in the Middle East. China has called for stability for shipping routes in the Middle East. Iran's Foreign Minister Abbas Araghchi is in Moscow for serious consultations with Russian President Vladimir Putin. In fact, Dmitry Medvedev, ex-Russian president, launched an attack on President Trump and questioned the effectiveness of the U.S. operation. He claimed that critical nuclear infrastructure in Iran was unaffected. He also went on to say that the number of nations ready to supply Iran with nuclear warheads is only going to increase. Putin has said that Russia will take into account that 2 million people from Soviet Union, the erstwhile Soviet Union, and Russia live in Israel, and clearly Russia's response has been muted, and experts say they are unlikely to extend any real help to Iran. Prime Minister Modi has spoken to the Iranian president, calling for de-escalation. European Union leaders have called for de-escalation, negotiation as well, but they are backing the US line that Iran must never, never acquire a nuclear bomb.
Many thanks, Parikshit, for joining us. That is the latest there as far as global reactions are concerned. And as Parikshit was pointing out, crude prices have hit a 6-month high on fears that Iran might close the Strait of Hormuz and disrupt the supply of oil globally. Now, this after Iran's parliament approved the closure of the Strait of Hormuz, which accounts for nearly 20% of global oil and LNG shipments. Several brokerage firms now believe that the crude oil prices could touch $130 per barrel. Meanwhile, Union Oil Minister Hardeep Singh Puri has said that the government had anticipated the possibility of such disruptions and had diversified its supply, adding that India has enough stock to last up to 3 weeks. Take a look.
We had diversified the sources of supply, and out of the 5.5 million barrels of crude oil that India consumes daily, about 1.5 and 2 million only come through the Straits of Hormuz. We import roughly 4 million barrels through other routes, and our companies, the oil marketing companies, have enough stocks. Most of them have stocks up to 3 weeks. One of them has, in fact, 25 days stocks. And we are also confident that we can increase the supply of crude through other routes should the situation so warrant.
That's the oil minister there. Now, the conflict in West Asia impacting Indian exports to Iran. Nearly 1 lakh metric tons of basmati rice exports are said to be stuck at the Kandla and Mundra ports. Speaking to CNBC-TV18, the All India Rice Exporters Association President Satish Goyal said that the export can't be sent to Iran as no insurance company provides cover to vessels entering a conflict zone. Exporters also worried of further impacts if Iran decides to close the Strait of Hormuz. And staying with the conflict, Iran has threatened to pull out from the non-proliferation of nuclear weapons treaty after the US strikes on its nuclear sites. But what is the significance of the treaty and what is India's stance? Santya is here to decode what it means. Santya.
Shireen, the ongoing US-Israel-Iran conflict has brought the NPT back into focus. The NPT is aimed at preventing the spread of nuclear weapons and promoting cooperation in the peaceful use of nuclear energy. Signed in 1968 and coming into force in 1970, the NPT has 191 state parties divided into nuclear weapon states and non-nuclear weapon states. The state parties that manufactured or exploded a nuclear weapon before 1st of January 1967 are classified as nuclear weapon states. The rest of the parties are non-nuclear weapon states. Under the NPT, the non-nuclear weapon states commit not to manufacture or acquire nuclear weapons, and the nuclear weapon states commit not to encourage or assist non-nuclear weapon states in acquiring nuclear weapons. Nuclear powers like India, Pakistan, Israel and North Korea are not NPT parties. India calls the treaty discriminatory, unequal and flawed, and North Korea withdrew from the treaty in 2003. So if Iran withdraws from the treaty, it will no longer be legally bound to allow the International Atomic Energy Agency to inspect its nuclear sites, nor will it be legally bound to refrain from building nuclear weapons. Iran says it signed the NPT and adhered to the IAEA safeguard agreement, unlike Israel, which not only didn't sign the NPT and never allowed IAEA inspections, but also does not even acknowledge its nuclear program. Iran has accused the Western world of conspiring against it by falsely accusing it of violating the NPT in order to destabilize the Middle East and further its oil agenda in the region. The Western world, however, claims that despite signing the NPT, Iran is flouting its norms. In 2005, Shireen, the IAEA passed a resolution accusing Iran of non-compliance with its comprehensive safeguards agreement under the treaty. Back then, despite its long-standing business, traditional and historic relationship with Iran, India voted against Iran. In 2006, again, when the resolution was referred to the UNSC, India again voted against Iran. Experts say that at the time, India was keen on portraying itself as a responsible nuclear power, and that's why it voted against Iran. However, since 2024, when resolutions were passed against Iran at the IAEA, on 3 occasions, India abstained from voting each time. The ongoing conflict will have long-lasting effects on India and Indo-Iran relations. India has considered Iran a strategic and trading partner. The Chahabar port is India's response to China's Gwadar port in Pakistan. Hence, the conflict and its outcome are extremely crucial for India as well. Shireen.
Santya, many thanks for joining us. Let's take our viewers through the market action of the day. Indian equities gave up early gains, ending in the red amidst global concerns over the Middle East tensions. The Sensex slipping over 0.5%, closing about 500 points lower. The Nifty lost about 140 points, down about 0.5% or so. But the mid-cap index closed about 200 points higher. So the broader markets did outperform for the second day. Prashant joins us now to take us through the market action. Prashant, finally closing in the red, but not too bad.
Well, the market reaction was very, very muted to the early Sunday morning US strikes on Iran's nuclear sites. Brent oil prices jumped 6% at open, but very quickly settled down to being about 2% higher. By the middle of the day today, they'd actually slipped into the negative on a day-on-day basis compared to the last close. And that tells you quite a story. And similar was the case with US equity futures or markets which were trading in Asia, etc. Nifty banged down slightly, nothing major, less than 0.5% basically. But mid and small caps actually recovered, and they both ended in the green. The other story and part of the reason, of course, why the market was down was geopolitics, but there was also a specific reason, which is IT stocks on the back of the Accenture results, which had been released on Friday. So actually, if you look at the top losers, it was Infy, HCL Tech, Wipro, TCS. These were down between 1 and 2.5%. There were also a few other losers, L&T, Hero MotoCorp and Mahindra, which lost in trade. On the upside, Trent was the biggest gainer on the Nifty. BEL was up about 3%, and there was a Hindalco and Bajaj Finance, which were up over 1% each. So just 4 names with gains in excess of 1% is what you had. More down than up, numerically, advanced decline skewed towards what was down, but volumes all on the upside. And actually, that's the reason why I'm going to look at what was up first. Z Entertainment, 12%, biggest volume-led gainer. The standalone refiners, Chennai Petro and MRPL did very, very well. Wire and cable companies, Polycab and KEI standing out. The defense companies, Garden Reach, Paras Defense, Zentech, Idea Forge, Eventel, and many others actually, looking up. And there was a spattering of other companies from a variety of sectors which did quite well. As I said, there was more stuff which was down, but no volumes. But I'll just name out a few. Ola Electric, biggest volume-led loser, 6%, new low here, $43 by close. Siemens was down 4%. Astral was down about 4%. There was LT Foods, OneSource, Sterlite Tech, Lal Pathlabs, some of the names which actually ending the session lower. The big, of course, talking point which markets are watching, of course, is Iran's response. If it's targeted, the markets will see it as an eventual road to sort of de-escalation. If it's more widespread, I guess, lingering continued uncertainty. Back to you.
Yes, that it certainly does, Prashant. Many thanks. In the currency market, the rupee weakened against the dollar as tensions in the Middle East flared up. This after the dollar index strengthened following US's strike on Iran's nuclear sites over the weekend. The rupee closing 16 paise weaker. Shares of Ola Electric slumping in trade today. This after 2.41 crore shares of 0.55% equity changed hands in block deals. The deal was worth 107 crore rupees. The buyers and sellers of the transaction are not yet known. Earlier this month, Hyundai Motor and Kia Corporation exited Ola Electric Mobility through block deals, so the stock under pressure today. Aditya Birla Lifestyle Brands is listed on the stock exchanges after its demerger from Aditya Birla Fashion and Retail. The demerged business listed on the NSE at 167 rupees a share, slightly lower than its discovered price of 171 rupees a share. Aditya Birla Lifestyle Brands comprise Reebok, Louis Philippe, Van Heusen, Alan Solly and Peter England, among others. We'll end to a break, but up next, food credit doubles in the first 2 months of FY26 on the back of robust wheat procurement. Early Kharif sowing signals that the momentum is likely to continue. That and more when we return. Food credit disbursed by banks has doubled in the first 2 months of the current fiscal year, hitting 34,000 crore rupees, driven by strong wheat procurement by the Food Corporation of India and other state agencies. Sapna standing by with more. Sapna, what else are you picking up?
Well, the data speaks for itself. So if you look at the financial year on year, well, that's a jump of almost 100%. It's double, 34,000 crores versus 17,000 crores April, May last year. And also calendar on calendar, the jump is even bigger. It's almost close to tenfold growth. So around 33,000 crores versus a mere 3,500 crores worth of offtake in terms of food credit by banks last year. So that's one piece of it. Well, of course, the reasons are wheat procurement. So if you look at the wheat procurement data itself, 30.88 million is somewhere the government has done in terms of the procurement, 16% higher year on year. And interestingly enough, this is also the highest among the last 3 Rabi marketing seasons. So if you look at, say, for example, 2023, the data, it was around 18 to 19 odd million tons of wheat had been procured. And that graph kept going up, and now we are almost close to 31 million odd. So what it has done is that it has really helped in terms of the food stock, overall food stock, and also in terms of the buffer requirement. And plus, very important, what kind of allocation goes to the PDS system. That is basically the free food grains program that the government has been running. So, of course, if you look at the central pool, as of now, around 38 million tons of wheat is there. This is double of what is required in terms of the PDS offtake. That's somewhere around 17 odd million tons is required in terms of the free food grain program. And plus, that 38 million odd tons is actually 4 to 5 million tons higher than your buffer requirement. So this is all very good news. Now, there's also another development that's happening parallelly because of the early monsoon. The Kharif sowing has actually already started, and what we are given to understand from the data, of course, and this is the latest number from the Food Ministry, is that the acreage, or rather the area sown, especially for rice, has actually gone up. It's already higher by around 11% odd. And possibly, if this is the way that things will continue, probably another bumper harvest as far as Kharif at least is concerned. There is no reason to think that the growth in food credit is going to flag off, or rather, it's expected to continue. That's what the broad expectation is.
Okay, Sapna, many thanks for joining us. The government is unlikely to extend the waiver on transmission charges for interstate renewable energy projects beyond the 30th of June. Sources say industry may face higher tariffs in a phased manner as developers factor in added transmission costs. Shivani Bajaj is here with more. Shivani, take us through the impact and the implications.
Well, that's right. The ISTS waiver, or the Interstate Transmission System waiver, which has been a crucial policy tool since 2019, is unlikely to be extended beyond the June 30th deadline. That's what the government sources are telling us. Now, Discoms and the industry has been pushing for an extension in this case. These charges are a major cost component for developers, and the waiver helped make solar and wind project bids more competitive in the recent years in India. While the exemption was originally set to end in 2023, it was extended till June 2025 to support India's 500 gigawatt renewable energy target. Now, from July onwards, new clean energy projects may face increased cost as developers will need to pay ISTS charges, potentially pushing up green power tariffs in India. Now, this could affect ongoing project bids, financing assumptions, and even the pace of future renewable installations. Delayed projects also that counted on the waiver are at risk, potentially becoming financially unviable. According to industry sources, the ISTS waiver has saved developers approximately anywhere between 0.5 rupees to 1.6 rupees per unit, which is a big chunk of their companies are slated to return in stages. 25% of applicable ISTS charges for projects commissioned between July 2025 and June 2026, gradually rising to 100% by July of 2028. Back to you.
Shivani, many thanks for joining us. In international news, Israel has said it has recovered the bodies of 3 captives held in the Gaza Strip since Hamas's 2023 attack. This comes as the Israeli military's attack on the besieged enclave killed more than 30 Palestinians. Israel's Prime Minister Netanyahu said that pressure Israel has put on Iran is helping its mission in Gaza. At least 7 people have been killed and dozens have been wounded in a massive Russian drone and missile strike on Ukraine's Kyiv and nearby regions. The attack sparked fires in residential areas and damaged the entrance to a metro station bomb shelter. 4 children were among those injured. Ukrainian President Zelensky said preliminary reports indicate that ballistic weapons from North Korea were also used. Now, Tesla's much-hyped robo-taxi service has been launched in Texas. The first rides, which are priced at $4, are being offered in parts of Austin. A small group of influencers were invited to participate in the closely monitored pilot. The robo-taxis use driverless Tesla Model Y vehicles. However, the electric vehicle maker has not provided details on the scope of the Tesla robo-taxi launch. NATO's member nations have agreed to raise their defense spending target to 5% of GDP. This is in line with US President Donald Trump's demand. However, Spain has said it received NATO approval to opt out of the spending target. Spanish PM Pedro Sanchez has said the nation can meet all NATO commitments by spending only 2.1% of its GDP. Well, with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Do stay tuned. We're back in a minute with plenty more.
Presented by Policy Bazaar.
CNBC-TV18, the Policy Bazaar Insurance Show.
Whether you're a daily commuter, a weekend road tripper, or a first-time car owner, having the right motor insurance isn't just about following the law. It's about ensuring financial security in case of accidents, damages, or any unforeseen events. But with so many policies, add-ons, and claim procedures, how do you know what's best for you? In this episode of the Policy Bazaar Insurance Show, we decode steering through motor insurance, what every vehicle owner must know. So buckle up as we are joined by a battery of experts. To start with, Mr. Tapan Singhal, the Managing Director and CEO at Bajaj Allianz General Insurance, Mr. Rakesh Jain, the MD and CEO at Reliance General Insurance, Shanai Ghosh, MD and CEO at Zuno General Insurance, and of course, Mr. Saravir Singh, the Joint Group CEO at PB Fintech. And these experts today will help you navigate through the ins and outs of motor insurance and help you drive with confidence. To start with you, Tapan sir, in terms of motor insurance, people always tend to look at it as just one particular element. But what people need to know, and it is very important to be aware of, is there are different parts to have under a motor insurance policy also. A motor own damage cover, a motor third party cover, a personal accident cover. Can you break down these three important elements for us? What do they mean? What do they come in use for? And what is mandatory by law as far as these three covers are concerned?
I'm very happy with the show first and foremost to, I think, Yashesh, Sarveer, and you putting this together because this awareness is required. Now let me answer the question you asked for. See, the mandatory part by law is the motor third party.
Yes.
There also, if I look at the penetration in India, I think people broadly agree about 40% Indians would be uninsured. Now, if that be the case, what we don't realize is that what we think is, ki kya hoga? Let's say I have a two-wheeler. If a damage happens also, I'm a safe driver, 1,000, 2,000 rupees, I'll pay for it. Why pay insurance premium, no?
Correct.
And the police, I don't know if it catches, doesn't catch. I'm perfectly fine. I go through areas where the police is not catching.
Correct.
But you will be surprised. I have a motor two-wheeler claim of 15 crores, no? A two-wheeler claim of 15 crores. And the two-wheeler value would be what? Not more than 50, 60,000 rupees.
Correct.
That is where third party is. Third party is unlimited liability. No, if an accident happens, somebody dies, on their earning capacity and the number of family members, you have a calculation made by the court and an order comes. If you're not insured, you have to pay that money.
Correct.
The insurance company only takes over your liabilities. That is what third party liability means. No? So fundamentally, if somebody thinks that what can happen, and even if it happens, I can afford 10, 20,000 rupees, but the liability can go up to 15, 20 crores because if an accident happens, somebody dies through your two-wheeler, it can be that bad. Second part is the own damage part. The own damage part, to break it down, is when the vehicle meets an accident, the vehicle that you have, then obviously the reimbursement of the repair of the vehicle is taken care by the own damage part.
Correct.
And third is the personal accident cover of the driver himself. Then the question happens, if you're paying for bodily injury, if you're paying for death, why should the driver take that cover? See, first party, second party and third party. The bodily injury cover by TP liability is third party. Third party means not related with the car.
Correct.
Not related to the insurance company.
Correct.
That's the third party, first and second.
Correct.
So the PA is because you are the first party, That's why you have to have the PA cover for yourself, which has to be there. So broadly, if you have these three things on a very broad parameters, there are a lot of add-ons and also which are very beneficial, which you look at, then you are more or less reasonably protected.
To come to you, Mr. Jain, what has come in the way of people not having an insurance cover which is compulsory in the first case? What are those couple of things which immediately should be done by the industry, by the affiliated sectors to ensure that the third party coverage goes up?
We must appreciate the need for third party, as we all realize now. The number of vehicles growing, the road infrastructure going, and obviously people moving on the roads. This is an ecosystem. It's the law which provides the ecosystem for the third party to be mandatorily taken. And this is not just about India, it's across the world, it is like that. I think this awareness significantly lacks in people. And sometimes the affordability takes the priority over this awareness. And people don't indulge into renewals also. Many times with the new car, it's mandatory for you to take, but then on renewals, people fall off insurance. So that is quite common in this country. Often I have come across people who fall off not because they can't afford, but just that they missed it. And they never thought that their cars are going to have an accident or something like that, which the liability of a third party can come to them. So I think somewhere, we have not created enough awareness about it. I must also say, there exists now a lot of digital means to really achieve this. In the past, obviously, the physical, challenges of implementing this were huge. But now, with Vahan data being there, the insurance repository, IIB being there, all the data, even PUC data, if you see vehicle registration, RTO data, all are digitized.
Correct.
We simply need to put a mechanism of connecting them. And
Absolutely.
wherever we have gap, we need to prompt the customer.
To come to you, Shanai, the whole bundling of long-term motor insurance policies. Now, what that does is that also puts some additional cost when it comes to the policy holder when he goes to buy a 3-year TP, 5-year TP, along with, let's say, a 1-year OD, whichever way he wants to look at it. Has that impacted penetration? Was the earlier process of insisting on a 1-year TP, 1-year OD better because that did not put a lot of cost burden on the policy holder, or do you think this has helped for a long-term commitment straight away coming in at least on the mandatory part of it for 3 years?
I think it has helped. Okay. I think at least now from a TP standpoint, all new vehicles, 2-wheelers or 4-wheelers, have a 5 or a 3-year, insurance. So to that extent, it's helped. But what it's done is it's created some confusion. People don't really understand the nuance of OD and TP. So once they've bought it, they think in their head it's 3-year, 5-year. And only when they are educated that they, they really realize that OD is not 3-year, 5-year. But there is a steep drop-off that happens after 5 years or after 3 years. In 4-wheelers, that drop-off is much lower. So I would say that in 4-wheelers, the average frequency or the rate of claiming is anywhere between, maybe between 10% to even 35% depending on how old your car is. So, large proportion of people actually experience the claim. So, I think in motor your penetration would be around 4-wheeler about 85%. The personal accident people don't appreciate the importance of that. If you look at the road deaths that have happened on the road, I think the statistics were 1.78 lakhs, which were one of the highest in recent years. 70% of that is 2-wheeler, right? Now, if that 2-wheeler owner had a CPA, then they would have at least got that one immediately, right? Absolutely. While they go through the entire process. But so I think it has helped, but a lot of education is still required to tell people that you can't drop off. And another segment that has a huge under-insurance is commercial vehicle. There, this 3-year thing is not there. So their under-insurance continues to remain.
To you, Saravir, now I understand third party, what we've understood well is compulsory by law, own damage is optional. Now what we tend to see is that for 2-wheelers, people do not, of course when the 2-wheeler is bought, there's an own damage policy which comes with it. But once that ends after the first year, people don't tend to renew the own damage policy for 2-wheelers. For 4-wheelers also, once the car attains a specific age, then people start thinking that I will take care of the expenses on my own. Do you think people are entirely aware of the benefits that they miss out on, even for 2-wheelers, if there is no own damage policy? Do you think people are well aware of it?
So I think, Yash, the way I would say it is that when we talk to consumers, it's awareness is a kind of very first level thing, right? The problem is, are you aware of what will happen if you don't have insurance? That is, I think, the real question. So people say, okay, like we've been discussing that I can look after the few thousand rupees cost to repair a 2-wheeler. But I think they don't realize that it's not a few thousand rupees. It can, as Tapan sir explained, third party liability can go into crores.
Correct.
But even otherwise, we've seen that now as the complexity of 2-wheelers is increasing, actually claim sizes are there. And when people want to claim, that's when they are shocked to find that they only have third party cover and they don't have own damage cover. So I think awareness of what will you do if you don't have cover is very, very important. See, insurance, the biggest challenge is that you have to pay first and you may get a benefit if something happens. But I think that the awareness that it is really, really powerful, because just to give you a sense, OD premium in 2-wheelers are really, really low, right? In like sub 100 rupees in many cases. So actually there is no affordability, etc. is a challenge. I just think that, the human mind is not wired to understand that incidents do happen, and when they happen, then the value is very high. So we tend to underestimate them upfront. So all I would say to your viewers is that it's really not worth it. If you ask me, even for 4-wheelers and definitely for 2-wheelers, it's just not worth taking that chance. And, it's just a peace of mind thing. I mean, don't have that extra cup of coffee or that ice cream, right? And instead, renew your insurance.
Policy as well.
So honestly, it's just that straightforward.
Well, I mean, what you say makes absolute sense. It gives you a lot of peace of mind. Whatever has to go wrong is covered. It at least gives you that satisfaction. But on that note, let's take a very short break. When we return, we talk about different trends in the motor insurance industry. What are the different add-ons that you can look at? What are those few things that you do not understand in your motor insurance policy? Also, how technology is making motor insurance a lot more, economical, a lot more customer friendly for all of you policyholders. We discuss all of that on the other side of the short break.
CNBC-TV18, the Policy Bazaar Insurance Show. CNBC-TV18, the Policy Bazaar Insurance Show.
Welcome back to the Policy Bazaar Insurance Show. We've been discussing one side of insurance which comes your way day in and day out, the motor insurance segment. And as promised, in this part of the discussion, we discuss about technology, we discuss about notable trends in the motor insurance segment. To start the segment with you, Mr. Jain, what are the most advisable add-ons that one should get as far as their motor insurance policy is concerned? And, when they opt for voluntary deductibles also, does it somewhere end up affecting the claim payout for any motor insurance policy holder?
So, very good question, I think, Yash. what we need to realize that the older policies were just a basic policy, accidental policies. Over the last few years, most of the insurance companies have started to innovate around the way a customer would like to customize his policy. So zero depreciation predominantly pays the whole amount for the spare parts out of any accident.
Correct.
Now, any accident, generally the car is old, but if you depreciate the car on the spare parts, it leads to an economic loss for a customer. So zero dep actually replaces with a new, I think, a product almost to the customer free of charge with a very nominal increase in premium. Similarly, you know, we see floodings, we see Bangalore, we saw, now monsoons are here. Now we see engine protect covers. You know, engine protect because it's a consequential loss. It's not an accidental loss. It generally occurs because of certain customer behaviors, also the way, you know, the environment is shaping up, and this is the most expensive part of the car. Now, over a period of time, more new covers, interesting ones are coming. People are also coming towards EMI protection. If your car is lying in the garage for more than a number of days, your monthly EMI, 70% of the cars are financed today, your monthly EMI can be paid off. People are talking about assistance covers. This is not just about getting your car towed. It's also about, look, if you get sick, you know, you can be taken to a hospital. If you really are on an overseas trip and all, you can be given a hotel. You know, there are various ways of concierge services which are getting built along with lifestyle and travel. So I think motor insurance is frankly becoming like a pizza. You know, most of the companies are now innovating through various kind of toppings. I would strongly urge a customer to really look at the risk and the real difficulties they face in and around driving their car. Not just look about getting paid in case there is an accident. Coming to your question of voluntary deductibles, I would say it's a good cover. You know, it obviously reduces the premium for a customer by 20-30%. However, I must say that the base policies in the market today are coming with 70-80% discount.
Correct.
You know, so there isn't much left beyond that in terms of a further discount, which is so tangible. And obviously, when a claim comes in, to that extent, the deductibles will be reduced from the claim amount. My sense is the customer should weigh the pros and cons of the premium versus the claim thing and make up his mind.
To come to you, Tapan sir, I mean, it's been about 2 years, 2.5 years that the offtake of electric vehicles have taken up very strongly. Initially, of course, we heard a lot of incidents about fire breaking out as far as electric two-wheelers is concerned. The technology as far as four-wheelers is not entirely tested with respect to the battery in terms of its last decimal. How does how does one look at motor insurance policy for their electric vehicles? Is there any different cover that one should look at? Is the industry, you know, assessing risks differently for electric vehicles? And are the premiums generally higher for a motor insurance policy when it comes to an electric vehicle as compared to an ICE?
For any risk, as an individual and look at it, think of whatever you've read in the newspapers, what is going wrong and what can go wrong, and see that are you covered for that or not. If you look at electric vehicles, there are 2-3 things which you talk about. The battery, the battery theft was happening, that's the most expensive part. Second is the fire which it catches, no, because of overheating, flood areas, no, and those places which happen. Third is you also have charging stations, which was not there in the ICE vehicles. So, no, that also would be a risk which should be there. Fourth would be concierge services, which Rakesh was mentioning about for the ICE thing. You would require at times, if your battery, conks out in the middle of the road, may require somebody to come help you change or swap the battery, which should be there. So these are the covers that you should be looking for when looking for a vehicle. And that is a basic principle of risk, no? I think whenever you're looking at any risk, think about what can go wrong and check that are you covered for that or not. So I don't think it's a question of affordability like, I think Savir also mentioned. The question is that are we aware of the risk? Or are we falling for the trap? Somebody says this is the cheapest and it's just a ticket lelo. That means you don't really want to buy insurance.
Correct.
When you go to buy anything, you go to buy a shoe, I've seen people figure out which is the lightest shoe, which is more comfortable. They do so much research.
Correct.
For something which is so critical for you, which protects you, lakhs of rupees, spend 5 seconds asking this question, what can go wrong? Relevant? Am I covered for that? And I promise you, I think the insurance companies are amazing covers. They would be covering you for it.
To come to you, Shanai, with respect to the new trends in the motor insurance side as well, what we are seeing is the use of telematics, the use of data in understanding the quality of the driver, the amount that the vehicle is driven for, and all those things, data coming in. Insurance industry, of course, looking to leverage this and giving benefits to the policyholder out of the translation of these two elements. Explain to us these two concepts: pay as you drive, pay how much you drive, and why is it important for policyholders to look at these things to get the best benefits for their behavior and make their insurance policy more economical?
Both these fall under the concept of usage-based insurance, you know, and internationally there are two kinds of usage-based insurance. It's based on how much you drive and how well you drive. So there are these two concepts, and both these present very different risks for you as a driver and for the insurer. So let's take how much you drive. How much you drive is very simple, based on the distance, how long you drive. It's very simple, it's the opportunity. If you drive more, the chances of accident are more. If you drive less, the chances of accident are less. So that is why insurance companies in India have come up with covers that are talking about distance-based insurance. So if you expect that you will drive for a very short distance annually or monthly, you will have a lower insurance. And the second one is pay how well you drive. So it's not just about distance, it's about how well you drive. Driving behavior is what is the most accurate predictor of the probability of an accident, and this is a case study. And this gives the power to customers to say that if you drive well, you can reduce your premium. Internationally, how this works is driving behavior based policy, where either they attach a device onto the car, or it's a beacon onto the windscreen, or it's mobile telematics. So based on either of these three technologies, they monitor the driving behavior of the customer and they give discounts to the person for that. So what this is doing is, while it is encouraging you to drive well, it's incentivizing you to drive well, and at the same time you're being kind of nudged to drive safely and make roads safer in the country. So both these, I think, are very good ways for you to control your pricing, gives you more power, transparent pricing, and for us to also make roads safer, at least through good driving based policies.
Saravi, to conclude this wonderful discussion that we've had today with you, if you buy your car from, let's say, a particular dealer, the dealer tends to have partnerships with insurance companies, 3, 4, 5 insurance companies, and the quotes at the time of renewal, let's say at the time of buying it, maybe you don't pay so much attention to which insurer, but at the time of renewal, when you're actually separately paying the premium, you tend to compare the cost. At that time, if you find the cost of A insurer cheaper than B insurer, but the B insurer does not have a tie-up with the dealer, he tends to suggest to you that, sir, if there is any problem while getting the claim, I won't be responsible, and there are problems. This is what was told to me as well. Eventually, because of the fear, you tend to buy your policy from the insurer which has a tie-up. Does it actually become a problem sometimes if there is no partnership and you want to get the claims? And what can the industry do to stop this practice? Because we speak about mis-selling, and this is, on the motor side, the biggest form of mis-selling that one can come across.
Yeah, I think, yes, you asked a very important question from a consumer perspective. Now, I think let's be very clear. From a regulatory perspective, there is absolutely no regulation which suggests that there is any tie-up between the dealer and the insurance company, or I mean, the insurance policy that you buy. So, customers are well advised to look at what is best for them. And here I think there are 2, 3 things. I would not say that just because the dealer is selling it, the policy is bad either. I think you have to say what are the, as has been discussed on this panel, what kind of features are you looking for? Is the policy that you are buying giving you that comfort, is covering the risks that you want to cover? And then make a choice whether you want to buy from the dealer or from a online platform or from a physical agent or whatever, or directly from the companies. See, because the truth of the matter is that claims are paid by the insurance company, right? Neither by the dealer nor by the person who's selling the policy. So I think I would say, the industry does a phenomenal job of paying claims, and I think that is true for new cars as well. So there is no truth to this point. As you can imagine, it is in the interest of the dealer at that point to talk about it that way, but that is not the reality. The reality is that there are people who buy brand new policies from insurers and from platforms directly, and they have a very good experience. The second thing I would say is that in the end, it is, really ends up happening is that you are so interested in the car buying process, right? You are looking at the shiny new piece of metal that you are really not that focused on the insurance, and that you tend to get to know about this later. So many times people figure this out later, and then of course there's remorse and you feel that I overspent. So I think the best thing to do is to just separate the two things. Insurance is separate, buying a car is separate, and largely there is absolutely no problem. So I would again urge your viewers to exercise their choice, buy what they feel is right, and buy the best policy for them. Whoever is selling it, I would say that there's no problem in buying from the dealer, there's no problem in buying from someone else.
Thank you so much, ladies and gentlemen, for the discussion today. With that, it's a wrap on today's discussion, but we promise to come back soon with another new episode, another set of guests with the same insightful discussion. Till then, stay safe, stay insured.
CNBC-TV18, the Policy Bazaar Insurance Show.
Hello and welcome to News Center. I'm Parikshit Luthra. The Israel-Iran conflict has escalated as United States joins forces against Iran. United States President Donald Trump warns of a regime change days after striking Iran's nuclear sites. This even as his deputy maintains that America is at war with Iran's nuclear program and not with the nation. Israel says it wants to wrap up the war as soon as it can and continues targeting its long-standing enemy. Iran says it has hit a United States military base in Syria days after warning that any American asset in the region was a potential target. China and Russia condemned Washington for the strikes. Arab nations expressed dismay but stopped short of condemning the Trump administration. The US's direct involvement in the war has heightened tensions in the region. India, which shares good ties with both Israel and Iran, has urged de-escalation. To take this forward, I'm now joined by Raymond Vickery, Senior Associate and Chair on the India and Emerging Asia Economics at the Center for Strategic and International Studies. He's also the former U.S. Assistant Secretary of Commerce for Trade Development. Also on the show with us is Strategic Affairs expert Anju Gupta. She's also the former Director General of UP Police and someone who understands terrorism very well as far as the Indo-Pacific region is concerned and also in West Asia. Let me now go across to Raymond Vickery first. Raymond Vickery, the implications for the United States. It's been almost 48 hours since the United States carried out those strikes. Iran is bound to retaliate sooner or later. What are some of the short-term, medium-term implications that you see for the U.S.?
Well, thanks very much for having me. I think that this requires very careful thought on behalf of the U.S. administration. The question is how best to build peace and prosperity in the world. It's not a question of national glorification or the glorification really of one man. President Trump has seen both domestically and internationally that his duty is really to transaction, to greater glorification of himself rather than institutional approaches which build peace and prosperity in the long run. I think that what we have to do is distinguish between short run consequences and longer run consequences. In the short run, we in the United States have experienced military success in Afghanistan, in Iraq. You could even include Libya and going back even further to Vietnam. But in the longer run, it hasn't worked out. Now, what will happen in the short run, of course, is important because retaliation often breeds retaliation and leads to a downward cycle. One hopes that will not be the case. But even if the United States should have continued military superiority and success along with Israel, in the longer run, what happens? Iran is talking about leaving the Non-Proliferation Treaty, which means that any hope of inspections by IAEA will go out the window. And even if there is regime change, the question is, what kind of regime? It is possible to get an even more radical Iranian regime. So it seems to me that what needs to be done is to try to return to a path of seeking peace and prosperity through institutional means.
Raymond Vickery, do you believe that the US's objectives here by entering and supporting Israel in the war are clear? And are those objectives and aims backed by strong evidence and facts?
No, I don't believe that our relationship to Israel is properly defined. It seems to me that what we've seen with President Trump is sort of an evolving approach without any overall strategic consideration of what the United States interests are. As you may recall, his Secretary of State, and he really is saying when this first happened, that this was a fight between Israel and Iran. Now, in his later statements, he's saying, well, we coordinated with them all the time. And I think you're quite right to point out what is the strategic relationship. It's not just with Iran, it is what happens across the Middle East. Gaza has not been a success. And so we need to get that straight. Domestically, I'm very concerned that Trump, having come in with at least an abhorrence of violence, is now getting a taste for violence as the way in which to further national interest without any consideration or without proper consideration of overall strategic concerns which you indicate.
Right. My final question, Raymond Vickery, would be about China. Perhaps the only country which has vehemently opposed and condemned what has happened is China. What role do you expect them to play, considering they are the biggest beneficiaries of oil flowing through the Strait of Hormuz? They have close linkages with Iran as well.
Well, I think that it's quite proper to raise China, particularly in the context of what happens with other great democracies like India. This is not happening in a vacuum. You could say, well, it's in China's interest to keep the Straits of Hormuz open. And that's certainly true. But under what circumstances? Do they get drawn into this to keep the straits open? And if they do, isn't that a continuation of this sort of string of pearls approach surrounding India? So the question of what happens with China and indeed with Russia are fundamental here. And then you get other consequences in terms of what China thinks about bombing as a way to get what it wants.
Yeah.
The problem is here to avoid World War III. The problem is to rein in the nuclear Armageddon, which has continued to face the world. And this is not the way in which to do that.
All right. Thank you so much, Raymond Vickery, for joining us on the program. Let me also get in Anju Gupta at this point. Anju Gupta, the United States, by hitting Natanz, Isfahan and Fordo, what has it really achieved, considering the Iranians are saying that all these sites had been evacuated and there is no significant damage?
Good evening, Parikshit. Thanks for having me on the show. Well, if we look at their objectives, there may be three objectives for these strikes. One is to prevent the development of nuclear weapons by Iran. And for that, hitting the nuclear site would have meant destroying the centrifuges which enrich uranium and enrich uranium. And has it been achieved? The Iranians are saying no, that they had already removed a lot of it. They kind of had a hunch that this was going to happen. Americans are saying they have been successful. The only way to verify it could be either through international inspections, which are very difficult now, because Iran will have to be brought on board, or by invading Iran and taking control of Iran. So that's the only way these claims can be, the claim by US can be verified about destroying centrifuges and enriched uranium. Second, objective was to get Iran to halt its attacks on Israel. Well, within few hours of this, US targeting of the nuclear sites in Iran, Iran mounted very vicious aerial attacks on Israel, on Haifa, on Tel Aviv. Then the third objective was for Iran to agree to zero enrichment, that Iran will not keep any capability to enrich uranium at all. That was the sticking point, in fact, before the sixth round, which was going to happen 3 days before, 3 days after the Israel mounted attacks on Iran. Now, Iranian president has said it very clearly that this is not acceptable to Iran, even after these strikes. So on the face of it, it is very doubtful if the three immediate objectives that one can think of, which the US had in mind mounting these, targeting the nuclear sites, it's doubtful if they've been met.
Okay, just to ask you about the worry around radiation. So far, there are no reports saying that there has been leak of any radioactive material, but considering that further US strikes cannot be ruled out, Israel has again struck the Fordo site. What's the larger worry for India in case there is any kind of leakage of radioactive material, and is that even possible?
Why it is possible is because, yes, targeting of centrifuges and enriched uranium is not going to cause that kind of radio clouds. But in this business, there would be research reactors, there would be what they call spent fuel, high-level waste. These are radioactive material. Now, if they get targeted, and nobody knows where they're stored, now, if they get targeted by accident, inadvertently, then there will be a problem. And they have a nuclear reactor at, another nuclear reactor which has not been targeted because Russia has warned against touching it. Russians are working there. So if radioactive material gets targeted, there will be radioactive clouds. And these clouds move very fast and they can spread anywhere given, the condition of winds and the direction and other factors. And they can reach as far as India. Why not? Let's recall what happened in Chernobyl in 1986, when there was an accident at Chernobyl, which was part of the USSR, former USSR. The radioactive clouds could be, they spread throughout the northern hemisphere. And this activity was also detected in the US, in Canada, and in Japan. So that could be the spread of radioactive clouds. So India is right there. We are not very far from Iran. And secondly, let's not forget, we have very large population in the Gulf region. They are also our interest.
Right. And we have about 10,000 people in Iran. Even though around 1,400 or 1,500 of them have been evacuated so far. Let me ask you about this whole issue around regime change. Israel spoke about it. Donald Trump seems to be supporting it as well. But who will the United States and Israel actually bring up? What about Khamenei's own successor in Iranian politics?
It is really ironic that when President Trump started this whole US-Iran talks, he actually wrote to Khamenei, the supreme leader, because everybody knows in Iran it's the supreme leader who has the final say. So he wrote to Khamenei asking for this direct dialogue, and 5 rounds had, taken place very peacefully. Somehow in the middle of all this, US administration is certainly talking about regime change, targeting of supreme leader. It looked like war rhetoric, but let's assume that it was not war rhetoric. They are serious about it. Now, supreme leader has named 4 successors, 4 or 5 successors. This is what I've read in the newspapers of Iran. Now, by naming successor, he's made sure that the regime stays intact. The regime is not going to change. The face will change. Secondly, with the Iran coming attack from Israel, US mounting attacks on their nuclear facilities, it is highly likely, in fact, it is common sense that their people will now rally around their supreme leader. So it is unthinkable how that regime change can happen. And let's not forget, Iran is a country with great depth. They have great depth of intellectuals, religious leaders, military commanders, administrators, just like India. So in such a country, removing a couple of people is not going to lead to the collapse of the system. That's my assessment.
All right. My final question, ma'am. We just have about a minute left, but if you could sum up the challenges for India now. Clearly, we get about 40% of our oil supply through the Strait of Hormuz. So yes, oil inflation is one impact, but strategically, how are we likely to be challenged in case of a prolonged war in the region?
One, contamination, exposure to our people, and we have people in the Gulf. It could come right up to us in case there's a nuclear issue. Second, the expats community in the Gulf region may start coming back if the war spreads, which it will in case it is not stopped now. Third, the disturbance of the Strait of Hormuz, even if they don't close it for India, is going to disrupt the sea lanes of communication, which is a big thing for trade, apart from energy and oil and gas, etc. Then our vessels, our people may be caught in crossfire. Let's not forget. So Iran is our region. Iran is part of West Asia, but Iran is as much our region because of the kind of connections that we have and the kind of proximity that we have. So I think it's a source of worry for India, and we should actively plan about it.
It is indeed a source of worry for India. Thank you so much, Ms. Anju Gupta, for joining us with that perspective. Very important answers there on the possibility of regime change and why it may not yield any major results for the United States or Israel. Time for a short break, but coming up on the other side, space promotion body InSpace has facilitated the transfer of small satellite launch vehicle technology from ISRO to Hindustan Aeronautics Limited. The move is expected to make HCL the only company in the country to be authorized to make SSLV rockets. A special conversation with InSpace Chairman Pawan Goenka on that and more. Welcome back. You're watching News Center. In a major development in India, space promotion and supervisory body InSpace has facilitated the transfer of SSLV technology. SSLV is Small Satellite Launch Vehicle technology, and it has been transferred from ISRO to Hindustan Aeronautics Limited, a Government of India PSU. HCL was selected from among 3 bidders. The entire technology transfer will be completed in 2 years, while initially HCL would be looking at manufacturing 2 small satellite launch vehicles. It would eventually become the only company in the country which will be authorized to make SSLV rockets. I caught up with InSpace Chairman Pawan Goenka about this development. I began by asking him about the cost that HCL will incur for this tech transfer.
The winning bid from HCL was 511 crores. That's how much they'll be paying over a period of 2 years for the technology transfer. And after that, they will complete ownership they will have of the design, non-exclusive. The patents will not get transferred. Patents remain with ISRO. But they'll be able to make, they'll be able to change the design. They'll be able to change sources from which they buy components. And any development they do beyond that will be their patent.
Right.
But 511 crores is how much they are paying to acquire rights for this technology.
Right. We've also seen from the statement by InSpace that there will be 2 SSLV launches that are being aimed at in the next 2 years by HCL. Could you tell us more about that?
No, so it's a little more complex than that. There are 2 rockets that will be built by HCL during the period of 2 years with hand-holding from ISRO. That's the part of technology transfer. Okay? But there will be many more launches of SSLV during this year. These SSLVs will not be built necessarily by HCL because they are already in process. And NSIL has already given contract to build these rockets. In fact, the first launch is likely to happen in October of this year, which will carry loads of many private sector companies, small loads, into the SSLV launch. The second launch is likely to happen in about February, March of next year. And after that, the next launch is likely to happen about July, August of year after. That is about a year from now. So before the 2 years are over, you would expect to see as many as 15, 16 launches of SSLV, rockets not built by HCL, rockets built by other sources. After that, HCL will take complete ownership.
Right. Now, what does this mean, sir? We also read reports which said that the entire marketing and manufacturing of SSLVs will now be done by HCL. What does this mean going forward in terms of commercialization, commercial users, sale, further manufacturing, private sector collaborations? What will be the role of HCL here?
Yeah. So see, this is not a manufacturing contract. This is transferring technology for HCL to own. Right? So HCL will therefore take full responsibility of these rockets as a business. That means they manufacture, they source components, they manufacture, they launch, and they do market development. And they own the P&L. They monetize the technology that they're getting transferred from ISRO. So it will be like a Skyroot or a Agnikul.
Right.
So the only difference is Skyroot, Agnikul develop technology on their own, and they have purchased technology from ISRO.
All right. So in a way, HCL can be a vendor to anyone who is wanting to buy or maybe acquire an SSLV for a rocket launch.
That is correct. In fact, only company that can build SSLV after 2 years will be HCL. Nobody else can build SSLV.
All right. And would there be any possibility of having another round of bids to maybe have another company, another PSU or private sector?
Not in the near future. Not in the near future.
All right. What are some of the commercial users that we are looking at, sir? You've said that while we are going to see 15, 16 more SSLV launches in the next 2 years, after 2 years, HCL will be the only ones to do so. And HCL will be initially working towards 2 rocket launches. What will be the commercial users of these rockets?
Well, the capacity of the SSLV launch vehicle is about 500 kg of payload. Okay. So launches that will happen with these this rocket could be one satellite of under 500 kg, could be multiple satellite of few hundred kg, could be dozens of satellites of 50 kg, 10 kg, 2 kg, all of these. So therefore, what we expect to see is in most cases, there will be an anchor customer, an anchor load, primary load, which could be, say, 200, 300 kg, and some other smaller load, what we call co-passengers, that will fill the capacity to take the full capacity of 500 kg. The benefit of a small rocket compared to a large rocket, and small rockets typically cost more per kg than a large rocket. The benefit is that the total turnaround time is very small. Maybe as little as 3-4 weeks from the time that you decide that you want to build a rocket till the time the rocket is ready. Okay, and a company can book the full capacity for taking small satellites, which in a situation like if you're going to use a large, say LVM3, and if you have a 100 kg satellite, you're depending on somebody else filling a 3.9 ton of load before your 100 kg comes in. So that's how the load will come. Multiple small satellites, and as you see these days, there are many constellations being launched, LEO constellations, and that could provide a tremendous level of business for small satellite launch vehicles. In fact, if you look at the projections that we see for future, we see a lot more exponential growth of small satellite launches than what we will see of very heavy launches.
That's an important point, sir. Would you be able to quantify the economic opportunity as a result? So you're saying 15 to 16 SSLV launches in 2 years alone before HCL starts its own operations. Going forward, what will be the annual economic opportunity out of this exercise, and what is the kind of market demand?
You see, the number of launches that we have based our project on is about 6 to 8 launches per year. Okay, HCL would have done their own calculation, their own market research to validate whether they will get 6 to 8 launches or get more than that. That only HCL can answer. But our estimation is that 6 to 8 launches will be a fair expectation to get every year post the 2-year period that we're talking about. And the 6 to 8 launches should produce enough revenue for the owner of the technology to be able to make the whole project commercially viable.
What is the approximate cost of one rocket launch, sir?
So let me put it this way, that if you look at the current cost of launching or current price of launching on a small satellite, and there are only 1 or 2 such launch vehicles available commercially globally, is beyond $20,000 per kg. Okay. If you take $15,000 per kg, if you take $15,000 per kg as the launch revenue, then for a 500 kg payload, we're talking about $7.5 million revenue from per rocket. And I cannot talk about what the cost of per rocket will be, but our calculation is 7.5 million revenue, or maybe somewhat lower, 6 to 8 rockets a year, sufficient to make the project profitable.
We've also seen meetings between SpaceX associates and the Indian government. Starlink has been given a license to operate in India, but at the same time, there are certain permissions still needed. And one such permission is needed from InSpace. Could you give us a sense, sir, what is the current status of permissions and approvals for Starlink to operate commercially in India?
Yes. So as you have said, that the 2 licenses are required. One is a GMPCS license, which has already been given to Starlink, and second is authorization from InSpace for commencing the capacity, which is currently in the process of being done. We already have all the internal approvals for that. We already have sent, our process is that we sent a draft authorization letter to the authorized company, which we have sent to them. And they will come back to us if they have any comments on the draft. And once they come back to us, if there are no comments on the draft, it's ready, we will sign it.
Dr. Goenka, thank you so much for joining us. It's always a pleasure. And thank you very much for giving us your view on the transfer of SSLV technology from ISRO to HCL.
रिटर्न ऑन कैपिटल कि अगर आप 100 रुपए धंधे में लगाते हो एंड इफ यू कांट जनरेट 15-16 रुपीज आउट ऑफ बिजनेस, तो उस बिजनेस का मतलब क्या है? फिर तो आप जाके अगर 7-8% ही करना है तो आप एफडी में पैसा रख दो. वन ऑफ द कंपनीज which is now known in the market is a company called Solar Industries. Today, the market cap is 1,50,000 crore. When we identify, it was a 1,000 crore market cap. Narratives will work for a while.
Right.
But finally, top line is vanity, bottom line is sanity, and cash in bank is reality. It's the promoter. He's the friend, he's the enemy.
Make or break.
Make or break. वही बनाता है, वही बिगाड़ता है.
Okay.
There are pockets of bubbles. I am completely acknowledging that. But it should not be painted with the same brush that everything is expensive.
I remember meeting Rhythm Desai at the Morgan Stanley conference, and he actually went on to say that Indian stocks are cheap.
Yeah, I mean, you have to search your pockets.
Yeah,
and I think ये मेहनत करने का time है. For you have to go at the ground level, search for companies, search for good promoters.
Finding the ultimate multi-bagger, that mid-cap or small-cap stock that will compound in such a way that it will light up our portfolios, that it will make all our dreams come true. Let's face it, this is a big wish for most of us investors when it comes to the stock market. But finding that ultimate mid-cap or small-cap stock that will lead you to riches, it's easier said than done. So, in today's edition of Market Cafe, I thought, let's go and meet a man who is one of the most celebrated and the most successful mid-cap and small-cap stock pickers of India. He's got over 2 decades of experience and he has so much to share. So let me go and introduce you to Pankaj Tibrewal of Ikigai Asset Manager. I can't tell you, Pankaj, how happy I am to be speaking to you in this environment. You know, this setting, thoda relaxed lag raha hai.
एकदम.
And the conversation, I think, demands it. We're speaking to one of the most legendary mid-cap stock pickers in India. So here he is, Pankaj, and about more than 2 decades in capital markets, right? And mid-caps and small-caps have been your forte, so to speak. But before we talk about mid-cap stock picking, Pankaj, I actually wanted to spend a minute to understand today's market. In 2025, we have seen such uncertainty on multiple fronts. Do you feel that return expectations need to be scaled down from Indian equities?
So, Surbhi, last 4-5 years post-COVID has been a dream run for equity markets in India. And obviously, in many pockets, we warned in September that there's a bubble brewing up. But let's divide the conversation into 2 parts. One is the domestic and one is the global. I think the big picture first on the global side, that the world is changing. The era of globalization, we were brought all in post the World War II. I think that's leading to deglobalization or fragmentation. And I think that's a big picture change we should not ignore.
Yeah.
Countries are becoming more inward looking. They want everything in the country. Protectionism is becoming a very, very big thing.
Absolutely.
And I think that leading to some kind of a macro change globally. And to me, it's not a trade war, it's a yield war. Look at the Japanese 30-year bond yield. Look at the US 10-year bond yield at 4.5%.
So that's the thing, that in a world of very severe dislocations, I mean, who would have thought that investors will start moving out of the US?
Yes.
Who would have thought that there'll be so much of trade conflict? Who would have thought that there'll be so much of geopolitical conflict? So in this world of major shifts, where are we and where is our market? And what is the kind of market that we are probably going to be in for the next, say, 2-3 years?
So I think in the context of the global environment which I spoke about, which is uncertain, very volatile, I think India is an oasis in the desert. And what we have been saying that growth will pick up. And look at what happened in the 4th quarter. 7.4% GDP growth. Government capex in 1 month was 280,000 crores. What RBI has done is remarkable.
Yeah.
At least in my 2 decades, Shurbi, I have never seen so pro-growth RBI.
Usually they're so conservative.
I mean, hats off to them. The system was deficit, durable liquidity, 3 lakh crores in the month of January. From there till now, they have pumped in more than 10 lakh crores. And the further CRR cut, which will start from September to October, will see another 2.5 lakh crores. Coupled with that, 100 basis points of interest rate reduction. So I think RBI is completely pro-growth. We are the only country in the G20 countries post-COVID which has brought the fisc from 9.5% this year to 4.4%. Only
Fiscal
country in the G20 nations. So I think we have gone a long way on the fisc consolidation. Now we think is the time to start on the escalation mode on the growth. And I think all the three parts I am quite bullish on, which is liquidity. Incremental liquidity is better. Incremental cost of funds will be lower than last year. And third, incremental growth, both on consumption and capex, will be better than last year.
So that's the academic part of it. Now let's translate this into again the market question that should investors continue expecting a dream run from Indian equities? Because post-COVID, it was a complete dream run. Then it started getting volatile and patchy. So now what?
So it'll be over longer periods of time. If you look at Indian markets, 5 years, 10 years, 15 years, 20 years, finally the EPS growth and share price growth is not too different. Right? What happened in the last 5 years? Nifty 500, Nifty almost compounded earnings at 18-19%, and so was the market return. The mid caps and small caps compounded between 22 to 25%. Slight PE re-rating, they saw the same returns, 25 to 30% CAGR returns. I think the earnings growth will not be as charitable as we have seen in the last 5 years. You saw margin expansion, you saw balance sheet deleveraging, and everything helped on the P&L. I think going forward now, our expectation is next 2 years, the earnings growth should be between 10 to 13%.
10 to 13%.
And hence, in the near term, there could be narratives, aberration, everything can happen in the short term. But over the next 2-3 years, I think returns should mimic your earnings growth.
That brings me to the central part of this discussion. The reason why we've got Pankaj on this conversation today on Market Cafe is because I keep hearing increasingly the talk or the narrative that this is going to be now a stock pickers market. Jo chulo, wo chale, wo wala market nahi hai.
Yes.
You have to be very, very sure about which companies and which stocks you're picking. First of all, do you agree with this assessment?
To a large extent, I agree to this assessment. And over the last 3 quarters, we are seeing glimpse of that. How do we say we are seeing glimpse of that? Starting second quarter of last year till first quarter of this fiscal year, the headline returns of the index and the median return of the index are two different things. What do you mean by that? Let's look at last quarter, which is fourth quarter. The NSE 500 index was about 4.5% negative. But the median return of the index was negative 11%. 7% divergence, which means few stocks are holding the index higher, they are performing, and the profit polarization is also happening there. So my sense is that it will be a stock pickers market as you move ahead, because there is a divergence between the earnings growth of NSE 500 companies. And companies which will deliver higher than expected earnings growth will be the darlings of the market. And hence you need to be a complete bottom-up stock picker. It is not that everything will grow.
No, that's true.
There will be few companies which will grow faster than the average. Few companies will grow below the average. And hence we believe that if you can pick up the right winners on the earnings growth side, you will be rewarded.
Which now brings me to the crux of the conversation. What is the secret sauce? Now, viewers, some of you might know this, otherwise I'll just tell you this. When Pankaj was with Kotak Mutual Fund, you joined in 2010, right? 2010. He started off by looking at the small cap fund as well as the mid cap fund at Kotak, and I think the sizes were very, very small.
230, 250 crores.
Both put together. So the funds were around 230 crores, and by the time he exited Kotak Mutual Fund, which was 2014?
2023.
Sorry, 2023. So from 2010 to 2023, roughly a 13-14 year period, I think you exited when the value of these funds, or the AUM of these funds was over 50,000.
56,000.
56,000 crores. So that tells you that managing almost $7 billion worth of assets, Indian assets, at the time that you decided to, branch out in your own entrepreneur style. So that's phenomenal. So then, how to pick these stocks, these multi-baggers, these big winners?
First, let's, I think, get the macro right. I think increasingly there has been a narrative over the last few months, sell mid and small and move to large cap.
Oh, yeah.
Yeah.
Even till now.
Even till now.
I think 7 out of 10 guests that I speak to, they still say that no, large caps offer better comfort, and there's still some overvaluation in SMIDs, as they're called.
So
small
3
and mid
points
caps.
I will like to draw.
Yeah,
And we mentioned in our quarterly newsletter, which I published in April, that on the headline basis, when you look at valuations, we acknowledge what people are saying, that mid and small caps are expensive to their history and versus large cap. So there's a relative margin of safety there. But I think devil lies in the details. So if you go a little deeper, what you find out that earnings growth in mid caps especially has been faster in the last 5 years. Even in FY25, which was a slow year, mid caps earnings grew at more than 18-20%. And going forward also, our expectation is that mid caps and small caps can offer better earnings growth than large caps. That's the one part. The second part important is the composition of the profit pool. So if I look at the top 100 companies, 52% of the profit is coming from PSU banks, private banks, oil and gas, and PSU sector, which are generally low P in nature. And that representation in mid and small cap is to the tune of 15-16%, 17%.
Okay.
So generally, when you look at X of these sectors, Nifty is trading at a premium to mid and small caps.
Oh,
so when you do a apple to apple comparison, and the third part is, when do they trade at a huge discount? Take 2018-19. You came from a huge bull run in 2017, and then you started seeing solvency issues, right? You had Yes Bank, DHFL, all kinds of skeletons were coming out, and there was a scare of solvency.
Correct.
This time in now last 5 years, the debt to equity and the leverage position of small and mid caps are far, far better in many cases compared to large caps also. And the last point which I want to drive, Surbhi, is that mid and small ab utne chotu companies nahi bache. Now the definition is up to 33,000 crore market cap is a small cap. Up from 33 to 1 lakh crore is a mid cap. So and they are sectoral leaders. You take tires, you take hotels, you take airlines, you take so many sectors like infra, capital goods, auto ancillaries. All these companies are classified as mid and small, but they are sectoral leaders in the sector they operate in. So I'm saying that the cycle and the texture of the market has changed. There are pockets of bubbles. I am completely acknowledging that, but it should not be painted with the same brush that everything is expensive and everything just sell and move away. I think in this market where 5,000 listed stocks, take out the top 100 stocks, you will find at least 40-45 stocks at any point of time, which will give you that kind of a value to ride on. So I believe that you have to be a stock picker, as you rightly mentioned, and there are opportunities in the market which will make you money over a 2-3 year period.
This is very interesting, because you're the second person that I've spoken to, I think, in the last 2-3 weeks, who has actually said that Indian stocks are not necessarily over expensive. I remember meeting Rhythm Desai at the Morgan Stanley conference, and he actually went on to say that Indian stocks are cheap. And I was like, wow, that's
I won't
refreshing.
agree to cheap, but yeah, I mean, you have to search your pockets. And I think ये मेहनत करने का time है. For you have to go at the ground level, search for companies, search for good promoters. And coming to your second point on what to do, I think over a period, what I have learned is that process of elimination is far powerful than process of selection.
There are still maybe some pockets where, things are a little overheated in the small and mid-cap space. So can we sort of rule them out? I mean, do you see, I don't know whether it's maybe defense or are there certain thematic areas where you do see excesses? Which ones would those be?
So, for example, one of my yardsticks is, for example, cash flows. So look at few of the EMS companies trading in India, right? Narrative is very strong.
90 times P, 100 times P.
110 times P. But when you open their cash flow statement, not all I am saying, but many of them who are trading between 25, 35, 40,000 crore market caps, the cumulative cash flow over the last 5 years, operating cash flow, is not even more than 50, 100 crores, right?
Okay.
That means it's a thin margin businesses, but they are hugely deploying money in working capital to drive growth. So I think that's something we need to be, I'm giving as an example.
An example, something to be cautious about.
That narratives will work for a while.
Right.
But finally, top line is vanity, bottom line is sanity, and cash in bank is reality.
Is the reality.
So cash flows you can't ignore at the end of the day.
Sure.
Yes, for 1 year, 2 year, there could be aberrations on cash flow either sides, but over a cumulative 4-5 year period, cash flow is something we need to be taking cognizance of.
So EMS is one such pocket. What about the hallowed defense space, where again, no doubting the narrative, no doubting the forward potential given what's going on. But what about the rest of it, whether it's valuations, earnings?
So many cases, valuations are out of sync with the narrative which is going on. And when we do a reverse DCF, which is discounted cash flow, many of these companies are factoring in 20% growth for a next decade perspective. I'm not pinpointing any particular sector, but we need to be cognizant that what is market factoring into. And just to caution you that there is a bubble brewing up in low free float stocks, SME names, many of those which are smaller, very small in size. There is valuation, problem. So I think we need to be careful in this market also. It's not a complete, just no-brainer market. And I think over a period of time, what you need to be cognizant about 3 things which we are part of our forensic Surbi. One, that promoters are the biggest friends and enemy of the business. So selection of the right promoter at the ground level is very, very important. And I think it is becoming more and more important in this entire volatile world, right? Disruptions will be all over the place. The promoters who are clearly have a strong skin in the game, passionate, integrity is right. I think you have to identify those promoters over longer period. That's my learning. That one thing when I reflect back over my last 20 plus years, that which has helped my companies grow in size, it's the promoter. He's the friend, he's the enemy.
Make or break.
Make or break. वही बनाता है, वही बिगाड़ता है. Sure. So you have to be very careful on the promoter side. The second most important point, Surbi, is cash flows. So what we have seen that there is a small bit of forensic we have created, that EBITDA to operating cash flow.
Okay.
EBITDA minus tax to operating cash flow, if anything is less than 70% over a period of time, it's a red flag for us.
Okay.
So 1 year, 2 year ho sakta hai, but over a 4-5 saal period mein, if you are not able to convert your 70% of EBITDA into operating cash flow post working capital, then there's some problem. And the third is that return on capital. कि अगर आप 100 रुपए धंधे में लगाते हो, and if you can't generate 15-16 rupees out of business, तो उस business का मतलब क्या है? फिर तो आप जाके अगर 7-8% ही करना है, तो आप FD में पैसा रख दो. So why you are running?
Well said. All the risk of becoming an entrepreneur, running a business.
Then what's the fun? And over a period of time, what we realized that
so at least 15% return on capital employed.
Over a period in India, where the cost of equity itself is 12, 11, 13 over longer periods of time and cycle. This time it could be low because interest rates are down. So I think when you combine all these things together, I think you will probably avoid mistakes. There will be some opportunities you will miss, but pitch पर लंबे समय तक खेलना है. Is my, and I think longevity is most underrated. सबको कल पैसा बनाना है, लेकिन equity market
सुबह से शाम तक बनाना है.
लेकिन longer term में अगर आप अपने discipline को maintain करते हो सकता है थोड़ा under performance आएगा, कभी out performance आएगा. But if you are staying in the market like this for India for the next 10-15 years, I think you will make money. So it's important that you have a forensic framework. And we have a 11-point forensic framework which we have spelled out very clearly. And हमने क्या किया सुरभि कि over the last many years we went and saw what how companies destroyed capital, how they became penny stocks.
Yeah,
right.
I'm going to come to that in a second. Just to recap for our viewers, so when we're saying mid-cap stock selection, at least Pankaj's basic, formula or rule of thumb, number one, promoter. Look at 80%. Promoter integrity. Number two, look at cash flows, whether the company can generate sufficient cash flows over a period of time. And number three is going to be the return on capital employed.
And balance sheet and cash and the growth.
And the growth prospects, valuations. I'll come to valuations as well in just a bit. So 3 or 4 broad filters through which you need to look at your mid-cap or small-cap stock selection process. We've done a lot of theory. I'll come back to valuation in just a bit because that also we need to understand, whether a stock, just because it's 70 times PE, should you not touch it? I'll come back to this, but let's do some stories as well, some storytelling in between. So give us some names, some examples where you applied these filters and then, went on to at least find a multi-bagger, and some cases where you cut your losses early because you realized that the red flags were being hit.
Yeah.
Some examples, 2 decades.
So let me just put a disclaimer first that this is not a recommendation to buy and sell. This has been my experience and my few examples I'm just sharing so that people get a better context of what we mean. So one of the companies which is now known in the market is a company called Solar Industries, right? A very less known
up and only up.
So a less known promoters in say for example Nagpur. 2006 they came for IPO. If my memory serves me right,
2006.
2006.
Wow,
if my memory serves me correct, Surabhi, they raised about 80 plus crores, and after that they just did a small dilution in 2013-14 of 100 crores, and every 3 years their top line used to convert into bottom line, right? And very strong promoters, but over a period they kept on reinvesting the cash flows back in the business for growth. Okay. And whenever you used to meet them, you used to get a sense of passion, integrity and skin in the game. They still hold the promoter family 75% or 74.5%. And today the market cap is 1,50,000 crore.
And now
when we identify it was a 1,000 crore market cap.
1,000 crores to
1,50,000 crores. And last 10 years they have been investing in defense, for example, without a single revenue coming in. So over a period of time, what you understand is that one, the promoter quality has to be extremely good. Because businesses kabhi linear line mein nahi chalte hain. There will be periods when couple of years business doesn't do anything. And we have seen that in many companies. There is a slowdown. There is some external environment problem, challenges, internal challenges. And there when you have a conviction on the business and the promoters, then you ride that slowdown along with them.
So tell me, and solar, just for context, I mean, now we all know solar is so big in explosives, in defense warheads. In fact, in Operation Sindoor, I think many of those warheads were used on the various missile systems that were at play. And the stock has gone on to achieve wonders as well. So on that point of staying the course, even through the rough patches, when a company is not showing growth, when it's going through a painful period where operating cash flows are not rising, or maybe there's a delay, or some of the usual fundamental parameters are not getting met, or margins are getting squeezed, how do you decide to stay on versus checking out, saying that red flag nahi, or
so one thing which you don't compromise is any governance issue and any red flags on balance sheet and cash flow. I think वो जहाँ मैं देखता हूँ मैं भाग जाता हूँ, whichever the narrative or the business story will be. I think if those are intact, even in a slowdown, I think what you have to check is that is the promoter more in pain than you? See, you are 25% shareholder in the company. Promoter is 50, 60, 70% shareholder. He's pained more by the slowdown than you are. And I have seen that leaders of the sectors, they work harder during that slowdown and emerge stronger after the cycle from a bottom. So I think you have to get that sense during the interaction, during the conference call of the quarters, that what are they doing to come out of that slowdown and the disruption which they are facing today. And if you get the right answers, you stay on the course. irrespective of what is happening in the market. And I think there are many companies which have seen such cycles and they came out much stronger after the cycle.
So, Pankaj, this is really interesting and it's actually very, very helpful. But we have a lot of other questions. So, viewers, we're going to take a break on this episode for now. This is part 1 of what's turning out to be a mid-cap investing masterclass. So, this is part 1. Catch us again very soon. We'll get you part 2 of this conversation with Pankaj Tibrewal.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. Iran reiterates its promise to retaliate against the US for striking 3 of its nuclear facilities over the weekend. Calls President Trump a gambler, says the US may have started the war, but Iran will end it. US President Trump warns of a regime change in Iran, even as the Secretary of State insists that the US is at war with Iran's nuclear program and not with the nation itself. Oil prices rise after Iran's parliament unanimously approves closing of the Strait of Hormuz and disrupting around 20% of the world's oil supply. The final decision on closing the strait lies with the country's National Security Council. The US urges China to intervene. Escalating tensions between Iran and Israel and closed airspaces in the region disrupt civilian flight operations. Airlines reroute flights via the Caspian Sea or via Egypt and Saudi Arabia despite the resulting higher costs. Air France, KLM, Singapore Airlines and British Airways cancelled flights to and from Dubai, Riyadh and Doha over the weekend. Warn more cancellations are possible. Indian benchmark indices are dragged lower by global concerns over the escalating tensions in the Middle East, but there's no strong sell-off yet. The Sensex and the Nifty down over 0.5% each, but the mid-cap index closes in the green. Global markets also deal with mild aftershocks. US stocks tread water, but German and French stocks see mild losses. Asian markets, a mixed reaction. Food credit doubles in the first 2 months of FY26 on the back of robust wheat procurement. Early Kharif sowing signals that the momentum is likely to continue, but non-food credit hits a 3-year low. The government is unlikely to extend the waiver on transmission charges for interstate renewable energy projects beyond the 30th of June. Sources say industry may face higher tariffs in a phased manner as developers factor in added transmission costs. At least 7 people are reportedly killed and over 22 injured in Kyiv after Russia launched over 352 drones and 16 missiles at various parts of Ukrainian territory. This latest barrage is one of the biggest since the conflict began in Feb 2022. Well, let's go straight to the top story this evening. The United States striking nuclear sites on Iranian territory has exacerbated tensions in the Middle East, even as Israel claims that it wants to wrap up the war soon. Now, the conflict between Israel and Iran intensified, with Tel Aviv continuing to strike the regime's military facility. Israel struck Iran's underground uranium enrichment facility at Fordo, which was struck by the U.S. over the weekend. New bombardments were also reported in Tehran and other cities, with 6 airports being hit in the attacks. Iran launched 7 missiles targeting Israel over a 40-minute period, calling President Trump a gambler. The Iranian military has said that the U.S. may have started the war, but Iran will end it. Iran's parliament has approved the closure of the Strait of Hormuz. The decision to close the waterway now rests with the country's National Security Council. Iran's foreign minister also met Russian President Putin in Moscow. Meanwhile, people in multiple American cities and across the world took to the streets to demonstrate against President Trump's decision to launch strikes on Iran. Protests also broke out in Iran's capital of Tehran as well, with citizens demanding a response to the U.S. actions. President Trump has hinted of a regime change in Iran. The president's comments come after Vice President J.D. Vance and Secretary of State Marco Rubio insisted that the U.S. did not want a regime change and was only at war with Iran's nuclear program and not with Iran itself. Take a look.
No, we're not at war with Iran. We're at war with Iran's nuclear program, and I think the president took decisive action to destroy that program last night. We have to give an incredible amount of gratitude to the troops who did an amazing thing last night. Think about this, John. They flew thousands of miles away, a 30-hour nonstop flight. They never touched down on the ground, and they dropped a 30,000-pound bomb on a target about the size of a washing machine. No military in the world has the training, the skills, and the equipment to do what these guys did last night. I know the president and I are both very proud of them.
Well, that's J.D. Vance, and tensions with West Asia has only worsened, with the U.S. striking Iranian territory since the 1970 Iran Revolution. Now, while China has criticized the U.S. for violating Iran's sovereignty, Arab nations, though empathetic towards Tehran, are yet to condemn Washington. Parikshit is standing by now to take us through the global reactions coming in. Parikshit, whether it's Macron in France or it is Putin, take us through what the world is saying.
Well, indeed a very worrying situation, Serene, and the world has been calling for de-escalation, but they've been largely divided on the U.S. attacks on Iran in support of Israel. The 57-member Organization of Islamic Cooperation has called on Israel to stop these attacks against Iran. The Organization of Islamic Cooperation will be setting up ministerial contact group for de-escalation. Saudi Arabia, Qatar and other Gulf nations have expressed dismay over the American attack. However, the Gulf nations have stopped short of condemning the U.S. China has criticized both U.S. and Israel, calling for de-escalation of the conflict with Iran. The Chinese ambassador told the UN Security Council earlier that the U.S. has violated Iranian sovereignty and exacerbated tensions in the Middle East. China has called for stability for shipping routes in the Middle East. Iran's Foreign Minister Abbas Araghchi is in Moscow for serious consultations with Russian President Vladimir Putin. In fact, Dmitry Medvedev, ex-Russian president, launched an attack on President Trump and questioned the effectiveness of the U.S. operation. He claimed that critical nuclear infrastructure in Iran was unaffected. He also went on to say that the number of nations ready to supply Iran with nuclear warheads is only going to increase. Putin has said that Russia will take into account that 2 million people from Soviet Union, the erstwhile Soviet Union, and Russia live in Israel, and clearly Russia's response has been muted, and experts say they are unlikely to extend any real help to Iran. Prime Minister Modi has spoken to the Iranian president, calling for de-escalation. European Union leaders have called for de-escalation, negotiation as well, but they are backing the US line that Iran must never, never acquire a nuclear bomb.
Many thanks, Parikshit, for joining us. That is the latest there as far as global reactions are concerned. And as Parikshit was pointing out, crude prices have hit a 6-month high on fears that Iran might close the Strait of Hormuz and disrupt the supply of oil globally. Now, this after Iran's parliament approved the closure of the Strait of Hormuz, which accounts for nearly 20% of global oil and LNG shipments. Several brokerage firms now believe that the crude oil prices could touch $130 per barrel. Meanwhile, Union Oil Minister Hardeep Singh Puri has said that the government had anticipated the possibility of such disruptions and had diversified its supply, adding that India has enough stock to last up to 3 weeks. Take a look.
We had diversified the sources of supply, and out of the 5.5 million barrels of crude oil that India consumes daily, about 1.5 and 2 million only come through the Straits of Hormuz. We import roughly 4 million barrels through other routes, and our companies, the oil marketing companies, have enough stocks. Most of them have stocks up to 3 weeks. One of them has in fact 25 days stocks. And we are also confident that we can increase the supply of crude through other routes should the situation so warrant.
That's the oil minister there. Now, the conflict in West Asia impacting Indian exports to Iran. Nearly 1 lakh metric tons of basmati rice exports are said to be stuck at the Kandla and Mundra ports. Speaking to CNBC-TV18, the All India Rice Exporters Association President Satish Goyal said that the export can't be sent to Iran as no insurance company provides cover to vessels entering a conflict zone. Exporters also worried of further impacts if Iran decides to close the Strait of Hormuz. And staying with the conflict, Iran has threatened to pull out from the non-proliferation of nuclear weapons treaty after the US strikes on its nuclear sites. But what is the significance of the treaty and what is India's stance? Santya is here to decode what it means. Santya.
Shireen, the ongoing US-Israel-Iran conflict has brought the NPT back into focus. The NPT is aimed at preventing the spread of nuclear weapons and promoting cooperation in the peaceful use of nuclear energy. Signed in 1968 and coming into force in 1970, the NPT has 191 state parties divided into nuclear weapon states and non-nuclear weapon states. The state parties that manufactured or exploded a nuclear weapon before 1st of January 1967 are classified as nuclear weapon states. The rest of the parties are non-nuclear weapon states. Under the NPT, the non-nuclear weapon states commit not to manufacture or acquire nuclear weapons, and the nuclear weapon states commit not to encourage or assist non-nuclear weapon states in acquiring nuclear weapons. Nuclear powers like India, Pakistan, Israel and North Korea are not NPT parties. India calls the treaty discriminatory, unequal and flawed, and North Korea withdrew from the treaty in 2003. So if Iran withdraws from the treaty, it will no longer be legally bound to allow the International Atomic Energy Agency to inspect its nuclear sites, nor will it be legally bound to refrain from building nuclear weapons. Iran says it signed the NPT and adhered to the IAEA safeguard agreement, unlike Israel, which not only didn't sign the NPT and never allowed IAEA inspections, but also does not even acknowledge its nuclear program. Iran has accused the Western world of conspiring against it by falsely accusing it of violating the NPT in order to destabilize the Middle East and further its oil agenda in the region. The Western world, however, claims that despite signing the NPT, Iran is flouting its norms. In 2005, Shireen, the IAEA passed a resolution accusing Iran of non-compliance with its comprehensive safeguards agreement under the treaty. Back then, despite its long-standing business, traditional and historic relationship with Iran, India voted against Iran. In 2006, again, when the resolution was referred to the UNSC, India again voted against Iran. Experts say that at the time, India was keen on portraying itself as a responsible nuclear power, and that's why it voted against Iran. However, since 2024, when resolutions were passed against Iran at the IAEA, on 3 occasions, India abstained from voting each time. The ongoing conflict will have long-lasting effects on India and Indo-Iran relations. India has considered Iran a strategic and trading partner. The Chahabar port is India's response to China's Gwadar port in Pakistan. Hence, the conflict and its outcome are extremely crucial for India as well. Shireen.
Santya, many thanks for joining us. Let's take our viewers through the market action of the day. Indian equities gave up early gains, ending in the red amidst global concerns over the Middle East tensions. The Sensex slipping over 0.5%, closing about 500 points lower. The Nifty lost about 140 points, down about 0.5% or so. But the mid-cap index closed about 200 points higher, so the broader markets did outperform for the second day. Prashant joins us now to take us through the market action. Prashant, finally closing in the red, but not too bad.
Well, the market reaction was very, very muted to the early Sunday morning US strikes on Iran's nuclear sites. Brent oil prices jumped 6% at open, but very quickly settled down to being about 2% higher. By the middle of the day today, they'd actually slipped into the negative on a day-on-day basis compared to the last close. And that tells you quite a story. And similar was the case with US equity futures or markets which were trading in Asia, etc. Nifty banged down slightly, nothing major, less than 0.5% basically. But mid and small caps actually recovered, and they both ended in the green. The other story and part of the reason, of course, why the market was down was geopolitics, but there was also a specific reason, which is IT stocks on the back of the Accenture results, which had been released on Friday. So actually, if you look at the top losers, it was Infy, HCL Tech, Wipro, TCS. These were down between 1 and 2.5%. There were also a few other losers, L&T, Hero MotoCorp and Mahindra, which lost in trade. On the upside, Trent was the biggest gainer on the Nifty. BEL was up about 3%, and there was a Hindalco and Bajaj Finance, which were up over 1% each. So just 4 names with gains in excess of 1% is what you had. More down than up numerically. Advanced decline skewed towards what was down, but volumes all on the upside. And actually, that's the reason why I'm going to look at what was up first. Z Entertainment, 12%, biggest volume-led gainer. The standalone refiners, Chennai Petro and MRPL did very, very well. Wire and cable companies, Polycab and KEI standing out. The defense companies, Garden Reach, Paras Defense, Zentech, Idea Forge, Eventel, and many others actually, looking up. And there was a spattering of other companies from a variety of sectors which did quite well. As I said, there was more stuff which was down, but no volumes. But I'll just name out a few. Ola Electric, biggest volume-led loser, 6%, new low here, $43 by close. Siemens was down 4%. Astral was down about 4%. There was LT Foods, OneSource, Sterlite Tech, Lal Pathlabs, some of the names which actually ending the session lower. The big, of course, talking point which markets are watching, of course, is Iran's response. If it's targeted, the markets will see it as an eventual road to sort of de-escalation. If it's more widespread, I guess, lingering continued uncertainty. Back to you.
Yes, that it certainly does, Prashant. Many thanks. In the currency market, the rupee weakened against the dollar as tensions in the Middle East flared up. This after the dollar index strengthened following US's strike on Iran's nuclear sites over the weekend. The rupee closing 16 paise weaker. Shares of Ola Electric slumping in trade today. This after 2.41 crore shares of 0.55% equity changed hands in block deals. The deal was worth 107 crore rupees. The buyers and sellers of the transaction are not yet known. Earlier this month, Hyundai Motor and Kia Corporation exited Ola Electric Mobility through block deals, so the stock under pressure today. Aditya Birla Lifestyle Brands is listed on the stock exchanges after its demerger from Aditya Birla Fashion and Retail. The demerged business listed on the NSE at 167 rupees a share, slightly lower than its discovered price of 171 rupees a share. Aditya Birla Lifestyle Brands comprise Reebok, Louis Philippe, Van Heusen, Alan Solly and Peter England, among others. We'll end to a break, but up next, food credit doubles in the first 2 months of FY26 on the back of robust wheat procurement. Early Kharif sowing signals that the momentum is likely to continue. That and more when we return. Food credit disbursed by banks has doubled in the first 2 months of the current fiscal year, hitting 34,000 crore rupees, driven by strong wheat procurement by the Food Corporation of India and other state agencies. Sapna standing by with more. Sapna, what else are you picking up?
Well, the data speaks for itself. So if you look at the financial year on year, well, that's a jump of almost 100%. It's double, 34,000 crores versus 17,000 crores April, May last year. And also calendar on calendar, the jump is even bigger. It's almost close to 10-fold growth. So around 33,000 crores versus a mere 3,500 crores worth of offtake in terms of food credit by banks last year. So that's one piece of it. Well, of course, the reasons are wheat procurement. So if you look at the wheat procurement data itself, 30.88 million is somewhere the government has done in terms of the procurement, 16% higher year on year. And interestingly enough, this is also the highest among the last 3 Rabi marketing seasons. So if you look at, say, for example, 2023, the data, it was around 18 to 19 odd million tons of wheat had been procured. And that graph kept going up, and now we are almost close to 31 million odd. So what it has done is that it has really helped in terms of the food stock, overall food stock, and also in terms of the buffer requirement. And plus, very important, what kind of allocation goes to the PDS system. That is basically the free food grains program that the government has been running. So, of course, if you look at the central pool, as of now, around 38 million tons of wheat is there. This is double of what is required in terms of the PDS offtake. That's somewhere around 17 odd million tons is required in terms of the free food grain program. And plus, that 38 million odd tons is actually 4 to 5 million tons higher than your buffer requirement. So this is all very good news. Now, there's also another development that's happening parallelly because of the early monsoon. The Kharif sowing has actually already started, and what we are given to understand from the data, of course, and this is the latest number from the Food Ministry, is that the acreage, or rather the area sown, especially for rice, has actually gone up. It's already higher by around 11 odd %. These are May end numbers, early June. So, the rest of the season still remains. So, net, this is a good indicator for the rural economy. This is what we are given to understand. And possibly, if this is the way that things will continue, probably another bumper harvest, as far as Kharif at least is concerned, there is no reason to think that the growth in food credit is going to flag off. Or rather, it's expected to continue. That's what the broad expectation is.
Okay, Sapna, many thanks for joining us. The government is unlikely to extend the waiver on transmission charges for interstate renewable energy projects beyond the 30th of June. Sources say industry may face higher tariffs in a phased manner as developers factor in added transmission costs. Shivani Bajaj is here with more. Shivani, take us through the impact and the implications.
Well, that's right. The ISTS waiver, or the Interstate Transmission System waiver, which has been a crucial policy tool since 2019, is unlikely to be extended beyond the June 30th deadline. That's what the government sources are telling us. Now, Discoms and the industry has been pushing for an extension in this case. These charges are a major cost component for developers, and the waiver helped make solar and wind project bids more competitive in the recent years in India. While the exemption was originally set to end in 2023, it was extended till June 2025 to support India's 500 gigawatt renewable energy target. Now, from July onwards, new clean energy projects may face increased cost as developers will need to pay ISTS charges, potentially pushing up green power tariffs in India. Now, this could affect ongoing project bids, financing assumptions, and even the pace of future renewable installations. Delayed projects also that counted on the waiver are at risk, potentially becoming financially unviable. According to industry sources, the ISTS waiver has saved developers approximately anywhere between 0.5 rupees to 1.6 rupees per unit, which is a big chunk of their competitiveness. So now, from 1st July, if this extension is not granted, which government sources say will not be, transmission charges are slated to return in stages. 25% of applicable ISTS charges for projects commissioned between July 2025 and June 2026, gradually rising to 100% by July of 2028. Back to you.
Shivani, many thanks for joining us. In international news, Israel has said it has recovered the bodies of 3 captives held in the Gaza Strip since Hamas's 2023 attack. This comes as the Israeli military's attack on the besieged enclave killed more than 30 Palestinians. Israel's Prime Minister Netanyahu said that pressure Israel has put on Iran is helping its mission in Gaza. At least 7 people have been killed and dozens have been wounded in a massive Russian drone and missile strike on Ukraine's Kyiv and nearby regions. The attack sparked fires in residential areas and damaged the entrance to a metro station bomb shelter. 4 children were among those injured. Ukrainian President Zelensky said preliminary reports indicate that ballistic weapons from North Korea were also used. Now, Tesla's much-hyped robo-taxi service has been launched in Texas. The first rides, which are priced at $4, are being offered in parts of Austin. A small group of influencers were invited to participate in the closely monitored pilot. The robo-taxis use driverless Tesla Model Y vehicles. However, the electric vehicle maker has not provided details on the scope of the Tesla robo-taxi launch. NATO's member nations have agreed to raise their defense spending target to 5% of GDP. This is in line with US President Donald Trump's demand. However, Spain has said it received NATO approval to opt out of the spending target. Spanish PM Pedro Sanchez has said the nation can meet all NATO commitments by spending only 2.1% of its GDP. Well, with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Do stay tuned. We're back in a minute with plenty more. They power your bank's data, your favorite app's performance, and the AI tools that seem to know you better than you know yourself. Behind it all is Snowflake. In just over a decade, this AI data cloud company has transformed how the world stores, processes, and extracts value from data. From Adobe and Pfizer to Swiggy and Razorpay, over 11,000 organizations globally rely on Snowflake as the data backbone of their digital future. Now, under the leadership of Sridhar Ramaswamy, the man who helped build search at Google and later founded the AI-native search engine Neeva, Snowflake is stepping into a new phase of growth. One that's powered by agentic AI, simplified enterprise stacks, and a clear mission to make data and AI transformative for everyone. In this edition of Young Turks, Voices from the Valley, we're at Snowflake's global headquarters, unpacking the company's evolution. From $1 billion quarter to AI-fueled innovation, India's upskilling push, and why Sridhar believes AI is just a tool, value is the real destination. As the lines blur between cloud, data, and intelligence, here's how Snowflake is building the platform that could define the enterprise tech stack for the AI era. Hello and welcome to the 12th edition of Voices from the Valley. I'm Shireen Bhan and we're at the Snowflake headquarters in conversation with CEO Sridhar Ramaswamy. Sridhar, what an absolute pleasure to have you join us here on Voices from the Valley. Let me start by talking to you about your story and your initiation into the world of Snowflake, which was, by chance, because you started your own company, Neeva, which got acquired by Snowflake in 2023. You weren't anticipating becoming CEO, but now 16 months into the saddle, what's the story been like?
You're right, Shireen. First of all, excited to be here, excited for this chat. Yeah, I came to Snowflake via an acquisition. We tried to create a search engine and we decided to pivot to enterprise and become part of Snowflake. And originally I had planned to stay around for 5-6 months and one thing led to another and I ended up becoming CEO. I'm having the time of my life. There's no better place to be than the world of data and AI. We're super excited about helping over 10,000 customers realize value from all of the investments that they have made with data. It's been thrilling. We had an amazing summit 2 weeks ago with over 20,000 attendees. Things are great.
I'll talk about the summit and your conversation with Sam Altman and the messaging that's gone on. But let's talk a little bit about where you find yourself today at this inflection point between what's happening in data and what's happening with AI. And you believe you're at the center of the AI revolution. So what gives you the opportunity to create the next unlock for Snowflake?
Yeah, so data for most companies has always been a bit of an afterthought. If you're a public company, you need data because you need to make your security filings every quarter. So it's a little bit of reporting the news. What we have realized more and more is that companies that use data to make themselves better on a continuous basis, like say Google Search or Google Ads did, those are the truly nimble companies that can adapt. And what AI now makes possible is, first of all, it helps you make sense of data that was previously impenetrable.
Right.
If you had a stack of documents, good luck trying to figure out what was in them. AI unlocks the value that's in these documents.
Yeah.
Similarly, any business person can ask questions in natural language because we're just used to it. It's things like that that AI brings on top of the investments that companies have already made with data. That's part of what puts us at the center. We've been all about how do you get value from your data? How do you have your data in order so that you can run great analytics, so that you can get great insights into where the business is going? AI is a massive speed up of that process. And that's what positions Snowflake to be in this great position.
Speaking about AI being the big accelerant, which is what you alluded to, from the data wars to the cloud wars, now to the AI era and the AI wars. What do you believe is the key differentiator as far as Snowflake is concerned today in this highly competitive landscape?
That's correct. That's correct. So, first of all, we don't pretend to be one of the research labs that are doing foundation models. I think those are few, but foundation models aren't all that useful unless you have access to the actual data that describes your enterprise, that has all of your contracts, that has all of the information that is relevant to you. And we use partnerships like with Anthropic, like with OpenAI and Microsoft and AWS and so on to bring the best models that are there on the planet to our customers. And it's really that magic of bringing these together, the thinking skills of these amazing models with the high quality data that is in Snowflake and the high quality data that we are helping people bring into Snowflake, that's the main reason that we are so relevant. And a lot of our product philosophy, which is rooted in things like simplicity, product cohesion. With AI, for example, you're not buying anything new with Snowflake. It comes as part of the platform. We've always had that one platform mentality, and AI now becomes this unlock on top of those things that we are doing. That's what positions us to be really well, to succeed in this AI space, because everything that we have done about creating an efficient data platform, an easy to use data platform, now gets AI as an accelerant for all of these things.
So what does all of this mean in terms of business outcomes then as far as Snowflake is concerned? You just announced your numbers, a beat there on estimates. So that's great news for you. Market cap almost between 69 and 70 billion, give or take. And it's been quite a ride from the time that Snowflake decided to IPO to where you are today. In terms of business outcomes, what could an AI future potentially lead to for Snowflake?
Yeah, so we just had our first $1 billion quarter, which is always a thrill for any company. Still growing strong, mind you. Our growth last quarter was 28-something%, which is a pretty big number on top of some $4+ billion of anticipated revenue this year. So we feel good in terms of where the business is. And our strength comes from core analytics, which is doing exceptionally well, with additional new products in areas like data engineering and AI, providing the additional oomph, the additional acceleration. It is that 1-2 of being strong in a core of a scaled business and naturally using additional things on top of that, that gives us confidence that we can lean into the business and that we can make it accelerate, in fact.
So $1 billion run rate, is that the new normal now, or is that the expected normal as far as Snowflake is concerned?
Absolutely. If you're growing at a very healthy rate and you made $1 billion in a quarter, which is $4-something billion, our guidance for the year is $4.3+ billion. Absolutely, that is the new normal. As I said, if anything, we should be taking advantage of the current environment, the current market, and aspiring for even more.
Well, you know, speaking of aspiring for even more and the ambition from here, I want to go back to the conversation that you had with Sam Altman. And the message from Altman was loud and clear. If you're not all in on AI, then you're missing the big opportunity, you're missing the bus, so to speak. But as you look at the environment today, as you talk to clients that you're working with, what's the sense that you get? What's the hesitation? What are some of the deterrents that perhaps are forcing people to sit it out on the fence still?
I don't think there are many people that are sitting it out. On the other hand, every rational CEO is going to demand outcomes, not just jumping onto some bandwagon. And it's the same with me. I, want us to use AI tools. We use a lot of coding co-pilots, for example, but I also want to make sure that my engineers are more productive. AI is not an end in and of itself. Again, that goes very well with the message that we give our customers, which is to be value-driven. I tell our customers that every project needs to generate positive ROI. I don't believe in super long investments without a lot of accountability along the way. So from that perspective, absolutely, lots of customers are leaning in. We have over 5,000 customers that are using our AI products. So I don't think there is an amount of hesitation. On the other hand, there are also lots of data that is trapped in legacy systems where it's hard to bring the power of AI. And there, we try to be measured with our customers in terms of, if you do this migration, this is the unlock that it's going to have on the business, and this is the positive impact that you're going to have. It's a process. I think people are doing it. Yes, there's a little bit of hesitation or sometimes fear about what this all means. But like Sam was saying, the best way to get out of that is to embrace it, is to embrace the change. Do it in little ways. In your personal life, I often ask people, what are all the dumb things that you do with AI? I generate memes with AI. I'm proud of it. But the more you're familiar with the technology, the easier it becomes to see the value that you're going to get from it.
So a meme a day, is that what you're working on?
It's like it's meme on demand.
It's a meme
whenever
on
you
demand.
want.
That's right. But you know, I want to walk you back to your beginnings. You know, from IIT Madras to the Valley, Google in between, Bell Labs as well. I mean, everyone's talking about the pace of change and how much things have changed. You know, take me through your own experience of witnessing, observing, and now participating in this kind of change that we're seeing.
I came as a student, as you said, from IIT Madras. I got a PhD, slow start, did research at places like Bell Labs. Moved to the Valley because I could see then that the internet was something else. That was the first big wave of change. And it came with its own exuberance, irrational exuberance, as somebody called it. There was a big stock market crash then. But the internet changed our lives. It changed publishing. It changed so many different things. I was fortunate to be a part of one of the icons of the internet age, which was Google, and in one of the best businesses that there ever was. We then lived through the mobile change, where all of a sudden, it's not a billion people, it's 5 billion people got their hands on the internet, on mobile devices that could do anything for them. I feel like this is almost a change of that magnitude, where there is a little bit of before AI, after AI, in terms of what it can do for innovation. And lots of lessons that we learned both in the internet era, but also in mobile, come in handy in terms of managing organizations through change, helping customers manage through this kind of change as well. It's exhilarating. It can be exhausting because there's so much change that is happening. But the unlocks are also pretty incredible. It's an exciting time to be.
You know, you talked about the Google experience and the big Google moment that you saw. Do you believe that we're likely to see that being replicated, except being replicated on steroids now in an AI era? I mean, what are we talking about?
You're seeing it right now. I don't think Google's market cap went to $350 billion as quickly as OpenAI's has. Absolutely. I think change is being driven faster and faster than before. It's an exciting time, but also it's one where you have to figure out how to manage change for yourself, for your team, for your company, for your customers. It's challenging.
Sridhar, the CEO playbook, you know, 16 months on, running Snowflake, you had some pretty large shoes to fill into. What's the playbook looking like at this point in time in a world which is sort of breaking and changing so quickly?
Great products, first and foremost. That's what defines great technology companies. And so I spend a lot of time with creating great products at every layer of the stack. Our message to our customers, we want to be there from ingest to insight, from where data is first born and brought into a system to when they can get insight from the system. We have an amazing go-to-market team. I'm super quantitative. Part of what I've contributed to that team is a framework for excellence. And we have a new CRO that is driving excellence on that side. That's the 1-2 punch of Snowflake. Great products, great sales, that leading to great customer outcomes. That's what drives our success.
So my final question, India, the importance of India as far as Snowflake is concerned, and more importantly, the ambition that you've laid out now for Snowflake over the next few years.
So we have a big team in India. We have an amazing team that's based in Pune that runs a lot of critical functions for Snowflake. We also have a presence in many cities in India. Amazing customers like Swiggy, Tata Motors, Bajaj, lots of them that we are very proud to partner with. And so it's a big market for us. India is going to become the 4th largest economy in the world pretty quickly. And I think there is an incredible amount of just value to be created by being there. I'm excited for it. We are leaning into things like having a larger team in India, helping with education more. We have a program called the Million Minds program, where we want to help people become more proficient with data and AI. So we are leaned into it. We are excited for India's progress.
And Snowflake, the ambition?
Well, I think we have the chance to create an iconic company. Data is going to be at the center of this AI revolution. I was part of creating the icon that Google has become. Everybody in the world knows Google. That's the bar that we set for ourselves in terms of the impact that we have on the world. Obviously, those are some very big shoes to fill, but it's one step at a time.
It's one step at a time, and we wish you the very best of luck with that ambition, with that plan. Sridhar, what an absolute pleasure to have you join us here on Voices from the Valley. Thanks very much for your time. That's Sridhar Ramaswamy here at the Snowflake headquarters, talking to us about where the world is headed and the kind of impact that Snowflake hopes to make as we enter this hypercharged AI era. From all of us here on the team for now, many thanks for watching. Do stay tuned to CNBC TV18. We're back in a moment. Welcome back. Here are some highlights from the AI action from the 12th edition of Young Turks Voices from the Valley. From bold bets on agentic AI to India-first innovations redefining global playbooks. The future is being built right here, and we're bringing you front row access. Until next time, keep watching Young Turks. This big billion-dollar bet that Cognizant has decided to make on AI, and I think it brings to bear the larger question facing Indian IT services companies today. In an AI world, how relevant will Indian IT services companies be?
I think, they're going to be very relevant. First of all, the $1 billion bet that we made was in 3 dimensions.
Yeah.
Getting a talent ready for the AI era, getting the infrastructure ready, which is the AI labs, and then building solutions, custom solutions for our clients. The Indian IT services companies are right in the middle of building those solutions, whether it is getting the data ready for the AI era or building the AI relevant solutions. And the $1 billion bet we have made is paying off really well for us. Our clients are loving it, our markets are loving it, and we like it, and we are doubling down on that.
Do you believe as the uncertainty ebbs, we're likely to see more of the large and mega deal conversion?
This framework will gain widespread acceptance is what we believe, and that translates to a large deal. We have proven the point in 2 cases in the recent past, and we have good pipeline with the same construct, where we are approaching clients with, saying that we can we can unlock the trapped value, and then we can help you fund transformation. By construct itself would become a large deal.
What are the next set of problems that you're hoping to solve for?
Most important right now is to make these agents and agentic systems interoperable. We are agnostic to what platform or cloud you're using, and you will be using many in an enterprise, but we need to be able to plug them in and have them work together without having to go re-engineer the existing system that you've built. If you ask a large language model to make a decision, it can come back to you and say, here's the best decision I think I want to make, and I am, let's say, 95% confident in it. In that case, you've set a threshold and said, okay, if you're above 90% confident, go ahead and do it.
Okay.
But if it comes back and says, here's the best decision I can make, but it's at around 65% confidence, you can say, okay, wait, we'll have a human come in and take over for you. And so some of that, like drawing the line as to where it's autonomous and where a human comes into the loop, can be automated in this manner. Well, the humans actually will have, trust me, much more to do than before. I actually think every time we've come up with such a hugely disruptive technology, we've thought that we're all going to be going home or going to the beach, and we've all gotten much more busy.
Let's talk about AI and what that's going to mean now as far as Notion's future is concerned. How do you see yourself making an AI pivot?
Well, AI is like new electricity for us. We've spent about a decade building an incredible editor, an incredible database where people are doing lots of work. There's tens of millions of people using the product. And now what AI does is it infuses all this power. One of the things that we always hear from people is that people really love the product, but they find it hard to really customize it or build it to a place that they would like. And AI enables that.
This is a space dominated by the big boys, right? Between Google and Microsoft, it's the lion's share of the market. Now, how do you take on these large legacy incumbents? What is the strategy to go after a share of that pie? And what do you see as the addressable market for yourself?
It is a multi-decade path, and it has been done before, so I'm excited about that. I was in school, maybe in college, 20 years ago. 20 years ago, Google Docs and Gmail came into life, and when I was in school, it felt like the best thing since sliced bread. Like we all grew up using these products, and when I went to work, I demanded that we should use Google products because that's what I grew up with.
That was the gold standard.
That was the gold standard. And if you talk to students today, high school students, college students, startup founders, they're all growing up on Notion.
Are you having conversations with ChatGPT on your drive back home as well, Ajit?
Not on a very regular basis, but
you are.
I am, and I'm using audio, video capabilities for professional and personal stuff. If I have some plants that the leaves are like dying, and I'm just turning on ChatGPT video mode and asking what type of plant it is, what should be doing, do I need to give more water, less water, is there too much sun, what's going on, and I get pretty good advice. And professionally also, it's been very transformational. AI is going to become very, very boring, and what I mean by that is it's going to be completely embedded in the apps that we use, in the workflows, and we won't realize that it's going to be boring. I remember still in the late 90s going from a text-based browser called Lynx to Netscape, and you could see graphics, and wow, this is amazing. Similarly, when I got my BlackBerry the first time, I was so excited that you can get email anywhere. Those things are boring today. They don't excite us anymore, and they're just seamlessly integrated into our life.
AI in India, Dave, and how you see that playing out. I mean, from a consumption point of view, a large part of ChatGPT's success is on account of Indian users. Forget monetizing it, that's an entirely different story. But how do you see the India equation with AI?
Yeah, I think the start has been slow when it comes to really market-leading AI venture creation in India. I think there's been a sort of lag effect to what's going on here. Historically, the software industry, the software startup industry in India was sort of a fast follower industry. They'd go after mature markets here and launch into those markets and build something that was better, faster, cheaper. I think in this age where sort of AI native startups are growing very, very fast and exploring new sort of domains, I don't think the fast follower strategy works. And so I think the India startup ecosystem is trying to find its feet in this rapidly changing environment. So I think that's a risk. But there's also opportunity. There's a lot of the manual work in the world, business manual processes has gone to India and Southeast Asia, the Philippines, and so on, contact centers and revenue cycle management and all sorts of other things in all these different financial services, healthcare, etc. I think there's about a $350 billion BPO industry. There's a multi-$100 billion IT services industry. And those are all manual processes. That is what AI is going after.
Let's talk about what's happening with the AI race today. And I know that you were in India. You've been talking to the Indian government about what it intends to do as far as the semiconductor mission is concerned. We've finally gotten started. Speaking of putting things on track, do you believe we're on the fast track? Do you believe we're in the slow lane today?
So we started off with a bang on semiconductor. So we literally, my idea and suggestion that they followed was that we need to have a semiconductor fabrication facility. So to that extent, they have, by the way, 6 different programs going on at different stages of the thing. But I think we still need more, in my opinion. And somehow I feel we are not as aggressively pursuing it as we were initially because there was something new about it. Yeah. So maybe I need to go back and really push a little bit harder for India to succeed in AI race. And to succeed, right now we don't build those GPUs ourselves. Although I would love to see India make its own GPUs. And I'm personally quite engaged in that process of making sure we have that capability and capacity. As you know, AI has become an arms race. And
you almost liken it to a nuclear arms race.
That's right. It's even more specifically, the chip is the fuel, the uranium that's needed, which is hard to procure, and all the countries want to keep it themselves, and that is the GPUs. And that's why I think it's important that just like India finally broke out and created its own nuclear bomb, the atom bomb, they need to really figure out a way to make this own GPU.
Let's talk money.
Hello and welcome to another edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, India's retail investors are all set to get a brand new asset class to invest in. This new product will be a bit more sophisticated perhaps than regular mutual funds, but hopefully not as complicated as PMS or AIF products. I'm talking about an asset class that will be known as the specialized investment funds, an asset class that will look to bridge the gap between mutual funds and products like PMS, which is Portfolio Management Services, or AIFs, which are alternate investment funds. Now, we have to discuss what the risks are, what are the tax implications, what are these new, more sophisticated strategies involved, and should we investors really care? Well, to do this, I have 2 very special guests with me in the studio, Radhika Gupta, MD and CEO of Edelweiss AMC, and Swaroop Mohanty, Vice Chairman and CEO of Mirai Asset Managers. Thank you so much, Radhika and Swaroop, for joining in. It's a pleasure to have both of you in person with me in the studios. And with your presence together, I know this is an exciting moment for investors. What are we looking at? Lady, let's start with you.
Thank you. It's lovely to be here. I think, I usually have more mixed opinions about new things that are launched. But with the SIF launch, I am reasonably bullish. You said it's a middle path between MF and PMS and AIF. I actually think that for the consumer, it brings the best of both worlds. And I came from an alts background, so perhaps this is closer to heart, but I think what PMS and AIF offered is flexibility in investments, flexibility in subscription redemption, how you use credit, how you use derivative. But what mutual fund offered was comfort. People are comfortable with the structure. You can do SIPs, huge sense of tax advantage. The consumer doesn't pay any tax. I think SIF gives you the flexibility that MF.
Jan Janisch in a few moments at the NASDAQ. It's VanEck highlighting the VanEck Digital Transformation ETF. Jim, as we've been sort of chopping around these levels just south of 6K last couple of days.
Yeah, look, I think that we're going to go back to the discussion of the Fed. And I think it's very hard to go back to the discussion of the Fed without remembering how belittling the president is willing to be in his social media comments. I just point out that the man has been a valued public servant. I think that if I were to say the things to you about him, I think you would say, Jim, that's a little disgraceful. And you got to take that back. But David, the word disgrace is kind of it doesn't come out. No one says that, well, that's disgraceful what the president says about JPAC.
No, I guess not. I guess we're at this point, he's been doing it so long, it doesn't really generate a lot of response, period.
Okay, but at the same time, is there a level where the ridicule seems has made its point?
In Trump land, it's over and over and over again. That's what you do.
So
just keep hitting.
Jay Powell, who is a distinguished American,
yes,
I think we'd all agree with that. It can be a free fire zone of name calling.
Yes. I mean, you know that to be the case because it continues all the time. When the president starts thinking about the fact that he would like lower rates and what that would mean overall for the economy. And obviously he comes back now as well to the interest costs in the budget, which is certainly an important concern. There's no doubt about that. And the fact that it would be reduced were there to be lower rates, at least potentially. Of course, Carl, you pointed out many times the long end's going to do what it's going to do. So it's, short end, yeah.
Well, look, I'm going to shock people by saying the
Let's talk money.
Hello and welcome to another edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, India's retail investors are all set to get a brand new asset class to invest in. This new product will be a bit more sophisticated perhaps than regular mutual funds, but hopefully not as complicated as PMS or AIF products. I'm talking about an asset class that will be known as the specialized investment funds, an asset class that will look to bridge the gap between mutual funds and products like PMS, which is portfolio management services, or AIFs, which are alternate investment funds. Now, we have to discuss what the risks are, what are the tax implications, what are these new, more sophisticated strategies involved, and should we investors really care? Well, to do this, I have two very special guests with me in the studio, Radhika Gupta, MD and CEO of Edelweiss AMC, and Swaroop Mohanty, Vice Chairman and CEO of Mirae Asset Managers. Thank you so much, Radhika and Swaroop, for joining in. It's a pleasure to have both of you in person with me in the studios. And with your presence together, I know this is an exciting moment for investors. What are we looking at? Lady, let's start with you.
Thank you. It's lovely to be here. I think, I usually have more mixed opinions about new things that are launched. But with the SIF launch, I am reasonably bullish. You said it's a middle path between MF and PMS and AIF. I actually think that for the consumer, it brings the best of both worlds. And I came from an alts background, so perhaps this is closer to heart, but I think what PMS and AIF offered is flexibility in investments, flexibility in subscription redemption, how you use credit, how you use derivative. But what mutual fund offered was comfort. People are comfortable with the structure. You can do SIPs, huge sense of tax advantage. The consumer doesn't pay any tax. I think SIF gives you the flexibility that AIF and PMS had. with all the comfort that mutual funds have. And the 10 lakh ticket size, I really think opens this up to consumers, a much wider range of consumers, because when you were talking AIF, you were talking 1 crore investor, which means someone with 10 crore net worth to hoga, because you won't put more than 10%. So that versus someone with a 1 crore net worth, I think the ambit of people that we can speak to is very good. So I think in India's asset management evolution, you know, you saw the evolution of passives, multiple investment styles, smart beta. I think this is a welcome step in the evolution, and I'm glad the mutual fund platform has been chosen, because it's a platform people have gotten comfortable with.
Okay. Well, the objective is to make it as simple as possible for people to understand, because there are nuts and bolts and nuances of this new product. Swaroop, what are your opening thoughts? Do you see this as a big stepping stone, or well, it will be one more product that AMCs offer?
No, it's a step forward, both for the investor as well as the asset manager. I mean, look at it, we are graduating forward into a slightly more evolved space. I won't say complicated or easy space, but for an asset manager, it's great to start expressing ourselves into new areas of investments. The regulations have made it far more broader than what we used to do. The risks are very different, so how we manage it, how we look at the whole space will be different to each fund managers. And I think it's the emergence of style-based investing coming out from each fund houses. So it's a great platform to express our backend to the investors. At the same time, from the investors' perspective, and I say this with all humility, when I look at the last 2-3 years in particular, when return chasing has become so blatant, risk understanding needs to go up. Finally, you start your investment journey thinking it's a process of return generation, but it's a process of risk mitigation. I think this will set the tone for people to understand risks more, and the safer or the better approach to risk will be a better approach to investing. So it's a great step forward, and I echo what Radhika says, and it's fantastic that mutual funds were considered to be this vehicle for the future.
To offer this new product. So I think the first checkpoint I think we've all taken note of, that you need to have a minimum investment threshold of 10 lakh rupees, which is not too much if you're looking at the mass affluent, households of India. Most of us are investing, that amount or maybe higher across mutual fund schemes. But let's understand the nuts and bolts of this product. So what the original understanding was that this product, the SIF, will have more flexibility in terms of taking long short strategies, more derivative positions, something known as naked shorting in the market. Radhika, if you could just expand on this, what are some of the basic differences, say, or in architecture perhaps, between regular MFs and this new product?
So I think there are 3 differences that consumers should know about. One is derivatives. Now, mutual funds were allowed to use derivatives. It's a myth that they were not. Arbitrage funds use derivatives, balanced advantage funds use derivatives, but they use derivatives for the purpose of hedging. They don't use the derivatives for the purpose of expressing a view. So if I was long stock A by 50 rupees, I had to be short stock A by 50 rupees in absolute amount. Now I can be short stock B by 10 rupees, up to the tune of 25%. So in that sense, I'm allowed to express a negative view or use derivatives beyond the purpose of hedging. So that I think is the number one flexibility. So suddenly, if you look at the SIF categories, you take a category which was a normal flexi cap category, but you are allowed to apply derivatives. You take a category, they've got one called X top 100 long short. It's like a mid and small category of the old mutual fund, but suddenly I can express a view that is negative.
And this is capped at 25%,
25%.
Right? The total short position, so to speak.
Is capped at 25%.
Okay.
So that's one. The second flexibility is around exposure to credit. Now, most of the conversation around SIF has centered around equity, long, short, etc., which is okay. But there are substantially larger relaxations for credit, which is a good thing. And maybe you will see the revival of credit funds post 2018 in some format. We saw the private credit industry grow in a big way. The third, which is related to both of these, is that mutual funds are daily subscription and redemption instruments. Here, depending on the category, you don't have to provide daily redemption. The asset manager can choose to provide bi-weekly redemption, or in the case of a fixed income fund, weekly redemption. So many of the issues of the old of having illiquid credit but having daily liquidity perhaps can be mitigated more sensibly.
To simplify this, what it means for me, the investor, is that there could be products which don't allow me to redeem on a daily basis. It could be perhaps once a week or once a fortnight.
And which is why it's very important in SIF and we can talk about this more, to read the risks and understand the fine print, because it will not be the same.
No, absolutely. In fact, we should try and flash that. I have that disclaimer that the regulator has also put out. I'll read this out since we're just starting the conversation. Here's what SEBI is saying, and there's a mandatory disclosure that will go with all of these new funds. Investments in specialized investment funds involve relatively higher risk, including potential loss of capital, liquidity risk, and market volatility. Please read all the investment strategy related documents carefully before making the investment decisions. I've taken more than 30 seconds to say it for sure. So, Swaroop, come in on this. I mean, and expand on some of these points, that there are more sophisticated strategies, some of the derivative strategies that Radhika alluded to. From an investor's perspective, I'll say, क्यों करना है? If I'm getting more return, तो ठीक है. Otherwise, why do it?
See, at this moment, forget SIFs. If somebody is not investing, it's that person's problem. It's probably the best phase of the country, and the best way to get that growth of the country into a person's portfolio is probably the capital markets, right? And this offers a far evolved position, like I've been using the word evolved, for the investor. Now, a lot of investors have different risk profiles, right? And this is a product which is catering to a slightly evolved, somebody who's been investing for 20, 25 years in mutual funds for that, can look at these in a far graded manner than they used to. Now, here's the thing. Now, suppose the flexibility is for 25%. We need not go 25%. Now, suppose the option is to go 12% in lower credit rating papers. We need not go 12%. Each fund will have its own way of expressing that same risk profile to the investor. And hence, the need for the investor to read a little bit more about this is very important at the beginning of this journey. And once that, and it's not rocket science to understand all this, okay? Guys like me will come and pose that it's a rocket science vehicle to make ourselves more important, but just a little bit of reading can ease out a lot of things. What can happen through these products will be far more evolved than what we've put on place in mutual funds is a submission.
So derivatives is one important aspect that Radhika touched upon. I believe that there is a greater exposure that these funds can take in REITs as well. For instance, REITs in REITs. Anything you want to add?
All those exposures have doubled. I mean, 20% we can go up to.
Okay.
And that's why the flexibility on redemptions.
Yes.
Some of the underlying assets need not be as liquid as we have to take on the mutual fund side, because we have to give redemptions on a daily basis. And that gives the difference of flexibility to the fund management. One can dig deeper into these papers and hence aspire to give a higher yield, right? And that's where the maturity of the product comes in, and it's up to the investor to understand why the need for periodical redemptions. It's for the betterment of the investor. See, in any portfolio, there are three types of investors. The investor who's coming in, the investor who's there, and the investor who's leaving. The fund manager has to be fair to all three at all point of time. Now, if the product is at the underlying is a little bit illiquid, then the person should be able to sell it, realize that value for the person who's going out, and also for the essence of investors who stay back. So all these have been thought through, and what has come out is a far suitable product for the underlying product, for the portfolio from an investor's perspective.
Okay, I want to quickly go over the categories, the strategies that the regulator is allowing. Like that for mutual funds, there could be one large cap fund, one mid cap, one small cap. So regulators very clearly defined what kind of funds can be launched by AMCs on the mutual fund side. Similarly, now they're talking about very specific strategies that can be launched within an SIF. So let's start. So equity oriented strategies, debt oriented strategies, and hybrid strategies, similar to mutual funds. So Radhika, let's start with the equity oriented strategies. What are we talking about here?
So I would just break this if you just look at mutual fund parlance to simplify. They have equity. Now they have three categories. They have an equivalent, or they have something called equity long short. What is that to me? That is a flexi cap fund in the mutual fund world with additional flexibility around derivatives.
Okay.
You can go everywhere, but you can also use derivatives.
Okay.
Then they have a category called X top 100.
X top 100 long short.
Long short. Now again, that is your mid and small cap. You used to have, we have mid cap and small cap. We used to have a mid and small cap category in mutual fund. We used to run one fund. That's mid and small cap. So you buy beyond the top 100, but you have the flexibility to short. I want to add one point to what Swaroop said. Just because you have 25% flexibility to short doesn't mean you're always 25% short. You could like a stock for the long term, for instance, in the mid cap space, but have a negative view for a month because there's an event going on, and then take a short position on it. So it's not mandatory short, it's flexibility to short. So that's your second. And there's a sector rotation category, which in my view is like a business cycles category of the old. But there you were expressing views, you were taking very concentrated bets on sectors. Here you can take negative bets. So I can be long financials, short technology. So that's your equity category in a sense. It's your old flexi cap, mid and small cap, and business cycles with the layer of shorting.
With the layer of shorting and the new nomenclature. Got that. There are debt-oriented strategies as well. There's a debt long short. And there is a sectoral long short fund as well. So do you want to sort of explain that a little
again,
bit?
same analogy. The debt long short is like your old dynamic bond fund, but you can use interest rate future. Flexible in debt in terms of where it can go in terms of credit and duration.
Also interest rate futures. It can,
you
can
use
be a play
interest
on
rate
that.
futures there. So it's dynamic bond fund with shorting. That's shown up. And then the second one is your sectoral. I think that will probably be used for credit kind of funds because you can do financial services. So all your HFCs and BFCs, etc., kind of exposure can come out. So again, dynamic bond fund and credit fund with shorting.
Oh, okay. All right. So
and liquidity.
Okay. So those would be some of the debt strategies. Then in this SIF, there are also hybrid strategies, which the regulator is allowing. There is an active asset allocator long short fund and a hybrid long short fund. Now, these products will evolve as we go, but Swaroop, I mean, broad thoughts on how they could look like, what they could be like?
Like you said, I mean, early days, and the beauty of this product is, every fund house can express the same category very differently. Unlike, in the mutual fund side, where the categorization has defined a lot of it, and ideation is somewhere taking a back step, and that's the beauty of this side. Radhika can take a completely different view of the same category than what we can take. Right, and both can be right.
25% short on that particular one sector and that sector fund. You could be long on it.
Yes, absolutely. And that is why I said it is evolving of the entire environment. And that's why we all have to go for a re-examination, passing thing of the whole thing. The environment will be reassessed. All of us have to go through
and a new name.
New name, everything. And you see, when you look at the new name, it's very important that it's been given a completely new perspective with our parent not being, we can carry, say, Platinum by Mirae Asset, but Platinum has to evolve.
Well, which is very important. Let's tell that to our viewers as well, that we have two of these SIF identities that have been launched so far in the market. The one that Mirae has put out, as Swaroop is saying, is called Platinum SIF, and the one that Edelweiss has put out is called Altiva SIF, right?
Yes.
Individual identities.
Individual identities.
And that's how these funds are going to be.
No, but I think it's important to have the individual identity because mutual fund, especially with Sahi Hai and everything, and I'm sure Swaroop agrees, has a connotation that it's very simple, it's very standardized. So, with due respect, a Mirae mid-cap and Edelweiss mid-cap, there is not that much difference in what we do.
You play in the same 250 stocks or,
and I know I'm going to get my money back in one day. There's that promise. So with SIF, I think for the consumer and the distributor, the challenge is the nuance will be a lot more.
Absolutely.
He's been saying evolved, I'm saying nuance. But you can't just rank sort to, X top 100 funds. You really have to look deep.
Absolutely. And I really hope that viewers are listening, because viewers, if you want to be in these sophisticated products, you have to do more homework for sure and ask more questions. And we'll continue with our questions after a very quick break, because we need to understand taxation and also general sense of return profile when we're looking at these new SIFs. Back in just a moment after the break.
Let's talk money. Let's talk money.
Welcome back. Well, we're in the midst of a very, very interesting conversation on a brand new product that's about to hit the market for all of us retail investors. It's the Specialized Investment Fund, the SIF as it's being called, and AMCs are in the process of launching this out. Remember, minimum threshold is 10 lakhs. The strategies are a little more sophisticated than ordinary mutual funds, but then can the returns be enough to sort of, justify that higher risk? That's what we're discussing. As I was thinking about our conversation in the previous segment, Radhika and Swaroop, it seems very important to me that the knowledge building around this product is going to be critical, because these are sophisticated strategies. And let's face it, when we're looking at investments, 90% of the conversation with our advisor or distributor is focused on return. Milega kitna? So how will, this will have to be dealt with differently, won't it, Radhika?
It needs nuance. I've been saying that again and again. And, you know, we as a brand under Altiva are spending a lot of time and effort in consumer training and in distribution training. I know distribution has to pass a certain set of exams, and many of them already are, but we are spending the effort on doing that. The greatest tragedy would be if SIF is seen as which PMS was, as a route to, I will get higher return.
Yeah.
Actually, SIF is not about that. What's the flexibility you've been accorded in the equity side? It's derivatives. Derivatives may be used to give better risk-adjusted returns. So, if in an arbitrage fund, in mutual fund, I was getting X return, maybe I can use some more sophisticated strategies to get arbitrage plus. Maybe I can get an equity-like return with lower drawdown than equity. But these are nuanced conversations. And we've moved to a world, as I said, where we have this sorting investor. You go to a website and you sort which is rank 1 fund.
Past 3-year return.
No, past 1-year return.
Oh, past 1 year return.
And I'm saying that is not healthy in mutual funds because all of us have different styles. It's even more unhealthy in SIF because we talked about equity long short. He could run a fund with 45% net equity exposure, and I could run a fund with 0% net equity exposure. He may obviously have a higher return, but are the risks comparable? So the conversation has to be about risk-adjusted return.
So, Swaroop, how will the investor navigate this? And, you know, isn't there, I don't want to be negative, but isn't there a very clear risk of mis-selling as well if the distributor doesn't explain all of this nuance and the risks that Radhika is speaking of?
I say that the beauty is we are at the beginning of the whole thing, and a lot of that responsibility lies on us MCs to form partners who will go out and propagate the risk. I mean, while we were discussing this, I was reflecting on myself as a salesperson. When I started my career, I was very afraid of talking about risks. But as I became more open about talking about risks, I developed better partnerships and better investors. And hence they stay with us longer, as simple as that. Till we are not afraid or think that risk is a bad thing, risk is actually the best thing that we can talk about. The more the customer understands, the bigger the wallet share will be. And so at the beginning, I think a lot of that responsibility lies with us. And like Radhika said, I think all of us will put our efforts to educate people. And more important, I think it's also to tie up with people who will understand and propagate it in the right manner. That responsibility lies with us, I think.
So now let me ask you, what do you think will the sales pitch be? I'm sure your teams are already working on this. And when we talk about risk-adjusted return, see, the mutual fund investor over the years is very clearly understood. Stay in equity funds, and I'm talking only equity right now. Stay invested 5, 6, 7-year period. 12 to 14%, you know, maybe in good years, 15%, basically 12, 13% compounded CAGR. We've, you know, come to understand this and internalize it. Explains how SIFs are still steady in volatile markets as well. So what is the pitch going to be to the SIF investor now? What should be a realistic risk-adjusted return to watch out for?
See, finally, there is a pyramid of the investor breakup. I mean, at the bottom is participation, where you come in and buy the market, right? Above that, you come into a mutual fund category, which is broadly I can say on the verge of being a commoditized product because it's very similar to each other. Above that, you come for these pretty specialized and very skilled kind of products, which PMS AIF were reached to a certain extent, and we now come into that entire picture. An investor has to choose where he or she wants to be, right? And then it's that mitigation of risk which defines a better investor.
See, but Swaroop is not talking about the risk-adjusted
average return
expectation.
See, there is this cliched.
He should not talk about
it. There is that cliched statement that higher the risk, higher the return. The statement should be higher the risk, higher should be the return.
Absolutely.
Now, in these three parameters, if the risk-adjusted return is not higher, then why should the investor
go
come?
For it?
It's up to us to come and say that because you are taking this additional risk, hence the chances of this return being higher are there. And that's something which we have to demonstrate. Right now, it's not right to talk because we have to demonstrate it and build track record. I'm sure the talent of the industry is such, and we are coming to it after 20, 25 years of doing that same business. But now, since we have the flexibility, maybe my initial thought is a lot of us will approach it with a little bit of caution, but then the fund managers will be free to express themselves. And trust me, the same manager will express himself or herself far broader than what we used to. So when this product unfolds and the communication becomes clear, clearly the need for a person to go up the risk ladder will also be justified is the simple point I'm making.
Almost running out of time, but Radhika, very quickly on this point of return expectations, and I'm saying compounding, 5 years if someone is in this product, it would be fair to expect I don't know, maybe at least more than 13-14%? Because MFs are giving you 12-13%, right?
So here's where I disagree, and I'm glad Swaroop didn't answer the question, because when the question is asked in a normal mutual fund, what is your return expectation? Kitna return dega? This is India. I go crazy because I'm like, kaun sa mutual fund? Mutual fund can be small cap fund and it can also be equity savings fund. And expectations are very different. Now, mutual fund has a wide variety of categories. SIF is so much wider. So
the equity SIFs, let's
I'm
say.
telling you, in an equity SIF, which has 80% equity exposure versus an equity SIF that's long short and has 20% exposure, the return will be very different. So at least our intent with this is, under Altipa, one, we're not going to rush to fill all 7 categories in one go. This is not NFO central. Each category, in my view, requires very different capabilities. It's not like you have a consumption fund and a healthcare fund and an IT fund and mid and small. Each category is a different capability. We'll launch a category, educate on the so if we're launching something in the hybrid category, we'll educate on the nuances of that category. What's the right time horizon? What's the risk you're taking? What's the return you could get compared to a traditional instrument? What could go wrong? And we'll do that for a while.
Okay. Out of time, I realize we need many more classrooms. The journey has only begun, right?
Yes.
But in 10 seconds, broadly, taxation is similar to what we have in mutual funds, right? As of now.
Product.
It's a mutual fund product with a new set of rules.
New set of rules.
Or different category of mutual funds.
Okay, fantastic. I think this is a great starting point, and thank you very much, because now we have some, opening thoughts and understanding of what this new, lovely little animal is going to look like, and how it evolves is something that we have to watch out for. Thanks very much, and this is already an open invite for a round 2, maybe a couple of weeks down the line, when some of these strategies start coming to market, and that's when we really need to pay attention and understand what they are and whether they suit our risk profile or not. Thanks very much, Radhika and Swaroop, for joining in. Promises to be, the first of many, many conversations on specialized investment funds. Well, viewers, with that, we have to take your leave. Do keep sending us your feedback, comments, and queries. See you again next week.
Let's talk money.
Hello and welcome to this special edition of Voices from the Valley. I'm Shireen Bhan, and we're coming to you from the Cognizant office in San Francisco. And this is also home to Cognizant's AI lab. Now remember, Cognizant has made a pretty bold bet on AI, $1 billion bet that is. Joining us now to talk about how that's paying off for the company is Surya Gumadi, the president of Cognizant for Americas, and also the man who is, of course, responsible for the AI lab, the CTO for AI, Babak Hojat. Thank you very much, gentlemen, for joining us here on this edition of Voices from the Valley. It's great to have you back on the program.
Thank you, Shireen. First of all, welcome to the Golden State. And thank you for taking time to visit our AI labs here in San Francisco today.
And this is what I want to talk to you about, this big $1 billion bet that Cognizant has decided to make on AI. And I think it brings to bear the larger question facing Indian IT services companies today. In an AI world, how relevant will Indian IT services companies be?
I think, they're going to be very relevant. First of all, the $1 billion bet that we made was in 3 dimensions.
Yeah.
Getting a talent ready for the AI era, getting the infrastructure ready, which is the AI labs, and then, building solutions, custom solutions for our clients. The Indian IT services companies are right in the middle of building those solutions, whether it is getting the data ready for the AI era or building the AI relevant solutions. And The $1 billion bet we have made is paying off really well for us. And our clients are loving it, our markets are loving it, and we like it, and we are doubling down on that.
You are doubling down on that. So the question that everyone is asking at this point in time, is this going to be an existential crisis?